stats and the positioning in the market right now. Nigel, over to you.
Well, today's session's got the ingredients of being actually a good one, and we like to end actually closer to the high point of the day. This has Washington as well as Tehran. They appear to be heading towards making an attempt to draw a peace plan, which is great news for equity markets, right? Which, we're also looking at a bit of a risk on sentiment because Brent, the dollar index, as well as the 10-year yields, all of them have cooled off in comparison to where we closed last evening. Yesterday, there was a bit of a mild pullback in the rupee as well, and I'd like to see more of the same because that will be the first cue that the FIs are tracking since they have been selling lock, stock and barrel. Yesterday's number as well was close to around $1 billion in terms of selling, the cash market data that we get in terms of the FI selling. And in March itself, they have already sold more than 1 lakh crore rupees. That's the first time ever in a single month they've sold more than 1 lakh crore rupees. On the index futures, well, they unwound some long positions. They added some mild shorts as well, but takes the short positioning to around that 86% odd. In absolute terms, the FI shorts as well as the client longs, they're at opposite ends of the spectrum. And normally this combination is not such a bad thing. The FI is aggressively net short around 2.5 lakh contracts, while the clients net long at around 1.5 lakh contracts or thereabouts. There was some writing that was seen yet again at higher calls, 22,900, 23,000 call. And just punching in these premiums that we're looking at, we get a bit of a level. The resistance zone should come in going by these premiums at around ballpark 23,350, 23,400 odd. And this resistance mark actually tallies in with the highs that we saw last week. Just the recent highs in that vicinity of around 23,350 to around 23,400 or thereabouts. The lows as well are going to be important. This week's low, well, that's going to be the important mark you're looking at. And the April low as well is crucial, though we shouldn't break this zone on the downside. My gut is, that Liberation Day low of around 21,700, that will not breach. Just going by the cues that we see, I don't think that we should be getting to that mark itself. Well, we'll also be keeping an eye out on the volatility index. Yesterday that cooled off a little bit, but you wanted to cool off more substantially, closer to around that 20-odd mark. Remember, a few sessions ago, it did breach that 20 mark. Now, in terms of sectors that I'm looking at, the last few days, metal prices, stocks, they have cooled down because the fear of demand destruction came back. So that index actually could bounce back because the attention will move back now to supply constraints. We'll keep an eye out on that one. Yesterday it was up close to around 2%, but I think, we could, this one will be in focus yet again. And stocks that I'll be looking at, Sun TV, post the big IPL deals that we saw overnight, X of the cash balance, X of the valuation you'll give to an IPL business, their core broadcasting business could be valued at just 2 to around 3,000 crores odd. So a technical, tactical bounce is what we could expect on Sun TV in today's trading session. And some gold prices have not just stabilized, they have bounced back. Muthoot Finance has actually seen a sharp correction from around that 4,000 rupee odd mark. That could be another stock to track in today's trading session. Net, Gift Nifty suggesting a gap up. I think by the end of today, you'll want to see this sort of gains of around 200 to around 250 points. It's got the ingredients of a good session. Let's see whether we get it.
Thank you very much for that. And yesterday we closed around that 22,900 mark. With that opening of about 150 odd points, we will get very close to the resistance level of 23,000, 23,100. Let's see whether we have the firepower to conquer that resistance level once we get that gap up opening. But let's get to the equity calls then. Venugopal Garre of Bernstein says they retain their view that lack of a support back home for the US, the heavy losses that US have already incurred, elevated crude prices, midterm elections in the US, all this should eventually put an end to the conflict, which according to them is unlikely to last beyond April. However, he says that because of the conflict, things have changed structurally. The damage at some of the oil and gas infrastructure means the issue is no longer incidental to the opening of Strait of Hormuz. The recovery may take time, anywhere from a few days for facilities which are shut down as a precaution to months where facilities have been damaged. Moreover, Bernstein expects several nations to up their buying and shore up petroleum reserves once the situation eases. All this basically means that crude prices are likely to remain elevated this year, even though it returns to below $100 per barrel. They see realistic chances of inflation breaching the 6% mark this summer. Rate cut expectations get pushed out for at least 2 more quarters, and GDP growth may taper. Taking this into account, Bernstein has cut the year-end Nifty target to 26,000. Well, moving on now to what the exact statements and quotes coming in from Trump. Remember, US has sent Iran a 15-point plan that requires Iran to dismantle its 3 main nuclear sites and end any enrichment on Iranian soil. The document calls to suspend its ballistic missile work and curb support for proxies and fully reopen the Strait of Hormuz. President Trump says that Iran is going to make a deal and that US is dealing with the right people. Listen in.
They're going to make a deal. They did something yesterday that was amazing, actually. They gave us a present, and the present arrived today. And it was a very big present worth a tremendous amount of money. And I'm not going to tell you what that present is, but it was a very significant prize. And they gave it to us, and they said they were going to give it. So that meant one thing to me: we're dealing with the right people. It was oil and gas related. And it was a very nice thing they did. But what it showed me is that we're dealing with the right people. Look, if we can end this without more lives being down, without knocking out $10 billion electric plants that are brand new and the apple of their eye, I'd like to be able to do that, you know. But they can't have certain things. I mean, you know the things. I don't have to go over the list, but again, it starts with no nuclear weapons, and they've agreed to that. There won't be any nuclear weapons. They're not going to have, and they're not going to have enrichment, any of those things. But look, I hate to say that we're in a very good bargaining position, and I hate to say that they're defenseless because, you know, until that last missile is fired, they have little power. But we are in about the best bargaining position. We're way ahead of schedule. And again, they have no Navy and they have no Air Force and they have no missile protection, and most of their missiles are gone. Most of their launches we've killed. The fact that they're talking to us and they're talking sense. And remember, it all starts with they cannot have a nuclear weapon. Just, you know, I said yesterday, they said, what are the top 10? I said, well, number 1, 2, and 3 is they can't have a nuclear weapon. They've agreed they will never have a nuclear weapon. They've agreed to that.
Well, is this the beginning of a potential de-escalation phase in the market? And can that result in a sustained risk on? That's the question for the equities. Cameron Brand, Director of Research at EPFR Global, now joins in. Cameron, first, you want to tell us what's the chatter? What's this present, which is worth tremendous amount of money, oil and gas related?
I think people have been expecting that Trump will push for a de-escalation for some time. I think people have actually been over here surprised that things have gone as long as they have. The chatter over here, to sort of answer your broader question, goes a fair bit beyond the events in Iran. Before the hostilities commenced, there was already a pretty big and diverse wall of worry that markets, well, U.S. markets weren't climbing them, they were kind of crawling across the top. And those haven't really gone away. And in fact, one of them, inflation, stagflation, the events in Iran and their impact on energy prices have given it more legs, more oomph. But I think, even when and if hostilities begin to move towards an end game here, that things are not going to sort of magically right themselves here. There's a lot of other issues that people are concerned about. Whether AI can deliver on its enormous promises and enormous expenditures. We have midterm elections coming up, which will probably change the what is possible in economic policy terms. We're wrestling with sort of another mini government shutdown.
Okay.
So there's a lot of chatter here, but a surprising amount of it deals with stuff other than the Iran conflict.
Okay. Cameron, you track the flows very closely. Since the start of the conflict, can you summarize the kind of flows we've seen in and out, the U.S. markets, emerging markets, and then India in particular?
Yes, I can. The winners, if that's ever the right term to use in these situations, have been U.S. Treasury funds and fund groups promising income streams. So dividend equity funds, for instance, have done very well. But for the most part, I'll get to India in a second. It's been a sort of an up and down grind. People haven't fled from the fund positions they held, but they've definitely adjusted them. They've gone up and down. India was among the group of markets and funds dedicated to India that did get hit quite hard. Turkey was another market that people factored in the worst case scenario from higher energy prices and the needs for imports. In the case of India, what we've seen within the emerging Asian universe is a very clear rotation out of India and mainland China funds into especially Korea equity funds. Korea seems to be the great hope at the moment, a reform story, an AI story, a defense story. And we've seen several weekly inflow records already this quarter.
Hi, Cameron. Good to see you in. Cameron, what about precious metals? There were a lot of flows that were going out there, and suddenly you had gold prices that pulled back close to around 20%. Did you see some kind of withdrawal of flows, or, what are your observations? Flows not as strong as what we saw earlier?
No, flows definitely not as strong as we saw earlier. I mean, I think in part, gold bugs had got their retaliation in early. They were already positioned for a pretty bad outcome. There's a number of narratives surrounding why prices retreated. Certainly, we saw some stepped up margin calls here, and gold is an asset you can liquidate quickly if you have to meet those. But as I've said before, and it hasn't actually played out this way, but certainly when the shooting started, the expectation was that it would be short and sharp. And people actually, what we saw here was people more focused on not overreacting than taking strong moves in the way you might expect.
Cameron, we'll leave the conversation here. Thank you very much for joining in. A quick check across Asia before we proceed. It's a strong risk-on start across Asian markets this Wednesday morning. So we're seeing broad-based gains of about 2.5–3% coming through for the Japanese markets, the Taiwanese markets. Hang Seng did well yesterday, and today it's followed up with a 0.6% move. But the other markets, which we're not showing, Nikkei and Korea, they too are up between 2 to 3% as headlines seem to suggest some optimism surrounding de-escalation after this conflict has gone on for nearly 1 month. GIFT Nifty implied open 150 points up. Let's tell our viewers then the interactions lined up on the show. 8:35 we'll be joined by Jignanshu Gore of Bernstein to discuss the platform charge revision by Eternal Swiggy. 9 a.m. Abneesh Roy of Nuvama will discuss United Spirits sale of RCB, the IPL team. 9:20 we have a special conversation with Nomura's think tank, Sayan Mukherjee and Orodeep Nandi. Following that, Nirmal Bang of IIFL Finance will be chatting with us 9:40 to discuss their credit guarantee scheme gold loan business. 10:15 a.m. Indianomics, Lata will discuss the impact of higher oil prices on India's growth story with Shantanu Sen Gupta of Goldman Sachs.
Time to slip into a quick break. We've got a lot of stock-specific action to track for you. We get to that in just a bit in our special Top 10 segment, but I give you a sneak peek. We look at United Spirits, Sun TV, RPSG Ventures, Saman Capital, IGL, MGL, Gujarat Gas, OMCs, Indiglobe Aviation, and Gold Financiers. All of them will be reacting to positive news flow.
Welcome back. Our research team is standing by with CNBC TV 18's list of top stocks for the day. And the big one is all the news surrounding IPL, United Spirits, Sun TV in focus. Manglam, take it from the top.
That's correct. You know, so after months of speculation, bidding wars and discussions, etc., finally RCB has a new buyer. And this came hours after Rajasthan Royals was sold to Carl Somani and the likes as well. RCB has been sold by United Spirits for about $1.78 billion or 16,600 crores to Aditya Birla Group Brookfield-led consortium along with Times Internet. And remember, this, while a big value unlocking is what we've seen, it's pretty much in line with analyst expectations of $1.5 to $2 billion. Most on the street were ascribing 15% as an SOTP valuation, and RCB is at around 17% of United Spirits' current market cap. The important thing, it's a business that does about 500 crores of annual revenue with 50% margins. For United Spirits shareholders, what is the net proceeds after this sale, post expenses and taxes, and how much is the amount that the company is going to distribute to shareholders will determine how it goes from here on. Analysts have expected if the company does a 100% payout, it could actually be 199 rupees per share as a one-time dividend. Even if they choose to keep 50%, it could mean a 100 rupee one-time dividend coming in for United Spirits shareholders. The important part, however, is that while it will be a positive for United Spirits, it's also set a benchmark for all the other IPL teams. And in the listed play, we have Sun TV, which owns SRH. And if you ascribe a valuation of nearly $1.5 billion to that, it amounts to about 65% of its market cap, X of cash. You know, the other businesses that the company has could be very attractive. And alongside that, we have RPSG Ventures as well, which owns about 51% stake in Lucknow Supergiants. So account for that and holding company discount, it could be actually over 200% of its current market cap. So positive for United Spirits, but an even bigger positive for Sun TV and RPSG Ventures.
Thank you. You know, in 2008, when Vijay Mallya won, it was $111 million, or about a little less than 500 crore rupees. Today, they've sold it for 16,700 crore, a 35x return in 18 years, and no other asset class would have given you that kind of outsized return. This is in rupee, in dollars, of course, a little less in actual multiples, but...
I'll just quickly weigh in on one, because India Cements is a company that I track very closely. You know, when this entire controversy broke out on IPL, the shareholder said, we want this business out of the core business. And today, the IPL franchise is valued more than what India Cements is. So when it went ex-IPL team, the adjustment was 1.5 or 2 rupees. And today, in fact, you know, that entity, the 1.5, 2 rupees, is actually valued at around 300 rupees for those that held on. So funny things happen, but clearly big value unlocking there in the IPL space.
It's one of the, we're a cricket-crazy country.
Yeah.
That is the fundamental truth. And second, of course, is the fact that sports franchises, around the world are very, very highly valued.
$5, $6, $10 billion at least. I know we're talking about $1.5, $2 billion. So
it's valued, as Manglam said, right? I think the first half of the year, the revenues were 600 crore rupees. You annualize it, you get to 1,000, 1,200. Of course, again, now it'll go up. But you're selling it at 15, 16 times revenue.
Yeah.
So incredible valuations.
Absolutely. Well, the other big story today is going to be Saman Capital. Ritu's here. The RBI approval has come through. Ritu, take it away.
Hi, Prashant. Yes, it was long awaited. Remember, the deal was announced in October, and now RBI has finally given the go-ahead for this deal with Abu Dhabi's IHC for, what is going to be the largest such investment by a Gulf nation into the NBFC space in India. Now, RBI's approval is for an acquisition of up to 66.6% stake in Sammaan by Avinair Investment, which is IHC's wholly owned subsidiary. Besides this, RBI has also cleared the appointment of IHC's Alvin Crosser as a director in the company's management for 5 years. Now, Sammaan says Avinair is going to invest about 8,850 crores, as they had previously announced, in the company through a preferential issue. So after that, Avinair is going to end up holding about 41.23% stake in the company. And once they complete the open offer as well, the stake is expected to rise all the way to 63.36% within, the limit that has been approved by RBI. But keep in mind, while the RBI approval is through, the SEBI approval is still pending for the deal closure. So that is the next one to watch out for. There are also some conditions that are attached to the deal. For instance, Sammaan, of course, cannot raise any public deposits. It is a non-deposit taking NBFC. The share transfer has to be completed within 1 year or the approval lapses. And if, the ownership falls below 26% after the transaction, Avinair will require fresh RBI approval to increase stake beyond 26%. So the long-awaited Sammaan deal getting the green flag from RBI. The focus, however, will now move to Shriram MUFG, and more importantly, RBL Bank Emirates NBD deals that are still pending a go-ahead from RBI.
Thank you very much for that. IGL, MGL, Gujarat Gas. Every day we track these oil and gas names. Sudarshan joins in with more.
So government's new notification can be a huge volume boost for these city gas companies of IGL, Gujarat Gas, MGL, as well as GAIL, because of West Asia war impact and the impact on Gulf facilities, the damage that it had seen. Government believes that LPG and LNG supplies can be constrained for a long period of time. And to make sure that that burden does not increase on the consumers, government has asked city gas companies, or basically notifies the rule to lay the gas pipelines, and also has asked oil marketing companies to inform consumers that their LPG supplies can be halted in 3 months if they do not respond to the notice of switching to PNG. And also they have laid out a uniform framework that addresses access to land, delays in grant, high fee and charges. So if you talk about the approval, land access and right of way will be approved in 3 working days, and domestic PNG connectivity will be done in 2 days. So it can be a huge volume boost as far as city gas companies are concerned.
Okay, all right. Thanks a lot for that, sir. Going across to Manisha, she's here to tell us about the drop we've seen in crude oil prices and the spike we've seen in gold. Morning, Manisha.
Morning, Nigel. Thank you so much for that. Well, I'll start with the crude oil prices first, where we've seen the futures gain up by nearly, decline rather, by 6 to 7% towards 98 a barrel. This is after there are reports that U.S. is pursuing diplomatic efforts to end war with Iran. There also is a conversation about seeking a 1-month ceasefire, and the U.S. also has sent Iran a 15-point proposal to resolve the conflict. Iran also says that they will allow passage of non-hostile vessels via Strait of Hormuz, and this is really the biggest thing markets have been looking at. Remember, it is 25 days now that the Strait of Hormuz is shut, and the vessel passage has been only at 130 of a number, which is fraction of what normally the traffic is at Strait of Hormuz. So this is a big one, and that has eased the prices slightly. Not just crude oil. If you look at heating oil, that is down 5%. Gasoline prices trading 6% on the lower side. Coal is declined by nearly 3% in the Asian markets as well. So everything that has to do with energy seems to be easing down. But there is strong gains coming back for the precious metal prices. Gold, for example, is gained 2% back towards 4,600. In this week itself, we saw the prices at $4,000 an ounce as well. So strong gains coming in for that one. We are looking at expectations that the major central banks may raise interest rates. That would continue to weigh onto the prices, but at this point in time, there is strong short covering coming in this one.
Thank you very much for that. Let's do a quick recap then of the top stocks. Stocks with positive news flow are United Spirits, Sun TV, RPSG Ventures, Saman Capital, IGL, MGL, Gujarat Gas, oil marketing companies, Interglobe Aviation, gold financiers. And no stock today on our radar is likely to open in the red. Here's what we'll do. We'll slip into a short break. On the other side, we'll connect with Jignanshu Gaurav Bernstein, and we'll discuss the hike in the platform, the platform fees by companies like Eternal and Swiggy, and what it means for them.
Welcome back. You're tuned into Bazaar Morning Call. Well, it's that part of the show when Hormuz joins us to tell us about the big movers yesterday and some of them that were backed with good delivery. Hormuz, take it away.
Good morning, Nigel. And a lot of the focus yesterday was on the beaten down large cap names that staged a bit of a rebound in yesterday's trading session. We'll start off with, of course, HDFC Bank. As a stock snapped a 4-day losing streak in yesterday's trading session, gained almost 3%. And volumes, though, this gain was down for the third straight session. It was the lowest in the last 5 to 6 sessions. And the turnover on Tuesday was almost 66% lower than what it was on the 19th of March when the news first broke out and the stock had declined. And the percentage of delivery also was the lowest in the last 6 sessions. 6 crore shares were traded yesterday. The 20-day average is around 5 crore shares. Around 56% of the shares are marked for delivery, so around about 3.5 crore shares. 20-day average of around 3 crores, so almost at par, if not more. And the stock, despite that bit of a recovery that you saw yesterday, is still down around 14% for the month of March. Now, L&T was the other one. It was the top Nifty gainer yesterday, along with Indigo. The volumes, though, on the flip side, contrary to HDFC Bank, were the highest in the last 6 sessions. 60 lakh shares were traded. The 20-day average is around 45 lakh shares. The delivery volumes, though, were less than 50% for the first time in the last 11 trading sessions. 30 lakh shares were traded, 20-day average of around 27 lakh shares. And even then, even till date, it's still the second worst performing stock on the Nifty for the month of March, is down around 18%. And the other one from the broader markets yesterday that did well was Vishal Megamart. There was an upgrade that came in from Ambit on Monday. The stock reacted to that yesterday. The biggest single day gain since April of last year. Close to 3 crore shares were traded. The 20-day average is around 1.8 crore shares. The third lowest delivery volumes, though, in the month of March, close to 40% of those shares were marked for delivery. So around 1 crore shares, the 20-day average of around 90 lakh. And during Monday's fall, the stock had slipped below 100 rupees for the first time since March of last year. And from there, it staged a bit of a rebound yesterday. And from the post-listing highs, which is close to around 160 rupees, the stock is still down 30% from those levels.
Okay, all right, Hormuz, thank you very much for that. Appreciate it. So that is perspective on a bunch of names where there were sharp moves yesterday. Well, let's bring in Jignanshu Gaur, who is now joining in. Remember, food delivery is getting pricier, and Swiggy, Zomato have hiked platform fees. Swiggy has raised their fee to 17.5 odd rupees from about 15 earlier. Zomato has also gone up to about 15. What's going on? I mean, how to read some of these? At the end of the day, there is perhaps also the issue of restaurants, cutting back on the length of their menus and all kinds of disruptions, of course, because of this LPG shortage. And of course, at the other side, there's this inflation shock. Jignanshu, good morning. Jignanshu is Director and Senior Research Analyst at Bernstein. So look at this in totality from an investor point of view. Jignanshu, what does this mean?
Thank you so much for having me here, Prashant. I think from an investor perspective, this is a logical approach, what both Eternal and Swiggy are doing. And it is an expected progression for an oligopoly two-player market, where the growth rates are now no longer the internet growth rates of 40, 50, or even 100%, but a more stable growth rate of around 18 to 20%. And hence, the objective of both the players is to ensure that they recoup all the investments that have been made in building these platforms and building these brands. So far, we've seen most of the income come from restaurant commissions, which have sort of been on an uptrend from 2019 to 2023. And since then, the focus has shifted on monetizing consumers.
So, Jignanshu, with this latest increase in the platform fee charges by Eternal and Swiggy, by how much do the earnings estimates get revised higher? Can you take us through the new numbers? And then, basis that, what will the valuation stand at?
Sure. So firstly, the platform fees today for both Zomato and Swiggy on food delivery are broadly same. The difference that you see is because they represent the GST differently. Swiggy shows it inclusive of GST, whereas Zomato shows GST in a separate line item. So both are around 14.9 to 15 rupees today. This is an increase of 2.5 rupees in the case of Zomato, approximately. Their EBITDA per order for last quarter for food delivery was between 20 and 22 rupees. So this, if it translates fully, is a 10% increase in EBITDA. But typically, we have seen it does not translate fully, roughly half translates. So we can expect a 4 to 5 rupees improvement in EBITDA for Zomato. For Swiggy, this is slightly higher because their EBITDA per order is lower than that of Zomato. So for Swiggy, the increase in EBITDA is higher. So it's around 7 to 9% EBITDA increase because if this food delivery fee translates to EBITDA in the same way that it has done in the past.
And why
Typically,
doesn't
they
the
plow this
entire
back.
amount? Why doesn't the entire amount get translated? You said only typically half of it gets translated to EBITDA.
So historically, over the last few quarters, where the gross platform fees have gone up, the net platform fees which they recognize are lower because they give rebates and discounts, and some of it is used for additional marketing support.
Okay, so for Zomato, the EBITDA increase is 4 to 5%, actual that we should expect, and for Swiggy, it's 7 to 9% post this revision.
Yes.
And therefore,
Yes.
now EPS estimates go up. What would the PE multiples look like?
See, the stocks have corrected materially right over the last 2 to 3 months, along with the broader market. So food delivery generally trades at 35 odd multiple on F28 EBITDA. It's still not earnings multiple because we do
Correct.
SOTP. Yeah. So that 35 multiple has sort of derated today to 30, and that helps the earnings narrative as we go into Q4 earnings.
All right. Hi, Jignanshu. Good to see you. Well, QCOM is way bigger for Eternal than Swiggy. But, periodically you see this argument that the valuation gap should not be so large. If you could help us out, what is the current valuation gap? And do you see a case of that narrowing a little bit?
Yes. So see, Zomato's today there is significant valuation gap by our SOTP, not looking at the current market price. But at our SOTP, we value Zomato's or Eternal's quick commerce businesses around $12 to $14 billion, whereas Swiggy for us is close to around $4 to $5 billion. Right? So we do believe fundamentally that the valuation gap will narrow, but the timeline for that needs to depend on how the competitive intensity is. From a 7-player market, we possibly need to see a scenario where there are 3 large credible players emerge, and today it is unclear who those additional players except Blinkit will be.
So, Jignanshu, one final question related to this. Have we seen any hit on demand? We haven't heard of any large mass-scale restaurants being shut down, like it was in the case of COVID. And at that time, it didn't really hit the demand. But you would have spoken to the companies. Has there been any impact on demand and therefore revenues?
Across food delivery or even quick commerce, QSR platforms, we haven't seen a material impact in demand. Demand has shifted as Prashant was mentioning. There has been menu curtailment across restaurants. So that demand has shifted to other restaurants. Larger restaurants have benefited because they have the greater ability to purchase LPG from the market, which smaller players may not have. And hence, QSRs have benefited at the expense of some of the smaller players. But at a food delivery platform, because you have so many restaurants, somebody or the other is available to fulfill demand. So far, they haven't seen any curtailment in demand.
Okay, all right. We'll leave it there. By the way, in your coverage universe, since we have you on, Jignanshu, beg your pardon, anything else which looks attractive? Everything has fallen. Anything which has come into buyable zone?
We continue to retain our ratings, specifically beyond Eternal and Swiggy on DMart, on Titan, and on Trent. However, we feel that the broader consumption is sort of not the key narrative today, right? The stocks, markets, everything is reacting, and I think that considering we might be entering an inflationary era again over the next few quarters, how the consumer demand revives remains to be seen. So while they look fundamentally attractive today, it's a good place to add both, I would say, DMart as well as Titan.
All right.
Beside
DMart and Titan, right?
Yeah.
Got that. Talk to you again soon, Jignanshu. Thanks for coming on this morning and running us through your views on the quick commerce players, but of course other consumer names as well. We'll take a break. We are back and Deven Choksi should be with us on the other side. So more stocks. There's about 15 minutes to go for the pre-open session. Stay tuned.
Welcome back. Deven Choksi is now joining in on the show. Deven, the stock to watch today would be United Spirits. Yesterday, also, the stock gained close to about 4%. And this is that much-awaited corporate sports M&A deal. And what fantastic valuations. $1.78 billion for United Spirits. So they're going to get that windfall. They could use it to pare down their debt, a special dividend for investments. Are you a shareholder in United Spirits? If you're not, would you advise buying United Spirits now with this large war chest that they have?
Yeah, Nima, good morning. No, I'm not a shareholder and neither we track this company enough. So I think we refrain from putting any particular view on United Spirits per se. But the most important part, I think this franchise is getting valued at about $1.8 billion, as you say. I think this is so very important because I think when you start looking at this business, which up till now has been given on the sidelines, I think different other franchisees are also expected to reflect, I think, some valuation somewhere in the books of the parent companies. And that's where probably I think one would like to take this particular valuation as a benchmark valuation, at least to begin with in this IPL season. And from that perspective, probably I think you would see how exactly I think the reflection would happen for players like Chennai Super King or for that matter Mumbai Indians among others as far as I think the valuation is concerned. We believe that I think it's a good valuation which is getting established at current levels.
All right. Hi, David. I think the bigger stock of the day could actually be Sun TV. And the reason I say that is because the market capitalization is ballpark around 24,000 crores. The cash in their books is around 8,000 crores. If you put in there the IPL franchise valued at 12, 13, 14,000 crores or whatever, the core business, you're getting it at around 2 to around 3,000 crores for a company that has an EBITDA of around 2,000 crores. The big question is, will they unlock value at some point of time and will the shareholder get some part of that value? That's going to be very, very important. For today, you can have a bit of a tactical bounce. What's your view on Sun TV? The stock has not done anything. Intent from the promoter, something as well that the shareholders are waiting for. Do you think at around 600 rupees you'll be interested, or too much of uncertainty?
And Nigel, I'm glad that I think we immediately connected the point I think which we were discussing up till now. I think as I was alluding, many of the parent companies would start finding this particular valuation, which is getting established in RCB's case, I think reflecting into their books, and the possibilities will start getting opened up. Not too sure at this point of time whether the Sun Group is going to take the advantage of this particular valuation, probably unlock the value. But you're absolutely right. I think if they do so, then the cash in the balance sheet would be quite handsome. And probably I think that could be the new trigger point. But at this point of time, it can only lead to further speculation because I think neither the company nor we have any kind of clarity on whether they would possibly go with the unlocking of the valuation. But if they do so, I guess I think this is going to be a new trend that we'll be seeing in the next 2 years or so. Wherein many of the franchise owners, I think, would start unlocking part of their valuation, and it could start getting reflected in some books, if not everywhere.
And this Saman Capital, do you look at it, that RBI approval has come through?
Not really. I think haven't looked into it, so I think we'll probably discuss at a later point of time.
Okay. If we are closer to the end of the war and the situation starts normalizing, Devin, what would you recommend buying? Because many stocks have fallen 10, 15, 20% from the start of the conflict just in this month, in the month of March. Which stocks would you advise buying now? What are you recommending to your own clients?
If you are immediately looking at, I think, next 1 week or so, I think probably the IT stocks will participate fast. I think that is what I understand. Rest of the other companies which are fundamentally so strong, I think they would start participating, but gradually. For example, I think likes of Bajaj Auto, for example, likes of Larsen. Reliance has already held strong. I think so that company remains relatively more clearer from the larger market cap perspective. Even some of the financials in particular, I think the larger banks, I think this could be the time when they would start finding themselves into 3 to 5% appreciation. Should I think the market give a bounce back, and maybe it's a bounce back to around 23,600, 700 odd levels. If it does happen, then I think some of them would start participating and maybe I think reflecting at least around 3 to 5% kind of a gain in the current stock prices.
Okay, all right. Devin, the other big question is going to be gold has bottomed out and will it return back to its winning ways? Now, the stock in focus is going to be some of these gold financiers, case in point being a Muthoot Finance. The stock in the last, I think, month or so, it's corrected from 4,000 rupees to around 3,000 rupees. Now, gold has bounced. Will you be interested? Mind you, the stock is not cheap. Or do you believe maybe you want to play it via Manappuram or IIFL Finance?
Nigel, I think we have been clear up till now that I think we don't prefer a gold theme in the NBFC per se. We are very clear that I think our comfort level stays largely with the larger part of the retail theme in the NBFC space, and that's where probably I think we feel that I think there is the money to make. The correction in the stock prices of some of the larger ones like Bajaj Finance has also taken place, and that poses bigger opportunity to me with a good amount of certainty. Vis-a-vis, I think, a pure play gold finance company. So we stay away from it and we continue to put our weight behind the NBFCs, which are purely consumer finance companies.
You said IT is best placed now if you want to capture the upside in the near term, if the situation were to normalize. Any particular stocks you'd like to highlight in IT?
So in the large caps, I think the Infosys would definitely one can expect, I think, a faster bounce back in companies like Infosys. And so would be the situation with Persistent as well as, I think, HCL Tech. So from a perspective of looking very selective, I think these companies could possibly show a relatively first move advantage, I think, because of the kind of price advantage that you are having. TCS is, I think, somewhere closer. I think it could also probably participate into this kind of an upside. Not completely sure about the mid-tier IT companies immediately, but yes, I think some of the mid-tier IT companies which are in embedded technology, I think they are relatively, I think, better placed comparatively. So one can selectively look at, I think, few names.
CLSA today has come out with a high conviction outperform rating on Coforge. They hosted their CEO, Sudhir Singh, to just discuss the AI narrative, etc. And Coforge's positioning is that AI is not going to be deflationary for service providers who have both domain and technical knowledge. So I guess he, constitutes Coforge in that bracket. So saying that AI is not going to be deflationary for all companies, perhaps that includes Coforge. And CLSA adds that this is a company which is going to see mid-teens US dollar revenue growth. It's trading at 20 times forward PE multiple, which means the PEG ratio is closer to 1 times forward versus historical 7-year average at 1.8 times. So CLSA making the case that valuations for Coforge are attractive, growth will be there, mid-teens US dollar revenue growth, and therefore a high conviction outperform rating. Their target price is double of the current market price at 2,278.
Okay, all right. Devin, a quick question on a couple of other names as well. We just spoke about the gold financiers. What about the metal stocks? I recall you were quite positive on stocks like Vedanta, and that gave very, very good returns. Now the stock has pulled back a little bit. The structural theme of deficit aluminium could continue. The last few days we've been focusing on demand destruction. Are you interested in Vedanta, or has it run its course? I think from the time you first spoke about it, it's up 30%.
We continue to remain bullish on the metal as a space, not for 1-2 quarters, but I think we feel that it is going to be a multi-quarter stories, where probably I think some of the metal commodity companies would remain from both on the demand side, and most importantly, some of the Indian companies which are basically putting in the mix of renewable energy into their energy consumption, they are going to have the profit margin advantage also coming along. So not too sure immediately whether we would like to buy Vedanta at this point of time. But yes, I think the price correction does mean some amount of interest once again returning back into the stock. We continue to hold and we'll continue to hold. That is what our take would be as far as the portfolio position is concerned on Vedanta.
All right. Thank you very much for that. We'll take a break here and we'll come back with some technical trading ideas. We also have Abneesh Roy of Novama to talk to us about the United Spirits' sale of Royal Challengers Bengaluru. And of course, as I said, Mitesh and Somal Mehta is going to be with us for those trading ideas. Stay tuned. Coming up. All right, I think 3 minutes out from the pre-open session to kick off. Somal Mehta is with us, the Mirae Asset Share Khan, and we also have Mitesh Thakkar of Bonanza with us. Gentlemen, good morning. Great to have both of you here. The GIFT Nifty implied open is what, 100 points, maybe a little more. Mitesh, what would you do?
Morning, Prashant. So I think, like yesterday, the level which I'm watching on the upside is 23, 114, 120. Yesterday kind of went till about 23,057 and tapered off slightly to close mildly lower than the day's high. And I think today also we'll approach that gap down which happened on Monday. So I think till we start getting past 23,120, I think I'll not go aggressively long. But yes, what we've done is that we've reduced our short exposure, taken profits on the short side positions, and on individual stock side, exploring some long trades.
Okay. We also have Saman Mehta now joining in. Samal, would you also explore long trades? And what would you advise after that gap up?
Good morning to everyone. Yes, absolutely. Expecting a bounce till 23,250, which is the 10-daily exponential moving average, and I'll be expecting this bounce to continue if it sustains about 23,250. Overall, the trend still remains negative. We are making low top, low bottom on monthly, quarterly charts, which is negative for the overall trend. But in this overall trend, I'll be expecting a good bounce in the next coming 1 week. The bounce could go up till 20 daily exponential moving average, which is very close to 23,900, 24,000. But we'll go step by step. Once it crosses about 23,250, that will be the right time to take a bigger call. Infosys, IT stocks and power stocks are looking good. So yes, expecting a good bounce.
Okay. Mitesh, what stocks would you go with?
So, I've been recommending some IT stocks yesterday, and Tech is one which features on the list today. So buy with a stop at 1359 for targets of 1400. Buy on some of the crude related stocks like Asian Paints, which I would recommend buying with a stop below 2194 for targets of 2260. BPCL was a buy yesterday. Today repeating the buy with a fresh stop at 276 for an extended target of 295. And a buy on Eternal with a stop at 233 or just below it at a target of around 248.
Okay, I remember yesterday it was Infosys which was a buy for you, and today you've added HCL Tech to the long list. Saumil, which stocks would you go with?
I have Infosys as well in my list. So Infosys has been consolidating for last 3 or 4 trading sessions, and yesterday it gave an uptick, crossing the previous swing high, which is a great sign for the stock. I'll be expecting a good bounce here. The momentum indicators have already given a buy signal. So the target for me would be 1360 on Infosys, and stop loss would be 1215. The second stock which I have chosen is Cummins India, and Cummins has been consolidating for a little while now, taking support at lower end of the Bollinger Band on the daily charts and 40 daily moving average, which is a very good sign. Good setup here, a triangular pattern on the daily charts. Stop loss would be 4,500 and target would be 4,900.
Okay, thank you very much for that. We'll come back to you for some more 9-10 calls. For now, let's talk about United Spirits. It's announced that it's entered into a definitive agreement for the sale of 100% equity stake held in its wholly owned subsidiary RCB to a consortium for a total consideration of 16,600 crore rupees. Manglam joins in with the details. Manglam.
Well, after months of speculation, bidding wars and a lot of discussion around it, United Spirits has finally entered the deal to sell RCB to a consortium of Aditya Birla Group. There is Blackstone along with Bolt Ventures and Times Internet. The stock is higher in pre-open, but most on the street, were valuing this business between $1.5 to $2 billion, and the deal has happened at around $1.78 billion as well. Forms about 15 to 17% of their current SOTP and understandably their market cap as well. What needs to be seen from here on is what proportion of this money is paid out to investors in the form of a special dividend. If 100% payout is done post-tax, then it could amount to nearly 200 crores per share, 200 rupees per share as a dividend. If 50% is paid out, it's about 100 rupees per share as dividend. But the bigger impact that we're seeing is on all the other listed companies. Sun TV, for one, has SRH. And now that the valuation for IPL teams has been formalized around that $1.5 to $1.8 billion, given the sort of deal that we saw in RR as well. This amounts to about 65% of their market cap. And LSG, which is owned in part by RPSG Ventures at around 51%, if you apply holding company discount, that company too has a market cap of around 2,000 crores. It would mean that the value of the IPL team itself for them is about 250% of their current market cap. Not to say that there will be a big jump on either of these shares, but there would be a rub-off impact definitely basis this deal.
Thank you very much for that. We now have Abneesh Roy, Executive Director, Nuvama Institutional Equities, now joining in. Abneesh, big deal. Finally, it's landed. Give us your initial thoughts and what it means for United Spirits.
Yeah, hi, good morning. Yes, good deal. So we have a buy call on United Spirits. Clearly, the overhang of deal not happening because of the geopolitical issue, that gets resolved. Plus, if you see, the Jaipur team also got sold yesterday. So this is almost more than 1,000 crores higher. Apart from this, if you really see, the actual deal value is almost close to 18,000 crores. If we consider the 500 crore, 550 crore of the women's cricket team, which will need to be paid to the BCCI, which obviously will get paid by the new owner. Apart from this, the 5% which gets paid to BCCI, that also will be paid by the new owner. So the real deal valuation for entire thing is closer to 18,000 crore. Yes, for United Spirits, now we need to see out of the 16,900 crore, what will be the dividend payout? Clearly, higher focus will happen. Our sense is the dividend could be in the range of 100 to 150 rupee. But yes, 6 months left for the transaction. On the fundamental side, also clearly what we see is Karnataka is a big positive for all the liquor companies because of the more favorable taxation and policy in FY27. And UK FTA, the Scotch RM benefit will kick in from Q2, hopefully, if the UK Parliament gets approval. Also, with crude cooling off, I think the glass cost and ethanol cost risk of inflation, that also cools off. We need to monitor that. In Q4, the results will be weak for United Spirits because of Maharashtra, but that is already factored in because stock has cooled off from 1650 to 1330. So our sense is it can go back to the 1650 level in the next 1 year. So we are positive on the company.
Dividend of 100 to 150 rupees, how much of that will be utilized? I mean, from the entire cash kitty of 17,000 crore rupees, how much goes towards dividend if they pay out, say, 150 rupees?
Yes, so how it works is essentially we need to see the taxation. We'll await for more clarity on that. If we apply, say, a broad maths of, say, 15% long-term capital gains, and then we also see what will be the, say, dividend payout. Last year, FY25, they paid a dividend payout of around 23%, but that was the initial years when United Spirits has come back to dividend. My sense is this will be a one-time dividend, much higher payout than the 23%, because Diageo globally is looking at clearly rewarding its own shareholders. So because Diageo is the owner, I think the minority shareholder of United Spirits will also get the same benefit. So based on that, I think it works out to 100 to 150 rupee on taxation and the payout. If we assume different scenario, it's a good number. On a 1330 rupee stock, if you see 100 to 150 rupee is a very good number, but it will take time. 6 months approval time is needed because BCCI and CCI approval is needed, but it's going to be in that ballpark range. We await for more clarity from the board and from the taxation impact on this.
These two deals will reset the valuation of all the IPL teams. So now you have Sun TV, which has taken Sunrisers Hyderabad. You have RPSG with LSG. What happens to the valuation of Sun TV and any of the RPSG stocks?
You're absolutely right. From a near term, it will be a sentimental positive for those two stocks also. But ultimately, you have to do the deal for the real value unlock. So United Spirits has done the deal. So it will be a near term sentimental impact for Sun TV because, as Mangalam rightly highlighted, almost 65% of the market cap is from the deal itself. And then you have the fundamental side of the business also. And that applies for the other name also. But that's a sentimental positive because they are not selling it. It's a paper wealth. It is not a real wealth. Till the transaction happens, it's a sentimental positive. But for United Spirits, we clearly see positives emerging because of this deal, Karnataka and UK FTA.
Okay. All right. Abneesh, thanks a lot for joining. Abneesh, just a quick word on the other alcohol beverage companies. What's the preference out there? As you said, you had a buy call in United Spirits. But what's the preference? So there, United Breweries, there was a bit of a tailwind that was announced in the Karnataka just a couple of months or so ago. So your preference in the other alcohol companies?
So absolutely. So we are positive in the space, but in Q4, because 6 days of rains happened in North and East India, my sense is all the summer categories like beer, carbonated drinks, even Imami will see that impact of 6 days. But FY27, the base becomes very favorable for United Breweries. Plus the Karnataka benefit is there. So yes, it's a FY27 call. So from near term, we'll prefer United Spirits. We'll also prefer Allied Blenders because they also will see that UK FTA benefit. Plus Q4, we see better numbers versus a Q3 where Telangana impact was there. So UB is more of a one-year call, but United Spirits and Allied Blenders, I think in the near term can do better.
Okay, thank you, Abneesh, for joining in. Always helpful to get your perspective in. So United Spirits stock in focus, 100 to 150 rupees of a potential dividend, but 6 months later down the year, once the deal is finally concluded, is what he expects for United Spirits. In pre-open, at least, it's just up close to about less than 1%, but it was up 4%. Yesterday. In pre-open, the Nifty is up about 150 points, which positions it exactly at about the 23,050 mark. We'd added 400 points in yesterday's trading session. Today, there is another 150 points, which potentially gets added. Mid-caps in pre-open at least seem to be doing a lot better. M&M looks to be the big star. Eicher Motors, Interglobe Aviation, stocks impacted by the war, the conflict, are the ones rebounding hard. Mitesh is back with us. Mitesh, your 9-10 call?
Yeah, I think I'll go with the buy on HCL Tech.
HCL Tech. Okay. Sudarshan is now joining in with the brokerage call of the day.
So I'll start with delivery. UBS has a buy call with a target price of 600 rupees per share. It says headwinds are behind and now all eyes would be on profitable growth. Three issues that had been ailing delivery. First, impact of quick commerce on e-commerce volume. Second, insourcing by Meesho. And third, heightened competition from private equity-backed logistics players. And UBS believes that all of those issues are now behind delivery. Bernstein has initiated coverage on majority of the power companies, have outperformed call on Adani Power, JSW Energy and Tata Power, and underperformed call on NTPC Green. It says India's energy security has been tested twice recently, first by disruptions around Russian oil, now by the Iran war. And like China, India is resource poor in oil and gas, but resource rich in coal and sector. This makes electrification the real structural answer as far as the power sector is concerned. Nomura has initiated coverage on Sagility with a buy call and target here is 55 rupees per share. It's a key beneficiary of AI and payer margin constraints fueling outsourcing demand and growth momentum. It expects 20% EPS CAGR over FY26-28.
Thank you very much for that. Mitesh, the stocks which have gotten hit, at least in the large cap space, are these auto names. So Tata Motors passenger vehicles, Tata Motors CV, Maruti. These are stocks still down 15-20% from the start of the conflict in this month. Would they be positioned well for a rebound?
For a rebound, yes. I think for a bigger reversal, I need to see some accumulation which is missing. So I think, for the timing, I'll classify a move on these stocks as a bounce back. They should at least give a pullback to their 20-day averages. But for a broader reversal, I think there's still some more time.
And Eternal was a buy for you, right? Eternal was one of the recommendations. What's the target price?
So the initial target which I'm looking at is about 248. If you look at the chart also, there was on the 27th of January a low made around 253. That's the next target. So 248, 253. In a good case scenario, even 264.
248 and then 264 on Eternal. And Swiggy's chart?
Swiggy, I think Swiggy compared to Eternal isn't a very strong chart for the time being. But if it can start closing about 285, 286, then I think a short-term reversal will be signaled for a target of around 305.
Okay, all right. Quick word, Mitesh, on Reliance Industries. That's the one that's been holding one end up. What's the view out there? It's been facing resistance, I think, at around that 200 DMA, which is ballpark around 1,450.
Also, I think, around 1,450 is a pivot weekly closing, which we got on the 6th of February, and a couple of weekly averages. So I think in the short term, I'm actually looking at a rally till about 1,450. A move beyond 1,450, 1,460 would be even more positive for this stock.
Okay. Once again, let's just pull up the Asian markets to see whether the gains are sustaining. There was strong follow-on buying seen across Asian markets this morning. Taiwan still up 2.5%. Nikkei holding up similarly with a gain of about 2%. Kospi is moderated a bit, but still up smartly 1.5%. The Hang Seng Index is just up close to about 0.2%. The implied open, the Nifty has settled with a gain of 150 points post the pre-open. IT stocks should be tracked this morning. Generally, a lot of analysts and experts are calling that after the kind of correction that we've seen, it's poised for a bit of a rebound, a tactical rebound, maybe of 15 to 20%. But the proof of the pudding will be in their FY27 guidance, and that we'll know in the early part of April when Infosys and HCL Tech announces their guidance, whether the guidance signals that perhaps the AI-related fears are overdone or not, and there is going to be growth acceleration in FY27 as the street is hopeful for. Mitesh, anything in the mid-cap IT space that catches your attention?
In fact, I was hearing you guys out discussing Coforge, and Coforge, I think for the first time is showing signs of some base building around the 1070 to about 1150 mark. In the short term, of course, 1150 becomes the first pivot, but if the stock starts getting past that, then I think a very strong rebound to about 1350 could happen.
Okay, 1.7% higher. Let's just put the GIFT Nifty up and see where we are. Sorry, the end of the pre-open up and see where we are starting. So it's 150 odd points, 23,064, 23,067. So remember, day before yesterday there was that sell-off, 600 point sell-off, and of course after that is when the President Trump's tweet came. The lower end of basically the low on Friday, the gap from Friday to Monday, the lower end is 2367. That is the first resistance, and we are opening right there at the 23,067 level, which is the lower end of the gap, which perhaps will get filled, and hopefully we won't have to sort of tread lower once again. But these are volatile times, and the amount of news flow, of course, makes the head spin. But you've got to keep an eye out on this, especially if you're trading, if you're investing. It's a little easier, I guess. Not entirely, but certainly you're not dependent on day-to-day headlines or headlines which change every hour. I think we are hitting market open at any time now, and we'll just stay with prices, look at large caps, look at where the Nifty 50 are opening, and I think it should be largely in the green. Tomorrow is a market holiday, by the way, so that makes it interesting. 23,068, 23,080, 23,100, so it's about 0.75% higher. You've got Nifty Bank, which is starting about 1% up, I think. And you've got the small cap index, which is up 0.8. The mid cap index will come up on your screen. I think there's some gains there as well. Yeah, so that's the picture. 570 points on the mid-cap index, and it's a decent start all told. Shriram Finance, Mahindra and Mahindra, Ultratech, and SBI, and Tata Motors Passenger Vehicle. I mean, these are some of the top gainers. So bulk of everything is opening on the Nifty heat map in the green. And you got some IT stocks which are coming off. Tech Mahindra, Infosys, Wipro, TCS, HCL Tech, etc. ONGC is there as well, as oil's cooled off a little bit. But otherwise, I mean, it's a pretty good start. Above 23,100 in the first 1 minute of market open. Rima.
Well, and it's also conquered yesterday's intraday high, which was 23,057. So straight away open with a gain of about 200 points on hopes of de-escalation, the end of the war. Plus, today is the monthly expiry of the Sensex. It got preponed to today because tomorrow is a holiday, and crude prices have also eased, and that is supportive. So 23,100 plus on the Nifty. Right on top, you've got Shriram Finance. That stock is rebounding. Auto names across the board are seeing buying. So whether it's Tata Motors or M&M, Eternal has now gained nearly 4.5% so far this week as the company raises platform fees. And Bernstein was telling us that this should help push their EBITDA by 4 to 5%. Ultratech Sammaan also on the buyers list. In terms of banks, the Nifty Banking Index is open strong, very strong. 1.5% up on the Nifty Banking Index and crossed the 53,000 mark. Buying visible in HDFC Bank, that's up 1.5%, while State Bank of India also in the green. Trend, Titan on the gainers list. Hindalco also looking smart. Actually, more or less, it's all in the green, barring 3 IT names, which are under pressure. Tech Mahindra seeing some profit booking. Yesterday, it was resilient. Infosys, HCL Tech also subdued in trade. So that's the large cap action for you. To quickly turn our attention to the mid-cap space, United Spirits is in focus on the back of the deal. Well, it's a subdued start, just up nearly 0.5% on United Spirits, though RPSG Ventures is the one which is getting re-rated, 15% up on RPSG Ventures, and Sun TV has surged 4.5%. For United Spirits, perhaps the trade played out yesterday and it was long awaited, though it's a landmark deal with very, very high valuations. Oil marketing companies too are continuing with their rebound. IOC, HPCL, BPCL, all up in the green.
All right, Rima, just a quick point on Sun TV. The very fact that the stock is up only around 4%, the street still doesn't believe there's going to be any big value unlocking exercise. Otherwise, the core business is valued at around 2 to around 3,000 crores for a company that does an EBITDA of around 2,000 crores or thereabouts. So that's why the stock is up only around 4%. If the management can indicate there will be some kind of value unlocking in a particular time duration, then maybe the street will give it some value. But otherwise, they have cash in the books, they have an IPL franchise, and yet the stock is, the market capitalization is only around 25,000 crores. The other one is Aventil, a small company, 3,000 crores market cap. They won an order of around 450 crores. I don't think they've done 450 crores of revenues in an entire year. So that stock as well is up close to around 10% as we speak. Big up move is what we're seeing on that particular name. And PG Electroplast, that's one of the stocks of the morning. They had indicated that they're pulling back on production because of unavailability of gas. They seem to have found an alternative out there. The street was trying to sniff this piece of news, and that one opens up. Gap up 8% higher. We'll try to get in the management either today or the next trading session to get some clarity with regard to how much will this alternate energy cost them. But for the time being, the street is celebrating that. Prashant.
Absolutely, and I think it's a pretty good start, right? 23,150 is where we are at right now. Well, Sayan Mukherjee is with us, and he's MD and Head of Equity Research at Nomura, and we'll be shortly joined by the economist at Nomura as well, Aurodeep Nandi, who should be with us shortly. But let's just kick this conversation off. Sayan, great to have you with us here. Thank you very much for joining us. So no one knows how this is going to play out, so forget about that, I think. But given the damage to markets, Sayan, are now, what are you telling clients? Are things at attractive levels? Is there interest? There is interest. I mean, that much we gauge from people that we speak with day in and day out. But is that translating into people putting money in yet?
So actually, yeah, you're right. So, it's very difficult to take a call. But if we just look back, let's say the situation which was there during the start of the Russia-Ukraine war, the market bottomed at somewhere around just below 17 times one-year forward earnings. Today we are at just above 17.5 times. So we have seen around 10% correction. And if I remember correctly, that time it was around 13%. So in that context, the markets kind of bottomed along with the peak that we had on crude that time. So from a risk reward perspective, if we were to believe that eventually this is going to sort of settle and we would have a lower crude oil price, the risk reward looks attractive. So maybe we can argue for a 5-7% downside from the current level, and then we can build from there. But just from a geopolitical perspective, this is a lot more concerning, let's say, compared to the Russia-Ukraine crisis, because we are talking about almost 20% of oil and gas trade is flowing to the Strait of Hormuz. That compares to 8 to 10% contribution that Russia had. And that time we didn't have supply disruptions. So now you have situations where, some industries are getting impacted, because of availability of gas, for instance. So I think from that perspective, it's more concerning. So if this were to stretch longer, then we may have to, deal with somewhat of a lower valuation than what we had in the past. So that's my, concern here. But yes, if we were to factor in a resolution, then it definitely the risk reward looks better at a market level from here.
So you're saying 6-7% downside is possible?
Yes.
But these are reasonable levels to start to dip in. And because, you're not going to be able to time the absolute bottom in any case, right?
So, yeah. So I think, what I'm saying is that for India, right, and for the Indian economy, for corporate earnings as well, crude at $100 or crude at, let's say, $70, there's a lot of, I think that point in the past, actually, when we had the Russia-Ukraine crisis, I think the expectation of crude staying higher for longer was not that high. This time around, I think, the situation is a lot worse. So you could see, let's say, even after the conflict ends, if there are sort of tension out there, there is always a fear of escalation. Countries may start building up strategic reserves, so there would be higher demand. So there's a possibility that the crude, prices stick higher for longer. The economy the corporates, they haven't dealt with 100+ crude prices for a very, very long time. So the system is not tuned to that level of price. So that kind of a readjustment would mean lower earnings, and to that extent, it could have an impact on the market. So I think I'm concerned till sort of the whole thing sort of resolves and we get the confidence that we are surely going back to, let's say, $60, $70 a barrel.
So about 10 days back, Sayan, you lowered the target price, the Nifty year-end target price, to 24,900 versus 29,300. So to get to 24,900 base case, what are you assuming in terms of crude prices and the impact on earnings?
Yes. So we are looking at somewhere around 7% reduction in earnings, assuming that crude prices remain elevated for, let's say, half the year. Now, of course, if it extends for the full year, the impact would be quite high. So, today, if you look at, most people are expecting the nominal GDP to grow at something like 10, 11%. And if I look at the consensus expectation on earnings, it's around 16%. Now, the question, I think, is, can we beat nominal GDP by that much of a margin? We were at a cyclical upturn, right? I mean, if I look at last quarter's earnings, there were signs of pickup, even in corporate capex, initial signs. So that upturn could have helped us beat nominal GDP by a fair bit. Now that gets stalled because of this uncertainty. So I therefore feel that we may see earnings cut, even if this thing gets resolved, because there would be a lingering tension out there. So to that extent, we think that somewhere around mid to slightly higher single-digit earnings cut is a possibility. So that's what gets factored in our, the target price that you mentioned.
Okay, and when you say crude prices will be elevated for at least half the year, we're looking at 80, 90 or?
Yeah, around 90. Around 90. Our view is that, I think that, let's say if you get crude somewhere around 80 or 85, the damage can be contained within the oil and gas ecosystem, right? The OMCs may be taking all the burden, but the moment it's above 85, it sort of starts spilling over into the economy in terms of, let's say, excise duty cuts, which sort of impacts the fisc, or eventually translates into higher prices at the retail level. So we are factoring in somewhere, if you ask me, somewhere around 90, 95 as the number. Yeah.
All right, Sayan, good to have you in the studio, and thanks a lot for coming down. A couple of quick questions then. We've got one variable out of the way, that's in terms of what you're assuming on crude oil prices. But I wanted to ask you, in terms of the earnings growth, you said you'll have pulled back the earnings growth estimates. So as of now, you're working with high single-digit earnings growth? Got that. So that's out of the way. And in terms of private capex, do you think it's going to be a bit of a washout here because of the uncertainty? Maybe don't factor in any private capex growth, or are you working with maybe mid-single digits?
I think private capex has been weak for a while now.
But the hope was that it'll come back in the coming fiscal.
Yeah. So I think it will get delayed, most likely, but maybe to the second half as people wait and watch and see how the situation settles. So I would say it's going to be a sort of a it gets pushed out by maybe 6 months. Mm-hmm. So that's what we would assume in terms of private capex.
All right. The other big talking point has been the Indian rupee. And we go on focusing about the FI flows, that it's been negative, the holding in the Indian markets is down. And for the month of March, the outflow has been more than 1 lakh crore rupees, something that we have never ever seen. What about the Indian rupee? In your interactions with clients and your expectations as well, do you think the rupee has overshot itself a little bit on the downside? And what are you all working with in terms of a range on the Indian rupee?
So, I think last 2 fiscal year, right? I mean, this year is about to end. We had seen in the secondary market almost $25-30 billion of FII, outflows consistently. And now on top of it, you have the higher crude oil prices, which sort of manifests in higher trade deficit. There are concerns on remittances as well, as So I would say this is a healthy adjustment which is happening in the rupee.
Okay.
Because, see, from an FII perspective, right, we have been saying why FIs are not engaging in India and they're not coming.
They're losing on the currency.
Yeah. So I think, either the currency settles or the valuations in the broader market, comes down.
Come down to par.
So, yeah. The combination of the both sort of makes good case for FIs to come back. So I think in that context, it's a healthy correction, which is sort of which should be expected, I would say.
But do you think the stage is set with the kind of currency depreciation that we have seen, the valuation adjustment, and now hopefully earnings growth comes back, maybe to not to the extent that we thought about earlier? Is the stage set for the FIs to come back?
Yeah. So, FIs have been sort of negative on India for the last couple of years. So it started off with a really high valuation, cyclical slowdown we had in growth in India. And then last year it's been about AI, right? I mean, starting off with India being not a AI play to being considered as an AI loser, right? So I think the valuation threshold for FIs are relatively lower. I think another 5 to 10% correction in the markets, I think makes the risk reward pretty favorable. And by that time, I think if we see some of the AI trade sort of peaking out and fatigue setting in, I think that could be a good point for FIs to meaningfully engage in India.
Talk to us, Sayan, about some, for the lack of a better word, Teflon coated stocks, some winners out of all of this, even right now, without the, where damage is already in, right? I mean, everything gets indiscriminately sold, and lots of stuff has gotten indiscriminately sold. Valuations are more attractive. Stuff that you've upgraded recently. I think you've upgraded Sagility, one name this morning.
Yeah, we initiated, yeah.
You initiated, sorry, yes. But just 4-5 names where you think, there's value already.
Yeah, so, I'm sort of constrained sort of taking
stuff
individual...
you publish.
Yeah. No, so I think we haven't really changed much of our sector. You see, from a, portfolio construct perspective, what we said at the start of the year is that it's been a narrative-driven market for a while, right? So things get priced in very, very quickly. So, for instance, if you see last year we had a very strong return in auto sector, right? So we saw cyclical recovery and you saw upgrade in earnings and the valuations going up very fast. And then you start seeing sort of fatigue setting in. Even if the companies are delivering numbers, it doesn't really translate into equity returns, right? So our approach has been more selective, more valuation focused, and just not carry on with the narrative, right? So in that construct, I think, still sort of remains as we go through this period of volatility. So some of the segments, right, for instance, IT services, pharmaceuticals, which have not done well over the past, few years, I think are the ones where we are constructive because we have taken a view, let's say, on, IT services that AI would be an opportunity at some point in time, and the investors would start looking at this more constructively than what they are looking at it today. Similarly, pharma, we have seen generic cycle going through, there's not much expectation out there. And there are opportunities not only in the US, but outside US. Similarly, areas within manufacturing, like auto components, EMS, these are the areas where we have seen, where the stocks that bottom up we like, or we have seen significant correction in valuation, because the narrative is not necessarily that constructive. Other names to sort of, buy at the current moment.
But generally speaking, this is all export is where your focus is?
Yeah, so see the domestic story, we like, say, financials, right? That also has corrected, quite meaningfully. Again, if you look at these areas that I'm saying, it happens to be export focused, but these are the areas where there is a valuation comfort. There's not.
You don't like them because they're export focused. You just like them because of
yes.
specific reasons.
Yes.
For IT, would you, for viewers who are watching, right? Would it make sense to buy like a IT ETF or something and sit on it?
Yeah, it makes sense to buy. Or you see, there could be different winners in the cycle, right? So if one can look at some of the mid-cap names or the smaller names who on a smaller base can grow faster, maybe one can create a portfolio on that basis. But yes, overall, I think we think that even the large companies, the kind of relationships they have built with the enterprises.
Would be easy to replicate.
Yes, so I think they should have a meaningful play as the AI transition happens.
A counter to that, just on IT, is that, so today AI is hurting IT companies in terms of deflation. At some point of time, AI will generate new opportunities. It will be a net positive. But the point is, no one knows when that inflection point will come, whether it's 1 year, 2 years, or 3 years, or 4 years down the line, when AI generates new revenue for the Indian IT companies. And if it is, say, 2-3 years down the line, till then, IT companies could struggle in terms of growth.
Yeah, so no, that's very critical, right? I think if it remains deflationary for a very long period, I think...
I'm not saying necessarily deflationary. I'm saying that being a net positive for the Indian IT companies, where the impact of deflation is offset by incremental revenue, and therefore IT companies can grow.
So I would say, what we are working with is essentially that we are coming to a stage, because you're seeing, huge amount of capex being done by companies on this front. So ultimately, enterprises will start to use it, right? Even in our organizations, we see things moving now at a faster pace, right? People are using AI tools a lot more aggressively. So my sense is in the next 12 to 18 months, it would sort of pick a lot of momentum. Okay. And stocks will react before that. So I'm expecting that the narrative on IT services, the question, when is AI going to sort of negate the impact of deflation? I think 6-8 months down the line, that narrative would start to, that's what our expectation is.
Okay. All right. Also on pharma, because Sayan, you look at pharma very, very closely. Now, this whole generic semaglutide going off patent, that's created an entirely new mega category. We've been talking about the opportunity. Who are the winners, according to you, in this?
So I think India is the first market which sort of allowed generic semaglutide to enter, right? And the interesting thing is, this market has not been addressed by the innovators at all. So this market is going to sort of get created. Interestingly, it's a difficult product, so you don't have many players, right? So all the players who over the weekend sort of announced launch of the product in India. I think all of them, right? You look at Sun Pharma, Zydus, Natco, Dr. Reddy's, and host Alchem, host of companies of sort of all these are big pharma companies. I think being in the first wave, they would be able to establish their presence in India because it's going to be a branded market. And the same companies are going to address the international markets very soon. 80 countries are opening up, including some of the big ones like Canada. So, the reason we are positive, one of the reasons is, right, on positive on pharma is this opportunity, because at least for some of these companies, it could be quite meaningful in terms of top line.
But here, do we need to be selective, or do you think all these companies, because there are different strategies, someone's doing vials, someone could be in the manufacturing of the hardware, someone has greater distribution. Can you just buy, say, a pharma ETF?
Yeah, so I think everyone would benefit at some point, at some level or the other. But I think there are companies who are sort of integrated in terms of they control the supply chain, or there are companies, who have differentiated product. Like, for instance, Zydus has come up with a reusable pen, which is sort of differentiating. So there are these couple of companies, who have either of the two, right? Some differentiation in the product or control the supply chain. And the names that sort of launched or got approval in the last, week or so, I think those are the ones.
You want to name the big ones that you like?
Yeah, so, in our coverage universe, we like Dr. Reddy's. One of the reasons is India, but of course, they are expected to be a big beneficiary on the export markets, particularly an opportunity in Canada, so that can be very significant. The other names like Zydus is also we like because of the differentiated, product that they have, which we think would allow them to get a very good market share in India.
All right, so on the point on tech, I had Abhishek Bandari who joined us on Finding Alpha, and he explained it so beautifully, with regard to the way tech companies had pulled back and how valuations got relatively more attractive. And I think in this month itself, tech has actually outperformed what the other markets have done, because it's fallen less.
Yes.
That said, you briefly mentioned upon financials. What's your stance right now? Because that's the largest component both on the Nifty and for our markets as well, and that's where the FIs have the highest amount of interest. What is, where are you all leaning to? Because private banks have underperformed PSU banks, but now the valuation gap has got very, very narrow. So at current reckoning, what is the preference out there, private versus PSU banks? And what about some of these NBFCs? High pedigree names pulling back 15-20% as well.
Yeah, so we like, so I think the sell-off that you have seen on financials in this round is also I think because, there is a concern on the broader economy if, let's say, the oil prices remain elevated. I think that's what has led to the pullback in some of these financial names. And valuation is something which we feel comfortable across the board. Now, as you mentioned, right, incrementally, of course, PSUs have done very well. Their growth has been better.
Yes.
But I think at this point, given where the valuations are, we are more inclined towards private sector than PSUs. We have to also keep in mind the treasury yields sort of moving up, which also sort of hurts profits and earnings for PSUs more. So yes, our preference is and also NBFCs, the quality names which have the pedigree are available at a much attractive valuations today.
Okay, Aradeep is also with us. Aradeep, traffic?
Wrong address.
Oh my God, that's. So we'll do a quick rapid fire. What's the real GDP estimate, Aradeep? Have you cut it for India?
Yes, by 10 basis points to 7% for FY27.
7%?
Yes.
So, and where does that put you in terms of, have you looked at the where others are? Is it at the higher end, lower end? I saw one estimate from Goldman yesterday at 5.9 real.
Yeah, look, I mean, come crisis, come, a lot of doom and gloom. So is growth going to be hit? Absolutely. I think there are two uncertainties. One is how long this crisis will last, right? So I think, different people will have different estimates based on, how long crude oil prices remain high. And the second aspect is, look, ultimately, someone needs to bear the burden. It's either consumers, if it's passed on, and then it impacts growth. It's either oil marketing companies that absorb it on their
consumer, government or industry, basically.
Consumer, government or industry. And that will determine some of the impact on growth. I think just a couple of points which are worth mentioning. One is that this is a mix of the Russia-Ukraine crisis and the COVID crisis. So you've got price going high, and then you have shortages of gas for industries, and then for other industries that feed into other industries. So, for instance, I'm
hearing a lot of negatives, but the real GDP number is still 7%.
Yeah, but look, here's the thing. India is getting into this crisis from a good starting point, right? From Goldilocks situation. So we've been seeing high-frequency indicators sort of inflect and move better. We've seen credit growth move up. So the question that we ask ourselves is the following. Is this a short-term crisis? And if it is a short-term crisis, then what will happen like COVID is it goes down, and then once the shortages sort of normalize, it bounces up? Or if it's a longer-term one and there's demand destruction and jobs get impacted and employment gets impacted, then we are in a different scenario. So our current baseline is that we are not in that sphere as of now. Consequently, we think that, look, the fundamentals are strong. Growth momentum was there. Yes, there's a shock, but once this normalizes, hopefully that gives us some runway.
As Sayan was pointing out, 90 is the 90...
around 86 or so is our average.
For a while, for the next 6 months?
Well, I mean, we've taken an annual average. But, I mean, it's really difficult to predict oil prices now. It changes with tweets. So, but broadly, yes.
By 27 average, 86 is what you're assuming.
86 is our baseline.
With that, a 7% real growth, essentially.
Yeah.
Got that. Will... what does it do to, what the RBI does, and, the rupee is the other one, right? Or you think it's overshot and things will stabilize? All this stuff stabilizes?
Well, I mean, for RBI, this is an unenviable quadrant to be in, right? Do you focus on inflation, which is going to be the first hit in such a shock? Or do you, if you focus on inflation, then you might risk growth. Our call is that if this is the baseline, our inflation forecast, we've raised it from around 3.7, 3.8 to 4.5. Again, because you are coming from Goldilocks conditions, you have a longer runway for the RBI. So we think RBI will keep rates on hold for now because it is a supply side shock. Why do you have to hike at this point? However, if the inflation impact is much more, right? And so, for instance, if you're talking of a world of $100 and the government is forced to pass on prices down, then we could be in a rate hike situation. But as of now, I think it's sort of worth holding horses.
And with crude at 86, assuming that 86, 87, what happens to CAD and BOP?
So CAD, we've raised it by around 0.4 percentage points to 1.6% of GDP.
Manageable.
It's interesting you say that. Per se, historically speaking, 1.6, 1.7% of GDP seems manageable for India. Again, we don't know how high crude oil prices go, so it can go up to 2% or so in a worst case scenario. But the point is this. The issue with CAD is not how large it is, but what's happening on the capital account side. And I think you've been mentioning on the program in the past about FII outflows and net FDI being weak. So I think the vulnerability that comes on the external sector side is that, yes, CAD is manageable as far as historical trend is concerned. But, are we going to get enough capital flows to even, plug this gap?
Yeah. Aradeep and Sayan, thank you very much, both of you, for dropping by. And apologies if we sent you the wrong address. Aradeep, thank you. Good speaking with you. And Sayan, thank you very much for running us through the equity view. We'll take a break. Nirmal Jain of IIFL Finance on the other side. Stay tuned.
Welcome back. Well, let's focus on the lending space then. And to help us out with that discussion, we're currently joined by Mr. Nirmal Jain, the founder and MD of IIFL Finance, who joins us on the show. And we'll focus on three big points: the gold loan, the risk portfolio, LTV sensitivity, what's the path to MFI and Samasta profitability as well as the impact of the geopolitics on the cash flows as well. Hi, Mr. Jain. Good morning and good to see you. Ben, first up, before we get to the operational part of the business, I want to focus on the value unlocking part. Various reports indicate that you're looking at unlocking value in your microfinance business. Could you clarify on that? Because the recent report suggested that Piramal is in talks for a deal value of ballpark around 4,000 to 4,500 crores. Any truth out there?
No, I don't think, these are very speculative and, these are not, factually correct.
In fact, so no value unlocking in Samasta Finance. Is that correct?
Yeah, so we are looking at an investment, part divestment or an investor. But, the names that are being talked about in media are without any basis.
Okay, all right. But the valuation will be fair of around 4,500 crores?
No, even that I think is a little speculative because, that will come only when at a negotiating stage, not earlier.
So value unlocking possible?
And, I don't think anything is on the card. So because if any Earlier also when this media report had come in the newspaper, we had reported that these are speculative, and if there's any such development, then obviously being a listed company, will announce it to the exchanges public, first.
Okay.
So it's not that these kind of announcement can, happen, and we are always accessible to media. So I'm surprised that newspapers carry these kind of reports.
Vimal, are you? Good morning, Prashant here. Are you saying you can't tell us what's going on because it's non-public information, or are you saying nothing is happening?
It's more like nothing is happening, and whenever anything happens, then we first come and tell media and disclose, and then we take.
So it's both things. Nothing is happening, and you can't obviously. You have to disclose it to exchanges first. What about IIFL Capital, Nirmal? If I can go there, it was our story. We reported some time back. Actually, almost 8 months back, I think, that you were looking to get an investor in and looking to diverse stake. It's not the environment currently, the IPO market, secondary market, etc., everything has gone into freeze because of what's happening with the market per se. But is that on track?
No, even that has been very speculative. So, I was just making that point earlier that whether, it's CNBC, Money Control, ET, all the leading newspapers, we are always in touch with you guys. So you can always confirm rather than carrying any speculative news which is more sensational or in a rush. So whenever anything happens, we'll disclose it to the entire world together.
I think the response to that story when we carried the story, Nirmal, was no comments, and we carried that. So, but I take your point.
I really don't remember, but absolutely is not worthy of any comments even now.
But you're saying nothing. Capital is also not. There's nothing happening there.
Nothing happening at this point.
Are you not trying also?
No, we are not trying. See, our capital doesn't need capital investment because it's a high ROE business and it's cash flow sufficient. So it doesn't need capital at this point in time.
All right, Mr. Jain, just to clarify on Samasta, you said that the name is speculative as well as the valuation could be a little off. But you're looking at unlocking value, right, in Samasta?
See, the entire, as we have spoken in our earlier meetings or whatever, that, there are multiple ways to do this. It's not exactly unlocking value, but strategically, there are multiple ways to, whether we can demerge, we can get a private equity investor, but nothing is on the card. So actually, honestly speaking, all these news are completely speculative and it will be waste of time of your audience to discuss this, because nothing is happening.
Okay, all right. So we take your word for it in terms of nothing happening on Samasta, nothing happening on IIFL Capital as well. But since you briefly mentioned demerger, the home finance business, is there a possible demerger in the works? And should we expect that sometime in the near future?
Yeah, there's a possibility, but not imminent right now. At appropriate time at appropriate point in time, that can be taken up by the board.
All right. So would it be a particular scale that you're looking at, or in terms of that, or is it a time frame? The next 18 months, should we see the home finance division listed separately?
So there's a strategic refocus of the business. The business is being restructured. There are certain segments that we want to focus deeper, and there are certain segments that we just want to exit or not focus on. With a new CEO in place, last few months back, we have embarked upon our new strategy. So once that new business model is fully in place and is smoothly running, that's the time we can look at this entire process of demerger.
Okay.
So talking about business, we've seen a very sharp correction in gold and silver prices. Gold particularly has been a big driver of your growth and profitability. Now, because of the correction seen in gold prices, what is happening to your book? Incremental volume growth, has there been a pickup? What are the LTV numbers now looking like? And at what point would it be a concern?
So we have been very conservative. So even way before, much before if you see last month itself, our maximum price at the branches have been significantly lower than, the 75% threshold or the industry peers. And we have been able to get our business even at those conservative valuations. So today, even despite sharp correction in the gold prices, our portfolio LTV may be around 60-62%. Also, not only that, every bucket we track every day, and our discipline to collect interest on a monthly basis is always very helpful, so that we don't accumulate, the interest, which actually increases your LTV surreptitiously. I think we are fully comfortable in terms of our margin of safety in our gold business and our collateral. The incremental lending also continues fairly strong, regardless of. Actually, the gold price surge has been significantly more than what would have expected. That many times borrowers actually don't need the full value, and it's up to the lender to make sure that the cash flow assessment is done, and the lending is conservative. So the
what is the
strong volume
LTV?
growth or the demand, I think, is also driven by a slowdown in the unsecured lending, which has been the feature since the last year. So we don't see any let up in demand, but of course the valuations and the LTV, we have been very conservative.
LTV 62, Nirmal?
Is okay, I won't have a real-time number, but it's closer to 60, 61 or maybe 62, not beyond that.
Okay.
At portfolio level.
At a portfolio level. What would be...
Not only that, if you really look at gold, so you got a 33% cushion even at 75% level. And also you value gold, intrinsic gold. So the value to the customer, because of the design and the other component, is significantly higher. So, that way, I mean, this business is fairly safe from that point of view at this point in time.
Yeah. It's just that we had such an extraordinary run in gold prices and a bit of a sharp pullback now, back to where we were at the beginning of the year in terms of prices. In terms of the portfolio across the board, Nirmal, is there any stress at all because of what's happening, especially on the unsecured side or, MSME, SME? We just had a Nomura economist talking about and this is feedback generally we've heard from real estate players and so many other industry leaders that we've spoken with, that at the margin there are some supply chain issues, and we tend to focus on the larger stuff because that gets the most attention, but beneath the surface, I mean, for a business from a lending business, you'd see a lot more. So is there any stress?
So there are pockets of small businesses where there's a stress. I mean, not that the collection efficiency has been impacted, but even the demand has been deferred, or people are cautious, and we are also cautious. So first, the unsecured lending, we have kind of discontinued in terms of the new customers, or since, if in this quarter, we have not done much of unsecured lending. Even in secured lending, so if you look at the Morbi, the huge tile manufacturing in the entire business there, particularly the LPG based, are almost shut down. Number of restaurants also, there have been, there are quite a few restaurants, they're not running at full capacity or shut down. Similarly, there are some, the metal converters, coating units, some plastic manufacturers are impacted by raw material prices. So there are many small pockets of businesses that have been impacted by this. Having said that, most of our MSME businesses, retailers, traders, and the distributors, they are not much impacted. We see that the demand slowed down because the paint prices have gone up. So then the paint distributors are also showing caution. So I think at this point in time, there's a lot more caution across, and from the lender side as well as borrower side, and people are watching. So if these things get sorted out in next week or two, I think things are okay. If they get prolonged, then one has to really assess. I mean, the cascading impact of supply chain, can get much wider.
All right, Mr. Jain,
supply chain disruptions are real, and we are seeing segments impacted by this.
All right. Mr. Jain, in terms of your business, as the chart is telling us on the screen, you've grown your gold business phenomenally. Do you think it's time now to maybe taper down a little bit on growth and focus on profitability? Would that be a call that you're taking, given the kind of run-up that you're seeing in gold prices?
So, okay, we want to make sure that our compliance and risk is foolproof, and the growth is basically a function of market. So, our growth, this year also has been driven by the lower base, because the year before we were impacted by the RBI embargo, and obviously the gold book had depleted very rapidly, and now we are scaling up. And we also, and there have been tailwinds in this business because of the gold prices as well as strong demand from the economy. So at this point in time, we are cautiously growing. But getting into next year, I think the growth what we had this year obviously will not be repeated. It'll be far more normalized growth in FY27.
Okay, all right, Mr. Jain, I wanted to understand what's the update with regard to the IT order. You had released that a few months ago, and you had assured investors it's nothing to worry too much. But the stock price had cracked big time. Is there any update on that front? Any progress?
So I think that is going on track as scheduled. And, so I again reiterate that there's nothing extraordinary because the special audit was a result of the search that happened last year and that was recommended by the search team itself. So from our from our side, we are complied with, we've given all the details. And I think we expect the entire process to get over very soon.
It'll all be clear with, nothing to negatively impact IIFL Finance. Is that what you would like to tell your shareholders? Because the stock pullback, not 10, not 15%, more than 20%.
I mean, I really can't comment on the stock prices and the investors who buy and sell the stock. But I mean, that's something which is in the short term, markets has many more factors. But in the long term, fundamentals basically matter a lot. And at this point in time, our company as well as sector are in a sweet spot, and the growth and the profitability outlook, I think, is fairly good. And the income tax thing also, as I had earlier spoken, obviously the search happened and there is nothing to hide, as far as we are concerned in income. We report our income in an absolutely transparent and full manner. There's no non-disclosure of income that we ever do. And obviously, when the entire process is over, we believe and we are confident that the justice will prevail and the things will be as they are. So, and the entire process, I think there has been good support from our side, and even the special audit team has been very cooperative in working hard and long time over time to make sure that things get done quickly, and so is the income tax department. So I think we expect the entire process to conclude in very, very quickly.
Mr. Jain, pleasure speaking.
Timeline, but it will happen sooner than we expect.
Sooner than we expect. Thank you very much for joining in and talking about a whole range of issues. By the way, for the market, it's picking up now splendidly, now approaching 23,200. We opened with a gap up. The opening level was 23,067. If you had bought the gap up, you would be higher by 200 points now, and in a span of two trading sessions. Yesterday's 400 points and today's 360 points, we've moved up smartly. So it's a good rebound underway. Mid caps are outperforming. Advanced decline ratio, that's the telling story. 12 stocks advancing for 1 in the red. So across the board, there is some optimism. Ritu now joins in to talk more about Saman Capital.
Well, the RBI has finally given its go-ahead for the Saman Capital deal with Abu Dhabi's IHC for what's going to be one of the largest such investments from the Gulf region into the NBFC space in India. Now, RBI has approved the acquisition of up to 66.65% stake in Saman Capital by Avanair Investment, which is IHC's wholly owned subsidiary. Now, RBI has also cleared the appointment of IHC's Alvin Krasta as a director on the company's management for 5 years. Now, Saman Capital says Avanair is going to invest up to 8,850 crore rupees in the company through a preferential issue. So after that, Avanair is going to end up holding about 41.23% stake. And once the open offer is concluded, Avanair's stake will rise up to 63.36%, which is within that 66% approval granted by RBI. Now, keep in mind, the SEBI approval is still pending for the consummation of the transaction. Now, RBI has also attached some conditions to the deal. For instance, Saman Capital, which is a non-deposit-taking NBFC, cannot raise public deposits. The share transfer will have to be completed within 1 year or the approval lapses. And if the ownership falls below 26% after the transaction, Avanair is going to require a fresh RBI node to increase its ownership to 26% or more. So the much-awaited Sammaan deal finally getting the green flag from RBI. And the focus now moves on to Shriram MUFG and the RBL Bank Emirates NBD deals that are still pending a go-ahead from the RBI.
All right, Ritu, thank you very much for that. 10% locked up. Nagaraj Shetty is with us of HDFC Securities. We're going to take stock of the market and what you should do with the 1% pop that we have on the index. Nagaraj, index first.
Good morning, Prashant. Yes, rightly, the way index has bounced back in the last couple of sessions is amazing, is indicating that the market seems to have bounced back, made a bottom reversal somewhere around 22,500 level, which was the previous opening upside gap of 11th April 2025. So all set for a more rally. The indices are looking very attractive at this point of time. And I think I'm expecting 23,800 kind of a thing in the next few sessions, at least in the near term.
Stocks, Nagaraj?
Yeah, I have two stocks from the long side. First one is paper stock. Paper sector itself is looking very attractive at this point of time. West Coast paper mills, after a sharp up move, it has consolidated at the higher levels. Currently trading around 434 levels. One can look to buy at this point of time. Immediate upside target would be around 460, and one can place a stop loss at 420. And second one is from Angel One, broking side. Angel One, after a minor downward correction, has bounced back sharply in the last two sessions, placed at the edge of upside breakout of around 240 levels. Currently trading around 236. One can look to buy at this current market. Immediate target would be around 250, and one can place a stop loss at 230.
Thank you very much for that. Get into a break. On the other side, we'll talk commodities. Manisha Gupta will join in as always. Welcome back. Let's turn our attention now to commodities. Manisha is now joining in, and she's tracking the decline in crude and gas prices. Manisha.
Thank you for that. Well, yes, the latest statements coming in from the U.S. president, the negotiation that's happening between the both countries, that is Iran and U.S., is what seems to be leading big reactions in many of these commodities. Just to put in perspective on what we're looking at is the U.S. and Iran statements. To begin with, U.S. has said that they are pursuing talks with Iran and have sought 1 month of ceasefire therein. There also are reports that U.S. was pursuing diplomatic efforts to end war with Iran. It also is about Iran, and that is a bigger one, that Iran has now allowed passage of non-hostile vessels via the Strait of Hormuz. Remember, that place has been shut for 25 days now, and what we do understand from Kepler is that 130 ships is all that has passed through Strait of Hormuz in this 25 days, which is just a fraction of what the kind of traffic Strait of Hormuz does. So this being opened up, especially for the non-hostile vessels, is something that is seen as very, very positive. And we have seen some bit of that geopolitical premium ease out of prices. I'll start with the crude oil prices, and we have seen 6% of a decline in the Asian markets therein, 5% down now. Remember, we did see $115 a barrel of a high in this week. So from 115, we are trading at around 99 at this point in time. 98 is the kind of low that we saw in the early market as well. Having said that, we still are nearly 30 to 34% higher for the month of March when it comes to the crude oil prices. So when you look at those averages for the first quarter, that is still going to be on the higher side. Gasoline prices have seen a decline as well. Heating oil is down between 5 to 6% as well. But for both of these crude derivatives, the prices still are up anywhere between 25 to 35% for the month of March. Take a look at the coal prices, and we were trading at a 17-month high of $148 a ton in this week itself. Currently, we're looking at prices trading at $138. So $10 has been shaved off in the matter of 2 trading sessions in sense of coal prices also. Still 20% higher for the month of March. So all of these energy markets are trading much higher for the month of March. The last 24 hours definitely have seen some profit taking coming in. But there also are gains that we have seen come in for metals as a sector. For gold prices, the low that we saw in this week was nearly $4,100 an ounce. From that, $4,570 is where we are trading. So nearly $400 to $500 is what we've seen as a jump come in for the gold prices. This is in last 2 days again. 2.5% of gains on your screens there. For the month of March, though, the gold prices are down by 12%. Take a look at silver prices, and we're looking at 4 to 5% of gains coming in for that one as well. We did see a low of $60 an ounce in this week. We're trading at 73.5 right now. So that is a $13 of a jump up coming in for silver prices. For the month of March, we're still 30% on the weaker side.
All right, Manisha, thank you very much for that. We'll take a break. We are back on the other side. And Indianomics is coming up with my colleague Latha. So stay tuned for that. She'll be talking to Santanu Sen-Gupta of Goldman Sachs. Goldman has cut India's real GDP growth forecast to 5.9%. It's one of the sharpest cuts when we look at their Asia ranking. Stay tuned. That conversation coming up.
Welcome to Indianomics. The worst of the war may be behind us. Going by recent developments, Iran has said it will allow passage of non-hostile country ships through the Strait of Hormuz. A 15-point peace deal is reportedly being negotiated. Crude prices have fallen but are still pretty close to the $100 per barrel mark. In Indianomics today, we look at what can be the ramification for the India growth story, for India's inflation and rupee as well. We start with perhaps the top-line economist, Shantanu Sengupta, the economist from Goldman Sachs. Shantanu, good morning. Thank you very much for your time. These are very, very fluid times. But your base case is that perhaps crude is going to be about $110 for this, for March, April, and maybe $80 averaging for the year. With that assumption, what do you think will be the impact on India next year?
Yeah, thanks, Lata. I'll just lay out a bit of nuance to this assumption that, yes, indeed, we are averaging 110 in our forecast, assuming a 3-week further closure or less flow from the Strait of Hormuz, and thereafter a full recovery over the next month. And it slides down towards 80. But remember, the premium that India is paying in terms of the Middle Eastern crude is something that we have baked into our estimates. So we are baking in on an average a $10 premium that India probably will have to pay through the course of the year. With that, and with the fact that product cracks quite elevated, you look at gasoline, you look at gas oil, which is diesel, you look at
Okay. I think we have to reconnect with Shantanu. The point that Shantanu is making is that we have to not just look at the Brent price. The actual price that India is paying is, at some points in time, even $30, $40 more than what the Brent price is. We had, of course, a detailed presentation from many experts that at certain points in time, the price that India pays for Dubai crude or Oman crude goes as high as $150. So even if the Brent price, the card price, looks like a little south of $100, the price that India would be paying even today for crude that is so difficult to get shipped from the Strait of Hormuz could rise by a significant portion. So the assumption even for the next few months could be that the ships or the tankers are going to be a trickle. They are not going to be that 100 ships that usually go through the Strait of Hormuz during peace times. It's going to be perhaps, half of that, 1/4 of that before total normalcy is restored. And then there is also, a congestion at the ports, the fact that several refineries have been shut. And then there is the other problem of some production facilities being permanently damaged, like, for instance, Qatar Energy. So Qatar Gas could be an issue even if normalcy is restored in terms of the shipping lines in the Strait of Hormuz. So we are going to see some impact for India's GDP and inflation, like we will see for many Asian countries. We are still waiting for Shantanu Sengupta, the economist from Goldman Sachs. Are we lucky? Okay, we should be getting him anytime now. Let's do one thing. Let's digress and just look at how the markets are doing at this point in time. We are seeing the rupee starting off on a slightly difficult note, and the currency is still under a goodish bit of pressure. We should not expect the currency to start, appreciating anytime soon, for the simple reason that we have seen a record 1 lakh crore rupees of stocks being sold by foreign portfolio investors, which means, something like over $1 billion, something like $10 billion have been pulled out from the Indian equity markets. That's a very big drain on capital flows. So we are going to have a problem even if there is going to be some kind of a normalcy restored in the Strait of Hormuz. Okay, I think we have connected with Shantanu. Shantanu, let's start at the beginning. What kind of assumptions do you have for crude, and what will be the growth impact, first of all, on the Indian economy in FY27?
Yeah, so while the $110 a barrel in March, April, and the slide back towards $80 a barrel is correct by the end of the year, we are baking in a premium because of the Middle Eastern crude that India imports. and the fact that also the product cracks, especially diesel and jet kerosene, is elevated, means that this is going to have pass-throughs in terms of manufacturing input costs into food inflation eventually. So we have baked in 5.9% year over year for calendar 26 growth and slightly higher inflation, north of 4.5%. We are looking at 4.6% for the calendar year 26 on inflation. Importantly, by Q4, we think you head towards 6% on headline inflation, purely because core goods inflation, we think, will be grinding higher.
Okay, now, between the time of your writing and now, we have seen some peace steps being announced. I mean, all these could be withdrawn in a day. We know that these things are not done till they are completely signed and sealed. But assuming that, the straits do open in 3 weeks, do you think there can be an upside bias to this 5.9 GDP growth? Because that's a shocker. We always thought we will at least be able to maintain the 6 decimal point. Do you think there's an upward bias at least to the 5.9?
If the premiums come down, so the 3-week hence reopening of the Hormuz is what we are baking in any case in our baseline oil price forecast. If the premiums that we are assuming for the Middle Eastern crude goes away, that would mean upside bias to growth, yes, in the early 6% handle, slightly lower inflation, and definitely lower current account deficit, because the current account deficit ultimately has a direct pass-through of the oil price assumption that you have. We think it is going to be north of 2% of GDP, but if oil prices are lower, it will have a commensurate impact on the current account being smaller, deficit being smaller.
Okay. Let's stick with the current account deficit. Is there a good chance that if the war were to wind up a little quickly, we get a current account deficit that's slightly lower? Simply because, just as we will import for even strategic reserves, it is possible that even the Gulf states will export from us with some vengeance. For instance, some desperate things like rice is exported to Iran and to the Middle Eastern countries. So is it possible that there is again a downward bias to your 2% current account deficit, which clearly at the moment is the highest on the street?
The 2% current account deficit can be lower, purely because of oil, as you pointed out. On the exports to the region, I would say that if you just step back and think about the shock that has hit us, I mean, our integration with the Middle East is significantly higher than what it used to be 10 or 15 years back. You're about 14% of our exports, about 40% of our remittances come from the region. And the crude linkages and the gas linkages we already know. So I would imagine that the pressure on remittances later in the year and some exports remain, but oil price is the real mover in terms of the current account forecast. So if we assume that oil price is $10 lower for the year, that would automatically mean the current account deficit lower by in the region of like 30 or 40 basis points.
So what's the forecast for the rupee, Shantanu? We have seen, even at a time when we have 1% current account deficit like this year, we have not been able to find capital flows to fill the gap. So are we looking at a more than the normal 3% depreciation next year as well?
So on the rupee, we already have a 95 forecast over the 6-month plus horizon. Okay. And there's an upside bias to that forecast given the kind of current account numbers that I'm talking about. But I think I'll just point out that whether it is 1.5 or 2% current account deficit, you're looking at somewhere in the region of $60 to $80 billion of deficit and a very likely consecutive year of balance of payment deficit. Last year was one. This year also very likely will be one, unless we are able to figure out, either equity flows later in the year or maybe FDI flows and so on, which means that the drain on reserves, the pressure on the INR will remain forward in our view, just purely from the balance of payments, whether the oil prices move around by $10 or not.
Okay, I'll pursue that point in a minute, but first things first. Are you going to trim the current year forecast as well? the FY26, not calendar 2026, FY26 forecast from the MOSPI stands at 7.6. Danger to that because of the March, instability?
Yes, we think that March growth in general will be slightly weaker. We'll have to see where exports land up, but also the fact that you have a little bit of shortage, and which has been proactively taken care of largely now, but in the initial half of March on gas shortages, I think will feed into growth. We would think sub 7.5% for the fiscal year, purely from the drag we would bake in from the March growth in the fiscal year.
Okay. The other very important point you make is that you are penciling in now 2 hikes from the Reserve Bank because, as you said earlier, inflation in the last quarter could go up to 6%. Now, this is clearly a supply shock. You don't think like in COVID, the RBI may look through it?
So it depends on the persistence, right? So our call is that this will be input cost pressures. This is not purely coming from crude, but it's coming from the product cracks, which are high, which means that if all your product prices generally rise, including something like polymers, that will start feeding into goods input cost and finally will have to pass on to the consumer at some point of time, leaving aside services inflation like airlines and so forth, which makes us believe that there is a chance that you head towards 5.5% odd core goods inflation and headline near about 6%, 5.5% to 6% by the end of the year. We have not really baked in a large fertilizer price shock, which can get food prices higher. And we can argue whether food price inflation is a possibility this year or not. We think that the stocks are quite significant, that India is running. The inventories of food are quite significant, and therefore we are not baking in a large food inflation cycle. But even with that, our forecasts suggest that you could head towards 5 to 6% headline by the end of the year, which is why we think that the RBI might need to react. Now, to be clear, if oil prices are, as you're saying, it's very volatile, if it is lower by $10 or $15, we will have to rethink those rate hikes and whether the RBI needs to hike or not. But currently, it's predicated on the fact that core goods inflation will really be the driver of this hike as you head into later in the year.
Okay, I was somehow expecting you to say that the currency depreciation is another reason why the Reserve Bank may want to sound hawkish. But do you think the Reserve Bank and the Government of India, more than the Reserve Bank, will have to resort to some special measures for the dollar? Oil being purchased, oil companies buying dollars directly from the Reserve Bank, or oil bonds itself, or for that matter, the way Indonesia has done. Indonesia has already done capital controls. They have, said that external investments capped at $50,000 per person instead of $100,000. Do you see any such steps being needed in FY27?
I would say that capital controls are quite far-fetched, but other measures certainly are on the table to rein the balance of payment deficit lower to a more manageable level. Our sense is that undoubtedly there's going to be a reserve drain this year purely from the BOP shock. That's the fundamental demand for dollars that you'll have, and this is one where too much of FX depreciation will also start feeding back into inflation. Yeah. The pass-through for FX depreciation into Indian inflation is relatively low compared to some of the other economies in the region. But even then, if you have a very large depreciation that is there, so our sense is that the RBI will try to manage the volatility in the currency such that the depreciation is relatively managed. But even then, we think it is definitely headed, at least in our forecast, towards 95 or higher.
Okay. So in your book, a Millennium Bond, a Resurgent India Bond, or a FX swap like we did during 2013, none of those extraordinary steps are called for.
So the first point towards getting towards a carry flow is having the carry in the first place, right? Which is why we think that eventually, if you're really thinking about these measures, your policy repo rate has to be higher than where. So if you are to think of these measures eventually, let's say in the second half of the year, then the first point would be to have the carry at a place where this kind of flow becomes attractive to come into India.
No, I take your point. That will be the first line of defense for any central bank to raise rates. And if those rates are raised, then your fear of a 5.9% GDP will obviously follow, because everything gets expensive, including consumption as well as capex. We hope it doesn't get there. And there is also the fiscal deficit problem. If the government is going to have a large subsidy bill, to that extent, you will have less money for capex. So there are problems galore at this point in time. Shantanu Sengupta, thank you very much for joining us and kind of preparing us for the worst. Let's hope it doesn't get there. Thank you very much for joining us. Well, that's it on this edition of Indianomics. It's time for a break. Chartbusters coming up.
The last street extends the recovery. Nifty picks up momentum after opening above 23,000, now holding around 23,300. Broader market outperforms. Real estate, auto, metals lead charge. IT stocks feel the heat.
Diageo sells the IPL franchise RCB to consortium of Aditya Birla Group, Times Internet, David Blitzer's Bolt Ventures and Blackstone for a sum of $1.78 billion. Sale puts listed companies like Sun TV and RPSG Ventures in focus, owners of Sunrisers Hyderabad and Lucknow Super Giants respectively.
Reserve Bank of India greenlights Avenir Investments RSC's acquisition of controlling stake in Saman Capital. Abu Dhabi's IHC will pick up 66.5% stake in the housing financier. Stock skyrockets.
PG Electroplast zooms after the company notifies that the current room air conditioner production ecosystem has almost normalized. The company has identified alternate solutions to LPG across manufacturing units and wallet gas crisis.
Small cap defense player Avantel jumps on the back of a 460 crore order win from Zetwork Manufacturing Businesses for supply of SATCOM equipment, order to be executed over a period of 3 years.
Well, hello and welcome to Chartbusters. We're coming to you live from the CNBC TV 18 Motilal Oswal studio. I'm Nigel. With me is Mangalam. And it's good to see Mangalam. A couple of good trading sessions. Yesterday backed up by today. I think today's session is even more crucial because yesterday was a bit of a relief rally. And today what we have seen, at least in the first 90 minutes, is that we're building on two gains, which is, a good sign.
Yeah, it is a good sign. And the other part is that, yesterday after the oil prices hit lower levels, they were increasing. And now they're holding on to lower levels. Yesterday, despite the up move, which was tentative, the FIIs unwound long positions and added some short positions. So can we see short covering take place today or not is a big thing that we will be tracking. Crude at still holding sub $100 per barrel. So a good time to get in Chandan Taparia, who will tell us whether we've now made a bit of a bottom and the market is seeking higher levels from here on. Chandan, over the last couple of trading sessions, we've seen a recovery from the lows. Do you think that this lasts, and what levels are you looking at the top for supply zones?
Good morning, Mangalam and Nigel. Thanks for having me. So market really witnessed decent recovery from lower levels from last 3 days. The important data internal we need to keep in mind that India VIX is almost flattish. It should go down. Even after the recovery of 400 points, VIX is almost flat at 24.5. VIX needs to go down below 20. That will give more clear picture about the short-term bottom out process. Second, the good part is that index has formed the bullish divergence. That means in last 7 to 8 days, it formed the new lows in terms of price, but relative strength index formed the higher lows. So in technical setup, that is called the bullish divergence. And accordingly, 23,333, 23,350 is an important level, and we are almost near to the same. So if market manages to get further 30 to 50 points move, I believe 200 to 500 points short covering move cannot be ruled out. So looking at that, I believe that now 23,000 could act as a major support, and decisive hold above 23,333, 23,350 can take the index towards 23,850 to 24,000. Now, if I look at the Bank Nifty index, Bank Nifty was comparatively underperforming in last couple of weeks, but it took support. Now it needs to hold 53,250. In that scenario, recovery and short covering could be seen towards 54,500 mark. So looking for some more bounce, and if that follow-up happens, I believe short covering trigger could be there from FIs and all other data setups. And the good part is that most of the counters are turning from their deep oversold territory. So that might also support the market to slightly move higher if a decisive breakout or decisive hold happens about 23,333, 23,350 marks.
All right, we take that point. So that's the view that you've given on both the frontline indices. What about individual stocks, Chandan? What's looking attractive right now?
Yeah, so first trading idea is buy on Cummins, one of the strongest counter. Even after the market weakness, it managed to hold 50-day exponential moving average on closing basis from last almost 15-20 days. Holding the gains, respecting his rising support trend line, given a consolidation breakout of last 8-10 days. So looks good with support of 46.30. One can buy for an upside target towards 4,900. Second trading idea, that is buy on Astral. We have seen short covering. In the recent decline, it took higher base at 1550. We are witnessing put writing, and longs could be placed as now the short covering is clearly visible as open interest declined by around 5 to 7% in last 2 days. So second trading idea is Astral with support of 1630. It can head towards 1730 kind of level. And one more trading idea that will be positive on counter like Tata Power. It seems that the declines are being bought and major trend is positive. So one can buy with support of 384 for an upside target towards 410.
Got it. All right. Thanks a lot for that, Chandan. Well, time to shift focus to our special segment where we get you a few ideas for profit from Money Control Pro. Madhuchanda Dey of moneycontrol.com joins us to talk about a stock that she's tracking closely. Madhu?
We are talking about IRCTC that has meaningfully underperformed the benchmark Nifty in the past year as the street remained concerned about the lack of visible growth trigger. The last quarter gone by, Q3, was however a decent one for the company, with revenue growing by over 18% YOY thanks to the performance of internet ticketing, tourism as well as catering business, with operating margin getting support from internet ticketing thanks to the strong growth in the non-ticketing revenue. Travel and tourism sector is clearly at the receiving end of the current West Asia conflict thanks to the soaring crude price, rising airfare, airspace restriction and LPG-led supply disruptions in the hotel industry. While IRCTC also could feel the pinch through its catering and Railneer business, the core business of internet ticketing remains largely insulated. In fact, domestic tourism could see strong demand as there could be disruption to international tourism, especially the budget tourism segment. The medium-term growth trigger for this company remains addition of new trains. The sharp decline in the share price, in our opinion, captures most of the near-term challenges.
Thanks a lot for that, Madhu. For the time being, though, we'll slip into a short break. You come back, we'll continue our focus on markets and stock-specific action. Stay tuned. Welcome back. You're tuned into Chartbusters here on CNBC TV 18. Well, time to shift focus then to the big IPL deals that were announced overnight. Manglam has hopped across to the big ball to break all of that down for us. Manglam?
Well, you know, as we talk about the recent IPL deals that took place, it's important to first understand just how valuable this league has become. Franchise valuations that are rivaling global sporting leagues as well. Rajasthan Royals valued at about $1.6 billion with investors which include global marquee names like the Walmart and the Ford family. And then you have, this team which was bought for just a few $100 million back in 2008. Similar is the case for Royal Challengers Bangalore, now close to $1.8 billion with institutional investors like private equity giants and large Indian business groups participating as well. The IPL isn't just a cricket league. It's a scaled sports entertainment asset with predictable cash flows, strong brand equity and global investor interest. So from a few $1 million in 2008 to $1 billion plus valuation today, near $2 billion, the value creation has been so extraordinary that sets the base for us to understand how the business model of the IPL works. Let's start looking at it from a franchise owner's perspective. The franchise fee, which is about 20% of the revenue for old franchise, and fixed fee for the new ones, the likes of LSG, etc. Then you have the player's fee, which is an expense, and then you obviously have the operating expenses. Whereas the revenue head for each of these IPL franchises, you get one, the central revenue pool coming in from the BCCI for title sponsorships, the big chunk of revenue coming in from media rights. Then you obviously have the team's own sponsors, gate revenue, and merchandise. So of the central revenue pool that accrues to the BCCI, 50% of which is held by them, and they give it to the other teams at 50%. Remember, media rights are close to around 500 crore rupees, title rights about 1350 crores coming in from the franchise fee. And how do these actual numbers look? From publicly available information that we have from CSK and RCB's annual reports for FY25, the revenues for the teams could be between 500 to 650 crores, with EBITDA margins between 37 to 40%. And these are among the highest EBITDA making margins, sport properties in the world. Going forward, what are the triggers at these valuations that people will be looking at? The biggest one will be the revised media rights auction cycle from 2028. And at the same time, you'll have the central sponsorship auction coming in from 2028 as well. These two account for majority of the company's revenues. Going forward, popularity of women's IPL is an optionality. Higher number of teams and high number of games. Currently, it's just a 2-month window. A likely longer window could also be a big upside. And finally, a lot of these companies have investments in overseas leagues as well, the 100, etc. If that comes about, then those could be big optionalities. But the big numbers will obviously be, the renegotiations of the media rights. But that's where the big risk is as well. Lower than expected ad spend environment, upside limited for new media rights auctions if they don't come at current valuations. And then going forward, any change in regulation by the BCCI could throw a spanner in the works as well. You already know the listed players beyond Diageo or United Spirits. You have SRH owned by Sun TV, 65% of their market cap comes in from there. LSG, RPSG Ventures owns 50% of that. If you account for a holdco discount and look at 51% stake, that could be nearly 250% of its current market cap, which explains why the stocks move higher today as well. So now that you know about the business, just sit back, relax, and enjoy the games.
All right, Mangalam, thanks a lot for that. We'll be enjoying the games coming this weekend onwards itself for this edition on that. But, we can't leave it at that. Everyone wants to chip in with some piece of information. So I think let's go across to Rachna, who puts the focus on the numbers behind all of these deals that have been announced. Rachna, you take it away.
Well, billion-dollar deals are rewriting the business of the IPL, and numbers tell the story here. Start with Rajasthan Royals. The team has been sold for $1.63 billion to a consortium led by Carl Somani with backing from global heavyweight investors, including the Walmart and Ford-linked families. This is a 100% exit, and the BCCI will also take its 5% transaction fee. That's roughly 765 crore rupees. Now, let's take a look at the returns the team has generated. Before the sale, emerging media held about 65%. Redbird Capital 15% and Lachlan Murdoch around 13%. But let's rewind it further. Rajasthan Royals was bought in 2008 for just $67 million, the cheapest team at the time. Today, it is valued at $1.63 billion. That is about 24x return in dollar terms. Emerging media, that's been with the team since day one, alone walks away with over $1 billion. Redbird came in later and yet clocks in about 6.5x in just 5 years. Lachlan Murdoch sees returns of around 10x in similar period. Then comes the bigger deal. RCB has been sold for $1.78 billion or roughly 16,600 crore rupees, making it the most expensive IPL franchise sale ever. The seller is United Spirits, owned by Diageo, and the stakes sold is a full 100%, including both the IPL and WPL teams. The buyers here are a powerful consortium that includes the Aditya Birla Group, along with Satyan Gajwani of Times Group, David Blitzer's Bolt Ventures, and PE major Blackstone. The BCCI fees here comes to about 835 crore rupees. So striking numbers for BCCI with both the deals, but the returns that RCB has generated are just as striking. RCB was originally bought in 2008 for 111 $7.6 million. It is now being sold for $1.78 billion. That is roughly 16x return. And importantly, this is an asset that Diageo did not even set out to acquire. It came as a part of the USL deal and is now delivering a massive standalone payout, almost over 50% of their original acquisition cost of the company, which was about $3 billion. So the big question here is, what is driving these valuations? Well, at the core of the IPL is its media rights cycle worth over 48,000 crore rupees. That translates into more than $80 million per team every year, with over $400 million of revenue visibility locked in over the next 5 years. And that is why global capital is lining up, because the IPL is no longer just a cricket league. It is a billion-dollar investment platform where early bets are delivering extraordinary returns and new money is chasing the next phase of growth.
Brilliant. Thanks a lot for that, Rachna. Thanks for giving us some color on that front. For the time being, I'll tell you what, to slip into a short break, come back, we'll continue to focus on the stock markets. Welcome back. Markets in a good momentum as we speak, currently at the high point of the day, building onto those gains. And let's focus on a couple of pockets of strength. City gas distributors, well, they perk up and trade after the centre notifies new framework for laying of GSA pipelines. Let's go across to Sonal for more on that. Sonal?
Thank you so much for that. Well, the gas conversation continues, considering that there are some supplies which are still under pressure when it comes to Strait of Hormuz. And that's why in a notification, the government has spoken about how LPG and LNG supplies are expected to be constrained for a prolonged period. And impact is due to damage to facilities in the Gulf and blockage of Strait of Hormuz. And that's why switch to PNG framework continues. The government has been talking about how LPG users should quickly switch to PNG. And in order to do that, they are also expediting the process of putting in pipelines for smoother PNG entry as well. They have notified new rules for laying of gas pipelines by city gas distributors. They say consumers will have to switch to PNG connections wherever it is available, and if it is available in their own area as well. They will be putting out uniform framework for laying of gas pipelines by city gas distribution companies, and it will address issues like access to land, delays in grant. There are high fees and charges as well that these companies talk about right now. The LPG supply to some of the consumers will be halted if they will be halted in 3 months for consumers who are not responding to PNG migration. So a lot of these city gas distribution companies have gone ahead, spoken to consumers that switch to PNG in case you do have a pipeline network in your area. OMCs will also notify residents of stopping the LPG supply if within 3 months they do not make that switch to PNG. Of course, this is for areas where this facility is available. They are talking about an approval time frame. So the land access, the right to wait will be given to city gas distribution companies within 3 working days, and domestic PNG connectivity after you apply for it will be given in 2 days. So these are ways they are trying to bring in more PNG to consumers in their homes versus LPG, where we are talking about some sort of supply shortage. So yes, if more pipelines are set up, and this is something which will mean more volumes for city gas distribution companies, and of course a continuous supply for homeowners as well. So that's why this is coming in as a positive notification.
Take that point, Sonal. Thanks a lot for that. That explains why these stocks are higher. Mahanagar gas up nearly 4%. But meanwhile, the reduction in crude prices has done well for a lot of these crude users as well. Asian Paints second day running is higher. In fact, this week's gains upwards of 3%. Remember, the stock had seen a near 18% correction from the start of this skirmish that we saw. Alongside that, Interglobe Aviation as well, one of the worst hit stocks in this month, is now bouncing back for the 4th straight trading session. The stock is up around 2.5%, taking this week's gains higher as well. And a few of these financials, Shriram Finance as well as IndusInd Bank, doing extremely well. In the broader markets, though, look at Godfrey Phillips. That stock is smoking hot, up 9% right now. Remember, all these tobacco stocks were beaten down and, were under pressure after the norm that came in, the new norm of a higher taxation on tobacco. These companies have gone ahead and taken price hikes. So is the worst priced in or not is what the street is eyeing for Godfrey Phillips. And let's say ITC as well. Valuations always comfortable for ITC. Z Entertainment is the other stock which is up 7%. So a bunch of these broader market names doing a lot better today than what we've seen at least in the last 1 month or so, with nearly 2,700 stocks in the green for sub 300 stocks, 261 to be precise, in the red as well. Those crisscross lines not crossing the green, way ahead and way above the red one right now. And amidst all of this, we have a bunch of other stocks as well on the back of brokerage notes, the likes of Sagility, etc. Sudarshan joins in with the details on that one.
So before I talk about Sagility, let me talk about the power companies. Bernstein has come out with a note initiating coverage on majority of the companies. Outperform call on Adani Power, target price 177. JSW Energy outperform call, target price 575. Tata Power outperform with a target price of 443. And for NTPC Green, underperform call with a target price of 80 rupees per share. It says India's energy security has been tested twice in the last few months. First by disruptions around Russian oil, and now by the Iran war. Like China, India is a resource poor in oil and gas, but resource rich as far as coal and solar are concerned. And this makes electrification the real structural answer as far as Bernstein is concerned. Second one is Sagility. Nomura has initiated coverage with a buy call, and here target price is 55 rupees per share. It says it's a vertically integrated healthcare-focused tech player, and it's a key beneficiary of the AI and payer margin constraints fueling outsourcing demand and growth momentum, and expects 20% EPS CAGR over FY26-28.
Got it. Thanks a lot for that, Sudarshan. Well, earlier today, we caught up with the founder and MD of IIFL Finance, Mr. Nirmal Jain, to understand the impact of the gold correction on the loan book outlook and also the road ahead for business amid the uncertainty. Let's listen in to what he had to tell us.
There are pockets of small businesses where there's a stress. I mean, not that the collection efficiency has been impacted, but even the demand has been deferred, or people are cautious, and we are also cautious. So first, the unsecured lending, we have like kind of discontinued in terms of the new customers, or since, if in this quarter we have not done much of unsecured lending. Even in secured lending, so if you look at the Morbi, the huge tile manufacturing and the entire business there, particularly the LPG based, are almost shut down. Number of restaurants also, there have been, there are quite a few restaurants, they're not running at full capacity or shut down. Similarly, there are some, the metal converters, coating units, some plastic manufacturers are impacted by raw material prices.
Right, we started the show with a big up move on the Nifty, and we end it with an even bigger move that we're seeing. 23,365 is where we are, a 450-point uptick. The broader market's a lot better. Let's see whether that continues or not. The best part, tomorrow is a holiday. With that, we wrap up on this edition of Chartbusters. Stay tuned. The dream of trading hour comes up next. Hello and welcome. You're watching us here on Trading Hour. We come to you live from the CNBC TV 18 Motilal Oswal studio. I'm Mangalam Malu. Joining me with all things market is Ritu Singh from Bangalore. Ritu, looks like a great morning if you're a bull. 460 points on the Nifty and counting. A lot better for the Nifty Bank and the broader markets. 2,700 stocks in the green, for about 274 in the red. We're so used to saying the other thing that you don't realize it when the market's doing so well over the last day and a half.
Yes, I mean, thank God for that. More advances than declines, and we're not really used to seeing it. But, it's a good day today coming after that 400-point up move yesterday, another 450-point today. So 850-point up move in the last couple of trading sessions. And, that's definitely good news for the markets to take back. The Bank Nifty trading higher by almost 1,300 points. The broader markets also doing well in trade. And sectorally, pretty much everything is up and about. Lots of individual movers as well in trade today. The gains, of course, led by the Realty Index, the Auto Index, PSU banks, all doing fairly well in trade today. Doing slightly, not so well are IT and energy, but that said, all in the green. India WIX, though, it's still about 1% higher. It's receded from that 25 level, but still around 24, despite the up move we're seeing. So we'll see how the day progresses, but almost 10 stocks advancing, like you said, the market breadth very much in favor of advances, and that's something to take note on. But in terms of individual stocks, one of the top gainers in markets today has been Saman Capital, and that stock remains in focus today after that 6.5% plus up move yesterday, another 10% plus up move today, and that is singularly because the RBI has cleared a major acquisition by Avinair Investment, which, remember, is Abu Dhabi's IHC's subsidiary, and that sets the stage for a significant change in ownership and control. So what has happened is RBI is now okayed a 66.65% stake acquisition by Avinair Investment. It is, of course, IHC's subsidiary, and also RBI has cleared the appointment of IHC's Alvin Krasta as a director on the board of the company for the next 5 years. Now, in terms of the deal, this gets, Saman Capital more than 8,800 crores of infusion. So Avinair, has proposed to invest 8,850 crores, and this will be done through a preferential issue. Once, this deal is concluded, Avinair will end up holding around 41.23% stake. After the open offer is also concluded, that stake will go up all the way to 63.36%, which is well within that 66% odd approval that, the company has received from the RBI. Now, keep in mind, while the RBI approval is in place, and that was the big one that was pending, the SEBI approval is still pending before the deal can be closed, but it is expected, in the coming few weeks, so not too much time, hopefully, for that. There are certain conditions, though, that come along attached with this deal. For instance, Saman Capital, which is a non-deposit-taking NBFC, cannot accept deposits from the public. The transaction needs to be concluded within a period of 1 year. Otherwise, this approval will lapse. And of course, if ownership of Avinair falls below 26% after the deal for whatever reason, they will require a fresh RBI approval to take their stake up to 26% or beyond. So Saman Capital, long-awaited deal, now cleared by RBI. Now, we'll want to hear next what happens with the likes of Shriram, MUFG, and importantly, RBL and Emirates NBD that are still awaiting the go-ahead from RBI. Okay, on that note, we'll move on to PG Electroplast. That's another stock that is in focus, up 4%, because the company says it has identified alternative solutions to the LPG shortage, and they expect the room AC production to be almost normalized. Let's go across to Upasna for more details on this one.
Well, first, let me give some background of what has exactly happened. So on 9th of March, the company had intimated the exchanges that the gas shortage under its supply agreement is there due to the Middle East conflict. Now, the disruption has led to the curbs of LPG allocation for the company with effect from 9th of March and prompting the firm to explore alternative solution. Now, today morning, the company has updated that it has identified an alternative solution to LPG and the room AC production, which was one of the key impacted category that has seen normalization. And with this, company is able to address the key challenge that was the LPG shortage. Now, if we look at the product business of the company, it is the key contributor. It forms nearly 73% of the total revenue for the company in terms of 9-month FY26 numbers. And this product business is consisted of RAC, washing machine and coolers, out of which RAC is one of the highest category contributor. Now, RAC growth on 9-month basis, it stands at 27%. And if we look at the company's revenue guidance, it is somewhere around, for the full year basis, 17 to 19% versus the revenue growth seen at 21% on the 9-month basis. Now, on the back of this, management had joined us when the entire LPG issue came in which the management had guided us that the gas shortage may impact the company's overall FY26 guidance, which is the growth of 17 to 19% will be impacted. And March alone accounts
almost 12 to 15% of the overall annual sales. So a huge impact is what is seen since it forms nearly about 12 to 15%. And company has also indicated in the mid of March that almost 1 week of production is impacted back then. So all in all, this will be a key monitorable, and we'll be also watching out if company comments anything on the RAC growth going forward as well.
All right, Upasana, thanks a lot for that. So that explains why PG Electroplast is up around 4.5% in an otherwise strong market. The stock had seen a big gash earlier. Now on the clarification, it does move higher. But what we'll do is take a short break, but don't go anywhere, because on the other side, our special big story will be unfolded. We have Vineet Karnik, who's the Managing Director, Content, Sports and Entertainment of WPP Media South Asia. We obviously discussed the sports market, the big deals that were announced yesterday, and more importantly, size up the market for the next year and a few triggers too. It's 500 points for the Nifty. The mood of the market is definitely buoyant, nearly 1,400 points for the Nifty Bank. And, for the mood for all the sports fans would also be a fair amount of buoyancy, would see a fair amount of buoyancy over the last 24 hours or so. The big news that was, played out, the RCB deal taking place for $1.78 billion, actual valuations closer to $1.9 billion if you take into account the BCCI commission along with the payouts that they have to make for the WPL deal as well. Then you have, Rajasthan Royals selling for nearly $1.6 billion as well. The sports market in India, extremely opportune right now. And who better than Vineet Karnik, the Managing Director, Content, Sports and Entertainment, WPP Media South Asia, to take this story forward. But before we, ask a few questions to Vineet, let's size the market up post the deal that took place. As per their latest report, which is Sporting Nation 2026, the sports market in India in 2025 crossed that 18,864 crore mark, which is nearly $2 billion. And cricket accounted for nearly 90% of this market. We always knew that cricket was big in India. This puts a number to that. 89% of India's market is cricket. The others are emerging sports itself. What is it that drives cricket and sports in India? It's media rights. Nearly 9,500 crores, over $1 billion of revenue coming from media. 7,900 crore come in from title sponsorships, central sponsorships, etc. And the rest, 1,350 crores, are basically endorsements which athletes and sports stars have as well. But the biggest point that we have to look at going forward for media as well is the stark divergence that we've seen in TV and the big growth that we've seen in digital. If you look at it, 2022, digital was 2,000 crores, TV was 5,500 crores. Now, 3 years, 4 years later, we're looking at TV, which is 5,100 crores, not a big growth. In fact, it's corrected from the time that we looked at it from 2022. And digital from 2,000 crores has gone all the way up to 4,449 crores. So that's the one that has created the biggest delta for the sports market in India. What is it that we're tracking in terms of triggers from here on? Revised media rights auction cycle for 2028, central sponsorship auction cycle for 2028 for the IPL, annually increasing viewership. You look at higher number of teams, games, perhaps a likely longer window for the IPL, the optionality that you have from popularity of women's IPL, investments in overseas leagues. All of this brings you some risks as well. Lower than expected ad spend environment. Remember the cancellation of real money gaming apps, etc., could impact the ad spend environment. The upside limited due to media rights auctions, not many players expected right now due to the consolidation, and maybe any change in regulation by the BCCI. So the risks, the opportunities, the numbers, all of you up for us, and that sets it up for the conversation with Vineet. Thank you, Vineet, for joining in. The timing couldn't have been more perfect. 2 deals announced. You reported, the Sporting Nation 2026 recently, and at the same time, the IPL starts this weekend. 16,000 crores is the sports market of India, and 16,000 plus crores is the valuation for RCB and individual valuation for RR. What do you make of those 2 deals that happened?
Absolutely, Mangalam, and as you rightly said, the timing couldn't have been better. I think, let me put this into perspective. So if you look at our report last year, the size of the market, sports market in India was about 16,400 odd crores, okay? Today, cricket alone is 16,700 crores, which basically means that cricket is almost 89%, as you rightly said, in India today. And that's the momentum. I mean, think about it that way. The numbers look huge for RR and RCB, but let's put that into perspective. I mean, tell me which is an investment opportunity in pop culture, in the world of sport, which is absolutely promising appointment viewing and the kind of momentum around the sport, not only worldwide, but in India as well. I think it's a perfect timing for and an opportunity for an investment to be done in this sector because...
What valuations? Because you're also looking at the numbers, you're also managing the ad spends, right? For the next round of media auctions that come in, Street is expecting not a bigger growth than what we've seen already. What do you think is a fair estimate for the Street looking at the next round of media rights auctions? How much could that delta be versus what it has been in the past?
Okay, so I think the way to look at it is not in this way because this is a very P&L way of looking at it. Let's look at westwards, okay? Let's look at a NFL or a NBA, okay? Today, the Dallas Cowboys valuation is almost $13 billion.
But for that, they do $1 billion of revenue.
Absolutely. And it's also been there in existence for 50 plus years. So that, and IPL is a 19-year-old old league, okay? So from that perspective, I think we are a growing market. And if you look at the numbers for cricket from 2021 onwards till 2025 in the last 4 years, the growth has been at a CAGR of almost 19%. Now that's very, very healthy. So so these 2 teams would have looked at these data points from a growth perspective, and definitely we are just scratching the surface in India, as you know, because 19 years is a too short a time. And our report itself used to be saying that we are sporting nation in the making. And therefore, I feel that it's a great time, a great opportunity for both these teams to unlock the value the way it is.
All right, so let's go across to Ritu now, the Bangalore resident. Ritu, what do you make of RCB being sold? Are you a cricket fan or a football person?
Well, I shouldn't say this on national television. We all enjoy cricket and, of course, the home of RCB right here in Bengaluru. But Vineet, let me come to you on where IPL really stacks up. Mangalam's been trying to ask you about these valuations and how they compare. NBA, Premier League, F1, they're all actively quoting Indian eyeballs. Now, for a global brand that is choosing to put, where its sports marketing dollars go, where exactly does IPL stack up?
So I think there was an audio. Okay,
Neat, so that question is to you on where IPL stacks
where does IPL stack when it comes to valuations as you compare to all the other global players, and how much more is the upside from here was the question.
Okay, so like I said, okay, if you look at NFL, the highest valued franchise in the world is at $13 billion, right? Today, IPL is just scratching the surface with $1.6 billion, $1.8 billion. I think that's the headroom to grow. And look at a country like ours with a 1.4 billion population, with a cricket crazy country, with a very, very rich and robust diaspora. I think it is perfectly poised to become one of the challenger sports and the challenger leagues in the world. And who knows, I mean, maybe 5 or 10 years down the line, we will be compared with the NFLs and NBAs of the world.
Right. So let's put the numbers in context now as well. Currently, the sports market is about $2 billion. The cricket market is about 16,700 crores. In the very near future, what is your expected growth rate for the next couple of years? And, beyond media and sponsorship rights, what's the kind of upside that you see there? We've still not scratched the surface on gate revenue, merchandise, events, all of that. So what are these optionalities?
So 3-4 things. So you're right. I mean, match day revenues, which is a combination of ticket sales and merch. Second most important thing, which we have not done quite a kind of a work that we should, is the non-live content. Now, non-live content is a very, very big revenue driver globally. Today, the digital assets that the IPL teams have can be monetized separately. Okay, and that can be a year-long fan engagement that one could have. So from a content perspective, I think, barring the live season, which is a 65-day season, there is lots that a team can do through the season. And I think when these two teams would have done the valuations, I think this part would have been a significant driver over and above the media rights, sponsorship, merchandising, and gate revenues. So I think non-live content, I would bet big on that, because we are also maturing as a market. So therefore, I think somewhere down the line, the cricket season, the IPL season, which is a 60-day season, from a live perspective, can get extended through a very, very compelling content through various different applications which teams have on a mobile, on a tablet, or even on television shows.
Right. Yeah, we'll go across to Ritu now.
Well, Vineet, here is something I wanted to ask you personally as well. Women's IPL, that is also part of this RCB deal. From a brand perspective, from where you sit, is WPL still a discount play for advertisers, or have we reached a point where women's cricket will also command comparable rates in future?
Okay, so that's a great question, Ritu. See, women's cricket after the World Cup win has been a completely different ballgame. So this year's WPL has done exceedingly well from an on-ground perspective and on-air perspective. If you look at the kind of advertisers you have seen on WPL this year, has been unprecedented. I think the kind of momentum we have with our women cricketers doing so well is phenomenal. And you're absolutely right. So that's also would have gone into consideration, considering that's a massive headroom to grow, because if you compare men's and women's, I think there's a huge gap between the valuations for both at this point in time. And that's the growth trajectory that we believe that we should be able to unlock in the next 3 to 5 years.
All right. Vineet, just a final question. We're at 18,800 crores right now. Say a few years from now, when we look at the numbers at, say, 26,000 crores, the incremental $1 billion, where do you think that comes from? How much comes in from media? How much comes in from sponsorship? How much comes in from the third part, which you are betting big on?
So today, if you see, the mix is 51% is media rights, and the rest is predominantly sponsorship. It's a culmination of central sponsorship and team sponsorship. I have a very, very positive feeling that the sponsorship ecosystem will keep growing at a year-on-year pace of about 14 to 15%. But more importantly, we will be able to add new revenue streams through content, through various different ways we can monetize a fan base. Because today, whatever sport we look at or we follow worldwide is eventually around fans. Fans are eventually paying for the top dollars that we are investing in. So in India, fan engagement will eventually see its unlock in the next 5 years, and we will see new revenue streams, new fan engagement opportunities that will get unlocked in the next 3 to 5 years.
Wonderful. Now that we've set us up for the sporting market in India, post deals, pre-IPL, what we'll do is we'll let you go now with a promise to join us back for a longer, deeper conversation around the sports market and the sporting ecosystem in
Fantastic.
India. Thank you so
Great.
much.
Thanks, Mangalam, for having me on the show.
All right, Vineet. With that, we'll take a short break, come back, focus on the markets once again, because that score is ticking to 5 centuries on the Nifty and counting. The Sensex up 1,600 points. Take a break, come back, get you more on the markets and stock-specific action.
Welcome back. Markets still, up and about, almost, 480-point gain on the Nifty. So that's almost, it continues upwards, and we'll see how it consolidates from here. But, one of the segments that remains in focus today is gold financiers. And, we'll pull up those stocks for you. And, the trigger really is the sharp move in gold prices, which are showing some signs of stabilization, maybe a potential rebound after the volatility that we saw in the last couple of weeks and a multi-session losing streak that we've been seeing. Currently, gold prices around $45, $74 an ounce mark, which is up about, 2% in trade. And that's why you're seeing stocks like Muthoot, Manappuram, all of them up and about currently. Muthoot, Manappuram both higher by about 4 to 5%, and CSB Bank also higher by almost 1.5%. Now, typically what happens is when gold prices go up, the value of the collateral increases, and therefore the LTV automatically falls, and that gives lenders a bigger safety cushion. But vice versa, when gold prices fall, you have the collateral value dropping, so LTV rises, and that increases the risk and potentially triggers lenders margin calls for borrowers. So the decline in gold prices also impacts the AUM because the ticket size goes down per gram. So an up move, therefore, in gold prices is incrementally positive, which is what you're seeing play through in the stock moves today. Although, if you look at a 1 month period, Muthoot, Manappuram, CSB, all of them are still down, from, the kind of prices we saw before, because gold prices are actually still down 18% from the record high that we saw. All of these stocks lower by 6 to 10% or so over the 1 month period. Now, currently, the LTV ratio is well within the regulatory range, and we also spoke with IIFL Finance this morning, one of the key players in the gold financing region. They said their LTV remains comfortable around 61% or so. Now, the tonnage growth for these lenders, which is a volume indicator, has also been declining or staying flat as of the third quarter. So that's also something we need to watch for closely. But incrementally, on the back of what's happening with the up move in gold prices, we're seeing some positive reaction on those stocks. But let's bring in Mangalam now for the latest trends on what he's hearing from the F&O space. And we'll continue that chatter from here. Mangalam, take it away.
Well, it's a big move that we're seeing in the markets right now. No two ways about that. The Nifty is holding at higher levels, upwards of 500 points. What's interesting is that, it's been led by the broader markets. It's a good day of gains. The Nifty Bank, the IT index is the only one which is slightly under pressure. The others are all doing well. Just one thing that I will be monitoring going forward. Look at the futures plate of both the Nifty as well as the Nifty Bank. Are we seeing short covering out there or not? On the Nifty, not so much yet, still some long positions being added, but the Nifty Bank's outperformance has had a lot of shorts cover their positions, and that's what the Nifty Bank futures plate would tell you. FIIs, as of yesterday's close, are 86% short in the index futures. So any sort of up move in the market would lead them to cover their short positions, and that would cause a bigger melt up in the market as well, and that's what the bulls are playing for right now. A lot of put writers are active at 23,200, 23,000 and 23,300 as well as we speak. What does this tell you? That the base of the market has moved much higher. Even if you account for 23,000 as an important base, then 22,800 to 22,900, which was the earlier low before we saw a crash in the previous week, is an important support zone for the frontline index. But as we move higher, the risk of overheating also begins, and as a result of which we are seeing some writing at the 23,300 call as well. The 23,300 call, which expires in 2 trading sessions from now, is trading at a premium of over 300 rupees. So telling you around 23,650 thereabouts, there could be some sort of supply that may come out, and which is why we will have to monitor the put call ratio very closely. It's currently at 1.23. Typically, it tops out at around 1.25 to 1.3. So those are levels that we'll have to monitor. The market started rallying when the put call ratio was at extreme oversold levels at 0.8. A lot of stocks are buzzing around, and a lot of them on account of short covering. So we have Keynes Tech, Manappuram Fin and Ireda seeing some shorts covered. Just watch out for 2 triggers now going forward. One, the March series expiry has just 2 sessions left. Yes, today is a Wednesday, but remember tomorrow's a holiday. Friday is when, there is 1 session, and the expiry is on Monday because the next Tuesday is also a holiday. So 2 days to March series. Today you have to look at today's trade as T-2 as against, T-3 or 4 as we would expect earlier. And the second part is that there could be some NAV propping by funds ahead of FY26 close. And with the war situation easing out, maybe some pumping of money into the markets by funds on account of NAV propping could take the markets higher as well. So those are a couple of factors that I'll be watching out for over the next couple of trading sessions.
All right, Mangalam, on that note, let's bring in Vinay Rajani, Senior Technical and Derivative Analyst from HDFC Securities, who joins us now for a quick technical check of the market. Vinay, thanks very much for being here. How are you reading the charts? This up move, do you expect it to sustain? What are the near-term levels you're watching for? And any top stock recommendations for the day?
Yeah, so this time we are expecting this pullback rally to sustain till 23,900 to 24,000. There has been some reasons behind it, some rationals which are completely supporting the bulls to take a grip from here. So there has been a positive divergence on RSI, and some breadth indicator got oversold and meaningful pullback was expected, and that is what happening. So we are expecting pullback up to 23,900. That is the next resistance for the Nifty. As far as support is concerned, 23,100 to 23,000 is a very strong support, and intraday dip should be bought into for the trading session, today's trading session. So our view is bullish on the market, As far as trading calls are concerned, we feel that the oversold stocks like railway is a sector where we have seen an extreme oversold condition, and today we have seen some bounce back in the railway stock. So Ircon International is looking quite strong on the charts. There is a positive divergence around 126. One can go long. 122 should be the stop loss. On the upside, I'm expecting a target of 135 in next 3-4 sessions. The second stock I would pick from the sugar space, so around Balrampur Chini is looking good to us. So Balrampur Chini is placed at let me check here, 505 level. So one can keep a stop loss at 495, and 530 should be next target. So sugar stocks can also do well in from here.
All right, Vinay, we'll leave it at that. Thanks very much for joining in with your trading ideas. Now let's move focus to Sagility. The shares of that have been gaining in trade. We'll get to that in just a bit. For now, we have to take a quick commercial break. Back in just a moment.
Hovering around the 23,400 mark for the frontline index, a lot of individual stocks doing well. There are some, news updates coming in on Kotak Mahindra Bank. They've responded to Dainik Jagran's report with regards to the Panchkula branch FD case. The stock's higher by about 1.5%. Actually, it's off the high, so we'll just monitor, the news developments out here. But a stock that's doing well is Agility. Nomura's initiated coverage on the stock with a buy rating and a target of 55 rupees. They believe that, this vertically integrated healthcare-focused tech player is a key beneficiary of AI as payer margin constraints fueling outsourcing demand and growth momentum. They expect about a 20% EPS CAGR over the next couple of financial years as well. But also a good time to bring in Sahil Kapoor from DSP Mutual Fund to discuss market fundamentals, his top sectoral picks. Sahil, they say that as bad as it is for humanity, wars typically end up being decent investment opportunities. So let me just ask you, for one, did you guys make any investment decisions during this period, and what sectors did you all back?
So yes, Mangalam, yesterday we came out with a release saying that this is the right time to up your equity allocations. And largely, as you said, that when there is a lot of noise and some sort of a panic, equity valuations begins to drop, and our senses they dropped a fair bit and reached levels where it made sense to at least own large caps in India. When you just look at the trailing multiples, let's say, look at just the Nifty, basis, let's say March earnings, which will be out in the month of April onwards. And if you adjust for the one-time labor charge, we were already trading very close to 18 times multiple on a trailing basis. So my sense is that market had become very close to fairly valued. And in some pockets, as you said, in sectors, largely large private banks, IT, part of FMCG universe, some chemical companies, housing finance companies, etc. Many of them were trading way below average valuations. In some cases, some large firms are trading as low as valuations seen last in global financial crisis. So it did make sense to up the equity allocation, and that is exactly what we did.
Sahil, since you bring up private banks, I mean, of course, HDFC Bank has been in the news after the chairman resignation. You had IDFC First Bank, the fraud that came to light, and subsequently the bank settling that. And today, right now, you have Kotak Mahindra Bank, this Panchakula municipality case coming up, 150 crore FD reconciliation that they're undertaking. All this is sentimentally negative in the near term, but do you think, fundamentally this changes the view, perhaps more in favor of PSB banks, given what's been coming to light in the private space?
So largely, I think all these instances have to be looked at from a case-to-case basis. But when you look at the banks collectively and ask a question whether does this make any fundamental change in how these banks are run in the long term and the quality of these businesses, I think the answer is broadly no when you look at it from a basket perspective. And if you are well diversified across this universe, I don't think you run the risk of making an error. Of course, it has to be on a case-to-case basis looked at much more deeply. But broadly, I think when you look at, let's say, large private banks in India, look at top 4 or 5, roughly they do a ROA of about 2% and run a leverage of about 7x. So doing about 15 to 17% ROE is not going to be tough. Let's say even if the ROEs, if we were conservative, ROEs were to be about 14 or 15%. And right now at 2 times book value, if they grow their ROEs at that pace of about 14 to 15%, I think it's a good time to own most of them. Even without penciling in a re-rating, I think investors can do quite well owning most of these large private banks.
Sahil, what about the NBFC space, and in particular the gold financiers? One day up, one day down. When gold prices move up or down, it's a volatile space as far as the gold prices are concerned, but the gold loan AUM continues to increase aggressively for some of these lenders. Your view on that particular sector?
So my sense is if you were to take a look at the gold prices themselves, they become highly volatile. Both precious metals, the frontline precious metal, they become highly volatile. So my sense is that the meat of the run or the heart of the bull market for gold prices looks like it's behind us. So you'll have to take a more calibrated approach towards this sector. When you talk about NBFCs, I think it's better to look at housing finance companies, which have been beaten down significantly. And there are a number of high quality companies which are available at much better valuations. So I think the lens has to be changed when you look at NBFCs, and the focus should shift from, let's say, what has done well over the last 2 years to what has not done so well.
That's very interesting. What has not done so well is actually the FMCG space. We've not seen a big outperformance in the pharmaceutical space as well, despite clamor for an up move coming by in the pharmaceutical space. And IT, that has been severely beaten down due to AI-related worries. What thoughts do you have on these sectors? Are they still investable? Is IT pricing in the worst?
So Manglam, I think IT is, again, anybody's guess what the future holds. But when you look at, the numbers that we have in hand, most of the IT, at least the large IT companies are now trading below their long-term average valuations. When you compare it to, let's say, the pre-COVID era, you might not find very large discounts, but of course, their return ratios have also improved quite a lot. So when you look at, let's say, the largest IT firm, and you get to see ROICs of about 50% plus, and you see that market expectations of earning growth is less than 2 or 3%, it makes you very comfortable in owning this space. It is very, very underowned. The Nifty weightage for IT firms right now is, I think, sub 8%, very close to 6.5% or so, down from about 11.5%, right? When you look at the ownership patterns, heavily underowned, underperforming. In fact, some of the IT firms are underperforming the bond market over the last 8 years. So I don't think they have price froth also. So as a contra bet, I think IT makes a lot of sense. For FMCG, the picture is mixed. You will have to go really bottoms up to find maybe 2 or 3 opportunities, which appear to be highly fruitful, highly undervalued. But broadly, many large FMCG firms continue to trade at very expensive valuations. They do not offer that high margin of safety. And as far as healthcare is concerned, particularly pharma, I think we are still in the middle of the cycle. Largely, a consolidation is ongoing. The earnings recovery, which began, I think, back in 23 or mid-24, I think is still ahead of us. And probably this is the time that it tests our patience, and we continue to hold it and own them.
All right, we take that point. Thank you so much, Sahil, for joining in and giving us your view on the sectors, the stocks and things that are likely to do well. We spoke about a couple of these consumption names. Because gold prices are down, now the street believes that maybe demand for gold ornaments, the ones which was people who are on the sidelines, will perhaps go ahead and buy, which is why we are seeing a big move on Titan. Look at Titan, up 4.5%. In fact, this week, it's turned positive for the week. One of the few stocks which has actually done well now. And alongside that, we have Kalyan Jewellers as well. That's the one which has seen a big swing of nearly 6%. And that stock too is at the high point of trade. So Titan doing well, Kalyan Jewellers doing well. So these are naturally hedged. When gold prices are higher, their value growth increases. Where gold prices are lower, their volume growth increases, and which explains the outperformance that we've seen in all of these jewelry stocks. But speaking about gold, speaking about the macros, let's take a short break, come back on the other side. We do have Manisha Gupta with all things bond market.
CNBC TV 18 and India Bonds present Bond Street.
Welcome back. Let's shift our focus to the bond markets, and Manisha Gupta is joining in as always to give us a breakdown of the latest happenings there. Manisha.
As all the other asset classes are, well, the bond market also continues to be quite choppy there. By the way, India gilts have seen off highs. Remember, we were trading at a one-year highs onto this one because of the large state bond supply that we are looking at in a holiday shortened week, by the way. So RBI in a statement yesterday has said that 12 states will raise nearly 395 billion rupees, and this is going to happen via sale of bonds on Friday. Now this is of course the last scheduled auction of state bonds that's going to happen in this financial year 2025-26, but also it is going to be ₹1 trillion of state bond supply that you are going to be looking at the market, especially in a week which is holiday shortened. Also, when you look at the global markets, well, the supply situation has softened. The US yields are off its highs as well, and that seems to be impacting the Indian markets as well. But as I told you, this is happening even as there is a decline in the crude oil prices. We are off the highs. We did see $115 a barrel in this week itself. We are trading below 100 at this point in time. Also, there are expectations of de-escalation of the US-Iran war, and that is something that the street will watch out for, especially in the Indian and international markets there. Interestingly, when we look at policy making, the latest suggests that NBFCs are now urging the finance ministry to ease the liquidity coverage when it comes to liquidity coverage ratio norms therein. This is going to happen by introducing graded haircuts for corporate bond investments. Currently, the situation is that there is a flat 50% haircut for bonds which are rated A and below that. And there also is a 15% haircut for bonds which are rated between AAA and AA-. So some changes in this sense is what the NBFCs are proposing. Any more details and development is something that we'll keep an eye on.
Manisha, thanks very much for bringing us that. Let's quickly pull up the Kotak Mahindra Bank stock. It had reacted sharply to the news, but it is back up again after Kotak Mahindra Bank issued a clarification on this Panchkula Municipal Corporation issue, where reports suggested almost 150 crore reconciliation issue in the bank, which the bank now says it has initiated a detailed inquiry into, following instructions from the Municipal Corporation of Panchkula. And based on what the bank has found so far, it says there is no violation of any KYC process. Everything seems to be in place. The account and transactions were handled in adherence with the norms. But, that said, the reconciliation process is still under view. And meanwhile, the bank has filed a complaint with the Panchkula police. So keep an eye out on that one. You saw a sharp fall after these reports, but a bit of a recovery coming in after that clarification came in from Kotak Mahindra Bank. We'll do one thing. We'll take a short break, but come back in just a bit to get you more on the markets.
CNBC TV 18 and India Bonds present Bond Street.
Welcome back. You're watching Trading Hour, and it's time to get you the macro signal of the day. Now, India's households are sitting on a gold mountain, and as of January this year, the value of gold that was held by Indian households has touched nearly $5 trillion. Now, that is 125% of our GDP, and of course, a lot of it is driven by the sharp increase in gold prices we've been seeing during that period, and most of that growth, by the way, is very recent. You know, in less than 1 year, for instance, we've gone from $2.8 trillion to almost $5 trillion of gold stock with Indian households. But here's a number that we need to focus on, and that is this 445 lakh crores of household gold, now exceeding the entire market capitalization of BSE listed companies, which was at about 422 lakh crores as of yesterday. Now, gold has become 65% of all non-property wealth that is held by Indian households today. That is more than deposits, it's more than equities. But unlike either of them, this wealth largely sits in lockers, it gets worn at weddings, and it gets passed down from generations, meaning there's no productive use of this. Now, who actually owns this gold really matters, because you need to understand whether the paper wealth actually translates into real economic activity. So if you look at the data, nearly 70% of the household gold stock sits with households that earn less than 5 lakh rupees a year. The single largest slice of about 36 belongs to those households that are earning between 2 lakh and 5 lakh rupees. So these are typically not your households that will significantly change their consumption behavior just because the value of the gold sitting with them has gone up or down. So there's no real wealth effect to talk about. Now, if the consumption channel is limited, what is this gold wealth actually doing in the economy? The answer is gold loans. And that's something we've been talking about a lot here on CNBC TV 18. The nature of gold, which is, its triple role as a store of value, store of wealth and jewelry, severely restricts its use as a productive asset. Now, loans against gold remain the only meaningful way that these households are putting it to work, and that channel has expanded sharply. Gold loan AUM has more than doubled from 5 trillion rupees in FY21 to 12 trillion rupees at the end of March 2025, and gold now accounts for 5% of the overall loans in the system and 12% of all of the retail loans in India, and it's showing no signs of a slowdown. Here's where this Midas touch really turns uncomfortable, though, because every rupee that is spent importing gold is actually a rupee that is leaving our financial system. Households converting deposits into physical assets, that draws down RBI's net foreign currency assets, and that constrains the reserve money creation and squeezes liquidity in the system. And as a result, we've already seen RBI had to inject almost $35 billion through forex swaps since January of last year just to offset this. India's net gold imports have totaled about $500 billion. That's 2.5 times the net FPI flows into India and 85% of all the combined FDI and FPI inflows. So we attract capital with one hand and gold takes it back with the other. And that's the macro signal to watch out for. $5 trillion in household gold is a big number, but the wealth is not spent, invested, or even easily recycled. It is draining forex reserves, pressuring deposits, and forcing RBI to keep compensating. And the primary way households are unlocking that wealth is by pledging it for a loan, and that is not a prosperity story, more of a liquidity signal that the markets need to remain watchful of. Mangalam.
All right, Ritu, thanks a lot for decoding that macro signal and telling us that household wealth or household gold does not really translate into any sort of wealth effect. So that's important data crunching out there. But a bunch of other stocks which are buzzing around. RPSG Ventures, obviously the ones that own 51% stake in Lucknow Supergiants, that's up 20% now. So it's been doing well all through the day. Now locked in 20% upper circuit. A lot of these, RPSG group stocks are doing well. PCBL, Philips Carbon Black, is also up 15%. We are seeing similar traction in a lot of these other names too. But let's speak about City Gas Distributors. They've perked up in trade after the centre's notified new framework for laying off the gas pipelines. Sonal joins in with more. Sonal.
They have been talking about how more households should consume PNG or piped gas versus LPG now for household purposes. And this is a step in that direction. The government spoke about how LPG, LNG supplies are expected to be constrained for a prolonged period because of damage that we've seen in Gulf facilities and also the Strait of Hormuz, where the vehicles or the vessels are not transporting right now. They say there is a switch to PNG framework where they have notified new rules for laying of gas pipeline by city gas distributors. Consumers have to switch to PNG wherever it is possible. If there is a pipeline in your area, you should be switching to PNG from LPG, according to the government. They are putting out a uniform framework for laying of gas pipelines for city gas distribution companies, and it will address a lot of issues that these companies face, which is because of land accessibility, delays in grant, high fees and charges as well. Some of the issues that these companies are facing. LPG supply additionally will be halted for 3 months if these consumers do not proactively make a switch to PNG if it is available in their area. All marketing companies will go ahead and speak to these consumers as well that they will not get LPG if they switch to PNG. So there's a 3-month period that the government has specified as well. Additionally, there is an approval time frame in place now that will be given by the government to these companies. Land access or right of way, they should be given it to them in 3 days, and any PNG connection after application has to be given to the consumers in 2 days. So it is in the step of moving towards more PNG connection, and that definitely would mean more volumes for city gas distribution companies, and that's why these stocks are higher in trade.
Take that point, Sonal. Thanks a lot for that. So those are a bunch of these city gas distribution companies doing well. With that, we're out of time on this edition of Trading Hour. You stay tuned to CNBC TV 18 from Ritu. Thank you for watching. Trading Hour is over. Halftime report comes up next.
Stocks power up on hopes of an early end to the West Asia war as US explores a ceasefire deal. Realty, consumer durables, PSU, banks and autos are the big gainers.
United Spirits will sell IPL team Royal Challengers Bangalore to a consortium led by Aditya Birla Group for $1.78 billion. This rubs off on the stocks of IPL team owners Sun TV and RPSG Ventures, while its shareholders eye a hefty dividend.
The RBI has cleared international holding company Abu Dhabi's acquisition of 66.65% stake in Saman Capital, paving the way for a change of control and an open offer to shareholders. The stock jumps on the news.
IIFL Finance MD Nirmal Jain tells CNBC TV 18 there is no plan to sell microfinance arm Samasta, but a partial divestment may be considered. He adds that while gold volatility isn't a concern, they have turned cautious on unsecured lending.
Brent crude fell as much as 6% in early trading, but is back close to $100 a barrel on reports of the US working on a ceasefire plan and Iran allowing non-hostile vessels to pass through the Strait of Hormuz. Meanwhile, gold and silver fire up as inflation-led rate hike fears recede.
Hello and welcome to Halftime Report. We are coming to you live from the CNBC TV 18 Motilal Oswal studio. I'm Sonal Putra and joining me today on the show is Hormuz Patakia. Hormuz, good afternoon. A cheerful day for the markets, I have to say. Some worries which are easing now as far as the West Asia war is concerned, and market is taking note of that. For the Nifty, we continue to be at that 23,200 mark, continue to be above that. We came off slightly off the highs of the day, but there's nothing major to worry about for now. The mid caps are up 2.1% higher on that one, and the advanced decline ratio, that is the one that should be on your radar. For every 11 stocks in the green, there is one stock in the red, so the market breadth continues to be very strong in favor of the advances. We do have the PSU banking index, which is up around 3%. The small caps also doing well. Autos, realty, financials, all the sectoral indices in the green as we speak. So looking good for the market so far. And we do have a lot of these stocks from the Nifty pack which are doing well. Shriram Finance up 5%, Titan up 5%, M&M Trent, all of them buzzing on the upside. But let's tell you what do we have on the show for you today. We'll focus on the buzzing stocks and big movers in trade today. And then Prashant Thakur of Anurag Group will join us to talk about West Asia war impact on the realty sector. On a commodity corner today, Soumyakanti Ghosh will connect with us to discuss the fall in gold and silver prices. And in our special segment on cryptocurrencies, SB Sekar of Binance will talk about the rise of cryptocurrencies in the Asia-Pacific market. Stay tuned for that conversation. Now let's go across to Hormuz. This is our first segment where we'll talk about all the stocks that are moving around in trade. Hormuz, what do you have for us?
Well, in just a day and a half, the color of the screen has turned from a deep shade of red to a deep shade of green. And from the lows that we made on Monday, which was around about 22,480, the index has now rebounded almost 1,000 points from those levels, or close to 1,000 points at least. And look at the stocks that have gained the most from Monday's low. And as all of these beaten down names, most of them impacted by the West Asia war, be it Indigo, be it Shriram Finance, L&T, Bajaj Finance, all of them. But for today's session, the newsmakers of the day, of course, are Saman Capital, of course, that is the IHC deal. The stock, of course, is in the F&O ban, so you need to keep that in mind. RPSG Ventures, of course, after the RCB deal, 19% higher on the stock, and PG Electroplast at one point had surged as much as 9%, has cooled off slightly from the highs of the day, but still holding on to gains of around 3.5%. The issues being sorted out for now in PG Electroplast has benefited a lot of its supply or its key clientele as well. Look at Blue Star, Voltas, Havells, all of them trading with gains of around 4 to 5% each. And PG Electroplast, they are the key clients of that company as well. Now, the gold prices seeing a bit of a recovery from the lows, and as a result of which the gold financiers are doing fairly okay. Manappuram at one point was up almost 6%. That's come off the highs. Muthoot has come off the highs as well, as has IIFL, but still holding on to gains of around 2 to 3%. Now, stocks that are doing well on very strong volumes, PCBL is 16% higher on the stock. Wockhardt is doing well for itself, 5.5% higher, and Deepak Fertilizers too, trading with gains of around 8%. And in a market like this, there are still stocks that are at 52-week highs, beg your pardon. Aurobindo Pharma is one such name. 3.5% higher here, 4% higher for Emcure as well, and Acutaas Chemicals doing well for itself. A recent listing, doing well, a post-listing high for the stock here as well.
Oh yes, and chemicals in general have been doing really well in today's trading session after a fall that we saw. Thank you, Hormuz, for bringing us that comprehensive list. Let's now shift focus to other sector, which is the automobile sector. Sources tell CNBC TV 18 that the PM e-drive extension is likely for electric two-wheelers and three-wheelers. Shivani Bajaj is joining us with more details on this one. Shivani.
Well, yes, we are picking up from sources that the government is likely to extend the PM e-Drive scheme benefits for electric two-wheelers and three-wheelers beyond the current March 31st deadline. Now, this move is being driven by unspent funds in the two-wheeler and three-wheeler segment, with the Ministry of Heavy Industries having already approached the Finance Ministry for approval. Importantly, the overall scheme outlay is expected to remain unchanged at 10,900 crore rupees. Remember, the extension is likely to remain focused on high-volume mass adoption segments like the electric two-wheelers, the e-rickshaws, the e-carts, where utilization of incentive has been the highest so far. And this is also in line with what the Parliamentary Standing Committee has flagged. The panel has pointed to large divergences between budget estimates and revised estimates across key auto schemes, with substantial cuts seen at the RE stage for FY26. It has recommended that the future allocation be backed by more realistic implementation plans. Now, the panel has also raised concerns that stringent global revenue and investment threshold for OEM eligibility could limit participation, recommending a more differentiated approach to support high potential domestic EV players. So, putting all of this together, the likely extension now being considered by the government appears to be aligned with both the utilization trends on the ground and also the policy feedback from the parliamentary panel, with clear aim of sustaining momentum in India's mass market EV adoption story without increasing the fiscal burden. Back to you.
Shivani, thank you for that update there. Take a short break. On the other side, we connect with Prashant Thakur of Anurag Group to talk about the impact of the war in West Asia on the real estate space. Stay tuned. Welcome back. Back to 500 points higher on the index. So 23,420 is where we continue to stand. Another stock that has joined the list of names that are at 52-week highs today is Granules India. That has surged to a 52-week high as well. It's at the highest point of the day now, 4% higher on that stock as well. So good going. It's been a bit of a spike over the last few minutes, but for now, market's doing fairly well. The Sensex weekly expiry, a second half promises to be interesting.
Oh yes, it always does, right? So many expiries in the week, but yes, that has been the market mood. But we've been talking about the impact of the war in West Asia on different sectors. It has now entered its fourth week, and the ripple effects are beginning to show across real estate sector as well. Construction costs across the board have seen a big surge. There is an interesting note which has come in from Anirok. Amid rising input prices and supply disruptions, the impact is especially visible in the premium segment. To discuss this and more, we have Prashant Thakur, who is the Executive Director and Head Research and Advisory at Anirok Group. Prashant, good afternoon. Thank you so much for joining in. It is a very interesting note that you have written. If you can summarize that, what are some of the inputs which are delayed now for real estate players? Is it impacting their deadlines? And is in turn, would that impact delivery to buyers as well? What kind of situation are you seeing on ground?
See, it's kind of quite uncertain time that we have entered right now. And if we look at the key construction materials, for example, steel, paints and cement, the prices have already shot up by 10 to 15%. And adding to the problem is the delay in the shipment that is kind of coming in, and plus the container cost have also gone up by almost 1.5 lakhs to 3.5 lakhs. So that is kind of a worry, some point that is bothering most of the developers right now, as well as buyers as well. So the real question over here is that will there be a price increase, or the developers will kind of delay the under construction project? So as of now, to answer the delay part, I think as of now, we don't see any developer raising a red flag and kind of asking for some kind of extension. But yes, if the situation prolongs, I think there would be scenarios where few of the projects might get delayed slightly. Now, coming to the cost part, I think the cost definitely has gone up by 10 to 15%, not only in terms of input cost, but also the labor cost, because the increase in crude oil is expected to increase the inflation, and plus all the commodities that are being used by common men will go up, and that's where your labor cost also will go up, because they would expect higher wages. So it's a double whammy right now. The situation is tensed, but as of now, it looks under control. But if it prolongs for another week or so, we might start to see some kind of impact on the cost as well as the construction timelines.
Prashant, good afternoon. Thank you for joining in. But is this not a medium-term problem per se? Because it's not as if, let's assume that the situation is resolved, the war ends tomorrow itself. But the damage that has been caused due to the war, that will take a while to restore. That will take months or maybe even years for normalcy. The second order impact being felt on a sector like real estate, do you believe that the problem or the impact or the sector is not as majorly exposed as such for the medium-term impact to be felt on real estate?
See, if you look at two parameters which are very crucial for real estate as an industry as a whole, the most important part is the positive sentiment. And the second part is certainty about your future income. So I think with this war, even if subsides, I think it has already caused some impact on the sentiment, which will take some time, because even if the war comes to a halt tomorrow, people will like to wait and watch how things evolve. I think it will have some lingering effect. The second part is that if you see the kind of impact it's going to have on the Indian economy, for example, yesterday we saw the downgrade happening in terms of the GDP forecast for the country. So it will take some time. People will wait and watch. They're not in any hurry to kind of commit any buying decision right now. And if we look at what the industry is going through right now, see, 2025 calendar year was a year where we saw the volume slowing down. The volumes declined by 14%, yet the value went up by 6%. So people already started talking about that, whether the momentum is slowing or not. The prices had run up quite high. And if you add on to the factor that this war has caused some further disruption, in my opinion, there will be some pause. I'm not saying that the prices will come down or the prices will crash, but we'll see some negative impact on the momentum in the short run. In the long run, if the peace lasts and some permanent settlement is arrived, I think the activity will resume and things will be normal. But again, in short term, things are a bit I would say, hazy. People will kind of wait and watch, because see, in terms of uncertainty, any long-term commitment or capital deployment takes a pause, and that's where we are right now.
So Prashant, quickly, if you can tell us, you don't think there will be a price rise despite input price hikes that we've been seeing for these developers. Is that a yes or no?
See, it's developers are in a tricky situation, because in 2025, if you look at the price rise, it was a moderate rise of 8% compared to what we saw 2-3 years back. It was in high double digit, and the reason for the momentum slowing was that people felt that the prices have really shot up too high. So it's a tricky situation for the industry, where the input cost definitely has gone up, and there's a very little headroom where they can pass on to the price to the buyers, because the momentum is already slowing down. So I think even if they're passing it on, it will be a very minimal amount, and most of the I think the price increase will be absorbed. Let us hope that this disruption settles down quickly and things resume to normal, because all this price increase in input cost is primarily due to the disruption that we have seen. If that settles down, things will come to normal, and we would resume our normal activity. But to answer your question, there is a little room for the developers to pass on the price rise to the buyers. But yes, the construction cost definitely has gone up because of this war.
A two-part question, Prashant. Firstly, the impact on the investments from NRIs, because those are also a significant portion in premium and luxury housing. And what I also wanted to ask you was that, does that not become a triple whammy for the sector now? Because since you mentioned that there was already a slowdown in demand, with all of this and no scope to raise prices already, would any potential buyer not wait for prices to come down and then take a decision in times like these?
See, more than delaying the decision in hope of price correction, I think they will delay the decision to wait for the situation to subside. Because see, the input cost impact will be less felt by the buyers of luxury housing, because they can absorb a certain amount of price hike. But the reason they would put their decision on hold or they will wait is because of the wealth effect that has taken an erosion because of the steep decline in the stock market. So that is one factor. But again, in this uncertain situation, as I mentioned earlier, that any long-term deployment of capital takes a pause. There will definitely be some value buying. There would be some developers who would be giving you some kind of preferential deal. There would be some bargain hunt in the market. But in my opinion, I don't see there would be any steep price correction, and then there would be some big announcement of some construction delay. We are not in that situation right now.
Okay. Take that point, Prashant. Always a pleasure speaking with you. Thank you so much for joining us with your thoughts on what's happening on ground when it comes to the impact of West Asia war on something which is very domestically driven, that's real estate, but that's the second order impact that we're seeing in the country now. Time for a break now. Jay Thakkar of ICICI Securities will join in with some trading strategies on the other side. Stay tuned for that. Welcome back. You're still tuned in to Halftime Report. 5:30 higher on the Nifty as we speak, above that 23,400 mark at the day's high. So what should you do now? Let's get in Jay Thakkar, Head Derivatives and Quant Research at ICICI Securities. Jay, do you think we'll go past the 23,500 mark now? And if that does happen, could we continue to see an up move? Also considering there is a holiday tomorrow, market holiday that is, what kind of levels are you looking at?
Good afternoon to Sonal, and thanks for having me. Well, I would say yes, the probability of 23,500, if not today, today being a weekly expiry, if not today, then going forward is quite likely it will be taken off. In fact, in this March series, I think that on the upside, at least 23,800 to 24,000 levels could be seen. So we do have only 2 trading sessions left post today in this March series. So in another 2 sessions, we might see that 500 points kind of a jump as well. So the reason being is that definitely we have good amount of shorts by the FIs in the index futures, which we are expecting it to cover towards the end of this monthly settlement. So I think that if the peace talks which have just started, or probably the de-escalation which has just started, if that continues and if we have further positive out of that, then we would be seeing FIs reducing their shorts and would not be rolling it over much to the April series, and hence we would be seeing the entire gap down, which because of which the gap had been created, that gap to be filled entirely, and the next resistance would thereafter be 24,000, which could be the immediate target as well for the March series. Now I don't see Nifty, in fact, even slipping below the levels of 23,000, because that had earlier acted as a very critical support. And for the March series, I would say entire March series, Sonal, 23,000 level was the one which acted as a very crucial support and had a good put base as well. It's just for one day we saw a gap down below that. Otherwise, 23 was the level. Also, we have seen since yesterday the India VIX started to reverse from up to down. We have seen the IVs also coming down, although it's not much down today. But I think if India VIX falls below the levels of 23, then you would see that further sharp decline in going forward. Is just because of the holiday or the truncated week. We haven't seen much of the fall today. So based on these all observations, the FI net shorts, the India VIX reversal, as well as I would say the kind of momentum which has now built up, the short-term trend is likely to be positive.
And in light of that, Jay, what are the stocks that you are recommending? Because a lot of these beaten down names are making a bit of a comeback over the last 2 days.
Well, yes, good afternoon to you as well, Umaz. We would be seeing short covering definitely in those stocks wherein we have seen a good amount of shorts that were created because of this war-like situation. The OMCs were the sector definitely hit hard, as well as realty, not to forget about the private sector banks, and also the IT, right? So these are the 4 sectors mainly, Umaz, I would say, wherein we have seen good amount of selling pressure. But, among the, IT pack, I think one can go long on HCL Tech. It's up by 2% today, trading at around 1400 levels. I think one can place a stop loss at 1350 and go long on HCL Tech among the heavyweights, IT heavyweights. I think it would inch towards the levels of 1500. There's a good risk reward out here because we have already seen 30% kind of a decline in IT sector in last 2 months. There are shorts accumulated here. So a short covering out here can't be ruled out if at all index is going to bounce back. So one is going to be from the IT pack for sure. And second, I would recommend a buy on Dixon. Now, Dixon too had seen a good amount of short that got built up. But, past few trading weeks, we have seen a good resilience here as well, like that of HCL Tech or IT sector. So it's likely to head towards the levels of 11,000, thereafter 11,500. On the lower side, I think that 10,200 will act as a good support. So there is a good risk reward here as well. And finally, one buy recommendation would be on Cummins India. This has overall outperformed Nifty in this fall. And I think the kind of record we've seen out here, we can see the levels of 5,000 on Cummins.
Okay.
One can buy the stop loss of 4650.
Okay.
Yeah.
Thank you, Jay, for joining us today. That's all about the technical check on the markets. But Mangalam is joining us now with all the action from the F&O desk. Mangalam.
Well, there is a day of good gains, and that's what we're witnessing today. The Nifty Bank. We've been seeing the markets go up from from the word go, and all dips are being bought into. We're considerably above, at the day's high right now, about the 500-point gain for the Nifty. Much more for the Nifty Bank. The broader market's doing extremely well too. The important part, however, is that this may lead to further melt up because the FI short positions are still 86%. And as the market's moving higher, put writers are, writing a lot of puts as well. 23,300 put, 23,400 put, Both of them extremely active, telling you that the base of the market has moved higher to about 23,100 to 23,000 itself. But at the same time, because things may not get overheated or should not get overheated, we've seen some call writing emerge at 23,400 as well for about 300 rupees premium. That tells you that maybe around 23,750 to 23,600, we could see some sort of resistance that will come by. To that extent, two things are very important to monitor. One, India VIX. Typically, with this kind of a move, you would see a 7 to 10% decline in the India VIX. That hasn't happened. It's just about a 1% decline. It's still holding at elevated levels. And secondly, the put-call ratio at 1.21 is moving towards overheated zones for the frontline index. So let's track how this pans out as well. But amidst all of this, a lot of stocks are on our radar. Shriram Finance is seeing a lot of long positions being added. Kalyan Jewelers, shorts are caught on the wrong side out there. They're getting squeezed. So that stock is up 7% with shorts covering their positions. But the triggers for the next two trading sessions are very important. Remember, the expiry for the March series is on Monday. Tomorrow is a holiday. So the expiry is just 2 days away for the March series. And over the next couple of trading sessions, tomorrow is a holiday and next Tuesday is a holiday, you will also see NAV propping by some of those funds ahead of the closing of the financial year. So that could also put volumes on the higher side, especially in the mid and small cap space. So those are a couple of factors that I'll be tracking over the next 2 days.
Mangalam, thank you for that update. Just before we take the break, it's a record low for the currency now, 93.98 for the dollar rupee, heading towards those levels of 94. We'll just get that spelling checked as well for the record. 93.98, the new low for the currency. Take a short break. Soumyakanti Ghosh joins in on the other side with Manisha Gupta to discuss the fall in gold and silver prices. Stay tuned.
Welcome back. Joining us now is Mr. Soumyakanti Ghosh. He's Group Chief Economic Advisor at the State Bank of India. Mr. Ghosh, thank you so much for joining in. What a pleasure to have you on a commodity segment. And I do want to start with the crude oil prices. First of all, we have seen the Indian crude basket continue to gain up, what with Brent and Dubai and Oman crude prices, which have been surging on the higher side. What scenarios are you working with, and what's your sense on what are we looking forward from here?
Yeah, thank you, Manisha, for having me on the show. I think regarding the crude side, there are two observations are making. The first observation is that I think the prices of crude are going to stay elevated in the range of, say, 100 to 110 for the Indian basket in the near future, at least in the next 2 or 3 months. Because as you correctly said, if you take the last estimates which the PPAC had released was at $119 per barrel. So even if you're assuming that, even if you just make an deep stick estimate of an percentile estimate of how much it could be in the next 2 to 3 months, the price actually moves between 109 to 112. And this is the first observation. The second observation is that in FY26 till February, the crude prices average for the Indian basket were close to $70 per barrel. So if that price moves up to around $90 to $100 per barrel, and given the fact that every $1 increase in barrel leads to around 1.5 to 2 billion increase in oil imports, we can have straight away an increase of around 30 to 40 billion in oil imports in the baseline scenario. So as of now, I think the most obvious conclusion is that there will be a widening of the trade deficit, provided the exports doesn't go up in the same proportion.
Well, that's about crude prices, but I have a larger interest in talking to you about the precious metal prices because they haven't really worked as per the textbook. There's a war going, there are inflation concerns, and gold, which is known as a hedge against inflation and geopolitics, hasn't really performed, and we've seen money float elsewhere. How are you reading this scenario? What's your future forward outlook when it comes to gold and silver?
I think gold and silver presents a very interesting proposition. If you remember correctly, I think in the month of October 2025, gold prices had retreated suddenly from 4,500 to around 3,900 in a span of couple of weeks. And then it started to move up. Then it moved around 5,500. After that, it has again retreated. The story of the silver actually often poem as gold, because you know that silver prices have not reached its potential ever, and over a longer period of time, and silver prices have stayed depressed. But I think silver prices in the last January, it touched a high of 120. After that, it has been retreated. There are a couple of points to note in this rally of the metal prices, precious metal and the commodity prices. The first thing is that I think as of today, why the gold and silver prices have not significantly increased. I think the logic behind is the strengthening of the US dollar. Because earlier we are having a story of de-debasing of the US dollar, but suddenly after the war started, the US dollar instead, which was actually depreciating at this point of time and moved towards 94, 95, has now hovering around 100 or upwards. So if the dollar is actually appreciating, that means that there will be pressure on the interest rates. And as you can say that the 10-year GSEC rates in the US are already closer to 4.5%, which were earlier declining. So if this is the case, if there is a strengthening of the dollar and there is movement towards this dollar-denominated assets during the times of war, and there is pressure also on the interest rate, the precious metals prices are of course likely to decline. Now there has been, as you have seen in the last couple of days, there has been a little upward movements in the precious metal prices in the hope that there could be some early resolution and the dollar could actually again move down and the interest rates move down. But my sense is that this movement might be temporary because the war is not yet over. If the war is not yet over, the strengthening of the dollar will not be over, and the hardening of the US interest rates, the 10-year yields, will not also be over. So I think this correction, there could be some corrections in the precious metal prices if I purely go by this logic from the current levels. And the interesting thing, which I think could happen maybe in the second half, this is again this is not going to be the pure textbook theory. But as you know that the all central banks, and also the fact is why the gold prices have been retreating, is that a lot of central banks are also selling golds so as to recover their cost. So that is one of the reasons.
Mr. Ghosh, are you saying that going forward, commodities are going to do well, especially precious metal prices? Because 2025 belonged to commodities. Can we say going forward, 2027 could be like that? The FY27?
What I'm saying is that in the medium term, there will be some retreat in the precious metal prices from the current level before it starts to move up again, which could be possibly in the couple of months' time from now on.
Okay. All right, Mr. Ghosh. Thank you for your thoughts. And Manisha, thank you so much for taking us through that conversation. News flashing on your screen. Sources tell us that the NSE may launch oil and gas contracts. Sudarshan is joining us with all those details. Sudarshan.
So it's an important story for MCX because they might face the competition as far as commodity trading, commodity derivative market is concerned, because the leader in the equity segment, that is NSE, is looking to launch natural gas contract. That's the Indian natural gas contract very soon, or say by the next quarter, in which MCX currently is the market share in the energy segment, or say non-agri commodities. MCX has market share of more than 95%. And also, SEBI recently, NSE had got the approval of SEBI to launch Indian natural gas contracts. NSE also looking to launch Brent crude contracts. Currently, they have WTI crude contracts, in which in the last expiry, they had the market share of 16%. And by the next expiry, NSE is saying that in WTI crude contracts, its market share will increase from 16% to as high as more than 30%. And also, why this energy segment is important? Because energy segment is 70% of total options average daily trading option mix, total mix, energy segment contributes almost 70% as far as MCX is concerned in current quarter. And I told you in non-agri commodities, MCX market share is 95% plus. And if you talk about entire commodity basket, MCX has market share of 85 to 90%. So we'll have to see how this pans out. But as of now, what we understand from sources that NSE is looking to launch Indian natural gas contracts by the next quarter.
Sudarshan, thank you for that update there. Take a short break. In our special segment on the other side, which is on cryptocurrencies, we'll connect with SB Seeker of Binance to talk about the rise of cryptocurrencies in the Asia-Pacific market. Stay tuned for that.
CNBC TV 18 presents Crypto Corner, powered by Binance.
Hello and welcome to CNBC TV 18 presents Crypto Corner, powered by Binance. We're joined by today SB Sekhar, who's head of APAC Binance. Sekhar, hi, thank you so much for joining in. And where is, according to you, is the crypto industry stand today globally? Is the narrative shifting from speculative to infrastructure and financial rails finally?
Hi, Manisha. Pleasure to be here. Thank you so much, and to CNBC TV 18 for having me. To answer your question, it's very well underway, and it's structural. It's not cyclical, in our view. Digital assets are no longer a fringe of financial services sitting on the outside. They're actually being woven in as part of it. So I'll give you some statistics to back that up quickly. In 2025, total crypto market capitalization surpassed 4 trillion. And this was for the first time. So this is an all-time high. US spot Bitcoin ETFs attracted over 21 billion in net inflows during that same period. And about just over 1 million BTC now sits on corporate balance sheets. Stablecoins in particular have been a bellwether, or like a main leading indicator for this trend. And they've crossed 300 billion in supply and are processing transaction volumes that rival Visa, MasterCard at the moment. These are not speculative or temporary metrics. They are, at this point, infrastructure metrics.
The other thing really is that Asia seems to be becoming a center of gravity for crypto innovation. Why would you think that is happening? And what are your sense on why is the most progressive regulatory jurisdictions also happening in APAC right now?
Yeah, it's a great question. I think it's actually a coming together of a number of things, right, that need to make this actual formula for success. The first is, as you mentioned, is regulatory clarity. So a whole number of large APAC markets have moved very decisively into formal and full-on licensing frameworks. So away from the spectrum of AML-only registrations or very minimal registration requirements to a full licensing framework. So Hong Kong's stablecoin ordinance, which came into effect last year, established a mandatory licensing regime for fiat-referenced stablecoin issuers. And if you recall, this is on the back of the historical VATP guidelines that existed for exchanges, which is also maturing into the broker-dealer model at the moment. So it's taking steps towards a full-fledged framework. Singapore has always had the Payment Services Act, but they've also now enforced the Financial Services Markets Act, Part 9 licensing framework for digital token service providers. And they've set a deliberately high compliance bar. So now they are moving into the phase of prioritizing quality over quantity, right? South Korea has taken big steps in terms of legalizing spot crypto ETFs in 2026. So they moved away from the long-standing retail-only model to a institutional and global adoption model. And this comes on the back of other changes like opening up exchanges to institutional clients for the first time, actually probably mandatorily requiring corporates to have as a part of their balance sheet crypto holdings, and also looking into the one exchange, one bank account model, right? Japan, for example, has a similar trend where they're moving away from a tax structure that was penalizing crypto almost relative to other traditional financial instrument markets, and bringing that down to a flat 20% tax consistent with securities, and taking actions again to open up to institutional adoption as well. So, India, which leads APAC consistently over the last couple of years in terms of digital asset adoption, and which has a relatively uniform adoption countrywide, and has a very strong digital infrastructure, as you know, is also making the moves, I think, gradually from that sort of a model, a registration-only model, to looking into what would, for example, stablecoins mean for India in the long run, right? So this is one element of it, which is the regulatory framework is maturing at scale. And then you also have the population, the dynamism, the mobile penetration, and the disposable incomes rising, which together, I think, is a perfect cauldron for moving beyond, experimentation towards large-scale adoption. So I think that's the reason why you're seeing, Binance has 20+ jurisdictions globally where we have licenses.
2025 was all about not just retail and crypto enthusiasts, but institutions and corporates in some sense also entering crypto in a very meaningful way. What do you say in sense of tokenization, blockchain infrastructure playing its role in finance as we go ahead?
Yeah, so let me talk a bit about the institutional adoption first, and then I'll pivot to real-world asset tokenization, which I think is the core of your question. So institutional participation is increasing globally, right? And it's starting to drive crypto markets and how crypto is accessed, allocated, used, traded, and held. So we see this shift directly at Binance, and institutional trading volume on our platform has increased 21% year on year in 2025, and OTC trading surged 210%. Right. So what we've done in response, or actually in anticipation of this, is we've built a full institutional product suite, tri-party banking, finance wealth, managed fund accounts, crypto as a service, which is basically us building infrastructure for other financial institutions to offer wallet and liquidity infrastructure to their end users, and Binance Prestige, right? Each one is designed around how sophisticated capital actually gets allocated. Now, beyond our own infrastructure, the broader institutional entry is very well evidenced at this point. Digital asset treasury companies, there are 195 of them at this point that hold over 1 million Bitcoin each, right? And companies have also broadened beyond Bitcoin. Almost 70 entities now hold a total of 6.81 million ETH, which is about 20 billion USD on their balance sheets. Asset management giants like BlackRock, Fidelity, Morgan Stanley have expanded their own crypto offerings. BlackRock's EBIT amassed 70 billion in assets in just under 1 year. Abu Dhabi Sovereign Wealth Fund holds about 500 million in Bitcoin. The Singapore Stock Exchange launched Bitcoin and Ethereum perpetual futures for institutional clients. So I can go on and on. What this is showing is that sovereign adoption, institutional adoption across the world is increasing on the institutional space. Now, what about tokenization and blockchain infrastructure in general, right? So tokenization, maybe early last year, the year before, when I was talking about it, it was a conceptual discussion. Right now, it's actually an execution-based discussion, and Binance is actively a part of it. Real-world assets basically accelerate the convergence of traditional finance and blockchain, essentially, right? And it enhances efficiency, it enhances 24/7 availability, and it actually enhances access to asset classes which the normal retail user before this previously was unable to access because of the high buy-in rates or high buy-in thresholds, right? And so the interest in RWA for institutions and for retail lies in the ability of this technology to improve market efficiency and democratize accessibility. And this is beyond just classification, right? So the infrastructure that we're building here will allow us to access products from bonds, real estate, cross-border settlement, remittances, and basically in a nutshell, it's financial inclusion at scale. And we already support this. So at Binance, we already support tokenized money market funds, including BlackRock's BUIDL, which is basically a way of using collateral, eligible collateral that institutional clients have to be able to build on top of that and give them stable yield-bearing assets available for 24/7 settlement, which, as you know, doesn't exist in a lot of emerging markets at this point. So this kind of operational utility, simplicity, and permanent availability simply doesn't exist in traditional finance. And I think that's where real-world asset tokenization is starting to plug in. And that's why institutions are building to adopt it. So just to finish off, BUIDL, Apollo's tokenized loan portfolio, Hamilton Lane's tokenized infrastructure fund, all of these were previously accessible only to institutions and only under strict conditions. Now what's happening is they're being made available to retail users through these institutions at entry points as low as USD $500.
CNBC TV 18 presents Crypto Corner, powered by Binance.
Still holding on to gains of around 500 points on the index, although we have come off that 23,400 mark. But of course, there is absolutely no reason for the bulls to complain. The Sensex is up 1,500 points and the broader markets are doing fairly well for themselves as well. Take your leave on this edition of Halftime Report from Sonal and me. Thank you for watching. Business Lunch on the other side. Stay tuned.
Stocks perk up on hope of an early end to the West Asia war as US explores a ceasefire deal. Realty, consumer durables, PSU banks and autos are the biggest gainers.
United Spirits will sell IPL team Royal Challengers Bengaluru to a consortium led by the Aditya Birla Group for $1.78 billion. This rubs off on the stocks of IPL team owners Sun TV and RPSG Ventures, while its shareholders eye a hefty dividend.
RBI has cleared international holding company Abu Dhabi's acquisition of 66.65% stake in Saman Capital, paving the way for a change of control and an open offer to shareholders. The stock jumps on the news.
IIFL Finance MD Nirmal Jain tells CNBC TV 18 that there is no plan to sell the microfinance arm Samasta, but a partial divestment may be considered. He adds that while gold volatility isn't a concern, they have turned cautious on unsecured lending.
Brent crude price dipped 6% on reports of US working on a ceasefire plan and Iran allowing non-hostile vessels to pass through the Strait of Hormuz. Meanwhile, gold and silver fire up as inflation-led rate hike fears recede.
Good afternoon, you're with us here on Business Lunch. We are coming to you live from the CNBC TV 18 Motilal Oswal studios. I'm Hormuz Patakia. With me as always, Arundhati Ramanan. Arundhati, good afternoon.
Good afternoon, Hormuz. You know, the market's looking good today. Easing of tensions in West Asia obviously helping stocks perk up, right?
And all of them relying on media reports, and the hope is that the tensions would definitely ease. Today, of course, the monthly expiry of the Sensex contracts, and with this move, the index is up almost, 900 odd points from Monday's low, which was around 22,400 as well, 22,480, 22,490. So doing well for itself is the Nifty as of now, 480 points higher. The Nifty Bank too, no different, almost 1,000-point gain, a 1,200-point gain on the banking index as well. 2.5% higher over there, so nearing levels of 54,000 is the Nifty Bank, and the broader markets have done fairly okay as well. But of course, we need to keep in mind that there are certain things that are still not in place. The VIX continues to remain at elevated levels, although it has cooled off from Monday's highs of well over 27. The VIX is still at around about 24. There you can see 24.5, so there is no movement there. Brent is back at 100. It cooled off earlier. It fell to levels of around 95 odd. So that has recovered most of those losses that it made in the early morning trade in Asia, and that is also back at around 100. So there are multiple monitorables that you need to watch out for, be it the VIX, be it Brent, and be it the fact that tomorrow is a market holiday and traders may want to remain light on positions considering the uncertainties, Arundhati.
Absolutely, lots of uncertainty going around, but right now everything boding well for the market as we speak. But you know, if you bring that advanced decline ratio up, you can see that we've got 2,633 stocks advancing for 398 that are declining. So that's looking good, and it's clearly in favor of the advances. All of the sectoral indices are gaining in trade. You know, PSU Bank index is over 3% higher. You've got Union Bank, Indian Bank soaring 4%. We've got SBI that's nearly 3% in the green. We've got that Realty pack that's also doing well. Phoenix Mills gaining over 4%. Oberoi Realty gaining in trade as well, nearly 3%. And we've got that Auto pack that's also zooming in trade. M&M, Bajaj Auto, Eicher Motors, all of them up between 2 and 4% in the green. But moving on, Saman Capital is in focus after the RBI cleared a major acquisition of Avenir Investments, setting the stage for a significant change in ownership and control. Let's go across to Ritu Singh for more details. Ritu?
Well, yes, it's a huge relief coming in with RBI giving a go-ahead for the Saman Capital deal with Abu Dhabi's IHC. And, you know, it is the largest such investment by a company from the Gulf region into the NBFC space in India. Now, RBI has approved the acquisition of up to 66.65% stake in Saman Capital by Avenir Investment, which is IHC's wholly owned subsidiary. And RBI has also cleared the appointment of IHC's Olvin Crosta as a director in the company's management for 5 years. Now, Saman says Avenir is going to invest about 8,850 crore rupees in the company through a preferential issue. So they will hold about 41.23% after that issue is done. And another, addition after the open offer will take their stake up to 63.36%. Now, keep in mind, the RBI approval is done, but the SEBI note for the deal is still pending. The RBI approval also comes with some conditions attached. So, for instance, Saman Capital, which is a non-deposit taking NBFC, cannot raise public deposits. If the share transfer is not completed within 1 year, the approval lapses. And if the ownership falls below 26% anytime after the transaction, Avenir is going to require a fresh RBI approval to increase their ownership to 26% or beyond. So much awaited deal getting the green flag from RBI, and the focus will now move on to the others that are still in the queue. Shriram MUFG, you have RBL Bank, Emirates NBD, still awaiting a go-ahead from the RBI.
Ritu, thank you for that update. A significant cool-off from the highs of the day for Sammaan Capital. At one point, the stock was up around 11 to 12%, and now trading with gains of around 4.5%. And mind you, the stock still is in the F&O ban, so no new positions here as well. There you can see the fall from the highs of the day. But Ritu, stay on, because Kotak Mahindra Bank is also in focus because of the alleged fixed deposit fraud linked to the Panchkula Municipal Corporation. Tell us more about that.
Well, yes, Hormuz, after IDFC First Bank, you have Kotak Mahindra Bank that finds itself in the middle of a fixed deposit fraud row in Haryana again, which is linked to the Panchkula Municipal Corporation. Now, we understand the irregularity came to light over the weekend after the Municipal Corporation instructed the bank to transfer the funds after the maturity of its fixed deposit. And then, of course, the bank found that the money was not available. Now, while the bank has not commented on the amount in question, reports suggest the amount under scrutiny is about 150 150 crore rupees. So it is not a very large sum. But that said, in a statement to us, Kotak Bank did clarify it has initiated a detailed reconciliation of the FDs and all the linked bank accounts that are maintained by the Municipal Corporation of Panchkula. And based on that exercise so far, it confirms that all the account opening process, the KYC documentation, etc., all of that is in order. But importantly, Kotak Mahindra Bank also saying a significant portion of the amount under review has already been reconciled. And the bank has now also, of course, filed a formal complaint with the Panchkula police. Now, remember, just last month, you had IDFC First Bank, which found itself in a near identical situation with the fraud at its Chandigarh branch, where the Haryana government had recalled their deposits and then found that the balance did not exist. Now, in that case, IDFC First Bank ultimately had to settle all of the claims, and it chose to pay out the entire amount in full of well over 600 odd crores. So in a way, IDFC First Bank has set a precedent. So we'll have to see whether the Kotak Mahindra Bank also plays out that case in a similar fashion.
All right, Ritu, many thanks for taking us through those details. But on that note, it is time for us to head into a short break. We'll put the spotlight on geopolitics and the latest developments on the West Asia front. On the other side, stay tuned.
Welcome back. Now, the war in West Asia continues with reports suggesting that Iran has notified the International Atomic Agency that a projectile struck the premises of the country's Bushehr nuclear power plant, though without any damage to the plant or without any injuries. While Kuwait's General Authority of Civil Aviation says drones targeted fuel tanks at Kuwait's international airport overnight, causing a fire. The Iranian Foreign Ministry, in a statement issued to the United Nations, has said that all non-hostile vessels can pass through the Strait of Hormuz, provided they coordinate with the competent Iranian authorities. Now, according to the Wall Street Journal, mediators from Turkey, Egypt and Pakistan are pushing to have a meeting arranged between US and Iranian officials in the next 48 hours, but both sides remain far apart. Now, Pakistan has offered to mediate peace talks between the US and Iran to end the war, an overture that was amplified by President Donald Trump on social media. Meanwhile, the US has sent Iran a 15-point plan that required Iran to dismantle its 3 main nuclear sites and end any enrichment on Iranian soil. The document calls to suspend its ballistic missile work and curb support for proxies and fully reopen the Strait of Hormuz. President Trump also said that Iran is going to make a deal and that the US is dealing with the right people. Listen in.
They're going to make a deal. They did something yesterday that was amazing, actually. They gave us a present, and the present arrived today. And it was a very big present worth a tremendous amount of money. And I'm not going to tell you what that present is, but it was a very significant prize. And they gave it to us, and they said they were going to give it, so that meant one thing to me: we're dealing with the right people. It was oil and gas related, and it was a very nice thing they did. But what it showed me is that we're dealing with the right people. Look, if we can end this without more lives being down, without knocking out $10 billion electric plants that are brand new and the apple of their eye, I'd like to be able to do that, you know. But they can't have certain things. I mean, you know the things. I don't have to go over the list, but again, it starts with no nuclear weapons, and they've agreed to that. There won't be any nuclear weapons. They're not going to have, and they're not going to have enrichment, any of those things. But look, I hate to say that we're in a very good bargaining position, and I hate to say that they're defenseless because, you know, until that last missile is fired, they have little power. But we are in about the best bargaining position. We're way ahead of schedule. And again, they have no Navy and they have no Air Force and they have no missile protection, and most of their missiles are gone. Most of their launches we've killed.
Dan Murphy is joining us now with the latest from the West Asia war. Dan, you know, US coming out with their plan. Iran has also come out and said what they want. So take us through the latest.
Good morning to you. Well, as you've been discussing today, oil prices are lower, market sentiment is up, and investors are really reading President Trump's 15-point peace plan as evidence that Washington is serious about ending this conflict. The New York Times reports that this plan covers Iran's nuclear and missile programs as well as shipping through the Strait of Hormuz. But of course, there are some fundamental questions still unanswered about who exactly the United States is talking to. And analysts tell me today this might sound more like a wish list than a ceasefire framework. Nevertheless, as you've just heard there, President Trump really signaling progress and also saying that Tehran wants a deal. And we are learning more about Iran's demands now as well, with the Wall Street Journal reporting that the IRGC is calling for the closure of all US military bases in the Gulf. They want reparations for attacks on Iran, control over the Strait of Hormuz transit fees, the lifting of all sanctions, and the right to keep its missile program intact. Now, a US official told the Journal that those demands are ridiculous and unrealistic. And no real surprises to also hear today that that is a view being shared inside the Gulf capitals, where leaders are also reportedly lobbying the president to stick with the war until Iran is weak enough or to not pose a threat to their people or to their critical civilian and energy infrastructure. And then on the ground as well, there are very few signs of a slowdown here because on the one hand, while President Trump is talking about a potential peace deal here, we also have defensive assets picking up in the region. The Pentagon is deploying thousands of additional troops to the region. Iran is maintaining its grip on the Strait of Hormuz. Israel also saying its strikes on Iran will continue at full intensity. And it's really unclear where this goes by Friday. Of course, the president's new deadline really sets up another critical juncture as we come into the end of the trading week. And as the Wall Street Journal also said today, we can call it Trump-style diplomacy, right? One hand extends while the other visibly winds for a punch. It's back over to you.
Dan Murphy, thank you for all of those updates coming in there from West Asia. Take a short break. Back with more on the other side. Stay tuned.
Welcome back. You're still with us on Business Lunch. IPL's billion-dollar valuations and strong revenue model are in focus as we break down the business behind the league. Let's go across to Mangalam Malu for all of those details. Mangalam?
Well, as we talk about the recent IPL deals that took place, it's important to first understand just how valuable this league has become. Franchise valuations that are rivaling global sporting leagues as well. Rajasthan Royals valued at about $1.6 billion with investors which include global marquee names like the Walmart and the Ford family. And then you have, this team which was bought for just a few $100 million back in 2008. Similar is the case for Royal Challengers Bangalore, now close to $1.8 billion with institutional investors like private equity giants and large Indian business groups participating as well. The IPL isn't just a cricket league. It's a scaled sports entertainment asset with predictable cash flows, strong brand equity, and global investor interest. So from a few $1 million in 2008 to $1 billion plus valuation today, near $2 billion, the value creation has been so extraordinary that sets the base for us to understand how the business model of the IPL works. Let's start looking at it from a franchise owner's perspective. The franchise fee, which is about 20% of the revenue for old franchise and fixed fee for the new ones, the likes of LSG, etc. Then you have the player's fee, which is an expense, and then you obviously have the operating expenses. Whereas the revenue head for each of these IPL franchises, you get one, the central revenue pool coming in from the BCCI for title sponsorships, the big chunk of revenue coming in from media rights. Then you obviously have the team's own sponsors, gate revenue, and merchandise. So of the central revenue pool that accrues to the BCCI, 50% of which is held by them, and they give it to the other teams at 50%. Remember, media rights are close to around 500 crore rupees, title rights about 1350 crores coming in from the franchise fee. And how do these actual numbers look? From publicly available information that we have from CSK and RCB's annual reports for FY25, the revenues for the teams could be between 500 to 650 crores, with EBITDA margins between 37 to 40%. And these are among the highest EBITDA making margins, sport properties in the world. Going forward, what are the triggers at these valuations that people will be looking at? The biggest one will be the revised media rights auction cycle from 2028. And at the same time, you'll have the central sponsorship auction coming in from 2028 as well. These two account for majority of the company's revenues. Going forward, popularity of women's IPL is an optionality. Higher number of teams and high number of games. Currently, it's just a 2-month window. A likely longer window could also be a big upside. And finally, a lot of these companies have investments in overseas leagues as well, the 100, etc. If that comes about, then those could be big optionalities. But the big numbers will obviously be, the renegotiations of the media rights. But that's where the big risk is as well. Lower than expected ad spend environment, upside limited for new media rights auctions if they don't come at current valuations. And then going forward, any change in regulation by the BCCI could throw a spanner in the works as well. You already know the listed players beyond Diageo or United Spirits. You have SRH owned by Sun TV, 65% of their market cap comes in from there. LSG, RPSG Ventures owns 50% of that. If you account for a holdco discount and look at 51% stake, that could be nearly 250% of its current market cap, which explains why the stocks move higher today as well. So now that you know about the business, just sit back, relax, and enjoy the games.
Mangalam, thank you for that. And now that the context is set, let's get the deal contours and put those big figures into perspective with Rashna.
Billion-dollar deals are rewriting the business of IPL, and the numbers tell the story. Start with Rajasthan Royals. The franchise has been sold for $1.63 billion to a consortium led by Karl Somani with backing from global heavyweight investors, including the Walmart and Ford-linked families. This is a full 100% exit. The BCCI will also take its 5% transaction fee. That comes to roughly about 765 crore rupees. Now let's take a look at the returns. Before the sale, emerging media held 65% of the team, along with Redbird Capital, that was at 15%, and Lachlan Murdoch around 13%. But let's rewind it further and go back to 2008 when Rajasthan Royals was bought for just $67 million. That was the cheapest team at the time. Today, it valued at $1.63 billion. That is about 24x return in dollar terms. Emerging media, that was on the cap table since the very beginning, alone walks away with over $1 billion. Eventually, they upped their stake, which is why the returns also go up. Now, Redbird came in later and yet clocks about 6.5x in just 5 years. And Murdoch sees returns of around 10x in a similar period. Then comes the bigger deal of the day. Royal Challengers Bengaluru has been sold for $1.78 billion or roughly 16,600 crore rupees, making it the most expensive IPL franchise sale ever. Now, the seller is United Spirits, owned by Diageo, and the stake sold is a full 100%, including both the IPL and WPL teams. The buyers are a powerful consortium that includes the Aditya Birla Group, along with Satyan Gajwani of Times Group, David Blitzer's Bolt Ventures, and PE major Blackstone. The BCCI fees here comes to about 835 crore rupees, and the returns here are just as striking. RCB was originally bought in 2008 for $111.6 million. It is now being sold for $1.78 billion. That's about 16x return. And importantly, this is an asset that Diageo did not even set out to acquire. It came in as a part of the USL deal and is now delivering a massive standalone windfall of almost 50% of the acquisition cost of USL, which was around $3 billion. So the big question here is, what is driving these valuations? Well, at the core of the business is IPL's media rights cycle was over 48,000 crore rupees. That translates into more than $80 million per team every year, with over $400 million of revenue visibility logged in over 5 years. And that is why global capital is lining up. And how? Because the IPL is now no longer just cricket league or a tournament. It's a billion-dollar investment platform where early bets are delivering extraordinary returns and new money is chasing the next phase of growth.
All right, Rachna, many thanks for taking us through those details. But with that, it is a wrap on this edition of Business Lunch. From Hormaz and me, goodbye and many thanks for watching. Midcap Radar coming up next.
Good afternoon. Welcome to Midcap Radar, live from the CNBC TV 18 Motilal Oswal studio. I'm Sonal Bhutra. With me today is Reema Tendulkar. Reema, good afternoon. 500 points higher on the Nifty. But, 23,500 continues to be an important level to watch. If we cross that, that will be important in terms of Nifty moves. Midcap's doing well, and all the sectoral indices in the green today.
Indeed, it's a powerful follow-on rally that we saw yesterday, 400 points. Today, we had a gap-up opening of 150 points, and on that, we've built at 500 points gain now as we speak at 130. In 2 days, it's a 900-point rally on the Nifty. Let's run you through the top headlines that we're tracking at 1:30 p.m. on Midcap Radar. Stocks power up on hope of an early end to the West Asia war as U.S. explores a ceasefire deal. Realty, consumer durables, PSU banks, autos are the biggest gainers.
PG Electroplast zooms after company notifies that the current room air conditioner production ecosystem has almost normalized. Company has identified alternative solutions to LPG across manufacturing units amid the war-led gas crisis.
Small cap defense player Avantel jumps on the back of a 460 crore order win from Zetwork Manufacturing Business for supply of satellite communication equipment, order to be executed over a 3-year period.
Sagility powers up in trade. Nomura initiates coverage with a buy rating. The brokerage highlights growth potential driven by increasing adoption of AI in healthcare, positioning Sagility as a key beneficiary of the evolving tech-led transformation in the sector.
RBI has cleared international holding company Abu Dhabi's acquisition of 66.6% stake in Saman Capital, paving the way for a change of control and an open offer to the shareholders. The stock jumps on the back of this news.
Okay, all right. Those are the top headlines that we are tracking. For the markets, as we've been pointing out, second day of rally on the markets, 23,500, that continues to be an important level to watch. A lot of moving parts in the broader markets. We do have the advance decline ratio, which is strongly in favor of advances as we speak. So that is a number which the street seems to like as well. Small caps also doing really well. That has been the fundamentals of the market, where some relief in the West Asia war and possibility of that going down is something that the street is watching out for.
Just some stocks which are not participating in the up move. One of them is United Spirits. The news is positive. There is a windfall gain of 17,000 crore rupees, but the stock is corrected over 1% today, 1.25% lower, but this follows a 4% gain yesterday. Sun TV is the other one. No re-rating, at least for today, seen in the shares of Sun TV. The big one has been RPSG Ventures. That's up 17-18%. NOSL 2 has corrected over the last 3-4 trading sessions. It's been popping up on the larger, very large volumes. Price action was visible, but today you are seeing profit booking while the rest of the market rallies on. But let's talk about some more stocks. This is Midcap Movers. Ria joins in to take us through the stocks, the small cap, mid caps, which are moving in trade.
Well, yes, let's start off with the gainers first. We have PCBL Chemical as well as Godfrey Phillips, both up on the back of very strong volumes today. Saman Capital also up roughly 5% on the back of the IHC deal, and Deepak Fertilizers as well as Sagility performing well in today's trading session. Some 3 stocks today at their 52-week highs, that is Emcure Pharma, Granules as well as Aurobindo Pharma. So Pharma stocks clearly picking up in today's trade as well. The Nifty PSU Bank Index remains at the top sectoral gainer, up roughly 3% today. Indian Bank, Union Bank as well as Maharashtra Bank being the top gainers in this index. On the losing side, we have 3 stocks today. OneSource Pharmaceuticals down roughly 6%, Metropolis Health down 2%, and even Alkyl Amines down roughly 1.5% today.
Okay, all right. So those are some mid-cap movers. Thank you, Ria, for joining in. Let's now welcome Ajit Mishra of Religare Broking for a technical check on the markets. Ajit, good afternoon. Thank you so much for joining in. What is the next important level on the Nifty? Do you think we'll be able to cross those levels of 23,500? And that could mean, adding on to more gains that we have seen, considering that tomorrow is a trading holiday?
Good afternoon, Sonal. So yes, it's true that markets have definitely showed strength in the last 2 trading sessions, and today specifically because crude is trading down below $100 mark and sustaining around that area. At the same time, the only challenge that I see in the market is that VIX is still holding around 24 level, which is still a very elevated level with hardly any sign of correction. So it seems like that market is definitely celebrating this move, but at the same time, the caution is still intact. in this move, in this recovery, we feel that a level close to around 23,600 to 800. It's basically a mean reversion move because the decline was almost vertical. So we shall be inching closer to the 20 EMA mark, which is close to around 23,800. So as of now, yes, this recovery is likely to extend with 23,600 to 800 being the next hurdle area for the index.
Well, it is indeed still back to tracking the headlines to get some more conviction and confidence whether the ceasefire holds. But the Dow futures is up nearly 400 points. So that on the sidelines is positive. European markets have not opened up for trade, but the futures are suggesting a strong 1% open. Ajit, what are you tracking in terms of stocks today?
So Rima, considering the kind of recovery that we are seeing in the rate sensitive pack, while Pharma is still holding the ground the way we were seeing the resilience continuing even during the down days. So SBI from the banking basket, wherein we are seeing that the stock has been establishing a base around the medium-term moving averages, and possibility of a rebound is there. So 1130 is an immediate target. SBI can be considered for fresh long position with 1025 as a stop loss. Then we have Laurus Lab, wherein we are seeing fresh breakout from consolidation range. The stock is trading very closer to its record highs as well. So indications are in the favor that this momentum is likely to continue. So 1110 is what we are eyeing as an immediate target in Laurus Lab, with 990 as a stop loss.
Take that point, Ajit. Thank you so much for joining in with that technical check. We'll slip into a short break now. When we come back, we'll be joined by the management of Embassy REIT on the other side. Stay tuned for that. Welcome back. You're still tuned into Midcap Radar. Let's get a corporate conversation going now. Amit Shetty, the CEO of Embassy REIT, is joining us now to discuss the business fundamentals and the outlook going forward. Amit, good afternoon. Thank you so much for joining in. In a recent conversation with one of the brokerage firms, Jefferies, you guided for around 10% NOI growth for the next 4 years. If you can give us a sense of what gives you the confidence of this growth and how much of it is through existing leases versus what is dependent on new leasing that would come by in the business.
Sure. Thank you, Sonal, for having me on the show today, and a very good afternoon to all your viewers. For the last 7 years, we've been building a very strong, resilient platform that's consistently delivering growth year after year. Right. Having said that, we have 4 primary growth levers, which is fundamentally the reason why I said, a double-digit growth on the NOI. The first one is the organic growth. The second one is the inorganic growth. The third is obviously, optimization of our debt. And finally, some of the capital recycling that we've actually done. So on the organic side, we've got about 1835 crores. That's about 50% NOI growth. On the inorganic side, we've got about 12 to 13 million square feet of opportunities across the country that we have actually evaluated that, we are now waiting for board approvals and also final DDs. So that's the other bit. And also from a debt optimization perspective, we've optimized our debt from 7.9% at the beginning of this financial year to about 7.29%. And obviously, some opportunities that are there within the portfolio, non-core assets, we've recycled those assets. Rather recently, we've recycled about 530 crores worth of, a strata-owned asset in Manyata that we sold. So this is fundamentally the levers that gives us the fundamental direction on the double-digit growth, Sonal.
Amit, hi. Afternoon. This is Rima here. You said you're awaiting board approval for making the inorganic acquisitions, 12 to 13 million square feet. Did I get the number right?
Yeah, about 12 to 13 million square feet. Yeah, we are actually evaluating. Some of these are at different stages of acquisition. Some are awaiting board approval, but
and how much will you spend to get them on stream, and over what period of time? Say in FY27, how much do you think you will be able to close?
Okay. So, I think, we've got 2 assets from our sponsor, which is a ROFR asset. One is about 400,000 square feet, prime CBD asset, which is leased to one of the largest technology companies in the world. The second asset is another 3.3 million square feet in Whitefield micro market. These are currently under evaluation, under technical due diligence, as well as legal due diligence. As and when we are ready, we'll come out to the market and we'll announce.
Okay, so this is something that Street will be closely watching, Amit. You've also spoken about 20 million square feet of active requests for proposals that are underway. If you can give us a sense of which sectors are driving this demand. We spoke about the big GCC push, but then IT was not doing so well. Is that trend continuing? And do you think that is something which will drive growth for the next 4 years? If you can give us the sectoral demand pattern.
Sure. Before I begin there, the last year was actually a robust year. We saw about 83 million square feet of leasing across the country. And majority of that, about 40% of that came from the GCC sector itself. 20% of that demand came from flex operators, and about 15 to about 19% from BFSI, and 10% from R&D and manufacturing. So there's been a whole lot of guys across this sector that have actually been on the back of this demand. Going forward, we see similar absorption of about 85 million square feet, and the RFP to date in the market is about 20 million square feet. Predominantly 40 to 50% of that demand is coming from GCCs, right? And having said that, currently what we are seeing is a whole lot of new companies actually entering the Indian ecosystem. Earlier, we were talking about the Fortune 500. Now we're talking something like Fortune 5,000 companies that are actually wanting to enter India.
What is the contractual rental escalation for you, or what percentage or part of your portfolio? And if it has to be market linked now, what is the rental escalation?
So, we have contractual escalation of either 15% every 3 years or, between 5 to 6% per annum, depending upon which property and which micro market that property is located. Having said that, over the next 4 years, we're seeing about 39 million square feet of contractual escalation already embedded in our portfolio, which will give us an upside of about 535 crores, which translates roughly about 14% per annum.
Okay. Amit, apart from office, even hospitality is becoming a big part of the overall business, right? What kind of growth aspects do you have here, and how do returns differentiate between the office business versus hospitality?
See, hospitality business for us is part of the total business ecosystem offering that we have, right? So we have about 6% of our revenue stream coming up from the hospitality business. Our hospitality business is actually grown. If you see, our ADRs have grown by about 14%. Our RevPARs have grown by about 11%, right? And we're looking at EBITDA growth of about double digit on our hospitality business, right? Having said that, we continue to invest in these large schemes simply because, from an ecosystem, I think this is what a corporate occupier really likes. The fact that, they can live, work, and, play in the same ecosystem.
Okay, all right. Always a pleasure speaking with you, Amit. Thank you so much for joining us with your thoughts on the business and the way forward. Looking at an NOI growth of 10% going forward and dividend per unit also to grow by 10%. That's the word coming in from Embassy REIT. With that, we'll slip into a short break. When we come back, we'll get you more on the markets. Stay tuned for that.
Welcome back. PG Electroplast was one stock which got impacted on account of the LPG shortage. Since the start of the conflict, the stock was down nearly 20% till yesterday. But today there is some good news because the company is informed that they've identified alternate solutions to the LPG shortage and therefore production should be on track. Upasana joins in with the latest.
Well, first up, let me give you some background. On 9th of March, company had intimated the exchanges that the LPG shortage is there because of the Middle East conflict. Now, the disruption led to curbs on LPG allocations with effect from 9th of March, prompting the firm to explore alternative solution. Now, today morning, the company updated us that the company has identified alternative solutions to LPG, and the room AC production, which was one of the key highly impacted category, must say, is normalized now, and the company is able to address the challenge of LPG shortage. Now, the company's product business is one of the key contributor to the revenue, which forms nearly 73% if I count on 9-month FY26 basis. Now, the product business comprises of RAC, washing machine and coolers, out of which RAC is the key category. If we look at the RAC growth performance on 9-month basis, it's seen an uptick of 27% on 1-year basis, and the company has given a full year guidance of 17 to 19% versus the 21% revenue growth run rate that is seen on 9-month basis. Now, when company joined us on the back of this gas shortage move, they had indicated that the gas shortage may impact company's FY26 revenue guidance, which is around 5,800 crore, and the March month alone accounts for nearly 12 to 15% of the annual sales. And as of mid-March, the company's 1 week of production was impacted. So the key monitorable now will be the company's RAC growth this quarter. Mind you that Q4 is seasonally a strong quarter for RACs. So let us see how the Q4 pans out for the company.
Okay, all right. So alternate supplies instead of LPG, that's running PG Electroplast functions now. Thank you so much for bringing us all those details, Upasana. Sagility is the other stock on our radar on the back of bullish note that is coming from Nomura. It's an initiating coverage. Let's go across to Sudarshan for the details. Sudarshan.
So on the positive brokerage note, Sagility stock is up more than 7% in today's trading session, and UBS has initiated coverage with a buy call and target here is rupees 55 per share. It says company is a vertically integrated healthcare focused technology player, and it's going to be one of the biggest beneficiaries as far as AI is concerned, and it's a pair margin constants fueling outsourcing demand and also growth momentum over the last few years. And going forward, it believes that its company is going to see 20% EPS CAGR over FY26-28.
Thank you very much for that. That is about Sagility. Now shifting attention now, a conversation that my colleague Ritu had at India Spora Forum in Bengaluru, where Bajaj FinServ Sanjeev Bajaj spoke about how they're leveraging data analytics and the steps taken in the AI race. Listen in.
We've been leveraging data analytics to get to know more and more about our customers. Our first data lake in Bajaj Finance came up in 2014, where we brought in structured and unstructured data together. So we had a 10-year head start understanding how to use data with machine learning, with the simpler algos over the past decade in enabling better decision making. And then November 22, when ChatGPT first came out, we suddenly saw the power of this. We are working in a number of areas. Yes, we have 400 agents working today. By next year, we'll have 600 agents across sales, service, and internal operations, underwriting, risk, with of course, in parallel, human eyes, monitoring, giving the final approval, because end of the day, we are a regulated financial services set of businesses.
Sanjeev Bajaj also spoke about Alliance and the reason behind the split. Listen in.
Bajaj being in control gave a, and we were always in control. We owned 76%, 74% from day one, was helping build the business. To Alliance, they built with us two very high quality business, but they are one of the world's largest companies. So they used to keep telling me over the last decade, Sanjeev, how can we keep telling other people around us that we will never be in a position of control in India because you're there? And I said, you know, I understand that. It's like if I were to go to some other country, I also want to be in control. I said, look at it this way, you got somebody working for you in India and building good quality businesses because we are always going to be in control. So long story short, they wanted to be in control. That is not going to be with us. So we actually parted very amicably, but we bought them out nearly $2.5 billion for their 26% stake.
Okay, all right. That's the word coming in from Sanjeev Bajaj. But looking at the markets, some of these stocks which are at the day's high, PCBL, for instance, is up 15%. We have Godfrey Phillips, which is up 15% in trade. Fino Payments Bank locked in upper circuit. That's seeing a gain of around 10%. Avantel, on the back of that order win, also is doing well in trade. That's up around 10%. Sagility, we just spoke about it. Z Entertainment is also higher by 6.5%. We do have Kalyan Jewelers as well, which is higher by 6.5% in trade today. And across the board, in some of these chemical names as well, we are seeing big gains come by. But with that, we'll take your leave on this edition of Midcap Radar. Stay tuned, your stocks when we return. Hello and welcome. You're tuned into Your Stocks. We are coming to you live from the CNBC TV 18 Motilal Oswal studio. I'm Sonal Bhutra. With me is Manglam Malu. Hey Manglam, good afternoon. A good day for the markets. Second day running. The Nifty is up around 500 points. Since yesterday and today, I think we've seen a 900-point rally on the Nifty already. It's been a good day for the broader markets as well. The advance decline ratio strongly in favor of the advances, and all the sectoral indices, they are in the green today. But on the show today, we'll answer individual stock queries from a fundamental angle and some sector queries from a technical angle.
Yes, we will, and this is the perfect time to do so, right? There has been so much volatility in the market over the last couple of weeks, and add to that, there is some semblance of recovery that we've seen over the last couple of trading sessions. Whether this sustains or not during these uncertain times, what should your portfolio approach be? What should your sector approach be? And at the same time, what should your investment approach be? And that's exactly why we're here on Your Stocks. As we can see, all the sectors doing extremely well in today's trading session. The only one which is not participating with that gusto is the IT pack. So that's something that remains to be seen, whether we do see the IT pack move in step with the others that have recovered or not. But to be fair, the IT index did not fall as much with all the other sectors as well. In the broader markets, though, the gains have been a lot more pronounced in a couple of these small stocks. So we have, something like a Keynes Tech and Z Entertainment, Kalyan Jewelers, PI Industries. These are mid-cap names. And if you look at some of the small-cap names as well, they are seeing a fair amount of traction. Triveni Engineering, for one, up around 13%. Godfrey Phillips is the other one, which is up 12%. And when we speak about Kalyan Jewelers and Titan, look at Thangamel Jewelers. That one's up 9% as well. And then we have RPSG Ventures, obviously been gaining all through the course of today's trading session. PCBL is another Sanjeev Goenka company group, which is up around 17%. So let's post this market check, get an idea of what your portfolio approach should be. And we do have our guests with us, Rohit Srivastav, who's the founder of India Charts and Strike Money. Along with him, Sneha Poddar, VP Research Wealth Management at Motilal Oswal Financial Services. Let's go across to the first query. Queries have been coming in thick and fast. Raja Shekhar writes to us from Andhra Pradesh. Holds about 20 shares of ONGC at 369 rupees, 25 shares of Eternal at 260 rupees. Wants to know whether he should hold or, he should continue to hold or exit at current levels. Rohit, I'll come to you. These are nifty stocks. But before, we come to you for a chart check, let's ask Sneha if, she has a call from a long-term standpoint on both Eternal and ONGC. Currently, ONGC doing well because of the upstream oil companies rising on account of higher crude, and the fear of withholding tax is, a windfall tax is removed. And at the same time, Eternal does extremely well when the market does well.
Okay, good afternoon. In case of ONGC, basically, obviously it's doing well because of the current ongoing situation. The oil prices are upholding high, so we're seeing the positive reaction over there. But from the long-term perspective, their KG Basin project is in the final commissioning stage, and we can expect the first gas anytime soon. And moreover, they've utilized 80% of the capex, which was about 35,000 crores earmarked for FY26. So almost 80% has been utilized, and basis that they have given the projection of almost 8% growth in the total production for FY27, which is a good recovery compared to the declining output that we saw in the previous years. Plus, it has about 5% dividend yield. So, dividend yield along with the production ramp up provides the fundamental cushion for the long-term perspective. In the near term, the stock might see some negative reaction once the war settles down. The prices may cool down. So, that could have some sentiment on the negative side. But in the long run, the commissioning of the KG Basin project is a big positive for the company. Now, if I talk about Eternal, so Eternal recently, they hiked the platform fees to 15 rupees, which brings it at par with Swiggy. So that will add meaningfully to its margin tailwind without hurting the demand. And if we really look at it. So they are shifting, they're moving more towards the Blinkit project, which is the quick commerce segment, and there they achieved the major milestone of being EBITDA positive in Q3, and they have infused about 450 crores to target 3,000 dark stores by March 27. So that will provide them a large scale compared to their peers. And moreover, the Hyperpure project is doing really well for them, which is becoming a challenge for their peers to replicate. So I believe they will, despite the heated competition, they will continue to retain the market leadership, and these levels are really good to accumulate from the long-term perspective.
Okay, take that point. Thank you for explaining that for us. Rohit, comment on this, since we are talking about Nifty stocks, what do you make of the Nifty levels now? We are at the 23,000, very close to the 23,500 mark. Do you think if we cross that, we could see a meaningful upside? Or do you think, considering that it is truncated week this week, the next week as well, we could see lower levels or at least consolidation?
No, I'm going to surprise you because we have taken a call that the market has bottomed out. The worst is over. And you should not expect a new low now from here, at least for the coming months. You're probably going to go above, 24,000 on the Nifty. 24,000 to 24,600 is what we're going to be looking at initially. There can be a case for it to even go higher. That would be the first, series of hurdles where we will try to take a judgment on, whether this only looks like a bounce. But I think given the extremes in sentiment, the kind of capitulation we saw into Monday, it looks like you may have made a more meaningful low for the market, and there's a case for it to go even higher. So we'll probably take a 3 to 6 month bullish call over here for markets to recover and continue to do well. The choice will really have to be on the right sectors or stocks. Everything might not participate. We have seen certain sectors underperform over the last 1 to 2 years. That would be an issue. But same way, even Bank Nifty, I think meaningful decline. We've made a low close to 51,300. We should initially be heading towards 56,000, and if we cross that, maybe 57,700. But be open to further upside for the same reasons that I just mentioned.
Take that point. So that's the call on Nifty, Bank and Nifty. Important one at that. You think the market has made a bottom, and from here on, you could see high levels come by in that range that Rohit just mentioned. We also spoke about ONGC, Rohit, and this is one space which has been in focus since the time the war started, the West Asia war, that is. What's your take on, say, Nifty Oil and Gas or some of these CPSE names that you would like to talk about?
So it's pretty interesting. The entire sector, especially public sector stocks or ONGC, as you mentioned, NTPC, many of them have actually held out very, very well through this entire, war period. They've sort of outperformed. Maybe they've even helped the index not fall too much, because if you had seen the selling become more broad-based into public sector stocks, they do have significant weightage in the index itself, and they could have probably brought it down to much lower levels. So they've played a pretty good role in keeping it up. But some of the logic behind keeping it up, as was being discussed earlier, has been, higher oil prices or even commodity prices, some of which have already cooled off. You have seen copper prices fall off quite a bit. So then, will you continue to see, these PSU stocks, which are in those related sectors, hold out? They would, but probably their performance won't be the same as it was right now. They may have been good hedges, in a poor market, but in a good market, you probably want to reallocate your funds elsewhere. So it's just a return question. If now the environment moves from risk off to risk on, then you want to be in growth sectors and not really in defensive sectors. So that's the main diversion that you would take, because PSU stocks have historically grown much more slowly than non-PSU names.
Yeah, take that point, Rohit. But let's go across to another query. This one comes in from Himachal Pradesh. We have Narendra who writes to us, and he has an investment query. He wants to know whether he can invest in Shelly Engineering for a period of 18 to 24 months. The good part is that the query is posed before making the investment decision. So whether or not is an answer that he gets before committing finances to that. Sneha, we've been speaking about the semaglutide opportunity, and they've also increased their capacity when it comes to pens for delivery of the semaglutide. Do you think Shelly Engineering for the next 18 to 24 months is a good investment bet?
Yes, definitely. I believe so because the company has moved into the high precision healthcare CDMO, as you mentioned. So it's a direct beneficiary of the global weight loss drug boom. And given that they are doubling the pen injection capacity to 150 million units with a new, Abu Dhabi plant getting operational by FY28. So obviously that provides a very strong revenue visibility. And they have, in fact, recently onboarded the two new global pharma majors for the pen injectors. So, keeping that the investor is looking from the 2-year perspective, it definitely has the potential to capture the massive earnings ramp up from here onwards. So, at these levels, one can actually look to enter into it from the long term perspective.
Okay, take that point. Sneha and Rohit, I would request you to wait. We have to take a quick commercial break. When we come back, we'll answer more of your stock queries and sectoral outlook on the other side. Stay tuned for that.
Welcome back. From the peak, we've seen about a 30-40 point correction on the Nifty. Can't even call it a correction. It's just a smidge of a decline. Maybe, will we get bought into as we've seen through the course of the day. Sun Pharma is one of the stocks which is seeing a big up move right now. In fact, the entire pharma pack, Sun Pharma is at the day's high. Dr. Reddy is up 4%. The Cipla stock as well is at the day's high. In fact, the pharmaceutical index itself should tell you the kind of move that we've seen in its constituents. But we still have with us Rohit Srivastava of India Charts and Strike Money, along with Sneha Poddar, answering your stock and investment related queries. Rohit, got to ask you about L&T. We'll talk about that in just a bit, but Nifty Realty.
You see, the real estate index has been one of the worst performing indices since 2024. So since the market peaked in September of 24, we've seen it actually go down. It hasn't made a new high yet. It also did not recover when the markets recovered last year, after the tariffs, came in. So this is one of the weakest segments. It's very hard to say whether even if the market bottoms now, will the real estate sector completely turn around or not. Slightly tough call. We would want to give it a miss for the time being. There is a short-term trade there where you can actually get a maybe 4, 5, 6% kind of up move in real estate stocks further from here. So there may be a trade, but when it comes to taking a longer term view, then I would still be slightly cautious with the real estate stocks.
So cautious on the real estate space despite the big fall that we've seen from the highs on this particular name. But what about metals? I'm trying to connect the two because now metal prices have increased and that's something that's impacting real estate builders in terms of input costs as well. What about metals? Do you think that is something that will make a sharper comeback? It did well at the start of 2026, then saw some decline. What's your call here?
There is a case. They've consolidated well. And they've also held out through the war phase, and of course because prices in general held up, thinking that you're going to need a lot more metals because of the demand for reconstruction or demand because of defense or whatever reason. Metal prices really held out. There's also the cost angle that oil prices go up and then commodity prices generally hold out. And the third one, which is more specific to India, is the weaker currency because most commodity prices are priced in dollars, and when your currency starts to weaken, then even if it falls in dollar terms and rupee terms, you actually see commodity prices hold higher. So there have been some positive things for the metal space. It's possible that you do see a meaningful move again in metal stocks on the way up. You want to really get some more confirmation on that though. Just because of this inversion, because once you see the war period getting discounted, will commodity prices make a comeback or continue to remain weak? Will the dollar really strengthen? Because that's one of the underlying reasons why commodity prices actually strengthen or weaken. And the dollar was strong since the end of January, which actually was putting downward pressure. Now, if that starts to weaken, then yes, it will add further fillip to commodity prices and help metals. But within the commodity space, what I would really ask people to look at outside of metals is look at the agro commodity space, because agro commodity prices are showing a very, very different picture. It's less looked at, often ignored, but there seems to be a strong agro cycle taking place below the surface.
Okay, take that point, Rohit. But let's look at the fundamental lens as well and some of the stocks which are in the infra construction space. So Siddharth is writing to us from New Delhi. He holds around 50 shares of L&T at 3,500 rupees a share. Also has a financial name in his portfolio, 300 shares of Bajaj Finance at 225 rupees. He asks whether to hold or sell at current levels. Sneha, comment on this. What do you make of these two names? L&T, there was this big fear of Middle East exposure, but they clarify that 95% of their portfolio or order book is not impacted at all. What do you make of these two names?
So basically, the current the current situation is actually providing a good entry point into L&T because, as you mentioned, given 35% exposure over this, but still 95% of the projects are unaffected, and moreover, the real story is that they have an order book of 7 trillion plus, which is a big order book, and it provides good revenue visibility. So though the logistic cost in the because of the situation has spiked by about 10-15%, but then this is a short-term impact, and moreover they are most likely to pass this on to their clients. The bigger picture is the larger order book that they have and which provides good revenue visibility. Plus, once the war settles down, so the kind of damage that we've seen in the Middle East, in order to build the infrastructure once again, L&T is a big contender over there, especially in the energy projects. So they have, they are one of the front runners over there. So that provides a very good potential from the long-term perspective. And also, their recent diversification into hydrocarbons, renewables, transmission, data center. So all these, add multiple legway to the overall growth story for L&T. So from long-term perspective, my suggestion would be it's a very good entry level, so one can accumulate at these levels. And in case of Bajaj Finance, the main focus is on their customer franchise expansion, which is on track. In fact, they recently, about to cross about 120 million this year, because they are adding about 17 to 18 million new customers annually. And and with the new AI implementation which they have recently done, So this seems to be quite achievable, and they are using it to actually improve their overall operational efficiencies. So in the recent, if you notice, MSME lending was the one segment which really slowed down and kind of impacted their numbers. But then the overall AUM growth has been really robust at 20% plus, which is a good positive sign. So from long-term perspective, I believe that Bajaj Finance will continue to be a market leader, and they will continue to grow at about 25% CAGR. So it's a good long-term compounding story. The short-term negatives the noises can be avoided.
All right, that can be avoided. Let's wrap it up then with one of the sectors that has been a bit of an underperformer. That's the FMCG pack. Questions on whether there is structural derating or not because of low growth and high valuations. Well, fundamentally, we know growth needs to pick up and valuations need to moderate a little bit. Chartically, what's the price telling you? Rohit, on the FMCG pack, after this underperformance, what's your call?
I think if you're seriously interested in FMCG, the big correction might actually be over in terms of price. From the peak in September to the bottom that we are seeing right now, we call this a large ABC correction in our language, and we are at the end of that third wave of the correction, which then puts you at the end of a very large corrective period for the sector itself. And the risk reward might actually be favorable to going long. So if somebody has a serious interest in having FMCG exposure, I think the time to look at it is probably now.
Okay, take that point. Rohit and Sneha, thank you so much for joining us today. We had a lot more queries which we wanted you to answer, but we're completely out of time. But thank you so much for joining us today with your thoughts on the technical front and fundamental lens as well. But with that, we'll take your leave on this edition of Your Stocks. But do remember to email us your queries and we'll address them with our experts. Stay tuned for Closing Bell to take you through the last hour of trade.
beyond market headlines. To understand the reasons for the day's movers and shakers. And get your portfolio ready for tomorrow. Beaming live from the CNBC TV 18 Motilal Oswal studio.
The Hang Seng is trading with gains of close to 1%. The Taiwanese index is almost 3% higher this morning.
They gave it to us, and they said they were going to give it, so that meant one thing to me: we're dealing with the right people.
There is perhaps room for more repair and recovery. We will see. It's not done yet. 23,068, 23,080, 23,100. So it's about 0.75% higher.
If this were to stretch longer, then we may have to, deal with somewhat of a lower valuation than what we had in the past.
RBI has also cleared the appointment of IHC's Alvin Crasta as a director on the company's management for 5 years.
Royal Challengers Bengaluru now close to $1.8 billion, with institutional investors like private equity giants and large Indian business groups participating as well.
So 850-point up move in the last couple of trading sessions, and that's definitely good news for the markets to take back.
Now today morning the company has updated that it has identified an alternative solution to LPG and the room AC production, which was one of the key impacted category, that has seen normalization.
Gold has become 65% of all non-property wealth that is held by Indian households today. That is more than deposits, it's more than equities.
23,500 continues to be an important level to watch. If we cross that, that will be important in terms of Nifty moves. Mid-caps doing well, and all the sectoral indices in the green today.
Okay, well, I think the turn has happened. The market's, of course, looking pretty good. 400 points on the screen right now. And this, of course, follows on the back of the gains that we saw yesterday as well. So 2 days, I think about 800 points is what we have on board for now. 23,320 on the index. Lots and lots of movers. Advanced decline is positive in a big way once again. This is Closing Bell. We're coming to you live from the CNBC TV 18 Motilal Oswal studios. I'm Prashant. With me, my colleague Rima. Rima, hi.
Hi, it's an 800-point rally in a span of 2 days. These are times when the bulls would have wished tomorrow was not a holiday, that we could have extended the up move, but very powerful rebound over the last two trading sessions. The high today was 23,450. So from that level, a little bit of a nick in the last 20 minutes or so. So we've come off about 100 points. But this has been a super solid trading session. Mid-cap index up 2.5%, more than 2.5% gain on the small-cap index. The advanced decline ratio has been strong, with 6 stocks advancing. And the optimism is extending even in the global market. So the Dow futures is now up 500 points. The last time I checked, about 1 hour back, the Dow futures was up 350 points. So that's extending the up move. And European markets too have opened up with strength. Let's unpack the final hour and tell you what's lined up on Closing Bell. Solid moves across the indices. The Nifty picks up momentum, now above 23,300. Broader markets moving in tandem with the larger peers. All sectoral indices in the green. Shares of Saman Capital are sharply off their intraday highs, but still in the green, following RBI's approval for IHC's acquisition of a controlling stake in the company. Reacting to the upbeat brokerage notes, we'll understand the rationale behind the stance in names like Sagility, Tata Power, JSW Energy, and others.
Rima, some of these names, right? Look at, we were talking about DPV yesterday, Shriram Finance. Yeah. Shriram Finance is up 10% in 2 days, right? Lots of these names which have moved rapidly. HDFC Bank is another case in point. I mean, Shriram Finance, 840, I think, is the offer price. Stock fell to about 875. And from there, it's given about 100 rupee up move. HDFC Bank, of course, from the lows has come up in a decent way. So, yeah, I mean, it is a combination of things. One, of course, the market hoping that there is going to be de-escalation. And by the way, it needs to happen. It needs to actually happen over the next few days. So far, it is commons and all of that stuff. But oil needs to start to flow from the Gulf of the Strait of Hormuz. So that it has to be tangible. It is on paper, it's headlines, but it's got to be tangible, and market will not wait that long. Over the next 2 days, all of this has to come to fruition. Otherwise, I mean, you'll start to worry once again. The other thing, of course, is this March, tax-related selling pressure. And I suspect perhaps that also is coming to a close. Is it a one-way kind of a move from here? Absolutely not. I think after 800,000 point, maybe we get to about 23,800 or so. And there the market sort of spends some time. It's not a runaway, one-way kind of a move. But it's just that there were a lot of shorts in the system, which still, I think, till yesterday there were some 38,000 contracts short, right? Before the war started, that number was about 20,000 contracts short, foreign contracts. So yeah, I mean, all that has to happen and perhaps will happen over the next next couple of trading sessions, provided this entire thing in the Middle East also, simmers down, as is the indication right now. How should you position yourself is the question. And Mitesh is with us with exactly that. Mitesh, good afternoon. Good to have you here. What's your sense? 400 points now, coming off a little bit as we speak.
I think that will happen, Prashant. But what is important is that one, we have got past 23, 120, 150 soon now. As long as we are above that, I think the short-term bias could be slightly. But we can say that the negative bias has been taken care of. Now I think I'll turn negative only if we start breaking to 23, 100. For the timing, it could be possibly a volatile range between 23,800 to 23,150. I think these are I'm watching. And on a stock-specific basis, I have a buy on BSE. Which has done really well. I think, it's held on in this decline also, and now it's trying to get on the upside. So keep a stop below 28.49. Look for targets of 29.80 to about 29.90. And IRDA is something, which is just come up. That's also trying to reverse. That's a buy with a stop just below levels of 117 for targets of 124.5.
Thank you very much for that, Mitesh. We'll come back to you. Let's talk about Saman Capital. It's up nearly about 6.5% today, though it's come off from the day's high, which was closer to 155. RBI has cleared a major acquisition by Avenir Investment, which means that there is going to be a change in ownership, control, and open offer. Ritu joins in with the details. Ritu.
That's right, Reema. The stock up and about. Yesterday, it gained almost 6.6%. And today, again, it was up more than 10%, now cooled off to about 6.5% because RBI has finally given it that much awaited go-ahead for the Saman Capital deal with Abu Dhabi's IHC. And it is the largest such investment by a Gulf company into the NBFC space in India. Now, RBI has approved the acquisition of up to 66.65% stake in Saman by Avenir Investment, which is IHC's wholly owned subsidiary, and also cleared the appointment of their, Alvin Crasta, who is an IHC, personnel, as a director on the company's management for 5 years. Now, Sammaan says that Avenir is going to invest about 8,850 crores. That's the infusion coming into the company, and it will be done through a preferential issue. So Avenir is going to hold about 41.2% stake after the preferential issue, which will go up all the way to 63.36% once the open offer is concluded as well. Now, keep in mind, RBI has given it the go-ahead, but the SEBI note is still awaited for the deal. Even the RBI note comes with some conditions attached. For instance, Sammaan cannot raise public deposits. It has to complete the deal within a year. Otherwise, the approval lapses. And if the ownership at any point falls below 26% after the transaction, Avenir will then require a fresh RBI approval to increase the ownership to 26% or beyond. So good news for Sammaan deal, getting the green flag for RBI. But for now, the focus will shift very much to these larger deals that are still in the fray. On your screen, you'll have the graphics, the Shriram MUFG deal, a large one, RBL Bank Emirates NB deal, which was announced all the way back in October, still pending the go-ahead from RBI. So we'll keep an eye out on those from now on.
Thank you very much for that. Siddharth Khemka, Motilal Oswal Financial Services now joins in. Siddharth, stock has gotten re-rated. It's up more than 10% in the span of 2 days, a little more than that. Is there more upside?
Hi, good afternoon, Reema. So unfortunately, we don't have coverage or view on Saman Capital, so very difficult to give me a view on that.
Okay, all right. Any of the other NBFCs that are pending approval, that you like?
So, Nigel, I think some of these NBFCs had seen a battered bruises in this fall. Shriram Finance is something that we like a lot. And I think valuations-wise, it had run up a little bit. But again, we believe that the the auto cycle in India, the auto sector, the CVs, as well as the passenger vehicles, that continues to do well. The company has been diversifying its mix to other segments, gold loans, tractors, secured MSME lending, to support the scalable growth across a balanced mix. And overall, we are expecting the around 18-20% kind of AUM growth. PAD growth should be around 30% with ROAs almost 3.9%, 4% kind of thing. So we believe that warrants a premium valuation compared to some of the other peers in the group. So we like Shriram Finance, and we have a target price of almost 1,200, which is giving a good, decent upside from current levels.
Shriram Finance. Okay, let's talk about the Kotak Mahindra Bank. There is a, sources tell CNBC TV 18 that an internal assessment of discrepancy is significantly lower than the 150 crore flagged off by Panchkula Municipal Corp. Ritu joins in with the details. Ritu?
Well, Reema, just to be clear, so far, neither from the government or Kotak Mahindra Bank, there have been no numbers that have been put on record. But what I want to highlight is this. Two banks in the span of less than a month, both dealing with deposit-linked irregularities, both involving the same Haryana government. So after IDFC First Bank, you now have Kotak Mahindra Bank, finding itself in the middle of this fixed deposit fraud row in Haryana that is linked this time to the Panchkula Municipal Corporation. Now, we understand the irregularity came to light over the weekend after the corporation instructed the bank to transfer funds after the maturity of their fixed deposits. And then the bank found that the money was not available. Now, while the bank has not commented on the amount, reports pegged it at about 150 crore rupees, but our sources indicate, as per the bank's own initial assessment, the impact could be roughly around 85 crore rupees, but the final number is only going to be clear once the reconciliation exercise, which is still underway, is completed. So the actual number could be smaller or larger, we'll have to see. Now, RBI has been very much in the loop, and at this stage, we understand the regulator does not see this as a bank-level fraud at all, though it remains unclear whether any individual wrongdoing could be involved. Now, in a statement to us, Kotak Mahindra Bank said it has initiated this detailed reconciliation of the accounts of the municipal corporation, and based on the exercise so far, it has found no wrongdoing on KYC or otherwise. Everything seems to be in order, and importantly, a large part of the amount under review has already been reconciled, and the bank has filed a formal complaint now with the Panchkula police. So, near identical situation involving the Haryana government departments at IDFC First Bank, now at Kotak Mahindra Bank. IDFC ultimately, as we know, had to settle all the claims, pay out more than 645 crore rupees in full. So in a way, that has set a precedent, and we'll have to see if the Kotak Mahindra Bank case also plays out in a similar fashion.
Thank you very much for that, Ritu, for that update coming through on Kotak Mahindra Bank. We'll have to see if the bank chooses to settle this particular dispute and issue. Siddharth, United Spirits, one would have expected an up move in the stock following the sale of RCB. Pretty big valuations, but the stock is down 1%.
Yeah, I think the numbers are definitely better than what the street was expecting. But again, the reaction today is a bit surprising. Even we were expecting that with this kind of stake sale, there should have been some upside potential, especially given that they are hiving off a non-core business and they are realizing a good value which can be used in driving the core business. Plus, there is also some expectation that some of these amount could be distributed as special dividend. So a little bit surprising from the move, but definitely I think it's a good step in the right direction. The focus of management only increases on the core business from here on.
Got it. What about Sun TV then?
Yeah, I think a lot of these companies which are owning IPL franchises will see some valuation uptick based on the two transactions we saw overnight, the Rajasthan Royals and the RCB Bangalore franchises being sold. So some of them, the SOTP valuation will definitely see an uptick. But beyond that, I think the upside for some of them would remain on the core business. So you have a Reliance which has a stake in the Mumbai Indians, and there are others. But again, as I said, core business is something that you need to look on. I think one-off uptick is what I would guess for Sun TV as well.
Okay, stay with us. Sid, let's hop across to Sud. Sudarshan is joining in to help us out with some stocks that are reacting to brokerage notes today. Sudarshan?
So first I'll talk about the power sector, where Bernstein has initiated coverage on majority of the companies. So it has initiated with outperform on Adani Power, and target here is 177 rupees per share. JSW Energy outperform, call target 575. Tata Power outperform, call target 443. And for NTPC, underperform, call with a target price of 80 rupees per share. It says India's energy security has been tested twice in the last few months. First by disruptions around Russian oil, and now by the Iran war. And like China, India is resource poor in oil and gas, but resource rich as far as coal and solar are concerned. And this makes electrification the real structural answer. And that's the reason it's positive on majority of the power companies. Next one is Sagility. The stock is up sharply. It's up more than 8%. Nomura has initiated coverage with a buy call, and target here is 55 rupees per share. It says company is a vertically integrated healthcare focused technology player, and it's going to be one of the biggest beneficiaries of AI and payer margin constraints fueling outsourcing demand and growth momentum. And going forward, it expects 20% EPS CAGR for Sagility over FY 26-28.
Thank you very much for that, Siddharth. You'll want to add what Motilal Oswal is most bullish on right now, if you have to do cherry picking.
Yeah, I think in this market, the fall has given good entry opportunity, especially in the large cap space. Some of the stocks that we are liking is State Bank of India, SBI, M&M from the auto OEM space. And a little bit on the high risk side is Larsen, directly getting impacted from the disruptions in the West Asian region. But we believe that those are only transitionary in nature, and once de-escalation happens, especially in some of the Gulf regions, the construction activity execution will pick up pace. Plus, there are a lot of additional opportunities that will come up from the reconstruction activity of some of these energy infrastructure, where Larsen has an edge in the hydrocarbon space, being one of the key EPC players specializing in the hydrocarbon space. I think SBI, which is witnessing a strong credit growth, they have guided for an improvement in the overall growth for next financial year, benefiting from the credit upcycle, strong, healthy asset quality, and valuations being comfortable compared to some of the private players. So those three stocks, SBI, M&M, and a bit on the high risk, not from the near term, but more from a 1 year plus perspective, Larsen.
Okay, all right. Sid, what about Ola? You know, one of those stocks that promised a lot, delivery was short, but you know, now it's around 25 rupees. Just spotted it because Sunny was one of the top volume movers and on the upside. 25 rupees, would you look to get in, or you're not interested?
Unfortunately, we don't cover Ola in that space. We do look at Ather Energy. I think that is something that looks interesting, but our top pick, preferred pick in the EV two-wheeler space would be a TVS Motors that has continuously remained at the market leadership on a monthly level. Some of the products are well accepted by the market in this space, and I think their innovation plus the leadership that they are showing, that continues to excite us in terms of execution. And I think that is where we would like to stay. TVS Motors being the market leader, Ather with its niche offering. So that's the two stock we like in the EV two-wheeler space.
I was just seeing the Ola Electric shareholding. So promoters have about 35% stake. FIs have 4%. In the DIIs, the holding is 7.3%, and it's Motilal Oswal and Mirai. Both of them have a stake in terms of DIIs, and the public shareholding is at 49% in the case of Ola Electric. And the way the stock has corrected, a lot of money has been lost in this particular space.
Right. Sid, let's find out your view on another name then. Lenskart. Yesterday I met Piyush Bansal at the Forbes India Awards. Had a chat with him. The share price actually vindicates him. You know, everyone is talking about hefty valuations. Well, from the IPO price, the stock is up 20%. So those that were brave enough on the day of listing, I recall it was down 10%. Well, they are making some good money. And it appears, you know, as a head of a business or as a founder, that man has a vision. At around 500 rupees, what do you think? It's not cheap at all. But it appears the street is betting on the entire theme playing out. They believe there's a longer runway, and they believe ultimately, you know, the market share will move up as well. What's your view?
So definitely, I think that is an interesting space. We do have recently come out with a report, with a positive report on Lenskart, and we believe that in the retail space, the niche offering that they are doing, that is definitely worth looking at in terms of the growth. I think we are estimating 56% growth in FY27 and another 45% earnings growth. So to that extent, the PEG is definitely more than 2 times. But given the niche business that they are developing, I think a very strong back-end integrated business with a very high gross margin, and with the economies of scale picking up, I think the margins would only go up from here. And hence, what we believe is that in the entire retail space, that is one new age business that one can look at. Is Lenskart. Definitely the management has been delivering what they have been promising, and looks interesting. We do have a buy rating with a target price of 600 on Lenskart. That figures among our preferred ideas within the retail space.
Yeah, Siddharth, thank you very much for that, and good speaking with you with what you're doing and what you like, your view on the market as well. We'll take a quick commercial break here. We'll come back. And Mithun Aswath of Kiva Advisors will be with us on the other side. Stay tuned. I think it looked like there was a bit of a dip developing, which has now been bought into. So we are not at 500, but 450. Solid gain still, 23,356. Stay tuned.
Welcome back. Let's talk more stocks now. Harmis joins in as always to put the spotlight on the top movers in the market. Harmis.
The green screen is something that we were not used to all through the month of March, but it has happened over the last couple of days. So start off with some gainers then. PCBL Chemicals is one name at the top gainer on the Nifty 500 in today's trading session. So still holding on to gains of around 15%. Is the biggest single day gain since January of 2018. And it's the kind of moves that you've seen in the last 8 years now. Today's volumes are the highest in 3 months. Close to 6 crore shares have been been traded today. The 20-day average of around 9 lakh shares, and 8% of the total number of shares that have been traded so far have been marked for delivery and features among the most traded names on the Nifty 500 in today's session. But despite this move, the stock is still down close to 40% from its 52-week high, which is close to 450 rupees. The other one that's doing well today is Godfrey Phillips, and is the biggest single-day gain in over a month for the stock. And today we have had over 80 lakh shares that have been traded. The 20-day average is just around 5.5 lakh shares, and 11.5% of those shares that have been traded so far have been marked for delivery. The stock is trading close to its 50-day moving average of 2091. It crossed that briefly intraday, but it is now continuing to hover around those levels. It's the third most traded name on the Nifty 500 today, and was down to a 52-week low on Monday's session during the sell-off, and is now trying to recover from those levels. This one too has nearly halved from its 52-week high, which is close to around 4,000 rupees. And lastly, Aztec Life Sciences is the biggest single-day gain in volumes that the stock has seen in the last 4 months. It's the top gainer on the BSE Small Cap Index today, gains of close to 18%, and it is a sharp jump in volumes that the stock had seen starting around 11 o'clock this morning, and since then it has been a vertical move upwards. Over 25 lakh shares have been traded on Aztec Life today. The 20-day average is just around 35,000 shares, and 8.5% of those shares marked for delivery. And this one too, just like the two names highlighted above, are also down around 40% from its 52-week high levels of close to 1,000 rupees.
Hormus, thanks very much for that. Mithun Aswad is with us of Kiva Advisors. Mithun, welcome back on the program. Thanks for joining in. You know, Mithun, many stocks are up 8 to 10% very quickly in the last 2 days, actually, from the lows of Monday. And I'm talking about, actually, I'm just looking at large caps, right? I mean, I count at least 6 names which are up between 8 and 10%. So the fall was very quick and the recovery is quick as well. The question is, will we go back to the 27th, 28th of February kind of levels, which is the pre-war situation? I mean, it's not a great mood back then even, right? Even before the war started. Everybody was biding their time and, you know, waiting for things to improve, etc., etc. And now we've got this. So, you know, things got sold into pretty heavily because of this war. My question is, you know, what's your assessment? Is there more to be had here in the month of April as well, or at some level 23,700, 800 and corresponding levels for stocks as well, we start to stall a little bit and then we kind of go back to waiting and watching?
Yeah. Afternoon, Prashant. I think the main issue the market will grapple with is whether we are going to see earnings growth of a reasonable quantum in FY27. Right. I think post the GST cuts, we saw some momentum come back into the consumer, you know, durable sort of segments, like you saw in discretionary automobile sales were picking up, and they actually were even good in February. So demand was picking up, and the economy was in a reasonably good shape. So I'm not too sure, you know, Q4 is not going to be too bad. But what we need to see is that in Q1 FY27, some of the repercussions of this war would translate into maybe lower manufacturing growth. A lot of the companies are facing challenges in terms of raw material, also increased costs because of the whole petroleum complex moving up. So I think that is what the market is grappling with. If we get maybe some sort of a truce or a ceasefire which is durable in the next week or so, I think maybe the market could even see through that, because valuations on a normative basis on a trailing earnings also is attractive for the large cap index itself.
Hi Mithun, good to see you. When plenty of variables right at play, but individual stocks could you could be buying those individual stocks you always wanted to at the price and the valuation of your choice. That said, give us a couple of names. You normally don't shy away from that.
Yeah, Nigel, I'll keep it simple this time. I think if you look at the index level itself, some of these large cap stocks like HDFC Bank itself had come to very lucrative levels a couple of days ago, even below 750 rupees. And if you go 2-3 months back, it was hovering at about 1,000 rupees. So, with a large cap financial itself, if it were to, retrace back to the 1,000 rupee level, you're talking about more than a 30% upside. So I think, large cap financials have corrected significantly. Why have they corrected? I think there is fear that the economy will slow, and could that in effect cause problems into financials. And that's why I reiterate, this cannot kind of be a protracted issue. If this goes on for another month or so, I think then people will start having larger downgrades for FY27. And that's when we have an issue. If we do not see that, I think the upside in the market does exist.
Okay. Mithun, you also like the entire pharmaceutical space. I remember once you were telling us that the valuations are broadly attractive. Now this whole GLP-1 opportunity has opened up. We were talking with Sayan Mukherjee of Nomura earlier, and he also looks at the pharma space very closely along with the India strategy. And he said exports can be a big opportunity. 80 countries will open up as an opportunity for exports, starting with Canada. So companies like Dr. Reddy's are well placed. Which stock are you betting on? Because this is an entirely new category which is being created. It is not substitution. So which one would you bet on?
Nima, I think it's going to be a highly competitive market with several players in that space. Actually, if you look at some of the correction in the recent past, even on the domestic pharma companies, those could be interesting opportunities. Even some of these MNC pharma companies have come to attractive levels. And typically, you should look at the domestic pharma companies more like an FMCG business. But if they are able to grow volumes at 10-12%, and if these are available at reasonable valuations, that could be a reasonably good space for one to look at. Even the diagnostic companies of late have corrected quite sharply. And that's another space where, valuations are becoming reasonable. And these are, more secular opportunities. Also, I think we should focus on companies where, the raw material issues are not that important. So if you go back to the COVID days, I think the IT sector was the one which kind of stood out during the turmoil because initially. So that's another space where, where valuations have become attractive. Obviously, there are fears of AI. But if you look beyond that, because even if AI was to disrupt this, I think it's going to take maybe 2-3 years out. And the opportunities that AI will present are also going to be large. So even the mid and the small cap IT companies have corrected quite sharply. And that is one space where, the tailwind is there, at least of the rupee. I do not think there's that much of demand destruction. And as well, there is no real inputs when you talk about IT. So that is one space which is kind of a little bit, positioned quite well to face these volatility if it continues.
Do you want to name some stocks in IT?
Rima, honestly, I think pretty much if you look at the top 3-4 names in the IT space, the entire basket valuations now looking attractive. If one were to be more aggressive, maybe look at some of these larger mid-cap names. But obviously, valuations there are slightly higher. But even in the frontline IT companies, the valuations now are, more like pre-COVID levels in the 15 to 16 times sort of multiples. Same case with the private sector banks. That's what I'm trying to tell you. The large caps have come to attractive levels.
And if IT gives you, say, a 15-20% kind of an up move very quickly, would you book profits in it? Because still there is that question mark about the kind of long-term, medium-term growth? Or is this, if you buy IT right now, it should be held for the longer term?
It's a difficult question. But obviously, if the US economy was to pick up and your deal wins increase even on the AI side, then, you could see sort of, maybe high double-digit growth for the next couple of years. That's the kind of best case. Maybe the upsides will be larger for the mid-sized companies because even in the last couple of quarters, they've been growing at 15-20%. And while their stocks are down 30%. So with that sort of an outlook, maybe the mid-caps offer slightly higher upside. But at an absolute level, I think the large caps also look attractive, with maybe potentially lower CAGR.
Okay, all right. Mithun, we leave it there. Thank you very much for joining us. Good chat as always. F&O positioning, right? I mean, what is it looking like? I think there were still lots of shots in the system till yesterday. And we'll, of course, know what's the position is post-close. But as we speak, what's happening in that part of the market? Nigel has walked across to the F&O desk. Nigel, over to you.
Well, Prashant, at the start of trade, we said that it's going to have the ingredients of a very good trading session. And boy, it's a good trading session, both on the Nifty and the Nifty Bank. You have, good move. And remember, this is just days away from the monthly expiry that will play out. So it's a good start, in terms of trade today. And we've just built on to those gains. The only couple of disappointments that I could spot is the Indian rupee. You'd expect some kind of strength to come back into the Indian rupee. That's not what happened. In fact, it's a little bit worse off in comparison to yesterday. So that's one point of disappointment. And the other one, I think, is the India VIX. That's not cooled off drastically. So it's still hovering around the 24-odd mark. You'd like to slam down closer to around the 22 mark and then, in fact, move lower. So a flattish VIX is what we're seeing. Maybe, the coming trading sessions, that as well will decline. It could be taking shape as well for the next series. Moving to the PCR, that's holding at around 1.2. That's the put-call ratio. So that's moved up from around that 0.8 that we saw a couple of sessions ago. On the option side, 23,200 put. The premium out there has come down drastically. It's down to around 230. Remember, the start of today's trading session, it was 460. So there is aggressive writing now that we're seeing at around this 23,200 level. In the 23,300 put, the premium out there, that's come down by half. 520 today, that's come down to around, more or less, it was around 250. Now it's at around 280 odd. So put writing has come back into play. In terms of individual stocks, the big boy, HDFC Bank, that's been the bit of an underperformer in the last few trading sessions. That's actually seeing fresh buying. So it appears this vicinity of around 750 rupees odd is where there is some long addition on that counter. And today it's backed by delivery as well. Eternal, another stock that fell one way from 360 all the way down to 210. That's gradually seeing some fresh buying in trade today. And finally, IRDA, the stock that got a bit of a slam dunk, that's seeing a bit of a short covering bounce. The shots were piling on out there. The stock was sliding for many, many trading sessions, and now it's seeing some bit of a relief rally. So it's a good trading session. If we go home with gains of around this 400, 450 points, with the Nifty Bank up close to around 1,100 points, the bulls will feel good, as there are plenty of shots in the system. Back to you.
All right, Nigel, thanks very much for that. And that is a good update to get at this point. We'll take a quick commercial break here. We'll come back, D-Street Chatter with Nimesh as always, and some trading ideas coming up as well. Okay, well, D Street Chatter in focus. Nimish is here with what he's picking up and the intel he's gathering. Nimish, rally on 800 points now, 2 days.
Oh, absolutely. So a decent pullback, and market looks extremely oversold. So any good news in the global market, you would have seen a bit of a short covering rally. Even yesterday, if you look at the numbers, there was more of a short covering rally than buying interest. The FIs were net sellers of almost $1 billion. Today again, the FIs are better sellers. That's the broad sense. Maybe the intensity is not that high, but still they are better sellers. The buying seems to be largely in sectors like select PSU banks as well as some private banks as well. Within basically the financials is where there is a bit of buying interest, and power as a theme has worked very well in the last couple of days. Power as a sector is where a lot of interest seems to be building up from institutional investors as well. So that's the overall feedback. The breadth has turned positive in the broader market as well for the second day running. The small cap index is up almost 3%. And again, the entire broader market stocks have been so oversold that there is a pullback rally. A lot of the stocks, even after the 2-day rally, are still down 50-60%. So a bit of pullback in the broader markets as well. But from a flow perspective, my sense is even today, the FIs are better sellers.
What about individual stocks, Nimish? What's on the radar?
So the first stock on my list is Devyani. Again, after the deal, there is not much traction happening. It's been consolidating. The stock has actually fallen from those levels as well. But now I understand there could be a corporate development in Devyani very soon. A potential buyback could be on the card. So that's the buzz as far as Devyani is concerned. The second name is Inox Wind. Again, a stock which has sharply corrected from the 50-day high. From high of 200, it collapsed to almost 75, 76. Now at these levels, there is a bit of buying interest back from larger HNI. So buy flows at HNI desk and some HNI activity seems to be picking up in Inox Wind. The third name is Granules India. That's been buzzing in trade today, large volumes as well. I understand at least one leading long only fund is an active buyer as well. And for Granules, one of the plant was under FDA inspection. Could be some trigger as far as that clearance is concerned. So that could be the very near-term trigger as far as Granules is concerned. And the last is PB Fintech. Again, sharp correction from the recent highs. But now at these levels, a bit of buying interest is back. Multiple buyers, but I understand from FI desk in PB Fintech. And interestingly, today Macquarie has upgraded the stock to not perform. They've retained the target price, but after the recent correction, they've upgraded the stock to not perform. So that's the reason why for the last couple of days, PB Fintech is seeing a bit of buying interest.
Some local interest as well from HNIs as far as PB Fintech is concerned. Devyani, Nimish, buyback, right? That seems to be the buzz.
That seems to be the buzz as far as Devyani is concerned. So remember, 1st of April is when the new buyback norms kicks in. So hopefully, maybe between April and May, as and when the board meets, there will be some companies which might potentially announce buyback. So Devyani potentially is part of that, wherein there could be a buyback very soon.
Nimish, across the, when you look at the brokerage notes, etc., and you go through them in detail every day, last few days, I mean, any 2 or 3 names which really stand out to you as you've gone through that list?
So, Prashant, power as a theme stands out. There is a very big report from Bernstein. They've initiated coverage on some of the power names, and in general, when I talk to some HNIs or buy-side fund managers, after the recent crisis, especially the war crisis, there is an anticipation that maybe power as a theme will do really well. The government focus will be back on that theme. So entire power ecosystem, whether it's transmission companies or for that matter, thermal companies or wind and solar, everything within the power pack is something which a lot of investors are focusing on.
Well, that's right. And talking about the Bernstein report, Nimish, I'm sure you had a look at that. Nikhil Nigania of Bernstein, he joined in on Finding Alpha. And he explained the entire chain. And he said that, post this war, the emphasis on power is going to be even more. And he was slightly less negative on the renewable space, which he's been spot on. He's been negative and the stocks have fallen off. But now he says a little less negative. Thanks a lot for joining in, Nimish, and giving us those insights. Well, let's hop across to Mitesh Thakkar, who's joining back with us. Mitesh, if someone had a long position, they've had a good ride for 2 sessions, take money off, enjoy the midweek break. Or do you think this market is good for more? We pulled back very, very swiftly. So do you think we can extend ourselves a little bit on the upside?
I think we can. See, this still looks like a pullback to me, but the good thing is that on the hourly charts, 2-hourly charts, the indicators have started moving up. So a slight positive out there. I think I would suggest if somebody has long, take out a long position. We've added on the stock side, not on the index side. But very clearly, this is a market, which maybe has made at least a temporary low, if not a proper reversal kind of a low. So therefore, I think longs can be taken. And on the stock side, BTST on Laurus Labs with a stop at about 1015. Look for targets of around 1045. And L&T after a long time has come on the radar. I think that's a BTST with a stop at 3630 for targets of around 3685.
Mitesh, you said this rally can extend till what level?
See, on the upside, on the Nifty, 23, 800, 850 is the next supply pivot. So I think that could be tested.
Got that. And then we'll see whether it can move forward from there or it reverses and heads lower. Thank you very much, Mitesh, for joining in. Let's talk about IPL. It's coming up, 2-month-long extravaganza and fun. And the billion-dollar valuations and the strong revenue model are also in focus. Now, Mangalam has broken down the business behind IPL and the numbers.
Well, as we talk about the recent IPL deals that took place, it's important to first understand just how valuable this league has become. Franchise valuations that are rivaling global sporting leagues as well. Rajasthan Royals valued at about $1.6 billion with investors which include global marquee names like the Walmart and the Ford family. And then you have, this team which was bought for just a few $100 million back in 2008. Similar is the case for Royal Challengers Bangalore, now close to $1.8 billion with institutional investors like private equity giants and large Indian business groups participating as well. The IPL isn't just a cricket league. It's a scaled sports entertainment asset with predictable cash flows, strong brand equity, and global investor interest. So from a few $1 million in 2008 to $1 billion plus valuation today, near $2 billion, the value creation has been so extraordinary that sets the base for us to understand how the business model of the IPL works. Let's start looking at it from a franchise owner's perspective. The franchise fee, which is about 20% of the revenue for old franchise and fixed fee for the new ones, the likes of LSG, etc. Then you have the player's fee, which is an expense, and then you obviously have the operating expenses. Whereas the revenue head for each of these IPL franchises, you get one, the central revenue pool coming in from the BCCI for title sponsorships, the big chunk of revenue coming in from media rights. Then you obviously have the team's own sponsors, gate revenue, and merchandise. So of the central revenue pool that accrues to the BCCI, 50% of which is held by them, and they give it to the other teams at 50%. Remember, media rights are close to around 500 crore rupees, title rights about 1350 crores coming in from the franchise fee. And how do these actual numbers look? From publicly available information that we have from CSK and RCB's annual reports for FY25, the revenues for the teams could be between 500 to 650 crores, with EBITDA margins between 37 to 40%. And these are among the highest EBITDA making margins, sport properties in the world. Going forward, what are the triggers at these valuations that people will be looking at? The biggest one will be the revised media rights auction cycle from 2028. And at the same time, you'll have the central sponsorship auction coming in from 2028 as well. These two account for majority of the company's revenues. Going forward, popularity of women's IPL is an optionality. Higher number of teams and high number of games. Currently, it's just a 2-month window. A likely longer window could also be a big upside. And finally, a lot of these companies have investments in overseas leagues as well, the 100, etc. If that comes about, then those could be big optionalities. But the big numbers will obviously be, the renegotiations of the media rights. But that's where the big risk is as well. Lower than expected ad spend environment, upside limited for new media rights auctions if they don't come at current valuations. And then going forward, any change in regulation by the BCCI could throw a spanner in the works as well. You already know the listed players beyond Diageo or United Spirits. You have SRH owned by Sun TV, 65% of their market cap comes in from there. LSG, RPSG Ventures owns 50% of that. If you account for a holdco discount and look at 51% stake, that could be nearly 250% of its current market cap, which explains why the stocks move higher today as well. So now that you know about the business, just sit back, relax, and enjoy the games.
Thank you very much for that. At least the ones who gotten early have made so much money. RCB was purchased for $111 million in 2008, and yesterday it was sold for $1.7 billion. Staggering returns. Mayuresh Joshi of MarketSmith India now joins in. Mayuresh, you want to tell us United Spirits, RPSG Ventures, Sun TV, all these are plays on IPL. Which one would you bet on? Or USL used to be, but you've got that possibility of a dividend coming through now.
Sure. Afternoon, Rima. No, absolutely. No, I think Mangalam explained it very, very well. But I think outside the SOTP valuation that one probably subscribes in terms of how much of upside can the IPL probably produce, I think the core standalone businesses is also something to be watched out for. And therefore, in the case in point being Sun TV as an example, I think how much in terms of subscriber additions and subscriber revenue market share is Sun TV probably able to garner with competition, obviously playing some element over the last few quarters. Advertising revenue, how is that shaping up? If you probably look at a lot of these digital companies' presentations that they've probably put out, I think the expectation largely is that the viewership is probably trending towards digital. And there is accelerated investments that happens in Sun's case, whether it be those digital assets or even their media rights as far as movies or film exhibition is concerned. And therefore, standalone business, how it shapes up, really will determine with IPL probably adding some element of value over and above that. Similarly, in the case of United Spirits, as you asked me, I think the expectation probably is that how much of the premium contribution is probably expected to come through in terms of premium brands. As you've probably seen with the alcobev industry, I think a large part of the market has shifted within their individual balance sheets towards the premium segment. But how much more of a contribution, both in terms of volumes and revenues, can create a substantial impact in terms of P&L, because they need to continue with their mass product, which probably becomes a large part of their cash flows in ensuring that the business probably continues at a stable rate. Obviously, I think the expectation on why United Spirits is down, I think the expectation largely is how much of an incremental dividend can probably come through or would have come through. And therefore, I think core businesses actually should perform well. I think IPL probably becomes just a value add in terms of the overall SOTP.
Okay, all right. We'll take a break here. There's 13 minutes to go for close. We'll come back in just a bit. More stock-specific conversation with Mayuresh. I think maybe we kind of sort of stalled a little bit, but it's not a bad-looking screen still, right? So because 425 points, okay, 396 points is what we have. Maybe it's a holiday tomorrow, and if the news flow will not stop, global markets are trading, and there's been a problem over the weekends actually, right? I mean, Friday post 3:30 news hits, and there's no way you can react or do whatever. And you've got to wait for Monday morning, and a lot happens between when you're closed and when others are trading, and then you come back and you've got to react to gaps up and down, etc. Maybe there is that element here at play. But if you look at US futures, etc., they're up 0.5%, 0.75%, the S&P, Nasdaq, etc. There's no let off there, but I guess there's a holiday, and it matters if you're trading with all the news flow out there. This news at the bottom of the screen, this is Ministry of Petroleum and Natural Gas, and saying they're essentially urging government confirms petrol and diesel prices remain unchanged, and I think there's a bunch of other stuff. Nothing market moving in that sense, but just reiterating some of what they've said earlier as well. Switch from LPG to PNG. That is what the government is saying right now. Okay, take a quick break. We are back. More on the other side. Stay tuned.
Welcome back. Well, markets are going to go home. Actually, we're going to wind down with at least a 380-point gain, which is not such a bad outcome. We're still in conversation with Mayuresh Joshi. Mayuresh, what about these Eternal and Swiggy's of the world? You know, just I think 18 months or so, everyone was talking about how our life has become so comfortable. There is a big runway. This penetration is just going to continue. We're going to get lazier. Stocks have corrected a fair bit. What has changed? Will you be a buyer?
So I think right at the top, I think we did hold a couple of names and we did trim it off, Nigel, to be honest. I think two things. One, I think valuations had started seemingly at those levels very, very expensive. And in terms of the business model itself, I think everybody speaks about competition. But I think competition might actually intensify, both from Zepto as well as what we are hearing in terms of if Amazon and Reliance Retail makes an entry into this space itself. So on the business model itself, I think both in terms of quick commerce as well as food delivery, the volumes in no two ways are going to go up. But at what margin and at what per metric unit of profitability is the EBITDA margin performance and the bottom line number going to improve is the question. The second element, obviously, is in terms of expectations of the dark stores that they've probably opened very, very in an accelerated fashion over the last few months. I think the expectation largely would be that as they scan more geographical areas, I think the capex spend will need to be done. They are cash-rich balance sheets, no two ways about it. But again, the cash has to be utilized in businesses that will have high margins. Take in point the case with Urban Company as an example, Nigel. I think their Insta services, I think the kind of losses that they're probably making, when are they going to recoup those losses, at least on the EBITDA front, is something to be watched out for. Therefore, both valuations, competition still makes us believe that they still probably seem expensive as we speak. And therefore, I think there are better plays in the market from a risk-reward perspective in our opinion.
Mayuresh, power is emerging as a structural theme and pretty much a consensus buy. So Bernstein today writes that how India's energy security has been tested twice recently. One was the Iran war, of course, and then even prior to that, Russia-Ukraine war. And like China, India is poor in oil and gas, but it's rich in coal and solar. And therefore, electrification becomes a structural theme. I remember BofA earlier this week was also talking about how power demand is surging, led by AI, data centers, etc. How are you all playing power?
So we absolutely are very, very optimistic on the entire space, Reema, and you're absolutely right. I think the expectations in terms of the renewable capacity expected to increase to 500 gigawatts with a tremendous amount of government capex spends is on the table, and there are no two ways about it. I think the government is continuing with that in an accelerated fashion. And therefore, I think the entire ecosystem, whether they are generators, transmitters, or even the ancillary plays as far as power is concerned, all probably are looking in good shape. With the larger names, I think Tata Power is an example, case in point. The scenario that they probably built up in terms of an FY30 number, profitability expected to double, EBITDA expected to probably double. The expectation in terms of their transmission capacity expected to increase quite significantly. They're adding on with expectations in terms of their distribution capacity, in terms of the number of consumers as well. The pump storage with the capex expected to be around significantly higher over the next few years should be relatively better as well. And at the same time, I think the debt equity ratios should get maintained around at 1.25 times. I think the incremental capex, a large part of that is going to go into the non-regulated equity business. And therefore, I think the expectation is that ROE should be better. Similarly for NTPC within the larger names. Strong dividend yield becomes a buffer, but the expectation in terms of additions of 6.5 gigawatts in terms of thermal, 20 gigawatts in terms of renewables, the receivable days from discoms has come down to 28 days. The capex expected to stand very strong at 56,000 crores. I think makes it a good point in terms of the power story. When it comes to ancillary plays, I think players like Godavari Power, as an example, they're not directly concerned in terms of how the grid is concerned, but I think the expectations in terms of the capacities that they probably process at this juncture, both in terms of sponge iron, the expectations in terms of pellet prices expected to be higher, and they produce significantly higher premium and high value pellets as we speak. Integrated business model, strong balance sheet with more than 800 crores of cash, 24% EBITDA margin. So our sense is that power as a theme and specific stocks within those would continue to.
Got that. By the way, any thoughts on, do you own, or your clients own Shriram Finance, Mayuresh? It doesn't, the Shriram Finance investment does not need RBI approval. I mean, except the fact that two of the directors on the board, to come onto the board of Shriram Finance need RBI approval. I mean, it's a matter of, I think it's a matter of formality as far as RBI is concerned, but hopefully it'll get done. Any thoughts on this one? High was about 1100 or so after the deal, at about 950 now.
No, so Prashant, as a clear disclaimer, we continue holding this stock in our global portfolios, and you're absolutely right. I think in terms of the formalities, I think it is just a question of when, and over the next few weeks, that might also probably come through. But in terms of the business model itself, I think one of the strongest balance sheets within the NBFC space, and a well-diversified one is that, specifically when it comes to advances. And within those advances bracket that they probably service, the unsecured portion is capped around 4.5%, which makes it even more attractive. Because in a scenario like this, where there is a large amount of uncertainty looming around on asset defaults, credit defaults, I think that is something that might shield Shriram Finance in a significant way. The second element in terms of their core business model, when it comes to the overall revenue pie, I think the expectations in terms of the CV cycle and the uptick in the CV cycle that we've probably seen makes us believe that the next few quarters numbers should be relatively better. Capital adequacy remains extremely robust and strong, and with the infusion expected to come through, I think the balance sheet growth can be even stupendous over the next few quarters as it happens. And therefore, I think the accretion in terms of revenue momentum, the accretion in terms of their risk metrics reflected through asset quality, strong capital adequacy, strong balance sheet, makes us believe that it's a very, very good candidate within the NBFC space. As I said, clear disclaimer, we continue holding this stock in our global portfolio.
Okay, thank you very much. Mayuresh will connect with you in the next show. For now, just winding down, the Nifty is closing around 23,300, a gain of 380 points. And this is in addition to the 400-point rally that we had yesterday. 2 days, 800 points. In percentage terms, benchmark indices are up more than 1.5%. Mostly it's all green. Just a couple of these IT names are under pressure. Tech Mahindra and TCS lost 2% and 1% respectively. And Power Grid came in for some profit booking. On the way up, Shriram Finance was the big gainer that rallied 6% Bajaj Finance, 4% gain. Ultratech Cement, big mover. Tata Motors, Grasim, Titan, L&T, the Adani Group stocks. These are all stocks with gains of about 3.5% to 4%. Big caps also doing well with a gain of 1,300 points. Banks outperforming.
Yeah, no, absolutely. And I think tomorrow is a holiday and market holiday for us. So 390. By the way, tomorrow is a market holiday. I think the next week also we've got a couple of holidays.
We've got two holidays, Tuesday and Friday.
Friday and I think it was on Tuesday. Yeah, so but yeah, Tuesday, two more holidays coming up.
And then 14th is also Ambedkar Jayanti.
I see. April.
And then 1st May.
Yeah.
It's good April.
We got all lined up, huh, Rima? I think there's some news at the bottom of the screen. This is the parliament speaker out of Iran. He's not saying anything new, but basically saying that we're closely monitoring all US movement in the region, especially troop deployments, and basically left off with a warning that do not test our resolve to defend our land. So, yeah, that's the thing. While there's all this de-escalation talk, the fact is there are about 3,000 US troops which presumably are on their way to be deployed in the Middle East. Not boots on the ground in Iran, but basically moving into the region. So that's essentially the contradiction. On one hand, you got President Trump talking on record saying, well, we're done with the war and we'll end it soon. But you also got this other parallel track which is going on. So a warning from the Speaker of the Parliament in Iran. 390 points is how high we've ended. So it's about 800 points in the last two trading sessions. It's a wrap on this edition of Closing Bell. Thank you for staying with us. Markets forward. We'll pick up on the action in just a bit.
Markets closed high for a second straight session, but off the day's high, the Nifty holds above 23,300 mark, with broader markets outperforming. Meanwhile, the rupee hit a record low of 93.98 against the dollar.
Kotak Mahindra Bank initiates a detailed reconciliation of fixed deposits and linked bank accounts of Haryana's Panchkula Municipal Corporation. This after the civic body flags discrepancies worth 150 crore rupees in fixed deposits held with the bank. The bank tells CNBC TV 18 a portion of the amount under review has already been reconciled.
Sagility shares gain after Nomura initiates coverage with a buy rating. The brokerage highlights robust growth potential driven by rising adoption of AI in healthcare, positioning Sagility as a key beneficiary of the sector's ongoing tech-led transformation. Hello and welcome. You're tuned into Markets Forward. This is your go-to show where we aim to get you all the key data points to gear up for the next trading day. I'm Sunil Bhutra. With me today is my colleague Harmis Fatakia. Harmis, good afternoon. Second day running of gains for our own markets. We ended higher today as well, above the 23,300 mark, but came off from the high. So at a point in time, we were up around 500 points. So we failed to, sustain those levels, and that had been the conversation since morning, whether we scale above the 23,500 mark or not. But that was not the case. But nevertheless, the mid caps did really well. We had a gain of around 1,200 points on the mid cap index as well, and all the sectoral indices, they were in the green today. The IT index did not gain as much as the other indices, so an underperformer in that case. But overall, a decent looking screen. We did come off from the highs, but tomorrow is a trading holiday, and what happens overnight with respect to West Asia war is something we'll be tracking closely.
It's unsurprising that we came off from those highs, especially considering the fact that tomorrow is a holiday and the expiry related factors also playing out. But you would take a 400 point gain yesterday, a 400 point gain today with both hands, considering the sell-off that you have seen from the record high levels. So overall, the bulls would still be a little bit more relieved, more than happy after the close of today's session. But here's a lineup of what we have in store for you today. We start with the top movers and shakers with Sudarshan. We decode why Kotak Mahindra Bank, Sagility and the stocks of IPL team owners were in focus today. And last but not the least, we delve into the key market events to watch out for going into tomorrow's trading session. To our first segment of the day, Sudarshan is here with the top movers of today's session. Sudarshan.
So good last 2 days that we have seen in the market, 400 points gain yesterday, 400 points gain today, and there is also Chutti tomorrow, trading holiday better we say. So that is also the reason we have a smile on our face. But first talk about the markets and the stocks. So first, top Nifty contributors which helped market move higher, Nifty move higher, L&T. For the last few trading sessions, this stock was under pressure due to West Asia war. Today closed with a gain of almost 4%. Similar move was seen for HDFC Bank. SBI and M&M also closed with gains of almost 3% each. And lastly, amongst top Nifty contributors was Bharti Airtel. That also moved 2%. But some of the stocks have seen major short covering, and these stocks were under pressure over the last few trading days. First one is Shriram Finance. Remember, from the highs of 1100, the stock had moved to as low as almost 930. Today, it's back to 956, up almost 6%. Indigo was under pressure because crude has been moving higher, rupee has been depreciating against dollar, and today this stock too closed with a gain of almost 3.5%. Bajaj Finance also moved higher today, almost 4%. Keynes Technologies, remember the management had spoken to CNBC TV 18 regarding the cash flow, and that the stock had moved lower to 6%, but today this stock too closed with a gain of 6%. And Muthoot Finance, because gold moved higher and tracking that move, today gained almost 5%. But some of the stocks reacted to news flows, and though on top of the list, AC companies, Voltas and Blue Star up almost 5% each, because there was a commentary from PG Electroplast. They have found alternatives to LPG supply, and the production is well on the track as far as AC supply is concerned. And Voltas and Blue Star are the clients of PG Electroplast. That's the reason big move we have seen in both the names. RPSG Ventures deal for the RCB is done, and RPSG Ventures is the owner of Lucknow Super Giants. That's the reason we have seen a move of almost 20%. And last one is Fino Payments Bank. Yesterday, the stock had moved almost 20% lower circuit, and today it's up almost 10% after the circuit limit was revised because there was a positive commentary that came from the management.
Okay, a comprehensive list. Thank you so much for joining us with that list, Sudarshan. That's about all the buzzing names. Let's get to individual details now. Kotak Mahindra Bank is facing a discrepancy related to fixed deposits of Haryana's Panchkula Municipal Corporation. Sources tell CNBC TV 18 that the amount involved is significantly lower than what has been reported. Let's go across to Ritu for more details on this one. Ritu.
Well, Sonal, you have two banks coming in the span of less than a month. Both are dealing with deposit-linked irregularities and both involve the same Haryana government. So I'll leave you to draw your conclusions. But, after IDFC First Bank, you have Kotak Mahindra Bank that finds itself in the middle of a fixed deposit fraud row in Haryana that is this time linked to the Panchkula Municipal Corporation. Now, we understand the irregularity came to light over the weekend after the Municipal Corporation instructed Kotak Bank to transfer funds after the maturity of a fixed deposit. And then it was found that there were some discrepancies. Now, while the bank itself has not commented on the amount, and nor has officially the Haryana government, reports had pegged the sum at about 150 crore rupees. However, our sources indicate the bank's own initial assessment is only about 85 crore rupees. But of course, the final number is only going to be clear once the reconciliation exercise, which is still underway, is completed. So the number may differ. Now, RBI, of course, has been in the loop. And at this stage, we understand the regulator does not see this as a bank-level fraud, though it's unclear whether any individual wrongdoing is going to be involved. Now, while Kotak Bank did not comment on the number, in an earlier statement to us, they did say they had initiated a detailed reconciliation of the FDs and linked bank accounts that are maintained by the municipal corporation. And based on the exercise so far, they have not found any lapses. Importantly, a significant portion of the amount under review has already been reconciled, is what the bank said. And they've also filed a formal complaint with the Panchkula police. So a near identical situation involving the Haryana government department accounts at IDFC First and now at Kotak Mahindra Bank. IFC, of course, settled all the claims, paid out almost 645 crores in full. So in a way, that case may have set the precedent. And we'll have to see if the Kotak case also plays out in a similar manner.
Ritu, thank you for that. It was a wild ride for Kotak Mahindra Bank after that news break. Up a minute, down another, and then eventually recovered to end above the flat line. Now, to take the conversation forward, we are now being joined by Mahindra Joshi of MarketSmith and Shrikant Chauhan of Kotak Securities. Gentlemen, good afternoon. Thank you for joining in. Shrikant, to you first. We are up almost, 800 points now in the last two sessions. But there are still other determinants that haven't managed to cool off simultaneously. The VIX is still at elevated levels. The currency is at record lows. Oil is still elevated. Where do you see the market going from here, or the levels that you're tracking on the index from here on?
Yeah, good afternoon, Hormuz. Good afternoon, Sonal and everyone. So while looking at the trend of the market, we have seen pullback whenever there is a deep sell-off in the market. And it has happened most of the time in the current fall. So this time also the market is recovering from the lows. It was around 22,500. From there all the way, it was around 23,500 today. But till the market is not crossing the level of 24,000, we need to be a little bit careful in this market, especially while adding long positions at higher levels. And today's lowest level, that is 23,000, is now going to act as major support for the market, because still we are following lower top, lower bottom series. So in case market breaks the levels of 23,000, then again today's highest level, that is 23,500, is going to act as major resistance for the market. So I am of the view that we may see one more upward activity, because the previous structure was completely oversold. So we may see the levels of 23,500, 23,700 or 800 sort of levels in the near term. But in case if it breaks the level of 23,000, then again the market can retest the levels of 22,500 or 600. So at higher levels, we need to be careful, and we need to be more and more stock specific.
Okay, stock specific in that case. Take that point this time around, Shrikant. Mahindra will be coming to you in just a bit. Let me talk about one more stock, and we'll go across to Sudarshan for that. Sagility has gained in trade after Nomura initiated coverage with a buy rating. Sudarshan is joining us with the target price, the reasons behind this particular note. Sudarshan.
So the stock was up almost 8% today's trade after a positive brokerage note from Nomura, which has initiated coverage with a buy call and target is rupees 55 per share. It says it's a technology-enabled pure-play healthcare-focused solutions and services provider with 90% of revenue company gets from US health insurance companies and 10% revenue get from US hospitals. And it had almost 81 client groups as of Q3 with average client tenure of 18 years, and the run rate is as high as retention rate is as high as 95%. And companies sees operations outsourcing markets CAGR in the range of 6 to 8% for pair business and 11 to 13% for provider segment going forward. And recently there were certain changes in US by US government for Medicaid funding cuts and MLR rules, and that led insurance companies to move towards digital and AI-led models, and that will also act as tailwind as far as Sagility is concerned. So Nomura believes company may report revenue CAGR of 12% and EPS of 20% over FY26-28.
Sudarshan, thank you for that. Mayuresh, you heard Sudarshan there on Sagility. The stock had a bit of a promising start, but then has cooled off again from those highs. And that's not just Sagility, it's the case with everyone from the IT space. They'll kickstart earnings in the next couple of weeks now. What are your expectations this time around? What is the most important aspect that you're watching out for from these IT companies going into the new financial year?
Afternoon, Hormas. No, I think this quarter typically is a very defining quarter as far as client discretionary spending order wins are concerned. And therefore, I think the managements get a good handle in this quarter in terms of how clients are probably looking at the environment around them and what kind of orders are expected to come their way. And therefore, I think the most defining aspect is going to be elements around this area itself. Obviously, I think the other aspects in terms of how margins will play out, what are the expectations in terms of constant currency growth, whether there is the pricing environment probably remains very, very stable as we speak. And individual sectors, whether it's BFSI, retail, manufacturing, in lieu of whatever is happening, specifically after tariffs, the withdrawal of tariffs, and now the Middle East crisis, how are they probably seeing all these elements being put together? So our own take is that both in the case of domestic companies, in the case of product-related companies, as well as hyperscalers, we'll like to watch out how Q4 numbers come out, how Q1 numbers come out in the case of Europe and American companies, and then take a call. But I think this aspect is going to be very, very critical in terms of the macro environment, the order pricing, the order, the margins at which these orders are coming, and therefore the implied realization in terms of constant currency.
Okay, take that point, Mayuresh. Thank you for explaining that. But to the big story today, United Spirits will sell IPL team Royal Challengers Bangalore to consortium led by Aditya Birla Group for $1.78 billion. Kal Somani-led group also buys Rajasthan Royals for a valuation of $1.63 billion. This rubs off on the stocks of IPL team owners, Sun TV and RPSG Ventures. But what are the factors driving these valuations? Mangnam breaks down the revenue model for us.
Well, as we talk about the recent IPL deals that took place, it's important to first understand just how valuable this league has become. Franchise valuations that are rivaling global sporting leagues as well. Rajasthan Royals valued at about $1.6 billion with investors which include global marquee names like the Walmart and the Ford family. And then you have, this team which was bought for just a few $100 million back in 2008. Similar is the case for Royal Challengers Bengaluru, now close to $1.8 billion with institutional investors like private equity giants and large Indian business groups participating as well. The IPL isn't just a cricket league. It's a scale sports entertainment asset with predictable cash flows, strong brand equity, and global investor interest. So from a few $1 million in 2008 to $1 billion plus valuation today, near $2 billion, the value creation has been so extraordinary that sets the base for us to understand how the business model of the IPL works. Let's start looking at it from a franchise owner's perspective. The franchise fee, which is about 20% of the revenue for old franchise and fixed fee for the new ones, the likes of LSG, etc. Then you have the player's fee, which is an expense, and then you obviously have the operating expenses. Whereas the revenue head for each of these IPL franchises, you get the central revenue pool coming in from the BCCI for title sponsorships, the big chunk of revenue coming in from media rights. Then you obviously have the team's own sponsors, gate revenue, and merchandise. So of the central revenue pool that accrues to the BCCI, 50% of which is held by them, and they give it to the other teams at 50%. Remember, media rights are close to around 500 crore rupees, title rights about 1350 crores coming in from the franchise fee. And how do these actual numbers look? From publicly available information that we have from CSK and RCB's annual reports for FY25, the revenues for the teams could be between 500 to 650 crores, with EBITDA margins between 37 to 40%. And these are among the highest EBITDA making margins, sport properties in the world. Going forward, what are the triggers at these valuations that people will be looking at? The biggest one will be the revised media rights auction cycle from 2028. And at the same time, you'll have the central sponsorship auction coming in from 2028 as well. These two account for majority of the company's revenues. Going forward, popularity of women's IPL is an optionality. Higher number of teams and high number of games. Currently, it's just a 2-month window. A likely longer window could also be a big upside. And finally, a lot of these companies have investments in overseas leagues as well, the 100, etc. If that comes about, then those could be big optionalities. But the big numbers will obviously be, the renegotiations of the media rights. But that's where the big risk is as well. Lower than expected ad spend environment, upside limited for new media rights auctions if they don't come at current valuations. And then going forward, any change in regulation by the BCCI could throw a spanner in the works as well. You already know the listed players beyond Diageo or United Spirits. You have SRH owned by Sun TV, 65% of their market cap comes in from there. LSG, RPSG Ventures owns 50% of that. If you account for a holdco discount and look at 51% stake, that could be nearly 250% of its current market cap, which explains why the stocks move higher today as well. So now that you know about the business, just sit back, relax, and enjoy the games.
Mangalam, thank you for that. A lot of people would be definitely looking forward to enjoy the games as it begins in just a few weeks from now. But Shrikant, other than this IPL, the one stock that everybody has been talking about over the last few days has been HDFC Bank. And the stock, after making lows of 740 odd, saw a bit of a rebound yesterday, extended those gains today as well. Has the sell-off ebbed now in HDFC Bank, or your advice is similar as it was for the Nifty to be careful at higher levels?
No, I think when the stock has fallen to 730, 740 sort of levels, it turned extremely oversold. And at 800 levels, there was like some doubt that whether the stock can recover or not. But after hitting the levels of 740, 730, now we are of the view that from here again we can see the levels of 810 or 820 sort of levels. So which is again 5% or 7-8% higher from current levels, which is decent upside in the short term that we can expect. So I am of the view that in case if there is any correction, it will be an opportunity for short-term investors as well as positional traders to create some long positions with a upside target of 5 to 8%.
Right. Mayuresh, with United Spirits, the IPL is around the corner. Yes, this big transaction has happened, but summers are around the corner too, and some enthusiasts should be wanting to guzzle down a lot more. What's your view here?
That might be the case. I think as summers come around, you might see increased consumption for United Spirits core portfolio. But it might be United Breweries that might actually benefit out of this, to be honest, Ormas. But for United Spirits, again, I think what we've always maintained in terms of Alcobev as a space is that the kind of percentage gains, the premium Alcobevs have made within their portfolio itself, I think there is only a limited scope for that to improve now. Because they still need those mass products to continue in terms of cash flows. And therefore, to incrementally expect a lion's share coming through in terms of the premium products and therefore better realization, better margins, incrementally a tad bit more is possible, but not a humongous aspect as we go forward. And therefore, how do these companies make a shift or a paradigm shift in terms of their product mix or introduce new products to probably ensure that these growth probably sustains is something to be watched out.
Take that point, Mayuresh and Shrikant. Thank you so much for joining in today with your thoughts on individual names, both from a technical and a fundamental lens. With that, we'll do one thing. We'll slip into a short break. When we come back, we'll get you the top market voices along with the key market events to watch out for on the other side.
Welcome back. Now, IIFL Finance has denied reports of potential sale of its microfinance arm Samast Finance. Founder and MD Nirmal Jain said that there is no value unlocking underway, but says that the company is open to a partial divestment. Listen to what he had to say.
We are looking at an investment, part divestment or an investor. But the names that are being talked about in media are without any basis. There are multiple ways to do this. It's not exactly unlocking value, but strategically there are multiple ways to whether we can demerge, we can get a private equity investor, but nothing is on the cards.
Goldman Sachs has slashed India's FY26 GDP growth to 7.5% amid disruptions caused by the Gulf conflict. It further estimates a 2% impact on India's current account deficit due to higher oil prices. Let's listen in.
So we have baked in 5.9% year over year for calendar 26 growth and slightly higher inflation, north of 4.5%. We are looking at 4.6% for the calendar year 26 on inflation. Importantly, by Q4, we think you head towards 6% on headline inflation, purely because core goods inflation we think will be grinding higher. If the premiums that we are assuming for the Middle Eastern crude goes away, that would mean upside bias to growth, yes, in the early 6% handle, slightly lower inflation, and definitely lower current account deficit, because the current account deficit ultimately has a direct pass-through of the oil price assumption that you have. We think it is going to be north of 2% of GDP.
And before we wrap, the most important bit of the show, the events to watch out for. Upasana is standing by with all of that. Upasana.
Well, although it's a market holiday tomorrow, but global events and other news will certainly flow in. Now, first up, let us look at the global economic cues. US initial jobless claims and EIA natural gas stocks change. These two data will be out tomorrow, so we'll be keeping a track on that as well. Now, let us look at some of the important board meeting lined up for tomorrow. Trent, there's a fundraise meeting tomorrow for the proposal of issuing NCDs up to 500 crore. So certainly that will be in focus. And Aster DM and Chennai Petroleum will be considering their interim dividend for FY25, FY26. Now let us look at some of the key other events. European Parliament votes on legislation related to EU-US deal, and also mind you that the G7 foreign ministers meeting starts tomorrow until 27th of March. And lastly, EU finance ministers meet is also scheduled from 26th to 28th of March. So all in all, looks like quite an eventful day tomorrow.
Oh, yes, it will be. It has been an eventful last 1 month. But thank you so much, Upasana, for joining us with all those details. With that, it's a wrap on this edition of Markets Forward. We'll be back with more news and updates on the other side. Stay tuned.
Good evening. Thanks for joining us on Business 360. I'm Shireen Bhan. The headlines that we're tracking for you this evening. The Americans are negotiating with themselves. Iran's military mocks President Trump's claims of talks with a top official in Tehran. Reports say the White House has sent a 15-point ceasefire proposal. President Trump insists that the U.S. is negotiating with the right people in Iran. Brent crude continues to hover around the $100 mark. Iran signals safe passage for non-hostile ships through the Strait of Hormuz once again. President Trump claims he received a very big gift from Iran related to the Hormuz Strait, but does not elaborate any further. Drones and missiles continue to wreak havoc across the Gulf as attacks continue. President Trump reposts Pakistan's Prime Minister's offer to host negotiations between the U.S. and Iran, but Tehran remains skeptical and fears a ground invasion as thousands of U.S. troops head towards the region. The Sensex and the Nifty regain more lost ground as stocks rise for the second day. All sectoral indices end in the green, but the rupee weakens against the dollar, hitting a new record low. The Lok Sabha passes the finance bill with 32 amendments. No new tax changes barring those announced in the budget. The bill now moves to the Rajya Sabha. Kotak Mahindra Bank initiates a detailed reconciliation of fixed deposits and linked bank accounts of Haryana's Panchkula Municipal Corporation. This after the civic body flagged discrepancies worth 150 crore rupees in fixed deposits held with the bank. The bank tells CNBC TV 18 a portion of the amount under review has already been reconciled. Global jet fuel prices more than doubled since the start of the West Asia war. Indian Airlines seek relief on airport landing and parking charges. Construction costs also expected to rise 3 to 5% amidst a surge in input costs. $2 billion deals reshape the business of IPL and cricket at large. The Birlas, along with the Times Group, Blackstone and Bolt Ventures, acquire Royal Challengers Bengaluru for $1.8 billion, hands with the Walmart family and Ford family to buy the Rajasthan Royals for $1.6 billion. Russia steps up its offensive in Ukraine, launches over 900 drones in a 24-hour period. Ukrainian officials say 3 people have been killed, many injured, as President Zelensky urges allies to provide more support. Facebook's parent Meta ordered to pay $375 million. This after the U.S. jury finds the company guilty of misleading users about safety and enabling harm, including child sexual exploitation. Well, the top story this evening, explosions continue to shake West Asia as President Trump insists that Iran will make a deal with the U.S. soon. Now, this comes amidst reports that the White House has sent Tehran a 15-point ceasefire proposal. According to both U.S. and Israeli media, Iranian officials have been informed of the plan through Pakistan. Now, details of the proposal still remain unclear. This after the U.S. president claimed that Iran wants to make a deal badly. Remember, a 15-point plea was the basis of negotiations between the countries last year as well. However, the Iranian military has ridiculed Trump's claims about negotiations in a video message. An Iranian military spokesperson has said that the U.S. is negotiating with itself and that Iran will never come to terms with Washington. He also told the leadership in the U.S. not to call its failure an agreement. Meanwhile, Iranian airstrikes continue to rattle countries across the Gulf. A drone attack sparked a fire at Kuwait's airport after it hit a fuel tank nearby. Power lines were also hit from air defense shrapnel, causing partial electricity outages for several hours in Kuwait. Air sirens also heard over Bahrain and Iraq, while Saudi Arabia said it intercepted at least 4 drones overnight. In a reversal of their previous positions, the kingdom is reported to have given the U.S. permission to use one of its air bases to launch attacks on Iran. Israel's capital, Tel Aviv, and parts of Jerusalem also continue to be targets. Drone strikes caused damage in residential areas and killed 1 person while injuring 12 others. The missile shrapnel also caused varying degree of damage across 7 locations in the country. Meanwhile, Israel and the U.S. continue to intensify their onslaught on Iran. The Iran Atomic Energy Organization has said that a nuclear power plant site in the country was attacked again. The statement alleges that the strike was in continuation of the attacks carried out by the U.S. and Israel, adding that no part of the facility was affected. Israel also stepped up its offensive on Lebanon. Areas in Beirut and parts of southern Lebanon have seen a barrage of Iranian airstrikes. According to Lebanese media, around 9 people were killed. Israeli defense officials also said that Tel Aviv will occupy southern Lebanon to create a defensive buffer against militant group Hezbollah. Iran daring U.S. troops to enter the country, as reports say the Pentagon is expected to send troops from the 82nd Airborne Division to the Middle East. Trump did not address a potential U.S. troop deployment to the Middle East. Oil prices fell after President Trump's claims that negotiations between Washington and Tehran are underway. However, trade through the Strait of Hormuz remains at a standstill. Iranian officials have informed the UN Security Council that non-hostile ships may pass through safely if they neither participate or support acts of aggression against Tehran. This after President Trump claimed that Iran is given a present, which is a very significant oil and gas-related prize to the U.S. yesterday, adding that this time Iran means business and that the U.S. is talking, and I quote, to the right people.
They're going to make a deal. They did something yesterday that was amazing, actually. They gave us a present, and the present arrived today. And it was a very big present worth a tremendous amount of money. And I'm not going to tell you what that present is, but it was a very significant prize. And they gave it to us, and they said they were going to give it. So that meant one thing to me: we're dealing with the right people. It was oil and gas related, and it was a very nice thing they did. But what it showed me is that we're dealing with the right people.
درگیری هایتان به مرحله مذاکره خودتان با خودتان رسیده؟ نه خبری از سرمایه گذاری هایتان در منطقه خواهد بود و نه قیمت سابق انرژی و نفت را خواهید دید تا وقتی که بفهمید ثبات در منطقه توسط دست قدرتمند نیروهای مسلح ما تضمین می شود.
Right. On Monday, Donald Trump gave the first indication of a possible de-escalation in the ongoing West Asia conflict. Media reports now suggest that both the US and Iran have put forward sharply contradictory conditions for a ceasefire. On Iran's nuclear program, the US wants a complete dismantling of its nuclear capabilities, no uranium enrichment on Iranian soil, transfer of enriched uranium stockpiles to the IAEA, shutdown of key facilities like Natanz, Isfahan and Fordo, and full access and oversight by the IAEA. Iran, however, has made it clear that its nuclear program is non-negotiable. On the Strait of Hormuz, the US says it must remain open as a free maritime corridor, while Iran is seeking a new order that would allow it to levy transit fee similar to the Suez Canal. On sanctions, Iran wants a full lifting, while the US has said relief will only come if conditions are met. The missile program remains another major sticking point. The US wants limits on range and quantity and usage restricted to self-defense, while Iran has rejected any caps. Iran is also demanding closure of US bases in Gulf countries and seeking reparations for war damage, both seen as highly unlikely to be accepted by Washington. The US, on its part, wants Iran to end support to regional proxies, while Iran wants Israeli strikes on Hezbollah to stop. Bottom line, despite early signals, both sides remain far apart, with key red lines still intact.
Yes, the red lines are still intact, Santya. Many thanks for joining us. But the Dalal Street today are gaining some lost ground after it gained for the second straight day. The Nifty ending about 23,300, led by HDFC Bank, L&T and SBI. The Sensex clocking gains of over 1,200 points, 1,100 points higher on the Nifty Bank, and the Nifty Mid-Cap Index up by about 2% or so. So a relief rally across the board coming in for our markets today. That's the story. Well, not the market sell-off today, a market rebound is what we saw. Up next on CNBC TV 18, the market town hall. Will the oil shock crash the global economy? What stocks do you buy in a time of a crisis? And can India's macros absorb the war stress? Top investors, energy market experts and economists will speak live on how to navigate the market's intense, turbulent times. That's coming up for you 5 p.m. onwards, live on CNBC TV 18. Now, consumers queued outside petrol pumps across the country to refuel their vehicles amidst uncertainty about supply. Sources telling CNBC TV 18 the government has dismissed speculation of any shortages, saying India has sufficient oil and fuel stock. The government has also reiterated that adequate LPG stocks are available and there is no cause for concern. Now, in a bid to address possible future shortages, the centre has also mandated that consumers switch to piped natural gas in areas where connectivity is available. Under the new rules, key bottlenecks such as right-of-way delays have been addressed through a streamlined approval mechanism. So how are countries in the Asia-Pacific region and other parts of the world tackling the fuel shortage? Kiran joins us now with the details. Kiran.
As the global energy crisis deepens, governments across the world are scrambling not just to secure supply, but to manage the public fallout. Japan will begin its largest ever release of oil from its national reserves from tomorrow. The government approved the release of oil equivalent to 15 days of private sector reserves last week. South Korea has enforced a 5-day vehicle rotation for public sector. Cars are being divided into 5 groups based on their license plate numbers. Each group is prohibited from driving on a designated weekday. The government has also urged people to follow a 12-point energy saving plan, which includes taking shorter showers, charging phones in electric vehicles only at daytime, and using washing machine on weekends. Philippines has declared a state of national energy emergency. It has also formed a committee to oversee orderly distribution of fuel, food, and medicines. Free bus rides are being provided to students and workers in some cities. Transport workers have announced a nationwide strike due to the rise in fuel prices. New Zealand's government has decided to provide temporary financial support of 50 New Zealand dollars to low-income families from next month in a bid to mitigate shocks from the fuel crisis. Australia and Singapore have agreed to maintain a continued flow of petrol, diesel and LNG. This comes as hundreds of petrol stations run dry in Australia. In Chile, long queues were witnessed at gas stations ahead of a fuel price hike which is set to take effect tomorrow. The war has also disrupted Asia's used car trade. Second-hand luxury vehicles like Lamborghinis and Ferraris have been stuck at China and Sri Lanka because the ships were unable to get back to Dubai. Back to you.
All right, Kiran, many thanks for joining us. So that is how different countries around the world are coping with the fuel shortages. Time for us to head into a break, but up next, Kotak Mahindra Bank initiates a detailed reconciliation of fixed deposits and linked bank accounts of Haryana's Panchkula Municipal Corporation. That and more when we return. Well, the Reserve Bank has approved the acquisition of a 66.65% stake in Saman Capital by Dubai-based Avenir Investments. Saman Capital has said that Avenir has proposed to invest over 8,800 crore rupees via preferential issue. The company will hold over 41% stake post the issue in Saman Capital. However, SEBI's approval is still pending, and that will finally close the transaction. Now, Kotak Mahindra Bank is facing an alleged fraud linked to Haryana's Panchkula Municipal Corporation with missing fixed deposits. The private lender has filed an FIR and initiated a reconciliation of its fixed deposit and linked accounts of the municipal body. The bank has also said that a significant portion of the amounts under review have already been reconciled with the corporation. Ritu is here with the details. Ritu, Kotak Mahindra Bank this time around, just before this, it was IDFC Bank, both dealing with the same jurisdiction. Take us to what has transpired here.
Well, it is interesting. You have two banks in the span of less than a month dealing with deposit-linked irregularities, both involving the same Haryana government. Now, after IDFC First Bank, Kotak Mahindra Bank finds itself in the middle of a fixed deposit fraud row in Haryana that is this time linked to the Panchkula Municipal Corporation. Now, we understand the irregularity came to light over the weekend after the municipal corporation instructed the bank to transfer funds after the maturity of a fixed deposit, and then it was found that the money was not available. Now, while the bank has not commented on the amount involved, reports have pegged the sum at about 150 crore rupees, but our sources indicate that the bank's own initial assessment is only approximately 85 crore rupees, but the final number is only going to be clear once the reconciliation exercise, which is still underway, is completed. So the actual number could differ. Now, Reserve Bank of India, of course, has been in the loop, and our sources suggest at this stage the regulator does not see this as a bank-level fraud, though it is unclear whether any individual wrongdoing was also involved. Now, earlier in a statement to CNBC TV 18, Kotak Mahindra Bank did clarify that it had initiated a detailed reconciliation of the FDs and linked bank accounts maintained by the Municipal Corporation of Panchkula, and based on that exercise so far, it did not find any wrongdoing. Importantly, Kotak Mahindra Bank says a significant portion of the amount under review has already been reconciled, and the bank has also filed a formal complaint with the Panchkula police. So, a near identical situation involving the Haryana government department accounts, first at IDFC, now at Kotak Mahindra Bank. IDFC First Bank, we know, ultimately had to settle all the claims in full. So in a way, that has set a precedent. Now, will we see the same story playing out in Kotak Mahindra Bank? We'll have to see.
We will have to wait to see. Ritu, many thanks for joining us. Our tensions in West Asia have driven up raw material costs, and construction companies are bearing the brunt. Analysts estimate that construction costs could rise by as much as 5% if the situation persists. Shilpa joins us now with the details. Shilpa, explain to us how much construction costs could go up by.
Well, you're right. Rising costs are now hitting yet another sector, that's real estate. Now, JLL has said that construction costs are set to rise by 3 to 5% in 2026, and this is led by a combination of things. Now, input costs for this sector too have risen sharply. Metals like steel, aluminum, and copper are expected to inch up by 2 to 4%, driven by global demand and supply chain disruptions. Add to that labor, where wages could jump as much as 12% after the new labor code kicks in. But the sharper shock here is coming from the geopolitical situation. Anurag says that input costs have already risen by 10 to 15% for the sector, and with the Strait of Hormuz disruption pushing up shipping costs by up to 3.5 lakh rupees per container and adding nearly 50 rupees per square foot to high-rise construction costs overall have really driven up for the sector. Steel also, which is a critical piece of input for high-rises where, ripped steel rods are embedded in concrete to provide tensile strength, that also has seen sharp price increases. Even bitumen, which is a key material for infrastructure, has also become costlier. Now, Anurag says that the impact is most visible in cities like Mumbai, Delhi, NCR and Hyderabad, and especially in the luxury housing segment, where developers may be forced to hike prices by over 5%. But with demand already slowing down, there is limited room to pass on costs. So developers are now faced with a tough trade-off, which is to absorb the hit, delay projects, or even rethink fresh investments. Back to you.
All right, Shilpa, many thanks for joining us. And speaking of rising prices, the price of jet fuel globally has doubled since the middle of February, while prices in India are yet to reflect the global spike. Sources say that airlines have already sought relief from the government on taxes and airport charges. Madhya is standing by with more. What are they asking for, Madhya?
Well, in just 1 month, global jet fuel prices have jumped over 100% from about $96 per barrel in mid-February to nearly $197 now. That's a massive spike, and fuel is already 40% of operating costs for airlines. And the spike is about 105% in just 1 month. While Indian prices are yet to reflect the global spike, airlines are now seeking relief from the government. They want cuts in taxes, so a VAT on fuel that states charge, then there's GST on premium economy and business class seats. So airlines are asking for relief on taxes and also lower airport charges like landing and parking fees that airlines pay to various airports. The government is looking into these demands, but there's a catch. Most of India's high traffic airports are run by private operators, and sources say they're unlikely to take a revenue hit just to support airlines. At the same time, more pressure is coming. Oil companies in India, as we mentioned earlier, are expected to raise jet fuel prices in April after holding back a big hike in March. So airlines are facing a double hit here: higher fuel costs and flight disruptions due to West Asia airspace closures. Flights are longer, more expensive to operate, and in some cases they're just being cancelled. What does this mean for passengers? Airfares could go up, but airlines are also worried if tickets get too expensive, demand could fall. So right now, it's a delicate balance. Airlines are trying to protect margins without killing demand, and hence they are expecting the government to step in and to help them navigate this crisis.
All right, well, let's see whether the government pays heed to those demands. Thanks very much for joining us. $2 billion deals have reshaped the business of IPL and cricket at large. Let's start with Royal Challengers Bengaluru. The Birlas, along with the Times Group, Blackstone and Bolt Ventures, have acquired RCB from United Spirits from $1.8 billion. Rachna is here with more. Rachna.
Well, Royal Challengers Bengaluru has just delivered the biggest deal in IPL history, and it shows how the business of the league really works. RCB has been sold for $1.78 billion, or roughly 16,600 crore rupees, and the seller is United Spirits, owned by Diageo, and the buyers are a consortium led by the Aditya Birla Group, along with Blackstone, Satyan Gajwani of Times Group, and David Blitzer's Bolt Ventures. This is a full 100% sale covering both the IPL and WPL teams. The BCCI gets a share too, a 5% transaction fee here, which in this case comes to about 835 crore rupees. Now let's look at the returns. RCB was originally bought in 2008 for $111.6 million. Today, it is being sold for $1.78 billion. That's roughly 16x return on the original cost. But the more interesting layer here is how this asset was held. Diageo never wanted to buy RCB directly, and it did not. It acquired United Spirits between 2012 and 2014, and as a part of a much larger deal in the alcohol business, RCB came along as a part of that transaction. And now by selling just this one asset, Diageo is unlocking nearly $1.8 billion in cash, while continuing to hold on to the core liquor business, but making and unlocking value in a non-core business almost as much as they paid for it, almost $2 billion, when the entire acquisition of USL was at about $3 billion. There's also a listed market angle here. RCB's valuation alone is about 17% of United Spirits market capitalizations, which means a single cricket franchise has become a balance sheet moving asset. Then let's look at who is buying. There's a large Indian conglomerate, the Aditya Birla Group, taking the lead. Then there's a global private equity, Blackstone, and then there are international sports investors through Bolt Ventures. This is an institutional capital stepping into the IPL with clear intent. And at the core of this story is IPL's media rights engine, which has led to this massive valuation spike. The current cycle is worth over 48,000 crore rupees. That translates into more than $80 million per team every year, with over $400 million of revenue visibility logged in over 5 years. Add to that sponsorships, ticketing and digital monetization, and what we have is not just a cricket team, but a high visibility, cash generating asset, and that is why valuations are rising.
Well, Rachna, let's now also talk about the other big deal, and that was Rajasthan Royals. Carl Samani has bought the team for $1.6 billion with investments from Walmart family and the Ford family. A stunning rise in valuation for this team as well, Rachna.
Well, when we talk about the business of IPL, Rajasthan Royals will emerge as a case study in how to turn things around and make that money. Though not official yet, the franchise is being sold for $1.63 billion to a consortium led by Carl Somani, backed by global heavyweight investors, including the Walmart and Ford-linked families. This is also a full 100% exit. Now let's look at who's cashing out and how much. Before the sale, emerging media held 65%, Redbird Capital 15%, and Lachlan Murdoch around 13%. At this valuation, emerging media walks away with roughly $1.06 billion, Redbird with about $244 million, and Murdoch is at $200 million. And then there's a very different kind of winner here, Shane Warne, who led Rajasthan Royals to their 2008 title, had negotiated a 0.75% stake as a fees for every season he played for the team. He played for about 4 seasons. That takes his stake to an estimated around 3%, which is now worth close to $50 million or over 450 crore rupees, which will now go to his family estate. But to understand why this is a story of turnaround and big gains, we need to rewind a little bit. Rajasthan Royals was bought in 2008 for just $67 million. At the time, it was the cheapest team in the league. Today, at $1.63 billion, it has given 24 times return in dollar terms and has emerged as the most expensive franchise. And the layers of return are just as important here, because emerging media built its position over time and now exits with over $1 billion. They were earlier with the original consortium. Over time, they built their position and now they stand at about $1 billion exit. Then Redbird, that came in 2021, which was quite recent, still delivers up to 6.5x return in just 5 years. And Murdoch, who was an early investor, is now looking at returns of around 10x. So this is not just one successful bet, this is multiple entry points, all delivering strong outcomes for the investors. And investors aren't the only winners here, because there's a BCCI cut here as well, and that comes to about 765 crore rupees on this transaction as fees. With these two massive deals, it is clear that IPL has evolved into a system where value is created and monetized at multiple levels. So it is a business that delivers $1 billion outcome more than just a cricket tournament or a league.
Well, that certainly is the case. Many thanks, Rachna, for joining us. 6 clearly being hit by both RCB and Rajasthan Royals. With that, it is time for us to wrap up this edition of Business 360. The news will continue right here on CNBC TV 18. Stay tuned. We're back in a minute with more.
Let's talk money.
Hello and welcome to a very, very special edition of Let's Talk Money. I'm your host, Surabhi Upadhyay. You can see I have a full house with me here in person in the studios, and I'll tell you why. We are celebrating. We are celebrating the 100th episode of Let's Talk Money. Yes, we've turned 100 episodes younger, and I want to start by thanking all of our viewers for constantly being with us in this journey, giving us your feedback, your opinion, telling us what you want to hear about, and all the comments that you give us on social media as well. It's been a very, very humbling journey for me personally. And I also want to thank a lot of the Let's Talk Money friends over the years who've taught me so much on personal finance, have helped me become a better professional, and only helped increase my passion for financial wellness and financial independence, because I truly believe everything starts from there. So this is a special episode. We have a full celebration. It's a 1-hour episode, by the way, which we'll play over this week and the next. So you already know them. You've met them so many times on the show. But let me quickly introduce once again Feroz Aziz of Anand Rathi Wealth. And we have with us Mr. A. Bala Subramaniam, who is the CEO at Aditya Birla Sun Life Mutual Fund, and Mr. DP Singh, who is the top boss at SBI Mutual Fund, among the largest asset managers of the country. Gentlemen, thank you so much for joining us on what is a very, very special episode for us here.
Thank you. Thank you. Congratulations.
Thank you. Thank you so much, DP sir, Bala sir, and of course, Feroz. I remember conversations with all of you in our old studios, in our old office back then, where we had a very different set. And that's when the personal finance conversations really started for me. And, you know, I realized that it's really about that, right? You have to get your basics right, your wealth, your math, your money management right to build anything forward in life, right? So I just want to start with opening thoughts on your association and journey with us. Of course, SBI Mutual Fund has been a sponsor of the show in the past as well. So very, very thank you. We're very, very thankful for the partnership. So DP sir, you tell us, you've been having these personal finance conversations with us for a long time. What would you say to us, and what would your first thoughts be?
Thank you very much, Surabhi, for all the great work you have done during the journey of 100 episodes. But one thing I will tell, whatever we were talking in the first episode, we'll be talking the same thing in the 100th episode.
That's true.
Because we are making the personal finance very simple.
Yeah.
And simplicity is the only constant in the personal finance.
Absolutely.
And simplicity sells. We want to turn, not with the jargons or anything, but the simplicity and the same financial discipline, continuous being there, whether it's a war, whether it is a COVID time, whether it is the prosperity which is all around. Anyone who has been disciplined in the personal finance, in investing, they have definitely created wealth for them. And every time is an opportunity to create wealth. So same is the case now.
No, that's true, and I think you're absolutely right. If we go back in time and turn back the wheel and look at our earlier episodes, the conversations will more or less stay the same. But Bala, DP sir raised a very important point. Keeping things simple in an increasingly complicated world, the world of financial services itself, every day is throwing up more choices. So it's not easy to keep it simple. I can tell you that from experience. What are your thoughts?
I think it got evolved over time. I still remember when the entire mutual fund industry started in 92, 94. I'm talking about private sector mutual fund coming onto the play. All of us were new to the systems. All of us had to explain the product, how actually the manufacturing is done in the mutual fund industry. Not many had known about how to make the investment, and most of them are actually trying to actually upgrade themselves on how to manufacture a product rather than actually how to invest. I think over a period of time, the manufacturing of a product left to the money managers' expertise. That's why I think fund management got evolved over time. And the investors started understanding, actually, I don't need to know actually how the money is being managed. I must know actually the asset allocation. I'm sure the episode that I'm talking about, 100th episode of yours, has done a great service to the nation, I would say, in making people understand. You must know actually how to save your money rather than how to manage your money as a portfolio manager. There are professional managers are there. And that's something I would say it got evolved over a period of time. And second is the literacy rates in India. I think when you talk about it, literacy rates. So normally we talk about literacy rates, passing out, knowing writing and knowing writing and reading and speaking types. So now I think the mutual fund industry has now become quite synonymous in every investment decision that you make.
Yeah.
I'm sure this kind of session that is being done by yourself, I think you have been an anchor of financial literacy in the country along with all of us.
Thank you. Thank you so much.
That something has actually paved way big time and actually making people understand the importance of saving rather than importance of knowing about how the investment happens.
No, absolutely. I mean, and I personally, I think the reason I was drawn into this career, it's been over 20 years, is that I felt that it cannot be rocket science. You apply some basic common sense, some basic logic, ask some basic questions, and you should get to the answer of how to manage your money properly and how to understand a little bit about the market as well. That's what got me here, and I'm still here tracking the markets every day. But speaking of asking questions, we've asked Feroz Aziz plenty of tough questions over the last, I think, 15 odd years, Feroz, right?
Yes.
Telling Feroz late in the night, no, Feroz, can you please give us an example? Can you make it simpler? How does this particular product compare with that product? So, Feroz, thanks to you, I think we've all become so much wiser over the years. So, big thank you.
Thank you, Surabhi. I think you're doing a big service, and I'll substantiate it with some data of why you're doing so much service. Because, see, personal finance is a foundation for everyone.
Yeah.
See, somebody could be a direct equity guy. You don't probably, not everybody needs some direct equity gyan. But even the direct equity client or an investor who has nothing to do with mutual funds, needs a home loan maybe, right? So personal finance is the bunyad on which everything stands, right?
Yeah.
So, and creating a foundation on that, I think, is a big service to the nation. Now, let me give you some data of why I think personal finance and journalism has had a large role to play, apart from the asset management companies creating a huge education drive using the investor education budgets and stuff. Today also, if the markets are falling, I was looking at the small cap inflow data after the war has broken out.
Yeah.
There's not one day of negative flow in those 36, 37 funds, small cap funds.
That's astounding data.
Astounding. 3,700
This is over the last 3 weeks of this Iran-US conflict.
Can you believe it? Wow. Every single day there is a purchase.
So
as an
funds are
aggregate
getting money.
small cap.
Yeah.
Because they are getting 300 crores, 200 crores a day, but we have 1,200 lakh crores of household savings. It's not like there's like Mavericks buying small caps during a war. They're buying some tiny portions in the form of systematic investment plan. That won't be possible. 10 years back, it would be dramatically different. So I personally think all the education you've done has created a lot of sensible investing.
Thank you so much. Thanks to all of you. And I now want to go back a little bit, for an anecdote in history. I think even when we started this conversation and back in, I think, 2005, when I started tracking the markets, every time there was a market crash, the first thing we would call up the mutual fund houses saying, kitna redemption aaya? Are people selling? Will there be more redemption? Will you be selling more? Because investors are pulling out money from funds. From that conversation in 2005 to a very different reality that Feroz is describing in 2026. Mr. Singh, okay, so let's talk about this war, the last 2-3 weeks. What have you witnessed in terms of investor behavior?
See, what happens is what we are talking about, the like small cap getting money. And understand, we are getting around 30,000 crore of SIP money every month. So putting on the working days, so it's coming to around 1,200 crores every day, right? If we are getting 1,200 crores every day through SIP route, whatever the redemptions are there, those are balanced when we look at the net numbers. Right? So the SIP book has been a very, very great, very big stabilizing factor in the market. And second, one more thing, when you rightly put it, 10 years ago, there would have been queues for redemptions, but today there's hardly any panic calls even.
And the market is down 10% at the index level.
Market, people are looking for the opportunity, and if people are not putting in money, at least they are not redeeming out of panic. Still, if somebody needs money, in any case, he or she will withdraw, but I have not seen that kind of. Yes, one thing is in the incremental lump sum money is little sitting on the sidelines because nobody knows that then
where is the bottom. You don't know.
So through investor education board, through these kind of programs, through whatever the Feroz team or people saying, at least in a staggered manner start putting in money. So that is what it is. Because market has already corrected 10%. Ultimately, it will come up. Who ever thought that HDFC Bank will be available at 1.5 times? It used to be 3-4 times. Right?
Never traded. I never thought it will fall below 3 times price to book.
That's a different story. Nothing wrong with the asset quality. But I'm just giving an example.
The market can do funny things.
Can do funny things. This happened. But these are all opportunities for building up the portfolios. And see, I think resetting happens. It's a good opportunity for the fund managers to rebalance their portfolios, and all these things are happening. And I think I've not seen panic setting in as
That's
such.
really good to know. That's really good to know.
Just
And
to extend what DP just mentioned, historically, if you look at the volatility, right from 90s, then coming out of various security scams, then you have geopolitical risk, then we have seen COVID in 2019, and Lehman Brothers collapsing in 2009. And each time when the market collapse used to happen, the one common question used to come, should I redeem or should I invest more? The number of questions used to come for redemption used to be far higher than the investing. I'm talking about the early days. We have to literally convince people that is the best time to actually invest when there is a huge amount of downside volatility. That's the time you can build your portfolio where you also know actually what price it is you are buying in the market. So that's the beauty in which we always, fund managers used to always say.
So okay, give me an anecdote. Your dealing rooms and your fund managers 15, 20 years ago during a market crash, say global financial crisis, the mood and whatever the conversations in the dealing room then and now, what is the difference?
It's an event, a similar kind of order, but this time I think the fall has been far higher. But despite that, the reaction to the market is relatively low. In the sense, fund manager reaction, rather panic situation is relatively low. Mainly because of the maturity levels of both investors and fund managers also improved. So when I talked about Lehman Brothers crisis, we were actually sitting in the market till about 11:30 in the night, trading in the bond market, thinking the next day when the market opens, you will never know what price you are going to get it. And that was the real situation we were there. And next day morning, of course, when we came to the office and we saw the screens everywhere was red, there are absolutely no issues. And we also seen, even when there was a political crisis, we have seen market hitting the lower circuit. And the complete panic, the market went to halt for about, say, a few minutes before the market opened. Having seen all such kind of cycles, this time around, despite the kind of fear that is there in the world market, with the oil price going up, definitely the situation is not, we can say, rosy as is ever.
True.
It's something scary as well. But still, maturity levels are far higher because I'm not investing for today. I'm investing for the long term.
That I think is the best silver lining in this case.
That has come.
That there is a level of maturity that has set in. The level of panic is lesser. People are willing to look at the long term. So that's the great upside to the Indian investor. But you know, we always put a mirror to ourselves on this show, right? So there's a reality check as well. There are certain downsides as well. Are we really still making the same mistakes 10 years, 15 years down the line when it comes to our journey to long-term wealth creation? So let's recap those mistakes and make sure we don't make them after the break.
Let's talk money. Let's talk money.
Welcome back. You're with us on a very, very special episode of Let's Talk Money. It's our 100th episode and we are celebrating our century with style, with some of our best-known friends over the years. We have Mr. DP Singh of SBI Mutual Fund, A. Bala of Aditya Birla Sun Life Mutual Fund, and of course, Feroz Aziz from Anand Rathi. So over the last episode or the last segment, we went over just what has changed in terms of investor behavior. And everybody agrees that the Indian investor is far more mature today, despite a full-scale conflict raging in West Asia. But now I also want to talk about the things we've still not learned. 15 years and counting. And this, Feroz, I want to start with, I'll never forget that January 26 moment when after gold prices having surged 65-70%, silver prices having surged 150% last 1 year, investors chose to pour in more than 30,000 crores in gold and silver and less than that in equities. And that really raised an existential question in front of me, ki hum kar kya rahe? You know, all this while we're talking about asset allocation, not chasing returns. Public is still chasing returns.
Yes, Ruby, public is surely chasing returns, like you said, right? That has a name called recency bias. You are governed by what happens in the last 6-8 months when you take decisions. That's very difficult to let go. Your heart overpowers your mind. Now, I did one study, okay? I'm yet to complete that study. I put all the inflows for the last 24 months in gold ETF.
Okay.
Let's assume all the money came from one person.
Okay.
And what's the profit or loss he would have made, I wanted to see.
Okay.
You know, gold has actually gone up 40%, 45% for the last 1.8 years.
All right.
In terms of price. But mutual fund ETF investor is marginally negative. Why?
How is that possible?
Because when they put 200 crores, the first installment, let's assume April 2024, ETF inflow was 200 crores. Let's say, I'll tell you the precise numbers. That 200 crores has made 100 crores of profit. But when it was going up, you had very small amounts where you were making money.
Okay.
When it came down, you had 20,000 crores in January. So that has lost 4-5,000 crores already. When you were going up, you were making money on 200 crores, 100 crores. जब गिर रहे हो, तो आप 20,000 crore पे loss बना रहे हो. So if all this money belonged to a person, he's not made any money in gold. And
but that's true for any asset class, right? You start small with equities, your incremental gain will always be small. Eventually, after 20 years, you have a large AUM, and then when there is a 10% hit on your AUM, so it'll hurt, right? That's true for all asset classes.
No, it's true for all asset classes. Now we're speaking about investor behavior.
Chasing return.
Investor behavior chasing return. But there's still a silver lining in the dark cloud. Now let me give you a study. SIPs, जो सबसे ज़्यादा परेशान करते हैं ना first 1 year में, the SIPs, those are the ones which make maximum money. I looked at SIPs, which made, in the first year, made less than 20% return. See, let's assume Surabhi starts an SIP as a new investor. And 1 year later, she sees minus 20% on an SIP.
Wow.
You will be very dejected. You will be so tempted. DP sir, meri SIP band kar do. You'll be tempted or not?
I'm mature now. I'll say, thoda aur wait karke.
No, not Surabhi. It's a very, very wrong proxy of what normal investor behavior is. Now, those are the guys, let's assume less than 20%. 8% of the times, if you started an SIP, 8% of the times you would be losing more than 20% in the first 1 year. If they continued the SIP for the subsequent 4 years, they would again make 13%. So there are 14% of the times you made between minus 0 and minus 20. So if you could hold that one bad year, the subsequent 4 years would have brought you back to 15% compounded return for the full 5-year period. So whatever looks painful in the 1 year, it doesn't mean that your next 4 years will not make up for it. And people are not stopping those SIPs in spite of being new investors. And don't lose hope. You've done a great job is why there's so much happening.
No, I mean, I completely take that point, and it's heartening to know that even as people were investing in gold and silver, but the SIP number was still rock steady during these last couple of months as well. But, you know, let's talk about some of the issues at hand, what Feroz highlighted. You know, recency bias, investing based on FOMO or a certain emotion. So, DP sir, what according to you are, say, the key, you know, cardinal sins or the biggest mistakes that even now, 20 years into this, that investors are still making?
See, again, coming back to the SIP story, the people who started SIP, the biggest mistake they're making with their prosperity going up, with their surpluses going up, they continue with the same amount of SIP.
Okay.
It has to top up.
Okay.
Unless until you do that, your ultimately you will be making money on a smaller portion. What Feroz was talking about. If you are not putting in money, if you are not stepping it up, you have to have discipline, and discipline of making it higher with the time when your prosperity goes up, your surpluses goes up. It has to go up. Generally, people don't do that. And today, see what is happening. The action is not happening because we have democratized the wealth creation in such a manner, thanks to the programs which we are doing. When I talked about every day we are getting 1200 crore rupees through SIP, if I put a number, we are getting a trigger of almost 4 million SIPs every day. There are 10 crore SIPs. So 4 million will be getting every day. So getting the action done by 4 million people on a particular thing on day-to-day basis is very difficult. It's basically lazy money. It has to be a little more active.
So basically, people need to top up their SIPs. They need to, review, top up, and when they have surplus funds, make sure they start investing more. Okay, so that's one key mistake.
That's one thing. And second, when they switch over from here to there and they're tracking the best performing funds. In my own case, when I look at my own portfolio, I did one study, as Feroz was talking about study. Had I been putting in all my money every 2 years to the best performing funds, because I've never churned, I've never gone to any of the portfolio. So had I been doing it, what will be the result? I was thinking that it will be 1 or 2% difference, so I'll be getting less. But I was astonished to see I would have made 3% negative CAGR return had I been putting every
year if you were churning your money in the top performing, every 2 years, the top performing fund.
The top performing fund, never look at that 6 months, 7 months, that decency bias. That should not be there.
That's a great example and study that you've done yourself. That chasing a top performing fund is not the way you're going to make money.
You
take
can
that point.
Make money and don't take them. There will be cycle. The top performing will become the underperformer. Underperformer will become the top performer. And I think when Feroz can do that because they are doing in a very disciplined manner.
Got it. So do not chase. First of all, top up your SIPs. Make sure you don't remain under-invested even when your income has grown. And secondly, please do not chase top-performing funds. So two clear instructions coming in from DP sir. Bala sir.
Just to add to what DP mentioned, when you chase return, you'll of course get a joy in the short term that I'm actually backing a fund which is actually performing the best. But every fund actually goes through its own cycles because market volatility doesn't leave anybody. Or doesn't spare anybody. A best performing becomes a worst performing becomes a best performing in different cycles. Therefore, the another mistake what people should not do, by way of chasing, you should not stop your SIP. Sometimes when you chase, you stop your SIP, and most of the time when you stop it, you don't start immediately. Therefore, you leave a gap. Therefore, leaving a gap is not the word doing it. Second is when you see this kind of volatility. The worst that people can do is actually stop the SIP. I think if you look at even SIP, the cancellation of SIPs, sometimes it comes because you are scared about the market, therefore you are cancelling it. Or discontinuing it, then you want to come back. Therefore, SIP is not meant for actually, it's for timing the market. SIP is actually for accumulating.
That's true.
People should remember it is a tool of accumulation in order to create a longer term wealth.
And not market.
As Feroz mentioned, especially in SIP, there will be a period of 1 or 2 years, like markets like today. The falling market, any SIP would have done in the last 1 year would be negative.
Absolutely.
That doesn't mean that investment is wrong. You have to understand, I'm not investing for 1 year. And the rupee cost averaging, if you have to take, I think the powerful way of investing and accumulating for long-term wealth through continuous investment rather than timing the investment through the SIPs, cancellation and chasing returns.
Got that.
That's another mistake people should not do.
Got that. So do not cancel your SIPs during periods of market volatility. Chances are that is where you'll hurt your cause the most when it comes to long-term wealth creation. Feroz, very quickly, you want to wrap up the mistakes. I think you came up with almost like 7 sins, right, that people commit while investing. So you want to wrap this up, the mistakes that people need to really guard against.
Trying to compress it, I'll just tell you. One is don't buy complex instruments. We analyzed 1,200 PMS portfolios of clients who have bought and sold. And we saw that whole PMS portfolio of 1,200 families worth almost 7,500 crores. And we saw 92% of them underperformed the Anand Rathi model portfolio of mutual funds. So all this tamjham of tax and cost and all that, minimum ticket size of 50 lakhs, if that for an ultra HNI resulted in underperformance to mutual fund on a pre-tax basis, don't do complex. I don't have one PMS in my portfolio, right? That's one thing. Second, asset allocation has to be on total assets.
Okay.
I met a gentleman, he says, yaar, ye mere financial assets hain, 7 crore ke, baki chhod de. मैंने कहा एसेट एलोकेशन है तो पूरे 22 करोड़ लिखो ना, प्रॉपर्टी भी लिखो, गोल्ड भी लिखो, हैंड लोन भी लिखो, पीपीएफ लिखो, ईपीएफ लिखो, एंड देन यू डू एसेट एलोकेशन. हाउ कैन यू डू एसेट एलोकेशन ओनली ऑन इक्विटी एंड डेट? राइट? टोटल एसेट एलोकेशन is the only way to do asset allocation. And the last one, don't have different yardsticks.
Okay.
Physical asset, 20-20 साल, कोई problem नहीं, and that to compounded return कोई calculate नहीं करता. Right? So please, if you have the same yardstick for financial assets and physical assets, just do that. Compounded return, CAGRs have to be calculated both for gold and physical assets, if that's the barometer for FDs and mutual funds.
Got that. Okay, so those are the investing sins that we have to avoid. We have become mature investors. That's something that the panel has completely acknowledged. But we need to do better and stop making silly mistakes which are taking us away from our long-term wealth creation journey. So we're going to take a pause here this week on this edition. But the celebrations continue because I'm coming back next week with the same three experts to talk about the golden rules that will really firmly put us on the path to wealth creation and financial independence, even in a turbulent market like the one that we're in now. So keep it with us next week. The conversation will continue. Thank you for watching.
Let's talk money.
Hello and welcome to another edition of the CNBC TV 18 Market Town Hall. The amount of headlines and consequently the market moves have truly been head spinning and dizzying to say the least. To be sure, the Middle East conflict is only the latest in a series of massive disruptions, which I'm referring to now. Since January of 2025, when President Trump took charge in the White House as the President of the United States, we've had non-stop run-through of news flow, which dwarfs pretty much anything else we've seen, at least I remember, in the past many years or so. So it's truly been historic. Headline roulette, you can call it, or whatever else, but absolutely head-spinning amount of news flow. And of course, it's had an impact on markets as well. From tariffs to AI to now Iran, all this has meant that markets have indeed corrected quite a lot. I mean, some because they need to correct, and of course, I mean, there's been a fair bit of indiscriminate selling, forced selling, etc. as well. And that is what this town hall is really all about.
Well, there is the micro and then there is the macro. So what we've done is we've divided this into three parts. First, we'll focus on the global macros and oil prices. Art Berman, who is an oil market veteran, and Ben Powell, who's here with us in the studio from BlackRock, is there. Second, we'll focus on the opportunities in the market right now. Harish Krishnan of Aditya Birla AMC, Sandeep Tandon of Quant Mutual Fund will be joining us. And then we bring in the macro heavyweights, Neelkant Mishra of Axis Bank and Sajid Chinoy of JP Morgan. So we've got all three bases covered in the next 90 minutes or so.
Well, I also want to extend a warm welcome to our audience. I mean, it's a small gathering, but it's an intelligent one. It's a very informed one right here in our studios, by the way. And you can see, I think, the visuals there. So just want to extend a very warm welcome to all the CNBC TV 18 Access members and, of course, our guests who are going to be joining us in just a bit in the other panels as well. So, you know, Rima and Art, my job is a little easier because we're going to ask a few questions to kick this off, and then we'll hand it over to the audience and take their questions to all our guests and all our panelists. So that, with that short introduction, with a short preamble, let me dive straight in with you know, the first focus area, which is, of course, the global picture, given the big oil shock that we have. Art, great to have you join us from the US. Thank you very much for being here. And Ben, glad you could make it to our studios. So it's a simple question with not such a simple answer, I guess. Is the war winding down, Ben? What's your sense?
I'm not so sure, actually. So I recognize there's a degree of optimism in the air over the last 24, 48 hours as the US president has made warmer noises, I guess, has spoken about his hope for a deal, a 15-point plan, and so forth. So I recognize that, the market recognizes that, and it's definitely relevant and interesting. However, we have to observe on the ground, I live in Abu Dhabi, the drone strikes have continued, the missiles have continued, and the Marines, the US Marines, I believe, arrive later this week. So I think the situation is, frankly, still very tense. The facts on the ground are mostly unchanged. Indeed, it feels more of an escalation in the last week than a de-escalation. So I recognize President Trump's words. Of course, I'm watching with huge interest, both as a citizen of the UAE and as a markets professional. But I think we need to be careful from being too confident and too optimistic, because sadly, as I say, the facts on the ground continue to be, frankly, quite alarming. And there is the potential for this to continue and worsen as these attacks on the physical infrastructure. Just overnight, we've had an attack on the Kuwaiti airports, one of the fuel depots kind of struck there. So I recognize President Trump's words, very important. He's the most powerful man in the world. But the facts on the ground continue to be unsettling, and that has not changed in the last 24, 48 hours.
Absolutely. If I can get Art, Rima, into the conversation as well. Art, same question to you. Do you believe the war is winding down? Ben, of course, is cautious. I just wanted to get your sense, because things have moved over the last 48 hours or so, and many believe directionally this is the first sign that things are starting to cool down and we are de-escalating rather than escalating. Art?
No, I think Ben has summarized it very well. My view is I see no de-escalation. I see more potential for escalation. I think that the words from President Trump are purely performative. It's very difficult to have your negotiating partner take you seriously when you're moving, combat units into the area. So, I think Trump is managing this like a reality television program. He needs lots of plot twists and, interesting, spicy things to add to keep everyone's interest. But at the end of the proverbial day, I see only escalation in the coming weeks.
So Art, what is your base case scenario right now? And in that event, where do oil prices end? And the best case is that perhaps the oil conflict ends in the next couple of days. In that scenario, where do you think oil prices will settle? Because even if the conflict ends, there are facilities which are damaged, which are not going to come back on stream immediately. And then even if there is a ceasefire, there's going to be an uncertainty surrounding that. There will be a geopolitical risk premium attached to the passage. So give me your base case for oil prices, a worst case, and a best case. Best case being that actually this is de-escalation.
Sure. So obviously no one knows the answer to that, but this is about informed speculation. I would say, I mean, for instance, Ben's boss just came out this morning, I believe, and said, 100 to 150 is BlackRock's base case for, I can't remember if he said for a year or for years, but it was something like that. And I see that as a possibility. But let me make it very clear. There will now be a permanent risk premium on oil, regardless of how this thing ends. And I would say that premium is no less than $10 per barrel. And so if everything ends tomorrow, the very best case we can get back to is maybe $80 Brent. Now, I don't believe that everything's going to end tomorrow or that we're going to get back to $80 anytime soon. So my bottom line is we don't know. It's a probability distribution. I think somewhere in in BlackRock's range is reasonable, certainly for the rest of 2026. And in the longer term, when all this, as you correctly point out, trickles out to the rest of the global economy, then we'll get down to lower prices as the global economy collapses.
And also several nations, considering the energy shock right now, are likely to increase their purchase and storage of petroleum reserves. How much can that push up prices, to your mind, Ben? Sorry, Art.
You want me to? Okay.
Yes.
So, we're talking about a few million barrels a day. If all the storage in the world could be released all at once, okay, it can't be. So we take 3 million barrels, let's just say, maybe it's 2, maybe it's 4, I don't know the right answer, and we weigh that against 17 million barrels, which is the shortfall. It's a rounding error. I'm not saying that we shouldn't do it. We absolutely should. I'm not saying it's insignificant. I'm saying it doesn't make that much difference. In other words, if we think about a man who's lost 20% of his blood supply and he's bleeding out on the ground, and we put a tourniquet on his leg, and now he's only losing 15% of his blood supply, the guy's going to die unless you get him to hospital very quickly. That's a very crude analogy, but I think that's a realistic way to think about this. Yep. In other words, yes, let's do everything we can, but let's recognize this is an urgent situation.
It is an urgent situation. And Ben and Art, both of you, I mean, I just wanted to come in here. Both of you don't believe that this is ending anytime soon. So am I watching the same news that you guys are, or you don't believe what President Trump is saying, or what is it? I mean, we've heard the man say on tape, on camera, of course, he said a lot of things, but he's also said this, and this is the latest, that we've achieved our aims and we're going to end this soon, et cetera, et cetera. So, Ben, you want to go?
Well, a couple of things. I think President Trump is sophisticated. So is it possible he's buying time for the Marines to arrive? I think that's at least possible. Of course, we don't know, but it is at least possible. And secondly, and I think more importantly, of course, America is the US. They are the world's hyperpower, so we all respect and listen to them because of their heft. But they are not the only player here. So you have to think about also the mindset of the Gulf Cooperation countries, the Gulf Cooperation Council, including the UAE and Saudi, and to be somewhat straightforward, They've just had thousands of drones and missiles thrown in their direction, so they may not be in a shake hands kind of mood. And the same, I think, could be applied to Iran. So Iran, again, we don't know how much is posturing.
But countries like Qatar, Oman, etc., seem to be facilitating. I mean,
Yes.
a sit down of some sort.
You're right. So there's a blend amongst the GCC, the different countries within the GCC. They're not all the same, that's for sure. But I think in particular, the UAE, Qatar, Kuwait, and Saudi have been surprised, would be English understatement, I think, surprised at the centrality of their role in this war. I think they were very much hoping that they could be something like neutral. It's a conflict between the US, maybe Israel, Iran, and the GCC. And this was not, it turned out to not be correct. Furthermore, I think Iran, they have said they want to make it very clear that there's a price to pay. Iran, the IRGC, the leadership of Iran, perhaps want to make it very, very clear to these other countries that if you mess with us, you will pay. And therefore, again, it's not so obvious that they will just shake hands.
That's the point, right? If you mess with us, there'll be price to pay. And here's President Trump saying we're going to stop messing.
So a couple of things. One is, I think even if President Trump stops messing, which again, I'm not so sure, but if that's the case, then Iran can decide, okay, now the punishment can come. Now the punishment can come. So maybe, we don't know, maybe we are only at the beginning of the economic pain. And I think I would say, just briefly, of course, we're all focused on energy. This is totally appropriate. But it's not just energy, by the way. It's fertilizer. Right. It's helium into semiconductor. So in a way, this is something like a 1970s supply shock, on the energy side, multiplied by COVID in a way. Not quite, but there's something there making the point that this is going to be really a very serious problem for the global economy and for potentially U.S. political pressures as well.
But by the way, the betting market, poly market, right, the marketplace, whatever you want to call it, 60% odds that the war will end by mid-May. Now, I don't know what ending the war, the bombs stop falling or a complete peace, the strait opens. I don't know what that question or that statement is, which the war ends, but poly market says 60% by mid-May. That's what they're saying. Art, you want to come in on the question? Are you of the view that this is just buying time before we see this continuing and intensify more?
Well, Prashant, I can say a few things as an American. President Trump lies all the time. I mean, that's not a criticism, that's a fact. He has not said a true thing about the situation in Iran for at least a week. So I discount everything he says as performative. I don't discount its significance. I just don't think it, I don't believe anything he says. The bottom line for me is that Iran is right now the strongest country on earth. It holds the entire global economy hostage to its control of the Strait of Hormuz. Okay, it's never been more powerful. It never dreamed of being this powerful, and it's not going to give that up, as you know, as you said and Ben said, without extracting a huge cost. Now, back to the bettors. Maybe the fighting ends. Maybe there's no more bombs by mid-May. So much damage will be done between now and May that, I mean, a recession would be an optimistic take. I don't want to be pessimistic. I'm just trying to, to objectively assess what's going on. And as long as Hormuz is only partially restored to flow, then all bets are off, and chaos, economic chaos, social chaos.
Art, if I can just ask you one thing. You saw the statement from the Iranian Foreign Ministry that they're going to allow non-hostile ships to pass through the strait, right? The problem is the strait and the oil not flowing. And they said, was that different from what we've heard before? Or there's nothing different? I mean, earlier it was we're going to set ships ablaze, and this seems a bit of a pivot, right? I mean, in their own way, they can't seem to be negotiating when they're being attacked, but a bit of an admission that they also want this to wind down? No, you don't read it like that.
No, I think, the Iran lies a lot too. I mean, that's the nature of this dispute. Iran wants to set up a tolling situation where they can get revenue that cements their control. In other words, if they can get other countries to actually agree to pay them for passage, then that essentially gives them diplomatic recognition that they're in charge of the Strait of Hormuz, which strengthens their position and gives them a little money. Bottom line, Prashad, is we're back to the strategic reserves. Maybe 1 million, 2 million barrels eventually gets through Hormuz with some kind of tolling situation. It's still a rounding error compared to what the world needs.
Well, the point is well made, Art. Iran is militarily weaker, economically weaker, but strategically far more important today than it was prior to the conflict. But Ben, the advice in all this for BlackRock is you all have dialed down tactical risk and you all downgraded U.S. equities to a neutral.
That's true. And I think we are in a different investment regime now, reflecting a more complicated world. And as Prashant said in his typically excellent introduction, it isn't just this a very acute and frightening situation. It's tariffs. It's a sense of globalization in decline. You can't trust other people. You have to be more reliant on yourself and your own nation and so forth. And I think that's going to persist. Hopefully this current crisis will pass. But I think those continue to be, as the kids say, the vibes, right? Those are the vibes these days. So what that's leading to from an investment perspective is a much more fractured global market and India market, I think. So we have moved from previously really a kind of everything bull market where you should be risk on, don't touch, and that works very, very well. I'm not condescending that approach. That was the right approach for an easier time, a more pleasant time. Now, in a fragmented, chaotic world at times, I think we're all going to have to work a little bit harder and be much more selective.
U.S. economy, is there a risk of a stagflation? I mean, the jobs data is weaker, inflation is rising.
There is a certainty of a stagflationary shock to some degree. And now I hedge a bit with to some degree, but for sure, we are going to have a price inflation problem, an increase. Inflation is already too high, by the way, and a growth slowdown. This is baked in the pie. Because last week was very important. We moved from a general concern from a global market perspective to physical damage. So this in particular was the Qatar LNG facility where the Qataris, they will be, I'm sure, roughly giving us a sensible timeline, 3 to 5 years to bring this back online. So this is, I'm afraid, even if we have peace today, the problem persists for some period of time, and therefore for your question.
Okay, so just one quick question then on the valuations of the Indian markets from an FI perspective. When we speak to domestic investors, they find the valuations of India very attractive. But foreign investors have been pulling money out. There's been an exodus. At what point do you think the FIs will be interested in the Indian markets? What will bring them back?
Soon, I think so. Like you say, the valuation is much more attractive. There's a degree of earnings stability and certainty. India continues to grow very well in the very big picture, driven, of course, by its very pleasing combination of great demographics and productivity, an ever more efficient economy, and so forth. All of that is still true. But as they say, capital is a coward. And I think global capital is very nervous to get ahead of the conversation we're having here and the uncertainty specifically around energy. So as and when, and this will happen, as and when we get any more certainty, some of the things that have suffered the most should rebound the most. And I think India will be on that list.
So in terms of emerging market, when we look at the whole world, et cetera, you guys do that, right? EMs, India's attractive.
Yeah,
within EMs.
We have a structural overweight to India within emerging markets for the reasons I mentioned. The phenomenal growth that is really at the scale of India is really unique on the planet. That persists. I think the AI story weirdly has been a problem in the sense that it's not so geared into India for now. But over time, can India, with its superb, educated and very huge workforce, can India leverage AI and become even more efficient? Sure, why not? So I think all of these stories, all of these thoughts for India are still true, but for the next short period of time, I'm afraid they are obscured by the geopolitical and specifically the energy problem.
Yeah. Art, you know, in the last conversation we had, you said, well, this is a world-changing event, right? That's strong language. Were you saying it for effect, or is it really a world-changing effect?
No.
Go on, explain that. Explain that quickly.
Yeah, so, I mean, energy is the economy, okay? It is the blood supply of the economy, and everything that happens to energy cascades through the rest of the economy. And so we compare this to previous oil shocks or other financial shocks, And those occurred at a time when the world had a lot more options, had a lot less debt. And so we're coming into this in a very stressed economic and fiscal and social background. And the world can't really take much more strain. And this is over the top strain. So the world will not go back to 2025. I don't know what the world will look like in the future, but I promise you that this is not going to be something in the rearview mirror that we're going to look at and say, oh, that was scary, but it's over now. Not going to happen.
Time now for the tougher questions from the audience here. So we have our CNBC TV 18 Access members, but we also have our next set of panelists here. Sandeep Tandon runs one of the largest AMCs in the country. And Sandeep also used to run one of the largest prop books in India. So he knows a thing or two about trading. Sandeep, go on. Your question.
One very specific thing on oil only. See, yes, we are all concerned about the narrative or noise which is getting built, and it is quite concerning. But if you really look at the data, okay, when I'm talking about the employed volatility data of crude, it spiked up to 180, it's corrected to half, 90, which means smart people are not factoring this level of pessimism, what we are seeing around us. At least if that was the case, then vol could have been remain elevated for longer term perspective, which is not the case. In the last 7-8 days, it has become half. So that gives us confidence that smart people are not factoring this level of disruption, what people are looking at. And we always see that we all get carried away at that point, you know, and we give up actually, you know. So we are in that sort of capitulative sort of scenario, which is all our bullish thought process has been given up completely. So the Wall's data does not show. Just want to understand your perspective.
Yeah, so I slightly take a point from your question, which is people are not that bearish, actually. So that worries me a bit. So we have this shock is ongoing. And from our perspective at BlackRock, what is priced in the energy market has not really been fully priced yet in other markets. So we've had this uptick in the oil price, most obviously the spot price, but now the price for oil a little bit further out towards the end of the year is now much higher, suggesting the market is somewhat more worried that this situation will persist for some period of time. That should feed through into Rima's question for higher inflation, and this should give central banks a problem, meaning they can't cut, maybe they have to hike. Higher yields, and then in turn, higher yields should be a headwind for global equities. So this is a little bit unsettling. Again, I don't want to sound too bearish. Of course, it also presents opportunities, to your point, I think. And will there be certain areas where the baby is thrown out with the bathwater? For sure. And actually, this is the moment over the next, say, 3 months when we can pick the longs that will make our portfolio returns for the next 5 years. So we're very open to this opportunity, but for now, I still a little bit worry that what's priced in the energy market is not yet fully priced in global bond markets and global equity markets. I still think that's got further to run over the next several weeks.
And there's also this thing that oil is a physical, the basic thing, oil is a physical asset, which is so demand and supply, whereas things like equities live in the future in that sense, right? So there is that element of pricing or mispricing, whatever you want to call it, right?
And on the physical point, just quickly, Prashant, like there is a risk of people who can't get it. So you can buy and sell equities. Maybe you don't like the price, but you can.
If you don't have it, you don't have it.
There's a risk not just of a higher price, but we're seeing talk in certain parts of Asia of shortages, which is also an acute problem building on top of the chronic that we're talking to.
Please, another question.
Right. Hi, good evening. We've heard the saying that, you know, data is the new oil. And as I reflect on that, I'm smirking because it seems that oil is oil and data needs the oil today. Right?
Well put.
So just wanted to ask you, either of the panelists, what's your take on the AI trade in the US? Does that slow down the entire juggernaut? Will the GCC countries withhold their investments that's going into the AI trade and any other second order effects?
Excellent question.
Thank you.
Ben, you want to take it?
I do. So it's been, again, slightly overwhelmed by, of course, the Iran situation. But the AI news flow over the last 4 to 6 weeks has been amazing. Incredibly positive in terms of the demand. No sign of a slowdown in demand. No sign of a slowdown in the CapEx. Will the CapEx slow down? There's no evidence of that so far. So I think the AI hyper mega super bull market is still real and ongoing, but will it suffer as a very crowded position in a general risk, I just sell everything, I don't even care what it is because I just want to hide in money, I think that's quite possible. So again, when I'm thinking about my laundry list of things I want to buy, maybe I'm not quite brave enough today, but I want to be brave at some stage in Korea with the memory play that they have. For energy, as you say, of course, is very thirsty for electricity and we don't have enough. So I'm not so heroic. I want to wait for some more clarity, but the AI trade, for your question, I think is still very, very alive, and the data over the last 4-6 weeks actually has been supportive of that. But again, it's been just completely overwhelmed, understandably, by the pictures and the reality of the Iranian situation. So I'm still very positive on AI, but I'm a pragmatist. Can it go down in this general risk-off? Of course it can.
I think wonderful question, and I think fantastic response there as well. You know, we could go on, and such a fascinating topic. And so many directions we can take to it, but we're out of time. Ben, I want to thank you for dropping by. A wonderful conversation as always. Great insights. Art, we'll of course keep tracking this with you in terms of where oil goes from here, and I think you've got a close eye as anyone has. Thank you very much for taking out the time and joining us from where you are. Well, that's the first panel really, but that's just the first. There are 2 other panels coming up. We'll take a quick commercial break here. We're going to come back and we'll ask the next set of panelists, and that's a pure market discussion which we'll be having, how to make money in the midst of this crisis. So that's what's coming up in just a bit. Welcome back to the CNBC TV 18 Market Town Hall. As promised from global macros and the oil shock, we now turn our attention to opportunities in the market. With me is my colleague Nigel. Nigel, hi.
Well, thanks a lot for that, Prashant. Well, they say with crisis comes opportunity. And that's precisely what we're going to be focusing on here. What can you do to make money from here on? That's the big question. We have with us Mr. Harish Krishnan of Aditya Birla AMC, and we'll also be joined by Sandeep Tandon of Quant AMC. We'll be focusing on the micro opportunities with Harish and focusing on the macro opportunities with Sandeep. But before we bring them in, let's assess the damage to the markets since the entire war broke out. Prashant, take it away.
It's not a pleasant task, Nigel, but
That's
someone's
true.
got to do it, right? Assessing the damage, the tally, or whatever you want to call it. But let me go across and tell you exactly what's happened since, the 27th of February it was. Just absolutely a quick run-through in terms of what we've seen. And returns, basically, I mean, a big bite has been taken out of returns for investors. The Nifty and the broader markets have lost between 8 and 9% since the war began. The damage to the otherwise still recently resilient banking space has actually been quite large as well. The Nifty Bank has lost about 13%. This is all from the 27th of February close. But it's not just India, right? Look at the damage to other markets in Asia as well. Markets like Korea and Indonesia actually have lost the most, 14.5%, 15% in that range. You look at flows, FPI flows, which had turned briefly into the positive the month before. They've turned negative once again. FIs have sold big, and you can see that almost $10 billion or so. But who's on the other side? It's locals. Those SIP inflows providing some amount of counterbalance coming through. Now look at commodities as well. There are fears of demand destruction. There are also input shortages with regards to metal processing, etc., which basically means that base metals have taken a knock as well. Things like copper, aluminum, not so much, but a bunch of other things. Gold and silver, magnificent rally over the last couple of years. And they were all the rage through the first 2 months of this year, but they've taken sharp knocks. Gold prices at about $4,300 at the lows recently were basically back at where we started this year. And of course, valuations will come up on your screen as well. So I'm just using the Nifty, the mid-cap index and the small-cap index. And what I've done is not taken forward estimates, but trailing earnings, P's based on trailing earnings, because I mean, the future is always uncertain, but it's more uncertain right now. But on a trailing basis, Nifty, P multiples at about, 18 point something compared to the 10-year average, which is about 20 plus. Mid-cap index, small-cap index. Basically, valuations have come off. The question is, have they come off enough for you to really jump in and deploy some serious amount of money and do some sensible things? That's the question. Let me invite Sandeep Tandon and Harish Krishnan. Gentlemen, if I can request you to come up on the stage, and we will ask both of you, exactly that question, what to do. Please. Welcome. Thanks. Hi, Harish. Please.
Thanks.
So let's start right there, guys. And, we were having this conversation earlier on the earlier panel, right? It's not just this one shock. It's like shock after shock after shock. Start with the tariff one, then there was the AI one, and of course now this is the oil shock. Let's start with the latest, which is this oil shock that we've seen and the 8-9% correction in the index. Have valuations become reasonable? Harish, let me start with you.
Sure. Clearly, as you said, that this is the here and now, but I just want to kind of contextualize. In these 18 months, we've kind of focused on 5 key resets that have happened, right? We've had domestic demand getting fired by tax cuts. You've seen rate cuts happening. You've seen a currency upgrade in the form of a sovereign upgrade. You've seen trade deals with 70% of the world economic output. And then you also are starting to see a transmission of rate cut cycle. This is what had happened before the war kind of broke out in the Middle East, right? So when you are a farmer and you start looking at, say, owning the farm for the next, say, 50 quarters or 70 quarters, what happens in the first 2 quarters has got very little meaning compared to the overall competitiveness that eventually will start coming through for the farm. So therefore, we think that, in this kind of a framework where we've done a lot of hard, heavy-hitting kind of shifts in policy response to all the other issues before this kind of development, we should kind of look at this correction very favorably rather than to get worried about. So that's point number 1. Secondly, to your question about energy shock and therefore, is it only India that's going to get impacted or is it going to have a cascading impact to the rest of the world? Let's draw our attention to what happened in the Ukrainian conflict, right? Now, at the Ukrainian conflict, at the peak, when there was an overall commodity boom, and do remember that at that time, agri-commodities went up through the roof, overall crude shock was roughly about 5.3% of world GDP. At today's prices, it's close to about 4.6, 4.7% of world GDP. That's where the total spending on crude, if this were to annualize for the whole of the next year, is concerned, right? So there's still some gap, but the bigger thing is the Western world had far lower interest rates at that point of time. Today, a lot of that is being fed into the Western world, and that is going to have a far bigger knock-on effect, right? So therefore, if I were to contextualize, can the world really absorb such huge amount of a shock absorption? The answer is no. And which means that we think that it's going to be a lot more pragmatic, that both the administration in US and hopefully the Gulf Council kind of puts their heads together and kind of de-escalates the situation rather than letting it go out of control. So if that be the base premise, we think that valuations are reasonably attractive in a lot of parts of the market, and which is where we think that rather than get obsessed about the next 3-6 months, let's look at companies which have become more competitive and which are on the right side of all of these disruptions.
Nigel, what we'll do, and what we thought for our viewers, what we'll do is we'll divide this conversation after getting initial comments from you, Sandeep, as well. We'll look at the three disruptions: the big AI disruption, tariff disruption, and energy disruption. We'll ask both of you, which are the companies, sectors which are on the right side of this disruption? Which are the companies which actually, I mean, for the lack of a better word, benefit or get hurt less? So that's what we want to do. I mean, there's one framework to use. But Sandeep, just to sort of kickstart and get your views, you use so many tools to analyze where we are at and whether things have priced in a fair amount of damage, or is there more to be done here? So what do you say to that question?
So Prashant, let's start. We in the beginning of the year, described 2000 on this one of the panels out here. We talked about fragile 2026 and as a PE contraction year. And we also talked about correction in global equities, particularly DM, and we talked about a massive correction in silver and gold, because that's the euphoric move which we saw. Now, if you really look at, it has corrected a lot, okay? And we think we are getting signs of capitulation now, where even bullish thought process is getting capitulated. There's a typical signs where best of the global houses makes big targets about crude. This is not the first time we are seeing, It's a human reaction, when you are in pain, you will try to see that everything has changed. But the fact remains that the relevance of oil has already lost as compared to what was earlier years. Now it's a gas and we are getting renewable. Now, if you look at the Walls data, the question which I asked, my point is that maybe yes, this month oil can remain elevated based on our predictive analytics. In February, we talked about that oil will rally, and we talked about dollar index risk to the global equities, and I think has played out. My view is that this will not last for long, and we are in the final fag end of that crisis. Maybe get extended by a few more days. That's what data is showing. Okay, and if you ask me, the beginning, by the end of the year, where the crude will be, I think it will be below 70. Okay, so where the concern, this is how we reverse calculate based what we call it market implied analytics. Okay, that is our data is showing. So I will go with that thesis. The data is got. Okay, and we are slave of data. So I'm not that much concerned the way people are panicking. Yes, obviously manufacturing sector will be affected. We have issues on the utility side. We have issues on the input side. We have issues on the output also. We don't know the trade related or the logistic challenges which we are seeing. But I think every crisis has opportunity. So I think I will look as an opportunity because India has already corrected a lot. We turned negative on India in July 2024. And I said in January, what was the situation in India in July 2024? Something similar is there in January 2026 for US, and something similar is there for Taiwan and Korea in 2026, where whole world is very gung-ho about Taiwan and Korea now. We think we are getting signs of complacency out there. Some, I will not say a maniac sort of thing, but there is signs of euphoria. I think the way I look at maybe beginning April, India has opportunity to outperform global equities, and India will fall less. And maybe by end of the year, in absolute and also you will see a new all-time high in indices. Okay, I will not be surprised at all to see maybe by the mid of the year also. So I think this is a classic phase where everybody is giving up. capitulation is there. And I mean, when we talk about equities from longer term perspective, but unfortunately peak of the cycle, every investor has a very high risk appetite and he's a long term investor. When 6 months later things change, I think if we have thought process, this is the opportunity, then I will like to increase our equity exposure. We were sitting on large amount cash. We have deployed up to large extent in this fall. So we like to use this as an opportunity. I think it's a brilliant opportunity for India after maybe 2 years of underperformance.
All right, take that thought very, very seriously, Sandeep, because the last time we were on the panel, you spoke about 2026 being a challenging year, PE getting derated, but you also made a point that India will outperform, and you're sticking to that stance as well. So maybe we're in for better times from here on. That said, a war like this throws up very opportunities in the post-war scenario. Could you tell us the top 2 themes that you're looking at, from here on? Power could be one, I think, so it's something that you're bullish on. Yeah. But run us through the rationale on those 2 top themes.
See, we have been, if you have to really play data center story, I think power is a theme, like how we played copper for the EV thesis in the past. I think power or energy as a sector is a great opportunity. That's one of the reasons we have more than 20-30% exposure in this space. Okay. So that's the one space which we're looking very constructive. Second space, as compared to IT, we like pharma as a space. I'm not saying all the pharma companies, but a lot of generic companies. And we have to keep in mind some of the pharma company will face challenges on the solvent side or their raw material side, which is a derivative of crude in some manner. So those are the areas which you have to exclude. Then I still like, in the current context, the BFSI space, private sector over public sector. We still like insurance could be opportunity. Asset management company itself is opportunity. Wealth management companies are thing, because asset management companies are serious threat to banking from a longer term perspective. I think great businesses which is getting, we are also part of that industry, so we understand that space quite well. And I think other areas which have to look at should be the sum of the consumption theme. The FMCG stocks particularly, they are still expensive. On relative basis, they have corrected, they have underperformed. Many stocks are in the neglected zone. So I will look for food processing companies also should be opportunity. And if I have to avoid at this point in time, I think it's a manufacturing space, because we really don't know. And none of the companies will going to really explain, because they themselves also don't know how exactly it is. So more from a conservative approach, I like to avoid manufacturing company. You cannot avoid completely. So I will say I will dilute these holdings and look for opportunity once we get more clarity on numbers, maybe down the line a quarter or so.
Okay, all right. Harish, let me get you in there. Now, we look at global markets and we look at PEs, return ratios and the likes. You have another way of looking at it as well in terms of India's market capitalization as a percentage of global market capitalization. Could you tell us what does that come down to and what does it compare with in terms of averages? Is it lower than what we've normally seen?
Sure. So India's share of world GDP of economic activity is roughly close to about 4%. Okay. Roughly a $4 trillion economy on $102 trillion global economic output, right? And if we tend to grow at anywhere between 9 to 11%, and the world growing in nominal terms anywhere between, say, 4-ish odd %, give or take, how it eventually pans out. You would think that, this number should be anywhere between 7 to 8% over the course of the next decade or so, right? Now, it is in that context that you should look at the India share of market cap. Right. Okay. India's share of market cap is currently close to about 3.1%. Okay. In the worst of times during the Ukrainian conflict, we kind of bottomed out at about 3%. In the time, in February 25, again, we bottomed out close to about 3%. Now, 3% is not some Lakshman Rekha that will never get broken. But if you are a serious long-term capital allocator and you see that big shift that India's share of economic output is going to rise in point of time to come, if you're going to buy in at 3% of world market cap, you generally should be looking for a very big asymmetric kind of a rise. And this also needs to be contextualized for the fact that, from US, there can be a lot of flows going outside. There's been a lot of money which has chased US assets over the course of the last 15 years. What happens if there is money which is actually going out of US, given the fact that it's exceptionalism, be it on innovation, be it on, let's say, security, be it on the safe haven status, all of that comes under question mark. So I think we should be kind of looking at these opportunities as well. So I would think, therefore, that, now is not the time to panic. Yeah. Now is the time to
the point you made, Harish, earlier, but you used the farmer analogy, right? I think it's such an important point that trying to finesse too much that I'm going to buy 2% lower, 5% lower, over a 10-year period, it's a decimal point change, right? It doesn't matter in that sense. If you're broadly right in the ballpark. So let's talk about what are you doing right now? Let's take energy. I said I'll ask you about energy disruption and who's on the right side of it, right? So who's on the right side of it, Harish?
So, unfortunately, we are all losers because broadly we are large importers of energy, right? But within each sector, when you look at it, there are certain energy efficient players compared to the others. Now, these are going to have outsized gains because in this environment where the going is going to get tough for everyone, the last man standing is the one who is going to take the most out of there, right? So, if you look at, say, some of the larger sectors like, say, cement, which is in effect a huge energy user. I mean, cement is all about transferring from one energy form to another energy form, right? Now, over there, if you've got an edge in form of energy conversion, that is like real solid gold today, right? And that is the one that is going to compound for you in terms of that difference and that dispersion. And that is going to help you gain market share in a very difficult environment. So, I think that would be one area. Similarly, if you think about this entire unorganized to organized in, say, building materials, we've seen a huge amount of unorganized players operating in the building material space, be it in pipes, be it in tiles, be it in ply, be it in other forms of consumer durables, etc. The reality is that a shock like this, typically the weaker hands don't have the purchasing power to kind of remain in business. Again, therefore, there's going to be a greater formalization and a cleaner balance sheet that's going to sustain through. So our call is not that, we have any edge to predict what the next 3-6 months is. But if I am able to identify and distill certain companies which are going to go one leg up compared to the rest of the competition, okay, that gap is likely to sustain for years to come, and that gap is what is going to get alpha for our unit holders. So that would be another area which I would say can come through. Another area could be, there's going to be this huge rebuild that's going to happen in Middle East. I mean, the war cannot go on indefinitely. And imagine the amount of desalination plants that have to come through. Imagine the amount of pipelines that have to go through. These are all economies for whom this is the bloodline, right? And they're going to have a massive amount of capex that's going to come through. At this point of time, of course, there is all this fear. But what happens if even the Ukrainian war kind of stops out? Okay, how about the entire kind of that region wanting to kind of rebuild? So I think these are all opportunities. See, markets are about spotting asymmetric opportunities where the optionality is not being priced. And today we are seeing so many such opportunities which are there, which is why we are not so worried about how to kind of navigate the next 3-6 months. I think if we try and over-optimize that, we're going to miss the bigger opportunity that's going to come through, which is where I would say that, as an investor, one should train their eyes on rather than looking at how do we survive the next 3-6 months.
Cement, building materials, and pipes, and,
even chemicals for that matter. Yep. Right, there can be a whole amount of inventory rebuild because post the last 2 years, the big problem has been a destocking problem globally. Now, if everybody wants to get back into that supply chain, there can be a bullwhip effect of inventory again going back. So these are all things that are hypothesis. Nobody knows whether they're going to play out in Q2, whether they're going to play out in Q4. The idea is that you kind of identify the best run companies which are positioned and who can execute for that opportunity, and then you kind
Harish, I know you can't talk about specific stocks, of course, because of regulatory reasons, but we've taken the liberty to use your fact sheet in terms of what you own in the fund, and we're putting them up on the screen for our viewers in each of these segments, each of these areas. But within each of these, the 4 segments that you mentioned, you got to pick what is lesser insulated to. I mean, that's what we started with, right? I mean, more competitive generally.
Yes.
The most competitive actually.
Absolutely.
Compared to the others. So it's not like the entire sector, but specific names, and I think that's an important point to make. It's not a call. It's a call on the sector, but also on companies in that sector.
Absolutely. So it's a call that, as the previous guest was saying, that if the baby is thrown along with the bathwater, that's the time that you have to actually look for the baby, right? And a lot of these sectors have actually kind of got bent, right? And mind you, these are sectors that have underperformed over 3-5 years. It's not that these have been darlings and suddenly because of this they have kind of cracked. So therefore, there is reasonable margin of safety. A few trades going right over there can make a huge difference for the fundamentals of many of these companies.
All right, very quickly, Sandeep, I want you to comment on this. One of the holdings that you'll have is in a company, Sun TV, and there is this lot of buzz with regard to the IPL valuations going at $1.5 to around $2 billion. Who would have thought? It seems there are companies like this, there are value out there. What do you make of this recent deal closure that we've seen on the IPL? And do you believe there's a lot more scope? Because if you compare it with global leagues, then still there's a massive runway ahead.
So Nigel, the fact remains that it's a new area and people have a lot of excitement. So you don't get into the valuation because valuation looks absolutely absurd. Okay, but the way globally this business has built, I think India also has potential to. So far, it's only about cricket, but you look at the women's leagues are coming up, the hockey is also getting built, and many other sports which the current government is also focusing a lot. I'm also very optimistic about this space. These are the space which people will look from a longer term perspective, and valuation globally has been expensive. So India is being a growth area, you can give a premium on the global valuation also. So I think it's a great opportunity from long term.
Okay, all right.
Okay, I think we can open it up, Nigel, to our audience and maybe take a question or two. Gentlemen?
I want to ask a question.
Yes.
I want to ask a question to both the guests.
Sure, please.
Two-part question, one to Harish and one to Sandeep. First, Harish, to you. From a retail investor point of view, we all know
If you will just hold up the mic.
everybody's portfolio is bleeding, right? So all have been investing into mutual funds or direct and whatever. In the last 18 months, nobody's made money. Portfolios are bleeding down 30, 40, 50%. As you said, this is a time to buy. But what should one do with the existing portfolio? How should they, churn the portfolio within that? And how should rebuild? Like the whole question is, from a retail investor point of view, what would be your advice to rebuild the portfolio given all the uncertainties which are there currently?
I think this is true as much for retail investors as professional investors, right? So the way we frame it is that we've been through a phase of reboot. In the last 18 months, there's been a lot of activity. Of course, the latest one is what we are seeing, okay? Which means that we need to refresh the portfolio, which is not to get anchored by the winners of the last cycle. We are going to see a complete different set of winners.
That in your
we would
your
like
schemes?
to believe so, but can there be room for improvement? I would certainly think
So what's the mantra like? Sell off your bad investments or just book out the...
So one is, of course, investments which haven't kind of worked out, book losses. I don't think there's any shame to admit that, investment is a probabilistic endeavor. You will make bad decisions, right? But to kind of identify that and bring it to closure, because that releases capital to more efficient ideas. Yeah. And therefore, you need to start looking at it from a new sense, new lens, right? And which is where we are saying that, the leaders of the next market cycle over the course of the next 3-5 years are going to be very different from the leaders of the last 4-5 years.
Sure.
Okay.
Have you identified one or two leaders?
I would say that, sectors like...
If I can to answer that, if I can urge you to talk about you said the new things, right?
Yeah,
you are very
sectors.
bullish on new age businesses. Yeah. Go on.
No, so I think, see, for example, if you think about new age businesses itself, okay, now they've created wealth overall, but in the last 6-12 months, they've also taken a very big knock. But if you look at overall new age businesses, they account for roughly about 1.5% of total market cap, okay? If you look at historically, what has been the proportion of market cap in loss-making companies in India? That's been anywhere between 5 to 6%. So India has always had loss-making companies, okay? But today, when you look at new age companies, what is it that their problem is? Their problem is that they are spending a lot of dollars in acquiring new customers, okay? Trying to create a new habit and then to try and make profits come through. I think in the world of AI, the cost of acquiring new customers can come down very drastically. And therefore, when you've got, say, only one large player in a particular area, which has, say, 25 crore users, these are not easy numbers to get through in any sense of time. Their ability to crank up a profit will surprise many people is our sense, rather than to kind of be dismissive about them. So we believe that, a lot of these companies, AI can actually be a very big beneficiary on, wherein on the application side, they can come up with way new approaches to try and target the same target addressable market. So that is again an area where we are extremely positive on at this point of time.
Sure. Sandeep, to you, we've learned this over the many years that if you identify the right theme, and you write that theme, even the worst performing company makes a lot of returns in equity markets. The last 2-3 years, the big theme was EMS. With this given context, anything that comes to you that is going to be the next big theme where even the worst performing company can make money for you?
So let me add your first question, which Harish has already covered. See, when we talk about the portfolio management, it's not about absolute return. It's also about a relative opportunity. Okay, so sometimes you people have to learn that People have thinking, I bought at X price, it's corrected sharply. It's very difficult to sell. That emotional aspect comes into picture. When you do ruthlessly rebalancing of your portfolio, so then you have to look at from current level whether these stocks have potential to move up further or they have potential to fall. If I'm getting a better opportunity, we should switch. Okay, that's the best thing we should do. Second thing, what was the second question?
Next big theme, like, any theme that you've identified which can, because, we've realized the worst performing company also in that theme makes a lot of money for the investors.
Isn't it best tea, but worst be tea kare.
And that's the example in EMS, right? The best company made 20x returns. The worst company also made 2x returns.
Yeah.
So first of all, Nimesh, we have to look at with some, obviously this sector has given extraordinary returns. But I think these type of stocks have significantly over ownership. My biggest worry,
From here, given the
I'm coming to that.
global environment, what is the big theme?
So I'm just linking with the over ownership thing. See, we have seen underperformance so far by all the over ownership where the FIs was there. Concentration risk was very high, and we have seen banking is a very classic example how we got butchered. My next worry is the over ownership on the domestic mutual fund side. Okay. That is also a lot of skewness we are seeing, and that is the pain point which we are seeing, and we have seen some amount of underperformance already started. So the theme which you have to look at, we have to identify beaten down, neglected themes, which is like people believe their hated zone sort of thing, or some of the companies where you have a lot of issues in the past. I think if you can identify the trend which is changing, I think pharma is a theme. Okay. Power sector is a theme. They have corrected a lot. Okay, a lot of people are still underweight on the energy and the power sector side. Pharma is grossly underweight both from the domestic. I think these are the themes which you can look into it. I talked about asset management and wealth or companies also. Insurance also in something similar, neglected zone for last many years should be opportunity.
Okay, I think we could go on, but I'm being told that we are on a clock. And the clock is running out. But I think wonderful insights from both of you. Sandeep, thank you very much for dropping by. Harish, fantastic. And I know you had more. So thank you for staying with us. But stay right here because Neelkant Mishra and Sajid Chinoy will tell us we're going to stress test India's macros. That's the next discussion coming up right after this quick break. Welcome back to the CNBC TV 18 Market Town Hall. Of course, the Iran war, the war in the Middle East, whatever you want to call it, of course, is the focal point. And what we're doing on this third panel here today is assessing the damage to India's macros. Put another way, stress testing India's macros and can it take the damage with regards to this oil shock? And will oil prices linger higher for longer? That's the big one, which no one at this point has the answer to. Lata.
Yeah, and what can the government do to mitigate this damage? That's also the focus on this macro discussion. We have two stalwarts who need little by way of introduction, Neelkanth Mishra of Axis and Sajid Shenoy of JP Morgan. Gentlemen, thank you very much for coming by.
Thank you for having me.
To be here. To our do. Sajid, we have to talk scenarios because we don't know what is your base case in terms of hit to the economy and what is an adverse case.
So I'm stating the obvious by saying there's just so much uncertainty. But Lata, I'll tell you why this is different from previous shocks. So typically when you get an adverse supply shock, like the kind you're seeing, it's stagflationary, right? We've seen that growth has to be marked down, inflation has to be marked up. That happened in 2022 in the Russia-Ukraine war. What's different about this energy shock from the past is that there's, of course, an adverse terms of trade channel through higher prices for energy importers like India. But the concern this time, after a long time, is actual availability of volumes. With half our crude imports coming through the Strait of Hormuz, a significant fraction of gas, the concern, not just in India, but all of Asia, there are many Asian economies more vulnerable than us, is if this goes on for several more weeks, will actually be a lack of availability of energy. Now, why do I say that? That's going to force industrial shutdowns. We've already begun to see in some countries rationing has happened, right? There's work from home in other countries. And that has a very material impact both on the outlook for growth, but also how central banks think. Because then, see, if there's no hit to activity because there's no shortage of availability, you're in a 2022 scenario where inflation goes up and central banks focus on that. But if suddenly there's a lack of availability of LNG, LPG, rationing, then think of this more like 2020. Think of this more like COVID. And there are two implications that flow. One is we've seen from COVID, outcomes are very non-linear. Once a business or activity shuts down, very hard to reverse that. Once a gig worker goes home to the village, very hard to reverse that. So then you begin to worry much more about the impact of activity and the hysteresis from the shock. In that environment, a central bank who's faced with this uncomfortable trade-off of weaker growth and higher inflation will focus on the former, will focus on weak growth like COVID. So the reason I'm not giving you an answer is because we're very early in the process. If this is more like COVID, I'd worry more in terms of growth outcomes. If this is more like 2022, you'd worry a little bit less about growth. And therefore, the last thing I'll say is the near-term policy implication. We think about monetary and fiscal policy in a bit. I think there are three stages to the response. The initial stage has to be in the next 2-3 weeks. How do you procure energy availability like your life depends on it? Right? The shadow price of a business closing down is almost infinite. So anything that we can get from the high seas at the spot price, whatever price it is worth it. So I think that has to be the overarching thing. How do you augment domestic production? How do you get imports from wherever else in the world? And thirdly and finally, how do you allocate scarce resources efficiently? The temptation is if you have a certain amount of LPG, give it largely to households.
I take all your points and policies, but I'm still asking whether you have a number. You know, like 7% was what...
So the rule of thumb is the following, right? That whatever your starting number was, say it was 7% for FY27, every $10 increase in crude prices is about a 0.4 to 0.5% of GDP adverse terms of trade shock. How much that translates into growth will depend on how much is borne by the public sector versus the private sector. Ironically and paradoxically, the more the public sector bears, the larger the hit to growth. If the fiscal deficit doesn't change because it's a one-for-one loss in other spending. Now, if there's an impact on a lack of availability, Lata, then for every $10 increase in price, the 50 basis points, you have to add that on. And therefore, it's so difficult to make an assessment so early in the process.
Neelkanth, I mean, Sajid, you heard him, right? I mean, in terms of one is the price that you're paying, the other is the availability itself. Right now, the shock is in terms of the price. Availability, yeah, I mean, we are doing some things, but it's not led to shutdowns. It's not come to that. There's some rationing and allocation to consumers in terms of who gets what first in the priority list. But Your thoughts, Neelkan, as you look at this?
So the first thing is this is a global problem. This is not just India's problem. And I'll tell you why it is important. So at the face of it, there is, as we've discussed in your show earlier as well, that about 20% of oil used to go to the Strait of Hormuz and 2.5% of gas. You do the maths, it's about 7% of world energy. There are clearly now the East-West pipeline in Saudi Arabia, there is Kazakh oil, Russian oil, Iranian oil, all of that is now coming to the market. So net impact may be close to 4%. And there's also energy substitution and all of that. Now, 4% of energy supply going down is 4% of world GDP going down. As simple as that. Now, we can discuss allocation effects, like who will bear the loss. For example, Gulf airlines are shut or have slowed down significantly. That's apparently 1 million barrels a day. There is, counterintuitively, because our retail prices are unchanged, our oil consumption is not falling. But if you have a free market like in the US and prices at the pump are going up, then consumption will start to fall. So it may be that initial stages, the reallocation of that 4% energy supply, I mean, who bears the loss, may actually be in very different markets than what intuition will suggest. But I think now the stress is, the markets are already worrying about non-oil stress. So you saw that in the problems that in the Monday market, Korea was down 6%. India was down about 3%. Japan was down 3.5%. China has started to fall. I think we are already hitting a stage where second order, third order supply chain effects are showing up. So
chips.
Yes. So if there is no helium, if there is, or the simple effects that we saw on the first day, that if you don't have LNG, you can't paint cars. You can't paint cars, there's a whole supply chain shock that is going upstream. So as you start to see like copper falling, gold falling, one can perhaps explain that, saying that incremental buying was coming from central banks in Asia and in West Asia, and now one side is trying to protect the currency, the other side doesn't have money. But now you have copper falling. And so clearly, I think
So there's demand destruction in that sense.
Yes, and supply chains are now, the second, third order effects are going to be so complex, which is why I think the pressure from markets. So you saw now that the UK gilts are up 75 basis points in 1 month. The US 10-year touching 4.5. I think the financial markets will force everyone to stop fighting and bring down the problem, right? So the question for us now is, if the fighting stops today and the Strait of Hormuz, say, opens, say, 1 month later, and I told you on the show 15, I'm still sticking to that if it doesn't open up by 15th of April, I think we are staring at a severe global recession. In which case, India may not be the worst market. So, so that is why I don't see these scenarios. I'll tell you the scenarios, right? So, as Sajid said, it is very straightforward. So, if you have $100 a barrel for 1 year, you have 2.1% of GDP gone. How much of that is fiscal? How much of that is, so basically you borrow from the future and spend today, and so on and so forth. There is about a 1.3% impact on inflation. There is a $60 billion balance of payment shock. So these are easy to do scenarios. But I think the harder call is, when both warring parties, and we have to include China on the side of Iran. So China and the US is backing the two fighting forces. When do they feel the pain strongly enough that they force concession?
That's a great point. But since you spoke about, if there is a recession, we may not be the worst market. We may not be worsted. One of our problems, or our Achilles heel, has been the rupee. Because even if our current account deficit is small, we have not had enough capital flows. Now, even at a time when our GDP was doing well, corporate earnings were still in mid-single digits or thereabouts, not attractive enough for capital flows. How do you see FY27? I mean, do you see a turn? We thought that fourth quarter is when corporate earnings are going to turn. Now it looks like that turn is not going to happen. How do you see corporate earnings in the next couple of quarters?
Yeah, in my view, if you ask me, if it doesn't look like this is, I mean, while the markets are celebrating today, I don't think this is over yet. I think that there's another 2-3 weeks of game theory, move Marines in, not move Marines in, threaten them, and all of that. So all of that will happen. I think my biggest concern, if you ask me, and I'll answer your question, is that you end up with an agreement with someone you think represents Iran, but then you find that they don't really control Iran. Because, see, in order to survive, I think the Iranian regime has decontrolled or decentralized operations. And it is quite possible that one guy says that, okay, fine, this is great for us. But the other guy says, you saw that, the foreign minister says something.
Capitulation can come.
Exactly. So it is quite possible that the Strait of Hormuz is closed, and now we are fighting a very different kind of battle, right?
It's an ambiguous piece. You don't really know.
So that's what I worry about. But I think that if it doesn't end by 15th of April, I think...
But Nilan, you do believe it will end by the 15th. That's that you think... You said a couple of more weeks. So you're saying in your mind you think that it won't go beyond that?
Yes. And as I said earlier, markets are a part of the war now. If the markets don't panic, it continues. If the markets panic is when everyone says, oh God. Because see, it is so complex to model, as Sajid was saying, it is impossible to figure out if you disrupt oil for 3 weeks, if you capped a gas field or an oil field, how much time does it take to reopen? Once you reopen, how much hoarding will happen? Do you have enough tankers to move things around? So if you are stuck for 1.5 months, it may take 2-3 quarters for everything to normalize. In which case, how do you assess economic impact and the supply chain and the complexities? So everyone is looking at the markets to tell them how bad things are. And it is when the markets and it's when the bond markets start panicking, is when people say, oh God, now we need to pull back.
That point is well taken, that markets will discipline the parties and hopefully, therefore, that 2-week period works. But I'm genuinely worried about capital flows because the rupee, our inflation and growth are not our problems. Our problem really is the currency. And okay, that point, do you see capital flows returning?
I think earnings cuts will accelerate, re-accelerate. So we saw February as a very good month.
So capital flows are still a question mark.
But capital flows is not just FII portfolio flows, right? Capital flows are also FDI flows. Capital flows are also FDI repatriation. See, the reason why we think balance of payment impact will be less than the terms of trade shock is that, look, FDI repatriation for us used to be 20 billion a year. Because of the stock market action and the VCP exits, it had gone to $50 billion a year. That $30 billion is stuck. Which IPO is happening right now? When you see gold was adding more pressure. Now, gold is down from 5,000 to 4,000.
So the same ETF pressure may not be there.
That's the point I'm making. So, look, this obsession with FPIZ, they're not principals, they are agents. And at some point, see, as of now, of course, people are questioning, oh, so much of money used to come from West Asia. But now money will come from Norway. Because they still are supplying oil, their oil supply is undisrupted. So, I'm not too worried about capital flows, especially if it is for a period of a month. What's the point of having $700 billion of reserves?
Do you think the Reserve Bank or government have to take something extraordinary? Like, oil companies directly buy from Reserve Bank, buy dollars from Reserve Bank or oil bonds. Or even as Indonesia has gone to the level of, capital controls. You can repatriate, you can remit only $50,000, not 100,000. Any extraordinary measures?
So I don't think that's a good idea because I think that adverse signaling impact of doing something extraordinary in a crisis suggests...
They won't do it voluntarily. Will they be pushed to it?
No, they will not. India still has enough reserves to go through for the next 2-3 years. In fact, I would argue we could be intervening more and letting the rupee depreciate less. And that would, in my mind, be a policy mistake. Let's step back here. We want, when crude prices go to 100, to elicit a behavioral response. You want Indian consumers and businesses to conduct economic decisions, keeping in mind energy is at $100 a barrel. How do you do that? That's where prices have an effect. So therefore, you need to do 2 things. The internal shock absorber is, over time, in the next few months, if crude remains elevated, and one quick digression, even if the war ends in the next couple of weeks, for the reasons Neelkant mentioned, supply disruptions will take many months to unwind, and we're forgetting on the demand side, many countries have begun to run down strategic petroleum reserves. What's going to happen post this? Everybody goes back to where they were and further. India will want more SPR after this. So you're going to be in a situation where supply takes long to come back on stream, demand's going to be above normal. So crude could remain elevated for the next 9 months, even if the war ends next month. In that environment, you want consumers to see the actual price, which means over time, I would argue, gradually raise retail prices so that you get the volume adjustment to higher prices. If you worry about the current account, Lata, we've discussed this before. There is any amount of evidence in India, some of which we've done in the last 10 years, which shows over time, a real effective exchange rate that depreciates does improve the balance of payments, current account and capital account. So if you're thinking from a 12-month perspective, the right and healthy thing to do is let retail prices go up, so volumes adjust, and let the exchange rate gradually depreciate so that the external sector becomes more sustainable. That's the internal and external shock absorber.
Sajid, JP Morgan, I mean, globally, we had a discussion earlier, and we had an oil veteran who said that they were building in 80, I mean, I think it was BlackRock, $80 for some time. Is that the view? I mean, even if the war were to end tomorrow.
Yeah, so exactly. If the war were to end tomorrow, I think the sense is that the second quarter would still be somewhere between 80 and 100, given these stickiness in the supply unwinding, and you gradually go back towards the scenario towards 80. That would be a kind of a benign outcome. And I would,
2 quarters?
Yeah, to the end of 2026, right? So you go from 80, gradually drift towards...
You average well over 80.
You average well over 80.
Have you cut growth estimates?
Not as yet, because my biggest worry is, see, if growth were to average 80 this year or 85, Prashant, I think at that point the impact is not very large. We were working with $70 a barrel. If it's, 10%, 15%, this is going to shave off 30, 40, 50 basis points. I come back to the first point I made. If you get shortages in Asia over the next 6 to 8 weeks, the non-linear hit to activity is much larger, as COVID taught us. So,
do you think, Lata asked you whether the RBI will have to do extraordinary measures?
Yes.
My question is on financial market side, but do you think the government will have to kind of put in place measures which lead to lower consumption of things?
So I think the natural way to do this is to let prices reflect their opportunity cost. But I think
there are elections around. I don't know if that will happen immediately.
But even if it happens a month from now.
May I interrupt at least one audience question? Because
we'll take not one, Lata, we'll take a few.
Just 10 seconds to say, there's a well-established playbook that both the RBI and the government can follow. If there are sectors under pressure because of a lack of availability, what you need to give is sector-specific forbearance, sector-specific support, sector-specific liquidity. So we've learned from COVID how to handle a non-linear supply shock. And I think that's what should be the first order of business.
I want to ask you about that earnings. You were just about getting started on that earnings cut question. But maybe just take a question from the audience and we'll come back. Please.
Can you hear me?
Yeah, please go
on. My question is to Mr. Chinoy. So, disruption of Strait of Hormuz, we already know. It has impacted real estate of Dubai already. Now the impact has slowly started in South Mumbai also. I can see 5% increase in, some of the luxury properties. So, is it going to remain constant or, this is going to be changing? Because everybody's saying that, I think it's a matter of 4 to 8 weeks, but I strongly feel it might go for a quarter also. I sell real estate, one of the reasons I'm asking.
I thought you were in the market for a house.
You see, Bombay prices have moved up.
Yeah, he's saying South Bombay prices are up 5%.
So a lot of this, so the judgment you have to make is, was this an aberration or are these shocks that are going to be frequently, happen in the future? And if you believe it's the latter, then yes, I think a lot of things will change in the world. Yeah, the beacon of peace that the Middle East was portrayed to be will cease to exist and people will begin to move out. There are reports of some financial sector firms moving from the Middle East to New Jersey last evening, and that's going to happen. But I think the bigger rethink has to be from a government's perspective. And I'll just take 30 seconds on this. We think about the next 3 months or the next 6 months. Think about the next 3 years. What have we learned from this shock? We're living in a world that's prone to shocks. The focus has always been, let's focus on maximizing average growth. I would say an important focus has to be, how do you minimize volatility? How do you protect yourself against shocks? And that, in my mind, means a couple of things. We have to build more buffers. We've seen what China has done the last 5 years. Buffers of energy, buffers of agriculture. In a world where supply chains get weaponized, right, and become fragile, and trade gets so weaponized, you need to be a little bit more self-sufficient by A, building buffers, and B, diversifying imports. So I think we have to start doing more risk management at the macro level in a world that's so shock-prone.
Sir, you had a question?
Yeah. Yes, ma'am. Sorry.
Please.
Hi, Neelkant. Good evening. I have a couple of questions. One is that, we have been, you've been talking about how the growth is going to get shaped off in the next 2 quarters. I'll just give you a very small example in the past 48 hours, when we saw that exuberance in the market taking place. Obviously in our stock market, but very interestingly, the bond yields, they didn't move. In fact, we were steady at 6.86. Okay. So is it an indication that, yields are going to shoot up beyond 7% because things are not going to be, even if the war gets over, the effect of inflation on the supply side, and then comes the demand side. It's going to be reverse this time, supply and then the demand. So both put together, that is definitely going to have an impact. And what is the kind of rate hikes that you see? Because we have seen a very sharp rate hike happening in the year 2022 across the world, including Fed, which had, I think, raised 425 basis point in a span of about, I think, 7-8 months in 2022. And here, not only in US, but also in India, what is the kind of hike that you're seeing? And if there's going to be an enormous amount of hike, which nobody's talking about at this juncture, that definitely is going to have an adverse impact.
Yeah, thank you. I think it's a great question to think through. Look, the direct impact of oil prices is going to be a one-time spike. So if you're going from $70 to $100, unless you think that there's going to be another 43% hike next year, I don't think this really warrants monetary policy to shift because this is a one-time shock. And especially given that we are starting with significant slack in the economy. So we are about 1 to 1.5 years behind where we would have been if COVID had not been there. So there is significant slack in the labor market. We were struggling with low inflation for a while. And this should not warrant rate hikes in India. There are second order effects where what if there are continued shortages of handsets? There are continued, because of gas shortages, if say, like I heard some tile suppliers saying that they've been asked by real estate companies to write to their RERA authority in the state that our deadlines are going to slip because we don't have tiles. Now, if those kind of supply shortages start hitting, then there is a general purpose inflation, which then perhaps warrants some action. But at this stage, I don't think that is required. What may be required if oil prices stay high is, in addition to, I think, passing through some of the energy prices, as Sajid was saying, our response should be not to let the currency face the entire burden of adjustment, but also to reduce volatility, slow the economy down a bit, and then raise rates. So if at all rates need to be raised, in my view, it should be to prevent excessive currency volatility. So see, given that our currency is already, I think, 3 standard deviations weaker than trend already. So the real effective exchange rate is now down to like 12, 13-year lows. So from an economic competitiveness perspective, I don't think it warrants to weaken anymore. If people are panicking and that the currency has no end, then perhaps you need to take on some growth shock to stabilize the currency. But other than that, I don't expect this to happen. The 10-year bond yields, it's a much longer debate. I think it is because of the persistent liquidity problems that we have landed up in this soup. I don't expect the yields to stay here once the liquidity normalizes.
That is another complete conversation which we can. Sir, you had a question.
I think ma'am has already covered my question, but if I can ask Sajid, what is your view on the US 10-year? Do you think can it cross 4.5 and all, considering the debt they are having?
Exactly.
What's your?
I think the US fiscal position is facing a perfect storm. Right? So think of what's happening over there. Firstly, because IPA was overturned, there's the potential that tariff revenues will have to be refunded. Now, that could take time, but that's a risk. Secondly, the longer this war goes on, the larger the fiscal cost is going to extract. So you're already starting with an unsustainable fiscal path, and then you've got deficits till the eye can see, and debt to GDP keeps rising. Now, thinking about central banks, the old adage, right, that if it's a temporary supply shock, a central bank looks through it. The more permanent it gets, you respond to it. Starting conditions matter. We forget the Fed has missed its inflation target for 6 consecutive years. If any emerging market central bank did that, there'd be fire, right? But we just become blasé. That is another year with inflation. So given that the Fed's running at almost 3% core inflation, that inflation expectations, depending how you measure it, are quite sticky. There is a concern in the US that high gasoline prices, when pump prices move every day and shape inflation expectations, could, in an economy that's doing very well, growth has been very strong, spill over into core. And that's another reason why the Fed may stay on a prolonged hold. So if you think from a US 10-year perspective, a Fed that's not cutting, a fiscal deficit that's getting widening, all of this is bad news for 10-year yields.
Neelkanth, if I can just ask you to finish that point, but Latha asked you about
what kind of earnings cuts?
Earnings cuts and what should we expect going forward?
Look, I think, prima facie, if I think I was well above the street before this happened at about 7.5% for real GDP growth for the year. If this lasts 1 year, I think, as I said, it should be 1.5 to 2% lower than where I was. I do think that there is at least 2% of GDP growth cut that I'll have to do for the first quarter if we don't see anything changing. And remember, we are making many assumptions here that in the effort to force Iran into concessions, there will need to be escalation. So whether the Marines land on Kharg Island or not, there will need to be escalations. And then you are relying on how desperate Iran is to retaliate. Sure. So does that mean more destruction, which is permanently takes out supplies, right? So we are talking about many, many challenges, but I do think that the pace of cuts, so we could see, I think as the March quarter results come through, that analysts are revising down earnings, maybe a 3% a quarter kind of rate cuts, or earnings cuts could actually resume. So we could lose almost all of the roll forward gains.
Well, I think we could go on, Latha, with lots more questions and so many directions we can go in, but out of time here on this discussion. Thank you very much, both of you, Sajid and Neelkanth, for joining us on the program.
And the wonderful audience.
Thank the wonderful audience here. Thank you all for being part of this program. Well, that's it on this market town hall. We've covered three things. We've covered, of course, global, the oil shock. We've covered markets, what to do in a crisis like this. And of course, we've spoken with Sajid and Neelkanth covering India's macros and where we stand. Thank you for staying with us. It was an interesting, insightful conversation for me. I hope it was useful for you as well. Thank you for staying with us.
Hello and welcome to Startup Street. I'm Arundhati Ramanan, and with me as always is Ritu Singh. These are the top headlines from the startup world. Burmese specialty restaurant chain Burma has raised over 38 crore rupees in a private funding round, valuing the company at approximately 500 crore rupees. For FY25, the business recorded outlet level profitability of over 21% and EBITDA margin of around 8%. Electric commercial vehicle manufacturer Euler Motors has bagged nearly $47 million in a Series E round. Led by Lightrock, Hero MotoCorp and Bloom Ventures, the fresh capital will be used for expanding the product line and manufacturing capacity. Quick commerce platform Zepto has launched new features, including a pay later option for interest-free credit and real-time images of fresh produce. The platform also added an add after checkout function. Amazon has acquired Pharma Robotics just under 2 months after the startup introduced a humanoid robot called Sprout, designed to be a friendly addition to social spaces like homes and schools. The e-commerce giant has deployed more than 1 million robots across its warehouse operations. Facebook's parent Meta ordered to pay $375 million. This after a U.S. jury finds the company guilty of misleading users about safety and enabling harm, including child sexual exploitation.
Well, in what's brewing today, electric commercial vehicle manufacturer Euler Motors has raised 437.5 crore rupees, that is around $47 million, led by Lightrock, with participation from Hero MotoCorp and Bloom Ventures. The round also had an additional 250 crore rupees of debt funding by Black Soil and others. Now, the company plans to use this money to expand manufacturing, scale its network, and invest further in core operational capabilities. So on that note, let me invite Saurav Kumar, who's the founder and CEO of Euler Motors, for more on the funding round and the way forward. So, Saurav, thanks very much for your time here on CNBC TV 18. Tell us about this large round you've raised in equity plus debt. How are you going to deploy the capital while also balancing this growth with capital efficiency, because the segment is known for high cash burn?
So we are going to invest this capital across three key areas. One would be in the forward, we would grow from 60 to 100 cities. So we would be investing this in marketing awareness about our product, EV segment, and taking Euler to 100 cities, ensuring strong customer sort of experience. We are going to invest the capital in R&D and further investing in the three-wheeler, four-wheeler product portfolio that we have, three-wheeler cargo, four-wheeler cargo, and the three-wheeler passenger. And third, we are going to invest this in expanding our manufacturing capacity. Currently, we are making roughly 1,000 vehicles a month. We would want to push this capital towards setting a third unit where we should be able to add another 1,000 four-wheeler a month sort of capacity. So these are largely like three key items in cities expansion, R&D, and backward factory capacity increase.
Well, a key focus of the fundraise, as we understand, has been expanding your manufacturing capacity. So there, tell us, what is the headroom you currently have, and at what scale are you building this over the next few years? So what kind of capacity addition will we see?
So we have two units right now, Ritu. The unit one is a three-wheeler where we have capacity to make 1,000 three-wheeler a month in a shift. And we have another four-wheeler unit where we have the capacity to make roughly 400 to 500 four-wheeler in a month. The one that we are adding will add like 1,000 four-wheeler in a month in a shift. So we would go from the current, capacity of roughly 1,000 three-wheeler a month a shift, and we will add like another 1,000 four-wheeler month a shift. So that is where we are talking about scale. So 2,000 vehicle per month in a shift is where we would be going to. Of course, it also depends on your sales numbers. So how much we produce and utilization comes from there.
You're targeting about 400 crores of revenue in FY26, which is a doubling year on year. So what are going to be the key drivers behind that kind of growth? And also, while you've reduced losses in FY25, you are still burning capital. So any clear roadmap to EBITDA break-even you could highlight?
Yes, so these are, I think, one of the toughest and great questions. So, see, so in terms of like revenue expansion, so we definitely, I think we are on track of 100% sort of growth on what we had looked at last year. So that should come out sometime soon. I think from here to doing another 100% will come from just the geography network expansion that we are doing on the number of city. Also, in terms of a product, if you see three-wheeler, four-wheeler, we've just added another four-wheeler last year that took 54 four-wheeler a month to like right now we are selling 400 four-wheeler a month. So we are also going to add some of these product in the same market that we are looking at. And over a period of time, we might also look at adjacent sectors within the light electric commercial vehicle, within the commercial and passenger transport, other segments which can increase the TAM. So those will be your three things that we will do on the product to deliver like 100% revenue growth. In terms of your EBITDA, I think largely three things, right? Like our EBITDA expenses that are coming is either in your gross, or either it's sitting at like your sales expansion, sales and supported, and then the overall sort of the R&D and the people overheads, admin. Largely as we scale from 1,000 and it goes toward like 2,000 sort of per month trajectory and toward eventually toward 3,000 a month, your fixed cost will start to like sublinearly grow and not necessarily just grow linearly with the cost. So that should bring that break even. So we are looking at a very sharp sort of timeline internally, definitely FY 29-30 is where we are targeting like getting to an EBITDA break even. And then from there, like look at the PAT sort of, which will be fairly within a quarter or so, we should be able to deliver that.
You know, Saurabh, you're also moving deeper into this four-wheel cargo EVs, where the penetration is still very much under 2%. So what gives you the confidence that this segment will scale faster now versus what we've seen already in the last few years?
See, so typically commercial vehicles, if you see, I mean, one example that is in front of us is the three-wheeler. If you look at the three-wheeler market, it went from 8% in, I think, FY24 to almost FY23, 24 to almost 25% around 25. And then I think you had, I mean, subsidies came down. Your differential between EV and ICE, GST also came down, but still it's around 21%, 22% electrification. So that tells us that the EV in commercial vehicle makes fundamental sense, even if subsidies and some of these things will reduce and taper. While it has set a very strong trajectory, these will continue to sort of penetrate. And four-wheeler, especially the last mile and the one-tonner, is just adjacent to that three-wheeler cargo. So that will, our belief is, behave electrification there will be much faster, and then subsequent will happen to your 1.5, 3-tonner sort of category. So some of this will continue to happen, and that is where if you look at the, after we launched Turbo last year, it immediately like, went from 50 to like 400 a month, because we were able to bring product at the right value and matched the affordability piece and the performance criteria significantly higher in terms of what competition or even what EVs ICE are offering. So I think if we continue doing that, I do believe like four-wheeler will electrify faster in the short term.
All right, Saurabh, we'll leave it at that. Thanks very much for joining us here today on Startup Street.
And on What's Brewing today, Bengaluru-based Pranos Fusion has raised $6.8 million to develop compact fusion reactor technology aimed at delivering clean, limitless energy. At a time when global power demand is surging, driven by AI and industrial growth, fusion is emerging as the ultimate solution, offering zero-carbon, always-on energy. Pranos is taking a different approach, building a compact engineering-led platform that combines software, superconducting magnets, and reactor design to fast-track commercialization. But can this deep tech bet crack one of the hardest problems in science and put India on the global fusion map? Joining me now to discuss this further, Shaurya Kaushal, the co-founder and CEO of Pranos Fusion. Shaurya, thank you so much for taking time out and being here with us on Startup Street. You know, you are a deep tech startup developing nuclear fusion technology, right? What sort of makes you believe this is the moment when it can finally move from labs to real-world deployment?
Hi, thank you so much for having me on the show. Very excited to talk about fusion and fusion energy. To come back to your question, a lot has changed in the last 5 years globally. Major advancements that we've seen is in high temperature superconducting magnets and high performance computing. So these are the two tailwinds that fusion energy has gotten across the world, and that's been part of our DNA from day
Sundar told
one.
me we can go. All right, and you are building a compact magnet-based fusion reactor, right? How is your approach sort of different from large-scale global projects, and why does smaller potentially mean more scalable?
Right. So, very relevant question. Fusion programs are historically known to become extremely expensive and extremely long termed. And we knew that very early on. We went to the best labs in the world, to ITER, to JET, to understand the real pain points. And that's when we started building the software. So from the software, we essentially come out with a more compact geometry, which includes high temperature superconducting magnets. So the moment you put high temperature superconducting magnets, you can make smaller reactors, more compact reactors, and that kind of makes the entire journey more capital efficient. We're also building this out of India. We've managed to put together a team of industry as well as vendors who are building it out of here, making the entire process close to 7 to 10 times more cost effective than the world.
Absolutely. And with global electricity demand set to surge, right, especially driven by AI and manufacturing, how big is the commercial opportunity for fusion, and where does India fit into that picture?
Well, the commercial opportunity for fusion energy is huge. So currently is estimated at $300 billion, supposed to grow to $800 billion by 2040. But that's the long-term projection for fusion energy to actually light bulbs. But with private investments alone, currently there is $15 billion across the world that's deployed in fusion companies. There are 53 fusion companies in the world, and we're representing India as one of the companies building the technology required to deploy fusion power plants. So that's where the largest business opportunity for us lies, that we're able to supply the technologies to the market currently.
All right. And you sort of raised the $6.8 million at a very early stage, right? You launched only in 2024. What are the key technical milestones this capital will sort of help you achieve, especially around your first plasma target that you have in 2026?
Yes, very interesting question. Our flagship tokamak, which is a test reactor, will go live this year. And it's powered by our software and our superconducting magnets. So really excited to make that happen. And mostly the capital will be deployed towards turning our software into a commercial grade software, and at the same time have our first reactor light up and our first plasma in 2026.
All right. And fusion is also one of the hardest engineering problems in the world, right? So at this current point, what are the biggest risks ahead, and how realistic are timelines to achieving that commercially viable reactor?
Right. So in terms of technology development, the technologies that we are working on have become quite mature from a vendor as well as supply chain perspective. The largest risks and the bets that need to be taken are on the tail end of the process, where you have a plant that's working, you've got fusion working, and you've got to make electricity out of it. Now, that's the global challenge right now, and there's multiple forces working towards that, but it's a solvable problem because it's an engineering problem.
All right, Shaurya, thank you so much for joining us on the show. We're completely out of time, but we wish you all the best on this journey going forward.
Thank you so much.
Moving on, the global AI story is hitting a critical inflection point where the focus is shifting from funding to execution. Big capital continues to flow into front runners, even as regulatory scrutiny intensifies and companies double down on core capabilities. Back home, India too is starting to find its place in this evolving AI landscape. Rachna Dhanrajani joins us now with all of the AI details. Rachna, give us a pulse check on the AI landscape.
Well, the AI race right now is entering a more decisive phase. Capital is still flowing, but the bigger story is how companies are choosing to deploy it. OpenAI is a clear example. The company has now taken its funding round past $120 billion, bringing in investors like Andreessen Horowitz, D. Shaw, MGX, TPG, T. Rowe Price, and Microsoft. At the same time, it's tightening focus too, and that's what we've been reporting over the last 2 weeks, that OpenAI is now focusing all its capabilities on its core functions, which is why it has shut down Sora and exited a $1 billion deal with Disney. The shift is towards core models, enterprise adoption, and infrastructure that can actually scale. Even as capital rises, the regulatory pushback is getting sharper by the day. In the US, Anthropic is in a legal battle with the government over restrictions linked to national security. A federal judge, however, in a hearing has now questioned whether those actions are excessive and has said that are they aimed at crippling Anthropic? And a ruling is now expected shortly by tomorrow. Now that will define how far governments can go in controlling AI companies. The scale of ambition is also expanding in the landscape. There's SpaceX, which is preparing for what could be the world's largest IPO in the history of the world, that is, targeting a valuation of about $1.8 trillion and raise over $75 billion. This was reported by Information earlier, but the story here is not just space, but control over future data and compute infrastructure. Back home, there are early signs of India entering this cycle more meaningfully. Money Control has reported that Sarvam AI is now in talks to raise up to $250 million, a round that could take it to $1.5 billion valuation, and we'll see participation from HCL Tech. And all of this will signal that domestic IT players may be starting to back AI product companies and not just service them going forward. And at the early stage, there's also an India Connect. New York-based Moda, founded by Indian origin girl, especially from Mumbai, Anvisha Pai, has raised $7.5 million in a seed round. It is also a reminder that Indian founders are also building in the global AI ecosystem, even if the companies themselves are headquartered elsewhere.
All right, Rachna, many thanks for taking us through all of those details. But with that, it is a wrap on this edition of Startup Street. More news and updates coming up on the other side. Stay tuned.
Let's talk money.
Hello and welcome to a brand new edition of Let's Talk Money. I'm your host, Surabhi Upadhyay. These days, when we talk money, investors have realized that talking about money only purely from an Indian equity market context is many a times not enough. In the last 15-odd months, the Indian market has underperformed global markets big time. And in this entire duration, the US market, for instance, has continued to be fairly Teflon coated. The market has weathered so many storms, whether it is the AI disruption, whether it is, of course, what's happening geopolitically, and now even the war in West Asia, the US market has remained relatively insulated. But this is not a conversation just about the US market. This is a conversation about Indian investors waking up to the need of diversifying their equity bets, the need to perhaps spread your equity investments in markets beyond India, going beyond Indian shores. Now, the problem when we talk about this is not too many Indian mutual funds are right now giving the option of investing in global stocks in a simple way. Why is that happening? What should investors do? And are there new options coming up via the Gift City? That is what we'll talk about on this show today. My guests are Aditya Agrawal of Wealthy.in and Nirmal Bari of PPFAS Mutual Fund. Now, I must say that PPFAS is one of the funds that has started offering some of these new concepts and these new options to investors via Gift City. So this promises to be a really, really interesting conversation. Thank you so much for joining us on the show, gentlemen. Welcome to both of you on the show.
Thanks, Surabhi. Pleasure to be here.
So, okay, I want to take a couple of steps back before we get started. And I think they say that the market is usually the best teacher. And Aditya, opening thoughts with you, because the market has taught the lesson of patience to Indian investors in the last 2 years. So why diversify?
Yeah.
And where to diversify? Let's start right there with the basics.
Right. I think we all often say, right, don't put all your eggs in one basket. I think that is something that we all understand even as kids. And if you even look at the theory of wealth creation, I think asset allocation is one word that we talk about a lot. And we ideally want assets that are uncorrelated. And we saw, for example, first what happened with gold and silver, and then we've been seeing for last 2 years that how global emerging markets and developed markets have outperformed India. Right. So I think that conversation that I should build a portfolio where I have as many assets as possible, which are uncorrelated to each other. I think that is something that, sort of has proven again itself to be the harbinger of wealth creation, and especially creating a portfolio that is sort of, that is able to test the test of all time. So I would say that's why, global as a theme has emerged very, very powerfully in last 2 years. And as we all know, ultimately investors pay attention to, returns in recent times.
Okay, all right. So lots of important and very important reasons that Aditya highlighted there. Diversification, de-risking your portfolio, looking at markets which are uncorrelated, and obviously developing a currency hedge as well, not holding all your assets in just one currency if it were to constantly depreciate. So these are some of the reasons why we need to look overseas. Let me bring in Nirmal as well. Nirmal, but let's face it, a lot of Indian investors end up doing things because they track price movements. So this whole conversation of investing in US tech really goes back to, I think, 23, 24, when, this creature called NVIDIA was capturing our imagination and the stock would just keep rising and rising. The NASDAQ was soaring. That's when a lot of Indian investors said, hey, I need to be in US tech. I need to have Apple and Facebook and so on and so forth. So let's start right there. Tell us why that is not the way to approach global markets, and how should one look at blending global exposure in their existing India portfolios?
One thing that clearly needs to be there when looking at global is that it should have a very long-term horizon. The investors, if they are looking at one particular stock and investing in that, and if they make some good money in the short term, they redeem, they'll be exposed to very high taxation in India. And short term, when I say it is not 1 year, it is 2 years when we look at global markets. So one should clearly have this. Equities anyways are a long-term product of 5 years or more. So build it as a part of your portfolio strategy, as a part of your overall allocation, rather than looking at one index, one stock over a shorter period of time.
Okay, very well said. And those are really important points that you've raised there, Nirmal, including taxation. Must always keep that in mind while we're planning our investments, anywhere, any asset class in any market. So let's get started. First and foremost, let's talk about the impediment. Now, not too many regular Indian mutual funds give us the option of investing in global stocks. Now, on this show, you've heard us tell you about those limits. So let's just quickly go over and revisit something that has been an RBI regulation for many, many years, Aditya, right?
That the CPU is back. And Jensen Huang said over and over again that CPU is back. And that was great for Intel. We knew it was great for AMD. Who thought it would be a direct play for ARM? And I think that ARM always had state license. But this is ARM doing something that frankly says, we're not the same company anymore, and you better wake up to our model changing.
They are going to be competing in some degree with some of their own customers, which is an interesting dynamic to think about the whole space, because now many of these companies are, in a sense, competing with their own customers too.
Well, that's something.
CPUs, GPUs, the CPUs, the whole thing.
Well, it was like when I talked to Sarah Fryer about aren't a lot of your investors your competitors and not necessarily your friends, or not necessarily friends of Microsoft? She said, yeah, you have to work things out. I will say this, but frenemies, but there is enough business for everybody because the CPU is in high demand. The Vera Rubin needs a lot of CPUs. That's the current generation, and NVIDIA is letting others do it. NVIDIA's got its hand. Remember, NVIDIA is focused on, I think, a lot on inference, which is that Grok licensing deal. I continue to come back and say we are avoiding talking about the company that is at the heart of the fourth industrial revolution, which is NVIDIA. But people are just saying, Jim, wait till the quarter. You're not going to get anybody buying NVIDIA to the quarter. I think if you wait till the quarter, you're going to pay 200.
Wow.
Yeah,
there it's moving up today. So NVIDIA, speaking of customers and competitors, NVIDIA is an investor in OpenAI. OpenAI buys a lot of chips from NVIDIA, which brings me back to Sarah Fryer, because I didn't want to move too quickly off of the Sora announcement, which is significant, which she talked about with you, Sarah Fryer did. Let's listen to what Sarah told you about ending Sora, and we can kick it on the other side. Here's Sarah Fryer last night with Jim.
On the Sora front first, the company, we're always looking at how do we stay focused, right? That is actually, I feel, the number one role of the CFO is focus and resource allocation. Many folks came and said, we don't have enough compute. We do have new models coming out. I can neither confirm nor deny the name, but it seems like you're getting close. In the April timeframe, it's going to drive even more agentic behavior.
Well, that's about this theme that is what I've always say about NVIDIA, which is that a lot of people say, NVIDIA, oh, that is artificial intelligence at its heart. Yet when you're with Jensen Huang, he always says now it's inference. And by the way, it's accelerated computing. You need their chips in order to be able to move fast enough. This Sora was burning it was burning your PC up. I mean, it's basically just saying, she has to say, listen, I need to take the scarce resource that is compute, which is NVIDIA, and I think they take everything from NVIDIA. I think they take everything NVIDIA would offer, and we got to be a part of it. Now, at the end of the day, you know these things, these zero-day options, which are kind of like putting a gun to your head? At the end of the day, between 3 and 4, they control the close. It's really rather odd. So anyone who wants to buy NVIDIA lower, just wait till 3 o'clock when the guys panic and they start blowing out the zero-day options. We don't talk enough about the flow of options and how nefarious they've become because they've been trumping common stock. The close of NVIDIA has been awful. A lot of that is zero-day option guys say who bought the 180s and in the stock's at $180.50, they got to blow them out. Watch 3 o'clock. The 3 o'clock sell-off of NVIDIA has been sickening.
You know what else happens at 3 o'clock?
A good show comes on.
Closing bell happens at 3 o'clock.
Kind of go, well, I can be vastly promotional.
Is it surprising to you that in just, 3 months, the Sora bye-bye? I mean, was it,
yes,
didn't Altman and Iger come on this program and talk about it?
But here's Needham,
in
Laura Martin.
December?
But Laura Martin says, OpenAI break up with Disney, fine-tuning estimates. She likes it. Saves Disney $1 billion in cash. No one needs to purchase OpenAI. Lowers AI-related anxiety of talent. I say Xanax, and if not, Klonopin.
That we were just showing a flashback
competition.
We were showing a flashback as you were reading that of Iger and Altman on this program. I think it was like, I don't know, mid-December. Wow. It wasn't that long ago. And they wrap it up. Disney's no longer doing the $1 billion investment. How quickly things can change.
Well, I think that when people want to demonstrate that they're committed to the anthropic way of business, which is business to business, one of the things you want to get rid of is something that just uses a huge amount of compute and doesn't make you any money. By the way, I think that they could raise the. When you think about what you could raise the price for, I think you could raise price Chat VT, and it would not. Chat is nuts. It would not slow down. I mean, I think they can raise the price. You can raise the price Netflix, you can raise the price Costco, and you can raise the price ChatGPT. That's how good ChatGPT's become.
We got a nice move in the NASDAQ this morning. You've been talking about, mega cap. Keep your eye on it. In fact, we are this morning, Jim. It's not just NVIDIA.
It's been a loser.
It's Amazon. It's Meta. I'll tell you what, though, the laggard continues to be Microsoft. I know we talked about it before.
They got to come on. Mr. Softy's got to come on. Tell you why it's still a buy. And I'm not just talking about co-pilot. I like to be pilot, by the way. I never like to be co-pilot. Listen, pilot. I am the signal. They are the noise. Have you noticed that?
We all take instructions from the tower back at Inglewood Cliffs, though, right?
But have you noticed, the tower, by the way, is what ServiceNow calls itself.
Yeah.
But isn't it interesting that when people are trying to express themselves, you always take, pencils up, pencils down. That was one I was using because the younger people were using. Yeah, they have great slogans. Younger people know what to say. And when I heard twice in 1 week that I was the noise and they were the signal, I said, I got to adopt that. I have no idea what it means, but I like it.
I'm looking at the
Matt
banks.
Murphy gave it to me. He said he's the signal.
I'm looking at the banks too, Jim, because I don't think you can talk. No, they're up today. I don't think you can talk about the market without talking about the banks. Just because, how can you have a stabilizing stock market if you have financial stocks like the big banks continue to go lower? I'm not talking about the private equity and private credit names, which are bouncing higher today too. But Goldman and J.P. Morgan and all those names have not traded well. They're having a nice morning now,
It is.
though.
I mean, I tell you that I think that they weren't trading well because have you seen an IPO of any size? How about a merger? Nothing because of Iran. These stocks might be trading up because people want to be in them because maybe the vast conflagration we talk about every day is over. Can you imagine where JP Morgan would be if Jamie was at all positive about anything? I mean, maybe like the 250th year. I mean, that's good, right? You got to get behind.
I think
that,
he was
right?
talking about AI taking jobs too. Which
Okay, so Steve Squeary this morning.
A lot of people are.
Steve Squeary this morning in his excellent chairman's letter in American Express, he's saying that it's allowing people to be much more productive, 30% more productive, no reason to lay off. Exactly contrary to Jack Dorsey at Square/Block/XYZ, who says that everybody's going to lay people off. Last I looked, American Express, pretty good company, started in 1850, still around. Stagecoach, yeah. But, really went there with the second industrial revolution and third. And maybe they're part of Jensen's revolution. I've changed that from fourth revolution.
I mean, but Bill McDermott scared the you-know-what out of people when he was on the network, what was it, just last week, saying that unemployment's going to be 30% for new college graduates because of AI?
People know how to pivot. I came out in one of the worst recessions, and I looked at people, and I just said, everybody found a way to get a job. You just don't make as much money.
Here, let's listen to what Jamie said about AI and jobs.
It is unbelievable, AI. It's coming. It's going to come quickly. Most technologies took a long time to roll in. The internet, electricity, tractors on farms, and society had a chance to adjust, move people to other jobs, and it did. It did quite well. I mean, look at the productivity of America from getting off of farms and electricity or something like that. This one may be quicker, and we know it's quicker. In fact, we're starting to see examples that can happen very quickly. So therefore, can we accommodate the people if they lose their jobs quick enough? And the answer is, again, I don't know that's going to happen. I think we can handle it. But if it happens to everybody, and all of a sudden it creates huge unemployment, that's a big problem for society. And I don't know the answer yet. You can't stick your head in the sand. It's going to happen, and if you don't do it here, it's going to happen overseas. So companies are going to have to compete, and the ones who stick their head in the sand will lose.
There's been no industrial revolution that hasn't created far more jobs than are lost. It does take between 10 and 15 years to start really accelerating. But there's no industrial revolution that has lost jobs. Why does this one lose jobs? Why? Do we think that people are just going to say, I'm going to go to school for $90,000 a year and I'm going to come out with no job and that's a terrific idea? I think that if I were worried about this stuff, I'd be worried about colleges. That's what I'd be worried about. Just like with NILs, the good big schools make it, and the other schools, they're shaking because people don't want a liberal arts degree because they didn't get to go to college to get stupid, to quote Sonny in Godfather.
There is this perspective, and it's been talked about since this whole AI thing sort of burst on the scene, of the idea of redeployment rather than removal of jobs. Now, obviously, you're going to have some level of jobs going away, that seats are filled by agents instead of human beings, but that people who have jobs will be just redeployed in other ways.
I want to work for Michael Intrader, my next life, at CoreWeave, as someone who screws things in, makes 300 Gs. Because I think Intrader needs to hire at CoreWeave, and I want to be able to have that skill. People know how to change. There is a level of adoption. Do people just keep going off the cliff like lemmings? No, you see, they have parents and they have student loans. And they say, listen, I'm going to go to engineering school. I mean, I got a history degree. My father was political science. My father said, now what are you going to do with that? Sell gift wrap like me? No, I'm going to cover a homicide in California and Florida.
Well, on that positive note,
thank you.
Before we head to break, it's time for the bond report. Let's check out how treasuries are faring this morning. That weak bond auction yesterday in the 2-year sent those yields higher, made people a little uncomfortable. Yields are down this morning, which is helping, I think, as well with the narrative. There's a 2-year back at 389, but certainly something to watch today as well. We're back after this.
$7 billion that overall mutual funds can't invest in global markets beyond $7 billion. This is a very old limit, isn't it?
Yeah, it is. So, even if you look back at history, as a country, we've always been a little bit cautious about our money flying abroad. right? And it's something that has stayed. Obviously, we live in a different world now. We are, as a country, we've become more powerful. We are, recognized as a world power now globally. But still, that limit is very paltry. So still, if you look at as a country, our mutual fund AUM is about $1 trillion now. But our mutual funds combined are only allowed to invest about $7 billion. And if you include ETFs, that's about $8 billion. So that's not even 1% of your industry's AUM that is allowed to be invested abroad. So I think those controls have remained. I think there have been talks about relaxing those limits. But I think instead of that, I think this gift city option, which is where through liberalized remittance scheme, you can actually remit money instead of remitting in the US, you're actually remitting to Gandhinagar, and from there it gets invested abroad. I think that's something probably a very welcome move that government has made, and simplified this whole international investing in last 7, 8, 10 years. So yeah, I would probably say that limit is probably here to stay, but I think government opened up another route to gift city products, and AMCs like Parag Parikh, DSP, Edelweiss have already launched retail products as well to allow people to invest abroad through the gift city.
Yeah. I must say, though, Parag Parikh Mutual Fund has been one of the early mutual funds that even within their regular India schemes, they were always taking some exposure in international stocks, and their early bets were in a lot of the US tech names, well before investing in US tech became fashionable. So compliments to the fund managers who've been picking those stocks rightly. But Nirmal, come in on this. And now here, let's get a little granular in terms of understanding markets as well. Now, if I look at the last 1 year, then the divergence between India and US is stark. Now, for the reference of viewers, in the last 1 year, the S&P 500 has gained about 20%. The Nasdaq has gained about 28%, and the Nifty has gained only 4%. So it's been a unbelievable year. We don't usually see such huge divergence. On a 5-year basis, the divergence is only 8-9%. The Nasdaq, for instance, is up 70% in the last 5 years. The Indian market, the Nifty, is up about 61-62%. So first and foremost, Nirmal, are we in an aberration phase right now? And if we are, then what would you tell investors? Investors tend to move in herds. So following US tech right now in terms of a sort of a bit of a herd mentality, could that be a risky strategy?
Are we in an aberration phase right now? The answer is clearly no. This is how the markets perform. Despite saying...
Vlad Tenev understands what gets these going. They're doing some interesting things in the market for pre-IPOs. And look, is the stock cheap? No, which is worries me. But Mark Benioff did a $25 billion. His stock is cheap.
This stock's never really cheap, is it? I mean,
no. I focus on the accelerated buyback of Salesforce because that's at the heart. That Adobe and ServiceNow are at the heart of what people are afraid of, extending even the private credit. The people don't realize that's what private credit. That's what people.
What was the Salesforce one, like 30? Was it 30?
Well, yeah, but he did the 25 accelerate. We don't know whether it finished or not. But Mark believes, and I've known Mark since 2007, and he's not naive.
Very much correlated and all. We have seen that over a period of time, except for very unusual periods like the 2008 global financial crisis or the 2020 pandemic, world markets tend to not move in tandem. So every year, if you look at the history, there is one or the other country which does superbly well, while there are other countries which are way below average. And that is what we have seen between US and India in the last 1.5 years, where Indian valuations have seen a time correction maybe, while US driven largely by the amount of investments that are going into AI and related sectors, have seen those companies surge.
Fair enough. Aditya, so let's get your take. A scientific way of diversifying the portfolio. How much would you allocate outside India right now? And I'm talking about, let's say, the pure equity component out of 100. How much would you keep in Indian equities right now? How much would you give to, say, US, any other geography? And within the US, should it be a broad diversified index like the S&P 500? Let's just go over thematically, in what proportion should we allocate the money?
Sure. So I think fundamentally core will remain India, simply because we are a country that is growing at 7.5%, and we have, by all accounts, we have 15, 20 years of growth ahead of us at a similar pace. So no other country in the world, no other broad index in the world, can sort of claim that. But at the same time, we have certain sectors which we are not exposed to. So I think global tech is one very clear area where, as a country, we have not been able to create those kind of companies and that kind of cash flow profitable businesses. So I think for me personally, and that's what I tell my closest friends as well, and wherever clients seek my advice, that you should limit your US exposure to between 10 to 20%. On slightly on the higher side, if you have plans of sending kids to the US, because as Nimal also said, there is you're protecting your money against the so there is a hedge
Currency.
to currency depreciation. But otherwise, and I would probably go all in only on just the tech sort of sector of the US, because that's one sector that we don't have exposure to. It's going to be highly volatile because it's like any other thematic fund that we have in our portfolio. So it's going to be very volatile. So it's not something that you can accumulate in one go, and you have to sort of pace it out a little bit, because there'll be buying opportunities, there'll be sometimes profit booking opportunities. So that's probably the only bet that I would take outside of the yes, and maybe not allocate more than 20%. Maybe start with 5, but maybe gradually take it up to 20% of my equity portion of my portfolio.
Okay. All right, got that.
Well, just the notion that Chevron's almost even be aware that that says that there's no deal.
I feel like you think like that right now is maybe one of, if not the most important.
Oh yeah, let's stop
stock, most important stock in the market.
Chevron's everything. That's just the only stock you need. Okay, so KB Homes. Well, I have a big meeting on Friday, my club, and I've been looking for down and outers. Every time you go for down and outer, you get a KB Homes. They didn't do the number. They didn't give you any real hope.
Cut their guidance, right?
Yeah, next thing you know, you say, "Geez, why did I buy that?" And it's a shame because there's value here. That's that's selling a little bit better on book value. It's always worked if you buy it around book value. The company's been buying it. But
you got to watch mortgage rates.
The war trumps everything because interest rates, and people don't feel like buying when it looks like things are terrible.
What do you got on that tonight?
Okay, I have Generac, which is all about data center now, data center power, and Paychex, which was up 4 in pre-market, is now unchanged. I urge people to be open-minded about whether there could be a deal, but more important, look for a coalition of the willing building. You need Britain, you need Saudis, you need other countries to come in. If not, then I think Chevron's right.
Market's a little bit of a fade right now. It's certainly not as
has
strong as it was right off the open. We're still nicely green though.
You don't want a shoot up. That fails.
I'll see everybody on the halftime report, obviously.
Last hour,
and then closing bell.
Last hour,
I'll watch that. I'll watch that. All right. We'll talk. Coming up, we are awaiting opinions today as well from the Supreme Court. Live picture there of the court. A decision on the case involving Fed Governor Lisa Cook could come today. We're back right after this.
That we do need to have some global exposure. The levels can vary, the choice of indices or markets can vary, but we need some global equity exposure. Now, the question is how? We're going to take a break. After we come back, the really interesting part. There are some regular Indian mutual funds that are taking money. We'll tell you which ones they are. But more importantly, a lot of Indian mutual funds are now exploring the route through Gift City, through which you can take exposure to global stocks. More about this after the break.
Let's talk money. Let's talk money.
Welcome back. You're with us on Let's Talk Money, and this week we are discussing how Gift City is emerging such an interesting route for us retail investors to look at investing in global equities, in global stocks. So let's get back to our conversation with Aditya Agarwal and Nirmal Bari. Both of them have been talking to us about the importance of global diversification. And now, Aditya, before we talk Gift City, first just recap for us these few funds in India that are still taking money, when it comes to global stocks.
Yeah, so there are actually very few. I think off the top of my head, the one fund that is taking money is the Axis Global Equity Fund of Fund, Global Equity Alpha. And it's something that, but it's such a dynamic environment that today one fund is taking money, and in a few days you will not find that that fund taking money. But one fund that we are seeing inflows on global scheme, global investing theme, is this Axis Global Equity allocation, which is called Global Equity Alpha Fund of Fund by Axis. And Axis, as you know, has launched this product in partnership with Stodders, which is a very well known and global asset management company. So that one fund is definitely taking money right now.
Okay. All right. I think we have a few other names on the screen as well. But again, I mean, these things can turn any day. Any day the funds can decide to switch off the tap. So make sure you check. Some of the names are on your screen. Now, gentlemen, let's talk about what Indian asset managers are doing in GIFT. Now, we need a global hub. And all kinds of, financial products are available in GIFT. But just explain to viewers of this show, they can take part in global markets.
Sure. So that's a great question. The first thing is that till last year, about a year back, all the FMEs, the fund management entities that are present in GIFT City, instead of AMCs, they are called FMEs. They had the option of launching only an AIF, where the minimum ticket size was $150,000 US, which made the accessibility very limited. Now, last year, the new FME regulations came in, which provided sufficient clarity on retail funds. And after that, there was some tax clarity which came in last year in the month of April. Post that, quite a few FMEs have started making a move towards launching retail funds. We have also launched a couple of them in the last month as well. Now, what a retail fund is basically for to simply put, it is the counterpart of mutual funds in India. It has similar
Hello and welcome. You're watching Global Lens with me, Ashmit Kumar. Now on to the latest. There are no signs of de-escalation in the West Asia conflict. Drones and missiles continue to cause destruction across the region, and that's coming amidst the US President Donald Trump's claim that Iran wants a deal badly. The US and Israel continue to bomb Iran while Iran fires several missiles towards Israel. Bahrain and Saudi Arabia have intercepted Iranian missiles while a fire erupted at the Kuwaiti airport after a drone attack. As per the Wall Street Journal, the US has proposed a 15-point peace plan to end this conflict with Iran. Moreover, Turkey, Egypt and Pakistan have been pushing for a peace talk in Islamabad. An Iranian military spokesperson who had previously ridiculed Trump, saying that he is fired, has yet again mocked Trump, saying that he is negotiating with himself. He further said that Iran will never come to terms with US and added that the US investments in the region and pre-war energy prices will not return until Washington accepts that regional stability is ensured. Iranian leadership said that it cannot negotiate with the US as Washington has attacked the country twice during high-level negotiations in the last 2 years. Another report has quoted sources as saying that the US is planning to deploy between 1,000 to 3,000 soldiers in the Middle East. However, US officials say that no decision on boots on the ground has been made just yet. Meanwhile, crude oil prices fall over optimism around talks with Iran. Further, Iran told United Nations Maritime Agency that non-hostile ships can pass safely from the Strait of Hormuz and will remain closed for the US and Israeli ships. Well, earlier in the day, I spoke to Israeli ambassador to India, Reuven Azar, about President Trump's comments on Iran and the proposed 15-point peace plan.
Negotiations. I think that we've seen these 15 points that were released. We have a good opening for having more stability, restore stability in our region.
Have you managed to convey a sense of red lines that Israel has that it will not be willing to settle without?
Yes, of course. We have mentioned them at the beginning of this operation, and they continue that path. So I think that the fact that these capabilities are being created are conducive to the diplomatic effort.
And even as we speak of conversations, your defense minister had said that the Operation Fury will continue with its full intensity. Is it possible to have negotiations as well as conversations at the same time, or does Israel believe that only a military solution will yield the desired results?
First of all, it's possible because that's exactly what we're doing. This is happening as we speak.
Okay.
We have a continuation of our military activity and we have negotiations in parallel.
Well, that's the Israeli ambassador telling us that it's possible to fight and talk at the same time. In fact, to help us understand, decode, unpack some of these moving parts, we have with us joining now for the discussion forward, we have with us Sanjay Pulipaka. He's the chairperson of Pulitea Research Foundation. Also with us, Ambassador Dogra, Rajiv Dogra, as well as Ambassador Ashok Sajjanhar, joining us now for this discussion. Gentlemen, thank you so much for being a part of this conversation. Ambassador Dogra, coming to you first. What do you make of Trump's peace talk plan and the 15-point agenda that has been sent across to Tehran?
Once in his life, Trump means what he says. But unfortunately, that assumption would be far off the mark because Trump never means what he says. He thinks he can deceive Iranians and get away with his actual plans. Because if you look at the 15-point plan that he has advanced, none of them, almost none of them would be acceptable to Iran. He wants it longer. He also wants guarantees from Iran that it will never again attack Iranian neighbors and so on. None of that is going to be acceptable. So the point is, why is he putting forward plans that he knows Iran will reject? The only thing is a ruse. As you said very rightly, there is also a elite marine party which is already on its way to somewhere near Iran. There are also rumors that Israel will also pitch in with its own elite soldiers. Perhaps Saudi Arabia may also send some troops. So if all this happens, they could have something around 15,000 instead of 1,000 or 3,000. But even that would be a force for slaughter by Iranians. Iranian army by itself exceeds 500,000 people, and they are committed. They know what their mission is and what their nationalism means. Whereas the soldiers from the separate countries and without any clear objective except seizing the Kurg island are bound to have a tough time fighting the Iranians. So Trump may have his plans, Trump may have his deception in terms of negotiating, but I really doubt whether he is going to succeed because for the first time in his life, he's met an adversary which is determined and which so far has been giving him blow for the blow that it receives.
Ambassador Dogra, let me also then ask you a follow-up question. Joe Kent, who recently resigned from his position in the United States, said that there is no resolution possible without Israel coming on board. Now, Israel is quite clear. We've heard from the ambassador to India that the red line is clear as far as Israel is concerned. No nuclear missiles, no missile program, no missile capabilities as well. None of these two conditions will be acceptable to Iran, who have put out their own list. And these two conditions sit right at the top, saying that their nuclear program should be allowed to continue, that their missile program should be allowed to continue. Again, the fact that Israel is a part of these conversations, do you see Israel playing the role of an active facilitator or perhaps coming in the way of any meaningful resolution between the US and Iran?
Well, Israel started it all. Israel is the one which provided the spark, which pushed America into this. Some say because of some hold they have on Trump. But whatever it is, everyone knows that it is Israel that made America get into this almost unwinnable war. At this stage, Israel, and I should correct myself, it's not Israel, it's Netanyahu, because Israeli people are tired of war, especially the failed one against Hamas. They have not been able to wipe out Hamas leadership so far, the new leadership. Hamas continues to operate, maybe in a much low-key fashion, but it is there. And Iran is a much bigger force. And Iran is a force which is giving Israel a bloody nose. And people are tired of daily bombings. So Netanyahu has a personal stake in this war continuing because otherwise he'll be in jail. The moment he's stripped of prime ministership, which is quite likely in case the war fails, he'll be in jail. So Netanyahu is a rigid man who refuses to accept the larger welfare of his country.
Ambassador Dogra also joining us on this conversation here with us is Ambassador Ashok Sajjanhar. Ambassador Sajjanhar, let me come to you and let me get you in on the dynamic of US deploying troops in the region. There are very credible media reports. The numbers, of course, vary anywhere between 1,000 to 5,000, depending on which resource you're tracking. But nonetheless, there is a certain movement of US troops. Do you see this perhaps as only a delaying tactic by Donald Trump to ensure that there is enough time and room available for deploying of troops on the ground, boots on the ground?
Yeah, thank you very much, Asmit. I think right at the beginning, Mr. Trump had said that he was not really considering deploying troops on the ground because I think whatever are the position of the MAGA base and, whatever has been the past experience of the United States in getting involved in these very long duration wars, whether it's in Vietnam or it's in Afghanistan or Iraq or elsewhere. So I think there is no great appetite for getting more troops on the ground. And definitely, one of the conditions, one of the attractions of Mr. Trump when he came to power was his base doesn't want this involvement and these forever wars. So I would have, and sending, whether it's 3,000 or even if you make it a total of 15,000, it doesn't make much of a difference because, here you have a country of 92 million people, you have an army of 500,000, you have the IRGC, which seems to be ruling the roost at the moment of 2,000, and, the Basij militia is also there. So they have adequate number of hands, and these troops, they don't have a single command. They have not operated in under a single command. So if they're coming from disparate sources, disparate training, disparate capabilities, and they're unfamiliar with the terrain of Iran, because in the west of Iran it is all very mountainous. That is how Iranians have been able to hide their missiles and have the missile cities under those hills. So I think it is not an workable exercise. I know that there are reports which seem to suggest that he's just buying time, 5 days and all. My own view is that he desperately wants to get out of this conflict, because he has found that it has become, number one, a war of attrition. Number two, it is a quagmire, from which he is finding it himself very difficult to extricate. So he's trying all these methods, getting 5 days and saying that, he's in conversation with a dialogue with the Iranians.
Right.
But I don't think it is leading anywhere very substantive.
Ambassador Sajjan, in the same breath, there are also reports emerging which suggest that perhaps sometime this week there may even be in-person meetings take place in Islamabad being hosted in Pakistan. Do you see these reports as credible? There are reports that Iran only wants to talk to J.D. Vance, that they want to enter some kind of conversation, and perhaps alluding to that is the concession that we saw this morning by Iran that non-hostile ships can sail through the Strait of Hormuz. Do you see that meeting take place in Islamabad? And if it does, what could be the implications of such a negotiation, such a meeting?
Yeah, 2 points. Number one, I think as far as Strait of Hormuz is concerned, I think Iran has always maintained, number one, it has said it has never been closed. And, ships can go through it. But of course, their passage is not safe. And one of the most important reasons why ships are not sailing through is because the insurance companies will not insure their cargo and their transit through the Strait of Hormuz. And it has been maintaining for quite some time, the Indian ships were able to come out, not 2, 3, I think at least 5 of them have transited through the Strait of Hormuz. So it's not the first time that Iran is saying. But that having been said, I think we also need to recognize, notwithstanding all the bravado that we've been hearing from the IRGC, that Mr. Trump must be talking to himself, because there is no talks that are going on between any of the negotiators from Iran. But I think Iran would also be desperately in need of some sort of an exit, because it has suffered huge punishment. Now the credible reports might not be available in terms of what is the stock of missiles and launchers and others, drones that Iran has. But we definitely know that its missile stocks would definitely have come down. The reports which seem to suggest 90% have come down. And the second is, in terms of the damage that it has suffered, not only to its military establishments, but even to its civilian areas, to its economic infrastructure. So I'm sure it must be wanting some way out, so that there can be peace, there can be security, stability, so that it can shore up, whatever punishment that it has received relentlessly from both Israel and the United States over the last 25, 26 days.
Right. Let's also get Mr. Pulipaka in on this conversation. Mr. Pulipaka, the fact that Iran has now said that non-hostile ships can sail through the Strait of Hormuz, does that indicate to you that there is some amount of appetite within the IRGC to allow some concessions to take this conversation forward, to take these negotiations forward?
Indeed, I would think so. One of the ways of looking at this is that negotiations are successful when both parties feel that they have reached a stalemate which is mutually hurting, and both of them start looking for an off-ramp. I think we are getting there in a way. See, Iran can claim that, look, we have survived as a regime despite almost a month of brutal bombing from Americans and the Israelis. So that's one victory they can claim. Second, as you pointed out just now, they can claim that they have a capacity to stop the flow of energy and goods through Straits of Hormuz. And the fact that they are saying non-hostile ships can go through Straits of Hormuz is again a message to the world that we are still in control of these waters. And the other thing that they can claim also is that this war has not only inflicted pain on Iran, but it has also inflicted pain on regional economies, destroyed the image of some of these countries as safe investment zones, and more importantly, has transmitted pain across the global economy. So Iran can claim that. And of course, the Israelis can also claim that their war objectives have been achieved. For instance, they can say that Iranian nuclear program has been irreversibly pushed back by a few decades, that their missile equipment has been destroyed completely, and perhaps they will hope that this economic destruction that has happened in Iran and the elimination of top leadership in Iran will create conditions for regime instability in near future. So the conditions are ripe, but we need to wait and see. Or maybe if you talk like a brutal pragmatist, perhaps United States is hoping to bolster presence for a new attack.
Fair enough. On that note, let's slip into a very short break, but we'll continue our focus on West Asia on the other side. Keep watching. Welcome back. We're continuing our focus on West Asia. We have with us Mr. Sanjay Pulipaka, the chairperson of Politia Research Foundation. Also with us, Ambassador Rajiv Dogra. Also with us, Ambassador Ashok Sajanhar. Ambassador Dogra, let me come to you. The situation that we find ourselves in, as far as especially the Gulf states are concerned, do you see them? Have they managed to cross a red line? Has Iran crossed a red line with these states to a point where the Gulf states will want to seek some amount of retribution? We've seen statements coming in from countries like Saudi that they reserve the right to self-defense. Or do you see them as active participants in some form of resolution between US and Iran?
Certainly, I'll come to that. But let me just refer back to the Strait of Hormuz and Iran letting non-combatant countries' ships to pass through. My interpretation would be that Iran does not want these ships to be there when fighting breaks out. And I think if that is the intention behind letting them pass through, it's a positive sign that Iran does not want unnecessary casualties of civilians, of people who are on board, people who are out of water and food. So that interpretation may be close to what is Iran's intention. As far as the red lines are concerned, Iran did not start the war. So Gulf states do not have any reason to say that these are our red lines. Iran is crossing or about to cross or has crossed, because some of the Gulf states were active instigators of this war. Saudi Arabia, for example, there are reports that the Saudi Crown Prince kept on goading, kept on ringing Trump and telling him to continue with his mission of attacking Iran. So now they cannot claim that, no, that is past, let's talk about future. The other thing is, reports are coming in even now that Saudi Arabia has offered one of its air bases for USA to launch attack on Iran. UAE already has been accused by Iran multiple times or that its facilities were being used for attack on Iran. So red lines, are mutual. Iran can claim that too many red lines have been crossed by some of the Gulf states. So rather than that, I think it is necessary for the rulers of Gulf states also to listen to the sentiment of their people and contrast this with the sentiment of Iranian people as per the reports that are coming out. We may be wrong, but it seems national pride has taken precedence over their dislike of the regime or their fear of the regime. So the status now is that in Gulf states, people are at a variation with the rulers. In Iran, they have for the moment joined in to stand with the rulers.
Ambassador Sajjan Har, one closing comment to you as well, that in terms of one of the demands coming in from Iran has been removal of US air bases from the Gulf. Despite all the action that we've seen over the last 20 odd days, do you see the Gulf countries agreeing for removal of US bases? Will they be happy to see these bases go? These bases, many said, have painted the Gulf countries as legitimate targets as far as Iran is concerned.
No, I don't think so. I think the first, the whole rationale, the raison d'etre of this basis here was because the relations between Iran and the Gulf states are not good. And it was basically to protect and to provide security to the Gulf states from Iran, from a belligerent and, aggressive Iran that they had wanted these. And also, I don't know how accurate it would be really, because the reports that I seem to have followed and read is that all these states had told the United States not to engage in an armed conflict with Iran because it was going to have, they would have to suffer the collateral damage because they have the military bases, the military assets of the United States. And Iran had very categorically stated that if this attack takes place on them, then they are going to fire at them, but attack them. But I think what Iran has done it has gone much way beyond what it might have threatened earlier, because it has not only hit at these bases, there has not only been a collateral damage there, but it has hit out at the airports, it has hit out at the refineries, it has hit out at the pipelines, the Ras Tanura refinery, 550,000 barrels of oil a day, even on Red Sea. There's no military base in Yanbu or anywhere else. Even as far as Ras Laffan, this refinery, gas refinery in Qatar. So the point is that, in my view, these states are saying it is not our war. We have not asked, we have in fact been telling the United States not to engage in this war. And I feel that, the report that had come out in Washington Post, which seemed to suggest that MBS had been telling the United States to, go after Iran, I don't think it was actually accurate. So the countries are also seething with rage and anger, in my view, against Iran for what it has done.
To thank all of our panelists for joining us, sharing their insights, Ambassador Dogra, Ambassador Sajjan Har, as well as Mr. Pulipaka for joining us and sharing your insights. But that, unfortunately, is all the time that we have. News and updates will continue right here on CNBC TV 18.
Hello and welcome to India Business Hour. I'm Ashmit Kumar. Here are the headlines that we're tracking this evening. The Americans are negotiating with themselves. Iran's military mocks President Trump's claims of talks with the top official in Tehran. Reports say that White House has sent a 15-point ceasefire proposal. President Trump insists that U.S. is negotiating with the right people. Iranian speaker warns that Tehran was closely monitoring all U.S. movements in the region, especially troop deployment. Brent cruise continues to hover around the $100 mark. Iran signals safe passage for non-hostile ships through the Strait of Hormuz once again. President Trump claims he received a very big gift from Iran related to the Hormuz Strait, but does not elaborate any further. Drones and missiles continue to wreak havoc across the Gulf as attacks continue unabated. An Iranian official tells Reuters that Pakistan or Turkey could host the talks with the United States, but Tehran remains skeptical of the offer and fears a ground invasion as thousands of U.S. troops head towards the region. Sensex and Nifty regain more lost